And there we are. Good morning, Jason.
Wake up, Lou. Nap time's over, buddy.
I had weird people whispering right here, right? How you doing?
Absolutely. I'm fantastic. And I'm looking forward to spending the next 2 hours here with you, answering Motley Fool member and YouTube streamers' questions.
2 hours?
Yeah, 2.
I got to call my agent. All right, fools. Good morning. Welcome. Here we are. He's Jason Hall. I'm Lou Whiteman. We are here and streaming to the world with YouTube. We're here to take your questions, to kind of give our opinions, to give our thoughts on things. We're not here to provide individualized financial advice. You know that by now, but it's still worth saying it. The scroll is going to say it if not. We're also here. We will, of course, be providing live commentary on Plymouth Argyle's visit to Watford starting at the bottom of the hour, but that's mostly Jason.
It's not Jason.
Well, that's a shame. All right. We're here to talk. Jason, I always say this, but it's really nice to have the weekend where the market is not trading, where, some weeks you can just tune it out completely and not think of it at all, but also maybe take a pause and reflect on the week that was and kind of what we learned, what we didn't learn, what we still don't know. Markets were down mildly for the week. S&P was down 1.5%. That is the 5th red week out of 6. We are still not, though. We have to go back a few years to find 6 red weeks in a row. We still haven't done that. Bitcoin did get a boost this week at least. But as always, Jason, I'm going to start out. I'm going to share, and we can kind of talk about what the Motley Fool's weekly review said. I could run through it real quick, and we don't have to hit on any of these things, but I think these are sort of the interesting things for the week. So, Lauren, I went ahead and shared that if you see it, and we can, So the big thing, and I don't know, so tariffs, I had to Google it, but apparently tariffs are a thing now, Jason. It's a great quote from a Bernstein analyst. Tesla wins, Detroit bleeds. And kind of with, just kind of where vehicles are assembled. Note that's not the whole story. As Elon said, Tesla is not unscathed. They do have parts that come in from overseas. And of course, Jason, you forgot. Yeah, there you go. You got it.
Well, I
Yeah.
mean, unscathed and far less disadvantaged than literally the entire rest of the industry are two very, very different things.
Yeah, yeah, and also, of course, if there's one brand that may feel it the other way on the reciprocal tariffs, I think that might be where
Absolutely.
Tesla
Yeah,
comes in.
I mean, that's a good point. So, I mean, a lot of what we talked about so far, before we move on to Kindle, Lou, with the tariff story, so far is the tariffs that the Trump administration is placing on imports into the United States. The reciprocal tariffs have been slower and far more targeted. And I think we're going to see some, and we've already seen that in a few instances. For example, where tariffs have been placed on specific goods that happen to be produced in states that overwhelmingly voted in support of President Trump. So it's going to be interesting to see how this plays out. And again, this is not a political show. We're not going to weigh in with
But it is what it is.
exactly. I mean, there are investing implications to at least be aware of, even though we're just trying to navigate the environment, and it kind of is what it is.
Right.
But I would expect that Tesla, in whatever ways that it can be, it's probably going to be targeted very, very highly because of Elon Musk's direct involvement in the administration.
Right. I mean, look, 4 years ago, they taxed bourbon because Mitch McConnell was the Senate Majority Leader. I think it's fair to say that if you've had a TV on in the last few months and you want to attack a company based on what's going on in the White House, and again, not political, but that, if you figured out bourbon for the Kentucky senator, you might stumble on the Tesla this time around. Fair?
Right. No,
Yeah.
Exactly.
Yeah. Yeah. It's just going around the world, and we can deep dive on any of these. And fools, get your questions in at Slido Fool 24. Kindle had a week, huh? Kind of really interesting short report, and not that interesting. The one thing, make sure fools look and read. Kindle did do. It's always curious to read how cagey companies are in response to this. Kindle was not cagey at all. Rejects in the strongest possible terms the conclusions reached within the report, which was clearly designed to manipulate the company's stock for short sellers' benefits, and noting that Gotham City Research, the company in question, didn't even contact them beforehand, which is kind of always that's a sign for me. In a way, they don't do that because they want the element of surprise, but yeah, so we'll see. Tom Gardner had some really interesting comments for those who are invested along with Tom in this that you can click to that Tom made. And again, we don't judge these things because we're not inside the room. We don't know exactly what's going on, but we can use principle, and we can talk about this later. We can use foolish principles and things that we take to all investing and apply it here, and maybe avoid damage.
Well, there's a key word in there in Tom's response: diversified portfolio.
Yes,
position sizing really matters with businesses broadly because of these unknowns, to use that recently overused term on here. Position sizing helps manage the risk of those sorts of things. So, all right, Lulu.
Lulu looking stretched. You get it? You see what's done there? But here, I mean, I think we all know the earnings, but again, Jim Gillies, just interesting comment. And, this is, I don't think Jim meant this as a permanent thing, but a reflection of what's going on. The market, this might be the market coming to terms with the idea that the high growth part of this story could be over. Which I think if you're a Lulu long, that is sort of the big question here. Not that it's, this is suddenly a bad company, or, they suddenly don't know what they're doing anymore, but, suddenly they're growing 7 to 8% and not 40%. And a lot of that is from here, can they grow international revenue? US is still 3/4 of this pie, but it's just not growing the same way international is. You either have to figure out how to grow the big part to have that move the overall needle, or make the part that is growing a much bigger part of the whole. That will at best take time. And so
Yep.
Lululemon,
And we can talk more about Lulu as we
yeah.
go through the hour too.
Yeah. Chewy, meanwhile, look, Chewy, congratulations. It wasn't negative. I think that's kind of the takeaway from Chewy earnings. They added 2% more active customers. That versus not adding last time. The big thing here, though, there are limits, natural limits to how many customers Chewy can get is what they can get out of their customers. Net annual sales per active customer were up. Auto ship is now more 80% of the business. Tim Beyers on Motley Fool Money had a great little thing talking about kind of an interesting comparison, I think, comparing what Chewy's doing with the veterinary business to what Warby Parker was able to do by putting retail locations in malls and kind of just an online business becoming a little more omni-channel to get touch points with the customer. I think that's an interesting comparison. I mean, veterinary care, it's kind of a lot to do in a way, but if they can kind of add this to the mix and just make themselves all the more, their goal here is for the customers they have to be their everything. And
I had a bit of an epiphany, Lou, about Chewy yesterday, and I'll share it later in the show as we talk through some of these things in a little more depth. But there's such value for these businesses when you're starting as a clean sheet, like Chewy was and Warby Parker was, versus some of the legacy competitors, especially for Chewy coming up against Petco in this environment where you build from the internet out versus from the retail footprint in. And I'll share, just to foreshadow what we'll talk about. I think they want to be more like a Costco / Amazon with the subscription recurring revenue stickiness. And then we'll talk about the vet business and how I think it plays into that.
I thought we were just going to share dog pictures. So, oh well.
Well, obviously, I mean, it's an and, Lou. It's not an
for
or.
ratings, right? Yeah. Well, yeah. What is this? A pharmaceutical ad? It's going to be all dogs, right? All right. One more to get to before we can dive deep. There was an IPO yesterday, Jason, and it was, I think one of the most anticipated IPOs we had. CoreWeave. They are AI adjacent in the middle of AI. And the debut wasn't what people had hoped. They had targeted 47 to 55. They went out at 40, slipped to 39, cost about $9 billion in valuation. And of course, the question now is how to read this. There is a argument to be made like, yeah, you see it post DeepSeek, AI is done, or AI is less done, less there. I mean, this was a company that, Microsoft is a huge single customer, so there is some risk there. It is an unprofitable startup in a market with risk, but also it's really hard to say how much of this is AI and how much of this is the broader market. As newsletter notes, this is the third big IPO bomb of the year. Venture Global and SailPoint both remain below their offer prices. So this is not an isolated thing. I think that CoreWeave is a unique company, and maybe we can read through that just anything AI doesn't just go to the moon. That doesn't mean investors are done with AI, but it is just a weird market to get into. We can get into that in Fools, and I'll drop the link for this into the chat, or Corey, I'll give it to you if you could do that, just because I know people said they had trouble finding it last week, but we are at the end of the quarter, Jason. The S&P 500 is heading towards its worst quarter since 2022. Kind of, it's, I think, a good time for a sentiment check. So, how are you feeling right now? Aggressive, moderate, or cautious? I'm really curious. We got 10 votes already, and this has only been up for a couple minutes. So, fools, get your votes in there. Like, what are we doing now based on this? And that's another way of saying the first quarter was down. Are we expecting the second quarter to be down, kind of, because, or is it time to go all in? Is it time to just be cautious? Very curious what people are thinking right now as they sort of address the market in these conditions. All right, Jason. A lot to offer. Fools, get in. We don't have to talk about any of this, but Jason, I'm going to throw that at you first. Where are you on that sentiment chart right now? It's are you looking for aggressive stocks, moderate, or are you cautious right now with this, kind of with where we are right now?
So I've talked about it before, Lou. Part of my natural inclination as a human, as a person, is I'm always expecting the next shoe to drop, right? I'm always expecting the economy to go bad in the next year, to go like we're always a quarter from the next recession. I'm kind of wired that way. Like I'm very long-term optimistic, but I'm short-term always suspicious that the economy is about to crash. So I've had to like rewire and build my investing frameworks in such a way that I invest despite that, because it can lead you down the path of hoarding cash and always waiting to try to buy at the perfect time. Um, so um, so as a result, I have really become laser focused around two things. Number one, really focusing on the long term and investing in companies, uh, not looking past potential short term implications and risks, but really focusing on the value, today's valuation, and thinking about a long-term outcome. And it's kind of allowed me to get better outcomes, but also having some rules around having some cash, and when I deploy that cash, that do help me take advantage of the periods like we've gone through, where we have gone through a little bit of a sell-off in the market, and that I don't know what's going to happen over the long term. So from a sentiment perspective, I've started to accumulate stocks that are more cyclical and maybe more volatile over the past couple of months, because the market has been down more, I think is a starting point. So when the market does go down, we get a 5% or a 10% sell-off, and the S&P barely broke that 10% threshold about a week and a half ago, and it's recovered and kind of bounced around since then. That triggered one of my pseudo rules around deploying some of my cash. And I invested primarily, I invested that cash in home builders. Even though 2025 looks like it could be good, mediocre, or awful, right? Depending on so many outcomes that are unpredictable at this moment. Because I do see the trends are so favorable, and we're still so many millions of homes underbuilt, particularly in the markets where those where people are moving to, where the migration trends are very favorable, the economic growth trends are very favorable. And I mean, it's a situation where we could have, another 500,000, 750,000 homes start getting listed for sale, and it doesn't solve the housing problem because the housing is dislocated from where the demand is, right? So I think that demand is really strong there. So that's a long way to answer this question. And that I don't think now is a time for me to be buying conservative stocks, because we've seen a lot of those more conservative blue chip stocks trade for premium valuations, because a lot of investors have moved to them, looking at them as safe investments. Costco, for example, even though Costco stock is down since it reported earnings, the earnings multiple is so much higher than it's been for really any time over the past 15 years. Over the past year and a half, that earnings multiple has just continued to run up. And I think that actually creates more risk, not the risk of losses necessarily, but the risk of underperformance. And I'm not going to buy a stock just because it's safe and going to underperform. I'm going to buy a stock because it's going to do something for my portfolio that I can't get from an index fund, right? And either it's going to have a high probability of outperforming, or it's going to generate a consistent high dividend yield, and they're going to be able to grow that yield over time, that across market environments is going to give me an adequate rate of return that can be better than bonds, maybe better than the market in different environments, but probably around the market at most periods. And I don't see the idea of buying quote unquote safe stocks is a safe idea for me. Where are you?
Yeah, it's funny because there's a nuance here that I think is I mean, not only is it hard to articulate, it's kind of hard to follow at times. So, like, it's not just that,
it's squishy.
Well, I can't explain it to you, Rubes. I can't explain it to myself, but, I both want to be long-term focused and not time the market, but I do believe that a lot of the companies that I invest in, there are times to invest in them and times not to, because especially these industrial businesses, like you say, the ones that are kind of tied to a cycle, there are just better times to get in. That because you're not likely to see an Nvidia sort of, up 100%, up 200% whatever it is. So yeah, I do think, and I honestly don't think we're there yet, but I do sort of look at times like this to be a little more opportunistic. Truthfully though, and you know this, I mean, for me personally, I'm in income generation mode right now, just for a brief period, just while I try and raise my cash for just life events. And you know, so in a way, this plays. Look, I might have end up being the luckiest person alive, because I was selling off parts of big winners in like bleeding edge categories most of the end of last year to buy kind of out of favor, kind of more just dividendy income stocks, not because I was making a market call, but just because that's what I needed for my
Right. It was an asset allocation move.
Right. So that might end up being like, you know, I mean, I can get a YouTube channel out of that, Jason. Talk about how I called it later, but no, truthfully, it's just what I need to do. But I do think that right now, it feels like we could enter a time when, for me, I want to be more aggressive, but aggressive with sort of my boring old stocks, not aggressive as in, let's see what 37 quantum computing companies I can get, you know? But yeah, so it's both. Fools don't try and time the market, and look at me, I'm thinking it might be almost time time to time the markets. But I do think both can exist. I'm much more interested in kind of for the cyclical companies who are tracking the cycle, and just being honest about what the cycle is with these companies.
I'm trying to wrap my head around the Elon Musk, Twitter, formerly Twitter. Can we say X, nay Twitter? Can we do it that way?
Yeah, let's just call it Twitter.
There you go. Okay, yeah. Twitter being acquired by XAI, which is Musk's AI company.
Or his son? I don't know. Anyway, yeah.
Well, right. To be clear, we're not talking about his child that is literally named the letter X.
Yes.
Is that right?
Yeah. I don't think we're talking about that. But anyway, who knows? The AI company and the Twitterish company, the company that the artist formerly known as Twitter.
There you go. Love it. Yeah. So Ed's question, what do you think of Musk buying X for his AI company, or using the AI company to acquire X? I think there's a couple of things that could be going on. I think the first thing is its consolidation of his interests, because we know that Twitter with Grok is using AI, and of his businesses, it's the two that do most fit together in terms of tech companies thinking about the employee base, engineers, coding, that they do kind of fit together to some degree, right? From the idea of R&D spend and building AI.
Put it this way, it's much less clear to me that you need to tweet to get to the Mars. So yeah,
right.
As far as these companies go, yes, there's much more of a overlap there.
Yeah. Right. So social media responses don't charge the batteries in your car. So there's no doubt about it. There's also the possibility that this is a way to start further leveraging his business interests for more money directly, because Musk generally hasn't sold down much of his interests in the companies that he owns. He's used them to get loans, right? That's how he's monetized those investments largely.
Right.
And there are some expectations that maybe that's what he's done. We've seen Tesla's stock price come down. It's still extremely, extremely valuable company, but it's come down substantially from the high over the past year. I think it's actually down over the past 3 years. And could there be some concerns about capital calls? Lou?
There could. Look, it's really hard to do the math here. Fools, what Jason's talking about is that, yes, Musk has pledged a lot of his stock as collateral to raise cash to buy Twitter, to do other things, to kind of live. And at some part, is there margin calls there? I think that's all true. I also think if you spend too much time online and you're seeing too many Tesla Q people, as they call themselves, the kind of crowd that has been that was short Tesla before it was cool. I do think that some of that falls under sort of fan fiction, the idea of like, oh, at 240 he's got to be liquidated, or at 210. So I think it's overstated, but I do think that there's probably a level where that factors in. And so just kind of, if I was advising him, I would be trying to look for alternatives, because you don't want to be called flat-footed. So anyway, continue.
No, but I think that largely it's just a combination of combining businesses that probably do, because we do know, Lou, that Musk does share particularly employee resources across companies that he owns. So combining those two businesses together probably makes it a little cleaner with utilizing resources. And I do think it probably is just a little bit of consolidating some of his asset base, and potentially something around managing his access to capital, as much as anything. Now, the question, of course, what are the investing implications of that? Because I think that's kind of the key, is if you're a Tesla shareholder, or if you're interested in Tesla as a potential investment, having a more focused Musk who's less worried about access to liquidity is good for you, right? Is good for Tesla, and Tesla's future, which, right now the concentrated risk is the auto business, right? Because we've seen it struggle. Let's be clear here. The struggles that we saw over the prior year had nothing to do with politics. It was a mature business that was still growing, but it had reached a level of maturity of its sales and its scale that the entire EV market got soft and weak, and Tesla went through a period of modest sales declines, right? What we've seen over the past several months is clearly a political reaction. There's no, if you look at what's happening in Germany and Europe particularly, it's clearly a political reaction. Maybe we're seeing the same thing in California. It's less clear, but we do know that based on records of the car registrations coming out of California, Tesla registrations are way down, like double digits, at a period when most of its competitors are up like 1 or 2%, right? So again, try not to extrapolate too much, because this is an investing show, not political commentary, but we are certainly seeing some near-term reaction to Musk's involvement in politics. But the thing to remember, China sales are down like by half, Lou, I believe.
Right.
That's not political.
Right.
That's BYD and other Chinese automakers that are producing cars that are cheaper and consumers are very happy with. And we saw with BYD's announcement, maybe technologically more advanced in certain ways. And let's be honest, most people would prefer to buy the domestic brand if they can buy the domestic brand, right? I think that's part of human nature, our natural tribalism. So all of those things are happening. And why does all of that matter? Because Tesla's broader ambitions are not to be a company making cars and selling cars to people. It's a company making autonomous transportation that's a service, that's a fleet. A company that's developing AI-powered humanoid robots that are distributed across industrial, commercial applications, in a market that could be worth trillions of dollars. A Tesla that's more and more in the integrated energy for power production through solar and energy storage with its battery business, which, by the way, the battery business is actually doing pretty good. The utility scale energy storage and even the home storage business is going pretty good. So the key, though, Lou, is Tesla is depending on selling more Model X's and Model 3s and Model S's, and to some extent the Model X, to fund that, right? That's the profits that are going to derive to be able to fund all of those other things. And that's looking more and more challenged. Whether all the political stuff proves to be anything more than just a speed bump, which, I mean, that's probably my expectation, is that humans are fickle and we get distracted pretty easy. And right now it's loud in the moment. And at some point, all of that kind of falls to the wayside, whether it's months or, a year or two down the road. But Tesla does have some real challenges with its auto business right now, that if it's going to do all of these other things that it's going to take billions of dollars to pay for, it needs to have a successful auto business to be able to do those things. So I think that's the extrapolation from Ed's question to how this is relevant for investors, is all of these moves come back to being able to focus on a Tesla that can deliver on its core auto business to fund its other ambitions, which, what's the market cap right now? $800 billion?
Something
Lou?
like that. Yeah.
There's a whole lot of market cap that's tied in things that Tesla has not commercialized.
825. Yeah.
So there you go. So what's Toyota worth?
Not that.
Toyota and VW, right? Those are
Toyota is 280 billion. Volkswagen, I'll have to do, because there's a million different.
Figure out which of the tickers.
About Volkswagen's about converting about 60 billion US.
Okay, yeah. So Toyota, right? That's the second largest by market cap.
Absolutely, yeah.
That's a pretty big variance between one of the best automakers in the world and one of the leading EV manufacturers in the world. And I think we do have to differentiate between those two. That you're paying for other stuff when you buy that stock. And most of that other stuff doesn't exist yet in a commercial way. I mean, it's one thing to get robots to line dance. That's pretty cool.
Mm-hmm. You got to get it over that. I mean, I thought dancing robots was the goal. But anyway, yeah,
fair. But no, but again, I want to stress the point, and this is why I always put Tesla in the too hard pile. I was a Tesla shareholder a decade ago, and stock did really, really well for me, but then all of Musk's involvement with so many other things started to I was probably more distracted by it than Musk, obviously, but it became too preoccupying for me as an investor. And I realized Tesla's too hard for me to own. It's too hard for me to follow and understand for it to be a meaningful amount of my portfolio. So I made the right decision that was also an investing mistake to sell, because the stock continued to run up so much after that. But I know it was the right investment for me, because I continue to be so perplexed and preoccupied by this business and its CEO and founder. But again, that's why I put it in the too hard pile, because, you're buying let's say a $300 billion car business for $825 billion. That other $500 billion is a lot of stuff that, has to go right for the investment to continue to. And if a couple of those things go right, Lou, this is a $2 trillion company in a decade, right? I mean, it could happen. Those things have to happen, though.
Yeah. So literally on the answer, with questions like this, I mean, I don't know. It's ripe for, I don't know, conspiracy or theories, because everybody, Elon Musk watching is a national pastime, the way watching the Kardashians used to be. But I try and put the investment banker hat on, and just a couple of things about this, I think that kind of, I don't know, it's boring, but I think it's sort of what's going on. He overpaid for Twitter. We know that, right?
45 billion.
Yeah. And that
this transaction represents about a $10 billion.
I'm not sure about that. I think I've seen that said. It looks more like for like to me. I would.
So I wonder.
Me reading it, I think kind of what I think this is he
Well, there's
overpaid
other
for it.
interests, Lou, that
Well,
have
yeah,
stakes
yeah.
in.
That's where I was going with this. He overpaid for it. He brought some other people into it, and there was debt involved. They've had a little trouble with the debt. I think that this is pretty simply a like for like over to a different entity with more assets that is sort of to keep the wolves at bay as far as just terms of people grumping about, what are you doing with X and why is XAI going over here? Because you talked about AI over there. I think that this is sort of just accounting to get the minority
Okay.
shareholders and some on
So yeah,
board.
purchase price $45 billion less $12 billion in debt, right? So
Yeah.
the enterprise value is the enterprise value.
Right, but yes, yeah, and if you look at the original purchase price, there was about 12 billion in debt. So I would bet that Musk and his minority investors in Tesla are basically on par at that coming into this new.
Right.
The question is, the fair question is that we are valuing Grok AI sort of how we value all of these AI things right now, on potential hype, whatever you want to call it, and not really based on reality. So in a way, this was an opportunity with sort of, a still highly valued asset to kind of get the valuation you want now. To me, that's like the story behind this. What's going on is that they just said, now is a good time before XAI is actually a revenue producing or a real business, and the market will value it based on fundamentals. Right now, it is being based on, the valuation is based on potential. So kind of why not? It's solving a problem for him in terms of this solves the I overpaid for Twitter problem. Is what I'm rambling to say. I don't think it's much more or less than that. They claim that XAI is heavily influenced by the Twitter feeds in terms of feeding it. I would say, if so, God help us. I think that's probably overstated. I've been on Twitter. I don't think we want our AIs kind of fueled off of that versus other sources. But there is some rationale to a business here, and but I think at the end of the day, this just makes a potential headache go away by combining X, which was still just from a banker and investor perspective, sort of a troubled company, with something that has a higher valuation, is more stable. And I do think it's kind of as simple as that. If it gives Musk new ways to borrow and kind of relief valves if Tesla goes wrong, that all makes sense to me. That might be part of the appeal. But at the end of the day, he's a very, very busy human being. He overpaid for Twitter. He's gotten a lot of gripes from his shareholders inside Twitter and bankers, and this is a way to make that problem go away, and pretty elegant one. Makes sense to me.
Yeah. No, I think that's a good way to think about it. I'm curious about Ed's question here. No question from Ed here. Currently, does Germany have a 10% tariff on U.S. cars imported into Germany, while the U.S. has a 2.5% tariff on German cars imported into the U.S.? I haven't been able to find any of.
That's not Germany. That is the EU.
It's the EU, right?
Yeah, but I believe it's that is correct.
Okay.
Or close to correct. Yeah, there is definitely a higher tariff on U.S. imports into Europe from the autos than there is what we go the other way.
And it's important to remember too that as part of global trade, European auto manufacturers have set up shop in the U.S., particularly in the Southeast. We've seen, I think BMW has a plant in Alabama, I believe.
Yeah.
Or is it Mercedes? One of
BMW is mostly or the upstate South Carolina. But yes, I mean, all over the place. And I mean, Toyota and Honda too.
Right.
And
right.
Hyundai and all of them. But yeah.
So yeah. Well, in your neck of the woods, there's a couple of big Korean manufacturers. But the key is that we've seen international expansion of manufacturing into of autos into the US over the past 20, 25 years, especially. And the US automakers do some manufacturing in Europe, right? That's part of
Yeah.
it's to a certain extent, it's part of the deal. Is if you want to do commerce with us, there should be some reciprocal manufacturing along with the trade. But the US automakers have historically not really done great over the pond, right?
Right. Well, the U.S. we've always bought, like the most famous GM owns or owned Opel.
Right. Acquired
And
manufacturing, not
right.
built and manufactured its own.
Ford, Ford owned
Motor.
half of the Swedes. Or actually, GM owned Saab. They've largely sold those off as part of the 2008 thing. But historically, Ford has, off the top of my head, I mean, Ford used to own Jaguar too. Remember, Ford. There was a time,
and it made some really crappy Jaguars too.
Yeah,
because they were Fords.
Yeah, there was a time where I think in the '80s where I think like the average person in the street of Great Britain thought Ford was a British company, just the way. No, well, no, I mean that.
I get it. Yeah,
they were so integrated there. Ford still has a plant in the UK. They have a bunch of plants in Germany.
The cars they were making were just for those markets too. They weren't. There were some that they were multi-branding.
Yeah, that's true though. All over though,
it is
definitely. The thing that's considered here, Ed, and it is complicated, and you're gonna if you accuse me of sort of weaseling out here, I think that there's some truth to that, but it's hard to look at any of these things in a vacuum as it itself. These tariff schedules are negotiated, and both sides have to give, and there's all sorts of things where it's disproportionate one way or the other, and it's sort of based on volumes and how can we make even. I think in this case, part of this is that the EU, look, they don't get a lot of cars from the US, so they would rather get a win there on the 10% and in return for lower tariffs on agriculture, which is something they want from the US more when these are negotiated or when these policies are set. Right. So to look at like auto tariff this in a vacuum, yes, it's correct. And it does imply unfair. But if you look at duties being charged across the border, just on like a more macro level, everything going on, there's a lot of inconsistency from one side to the other. And it all sort of happened, in a kind of as part of a big negotiation where both sides were kind of giving some, but getting what they wanted. And so if you're now going to come back and pull out any one of those specific deals, it's both accurate but not necessarily telling the full story, if that makes sense.
Yeah, and I think it's important to remember too that the reciprocal reactions to these different tariffs are almost always going to be on different products, right? You're going to hit this industry. For us, we're going to target it against something that really relies on importing into our markets, so that's important. And as the investing take for me here is that this is why broadly the automakers, to me, with rare exceptions, are not really investable ideas. It's such a tough cyclical industry. In a lot of ways, in most markets, it's kind of zero sum, where you're all fighting for a relatively mature piece of the pie, and your growth comes at somebody else's loss. It's a brutal industry, and there's rare opportunities that I see deep value that can be worth buying. I mean, we've seen this the idea of the EV transition, which is real and it's happening, right? It's going to continue, and at some point, it's probably going to accelerate a little more as technology gets better and the batteries get better and the vehicles get lighter and less expensive. I mean, they won't cost less than they do today, but our money will go a little further in 5 years or whatever. so that'll make them more affordable. But the things that are going to get us there that are going to be good for society writ large, I don't think are going to make investors more money to buy GM or Ford, or you know what I mean? So broadly, I mean, I want to follow this and understand it, because I do think you start getting into some of the suppliers and the distributors and some of the in-market businesses like the dealerships, strangely enough, there are pockets of value that you can invest in and find compounder, great high quality businesses that do generate long-term value for shareholders, but it's not at the automakers, right? It's not the ones we hear CNBC talking about because they're giant multi-billion dollar companies and everybody knows the brand names. It's the companies nobody thinks about because they're the ones behind the scenes supplying the automakers, or the ones everybody hate because they're running the dealerships. So
yeah. I would say, especially on the mass market, that
yeah.
autos is a tough business to invest in. If you want to get into niche markets,
Ferrari's not an automaker; they're a premium luxury brand.
Yeah. Right? And I don't know. I mean, I'm not going to advise the CEO of Tesla, but I actually, if it was me way back a few years ago, I might have gone in that direction towards Ferrari instead of trying to go towards General Motors. But who knows?
Well, Tesla's success was being more of a pseudo Ferrari than a pseudo Toyota. The Model S was $100,000 car. Right. You can get margins selling fast cars, that people that have money want to signal, hey, I'm pro environment. Right. And business has done incredibly well there. But again, they've lost some traction even there as they've moved more down market.
Yeah. You want to talk Lulu?
I do, actually. It's funny you say that because I was actually pulling up the Q3 results. So the company just reported fourth quarter.
Yeah.
I wanted to give some context.
Cyber Mikey wanted to talk Lulu, which it's giving disappointing guidance for 2025, competition from all sorts of brands, Alo Yoga and Ferrari. I'm not a big yoga guy, Jason. I got to tell you.
I can tell by those pronunciations.
But
I'm not either, but I'm assuming they're wrong. Your pronunciations,
and I didn't even really try every time. But what initiatives are needed to outperform the market over 5 years? And also, is the growth story over? All the right questions, I think. What do we think?
So I think the growth story is changing at a starting point. But when it comes to competition, this is nothing new for Lululemon. Lululemon has been able to prove that it is, I don't want to say timeless because everything comes to an end at some point, but it has proved that it's one of its economic moats is its brand, that it has proven to be a sustainable competitive advantage because, generally speaking, they have prioritized really, really high quality goods that are comfortable and they look great and they're expensive and they will not compete on price, right? And that's why there's a million knockoff Lulus out there, and plenty of manufacturers have made little cottage industries selling Lulu knockoffs to people that don't want to pay Lulu prices, right? That in and of itself, I think, demonstrates how strong Lulu is as a brand, that it has continued to grow larger over the long term. Lou, you're right. Knockoff Lulus, that is a great band name. That's a great band name. But again, to me, that is proof that there is a bit of a moat with its brand. I mean, look at Coca-Cola and Pepsi, for example. There's a million store brands, and those companies still done a pretty good job over the past 50 years of becoming bigger and bigger, more powerful brands. So, but again, I think Lulu's the key that has kept that brand value there is they've continued to innovate new fabrics, high quality clothes. They've made men are big Lulu buyers now for athleisure. Lulu has established a foothold into the men's market, and we've seen other big brands like Under Armour try to move more into athleisure with limited success. But Lulu has remained the dominant brand. And I think it also has some advantages over a lot of its peers in that it has full integration of product design. Of course, it contract manufactures like everybody does anymore, but operates its own retail stores, its own e-commerce, And that I think does give it some advantages over the competition that largely has had to rely on the wholesale market, for the third party retail that's so important. And now your product is sitting on a shelf next to somebody else's, right? Which makes it harder to leverage your brand as being more valuable. So I think sometimes that gets a little bit overlooked. And we're always going to see competition, and eventually some competitors are going to pop up there that are going to take some market, and they're going to gain some scale, and could prove durable. I'm never going to count that out for any retail brand, any fashion brand, and to a certain extent, Lulu is a fashion brand as much as anything else. But I think it's also important to remember that there's cyclicality at play here. I'm going to pull up on the screen. If you give me just a moment here, I want to share the fourth quarter results. And then I'm going to flip back to the third quarter because it's, I think, good context. Lauren, I just sent that over. There we go. So this is the fourth quarter, and let me embiggen this a little bit. So you can see, in the fourth quarter, revenue was up 14% on a constant dollar basis. So since they do business in a lot of markets, America's revenue was up 8% on a constant dollar basis. International revenue growth, this is the key. It's a much, much smaller business.
Yeah,
the international business.
75% from the Americas.
Yeah,
so,
right. That's the key.
That's what drives this bus.
So here's the key. But this is the thing that I wanted to hit on. We can go back just one prior quarter. America's revenue was only up 2%. This was the third quarter. Mm-hmm. In the fourth quarter, America's revenue was up, substantially higher. So the key is the guide, right? I mean, that's the key. Let me get down here to the
and note, just comparing quarter to quarter, that there should have been a holiday effect. So you'd hope that it would be a little better in this last quarter, but yeah.
But again, that was this fourth quarter compared to the holiday period a year ago.
Mm-hmm. Okay,
right?
Gotcha. Yeah.
Sorry.
I thought it was sequential, but no. Okay.
No. Year over year, right? Year over year. So this is the thing. It's looking forward. 6 to 7% growth for the entire enterprise represents a big slowdown of the business. And what investors are trying to figure out now is this a significant permanent, I guess we could say permanent, durable might be a better word. Is this a durable change in direction from double-digit growth to mid to high single-digit growth for the entire enterprise? Right. And I think that's what the market is trying to figure out. The reason the stock sold off so much is guidance. Management was also saying, look, we manufacture in China and Mexico. Tariffs are going to be a thing we have to deal with. There's broader economic implications if we go through a protracted tariff environment that could weaken the economy. Our consumers are spending discretionary money. If the discretionary spend gets squeezed, we're the kind of business that sees some of that first fall off of sales. We're expecting this to have a big impact on our business. My guess is that they're probably being very, very conservative with their guidance. They're willing to take a hit on the stock price to be full disclosure to the investing community that this is the environment that we're operating in, and we don't have great expectations. Now, I do think this is a far more mature business, but if the international business continues to grow it's been growing at, 4x the North America rate, the Americas rate. Mm-hmm. If it can just grow at double that rate 5 years from now,
over time,
it's a sizable business. And as it gets larger, as it becomes a larger piece of the pie, it can help reaccelerate growth. I think over the long term, there's a good reason to see Lulu growing its America's sales at mid-single digit rates. I think that's reasonable because they're going to be able to continue to expand the store base, the base of customers based on population growth, based on GDP growth, and then just inflation itself. They can probably increase their prices a little more than inflation, just a little bit more, and get a little more operating leverage. You add that all that up together, and 5 to 6% revenue growth in the Americas as kind of a baseline over the long term is pretty good, because they can turn that into 8 to 9% operating earnings easily. And then you've got an international business that's growing even faster. I don't know. I think it's easy to say the best is over, but okay, whatever, the best is over. What looks going forward to me still looks pretty damn good for Lululemon, for investors that have the right expectations of a business that should probably still be able to compound earnings per share 10% or more. Like, I don't see any reason why the business, I mean, there's plenty of reasons why it can't, but I don't think the story has changed so much that we should expect it to not be able to grow earnings per share 10+% per year.
So I guess my question is, how great was this story to begin with? Okay. And just,
Yeah.
I mean,
Yeah.
and this might be firmly on the I don't get it. But I'll share my screen just so we can play shock jock, play radio a bit, Lauren. But okay, so I think we all know it's been a bad start to the year. So look, year to date, Lulu's down 23%, losing to the market, right? But Jason, this is what's interesting to me. But okay, if you go back, all right, so it's been a bad year, right? All right. So over the last 12 months, Lulu is losing to the market by about 30 percentage points. All right. But okay, this has just been recent turbulence. You know, it's not too bad. So let's take it out 3 years. Okay. And we're going to, oh, wait, hold on. Over the last 3 years, Lulu is losing to the market by about 30 percentage points. But okay, but this is a long,
Can you scroll that up a little bit?
only a bit.
Because we got
Only a bit.
the scroll
Yeah.
is laying
Yeah,
out.
Lauren, if you can maybe get rid of the question, we can see it better, because unfortunately that's
There we
yeah,
go.
there you
Thank you,
go.
Lauren. Perfect.
So there you can see it. And just to show you the 1 year too, we'll go back and see that. Yeah, so okay, but over the long term, this has been a great growth story, right? Let's look at that 5 year chart. Oh, wait,
Woof.
oops. They are losing to the market. And yes, Lou, this was a growth story. Go back 10, I'm pretty sure. Yes, there you go. There you have it. If you've been invested 10 years, you're doing great. But if you bought this stock on, what is it, March 29th, 2020, you're losing to the market. I get the appeal, and I like this business. It as sort of like, I get why, but this one, for a while now, I mean, as a long-term hold, I I don't get it.
That's okay. That's why there's a market. I love these conversations, because that context, that context is valuable. And
Yeah.
if you're only talking to people that agree with you, what are you even doing? Right? What are you
Retail
even
is
doing?
really hard because
Yeah.
Wall Street only pays for growth, and there's only so many, people to hit and all that. And then styles change. And Lulu has done, I think, an admirable job navigating. I think it's a well-run business, but it's just, as a stock in a very, very difficult sector, I think, for me to find anything that I'm really like, oh, I want to hold this 5-10 years. It has fallen short for some time now.
I have one more chart, because further context is always
Sure.
useful.
Sure.
Lauren, if you can add this. So let's think a little bit about valuation too. Lulu, and 2020 is weird, right? From a
Right.
valuation, 2021, that period is weird from a
Right.
valuation perspective, because a lot of businesses took it on the chin because, well,
Mhm.
nobody was buying their stuff.
Mhm.
But we've seen a massive multiple contraction for the business, massive multiple contraction, to the point where maybe with a Lou Whiteman, where this starts to scratch that itch a little bit and get compelling, is that it's a business that can compound its earnings per share, trading for less double digit rates, trading for less than 16 times operating cash flows,
Mhm.
less than 20 times earnings. So maybe part of the story that it's important to remember is that we've seen the earnings multiple come down as much as the stock prices come down, because the price matters. What's the change in those numbers over the past 5 years? The stock is up
Mhm.
55%, but the earnings multiple has been cut in half. So is part of the conversation, it's been a bad business, a bad stock, or the multiple has finally started to line up with setting up investors for better returns going forward? And I'd lean towards the latter. Though, Lou, you're right. That's a long time to have underperformed as a stock.
Right. And you might be right. And they've done a decent job. They're starting to bring their share count down. But as far as if you want to go bargain hunting, I want to see, because I mean they can generate cash. So, you know, you either better find growth or you better start returning cash to shareholders. I won't be a snit and bring up their dividend yield chart.
No, you don't have to, but I will point out that the company has tripled its net income over the past 5 years.
Right.
But that's pretty good.
Right. And at the same time losing to the market and buying back about 6% of its shares. So, you know,
I'm not even talking earnings per share. I'm talking straight.
Yeah, I know.
Yeah.
But okay, if you want to get me on board as a value stock, show me what you're giving me for that, or show me how I benefit from that. And
full disclosure, I don't own Lululemon.
Yeah. No. And I get the appeal. I think it's a well-run business, but again, this is the hardest part of this job, is kind of to say, I like the business, I don't like the stock, because that really hurts. And a really smart guy, his hair's a little thinning, but he's a great dad, a super smart investor, once reminded me that one of the great things about picking stocks is that, unlike baseball, you don't, there's no implication for not swinging at a pitch. There you go.
That was Lou, by the way, that told me that.
Well, I just that doesn't sound right, because
I know. Well, that's why I wanted to be sure to say your name.
Thinning? Yeah, I don't know. You see, it's great. Thanks to these headphones, you can't even tell.
Fair.
I can. Yeah, my hair.
Right. What's next here? We got some more questions.
Well, we're on the top of the hour, so should we stop?
Yeah, let's go ahead and we'll do our pause. So, for those who don't know, we do make the replays available. So it is nice to have a clean moment of silence between me and Lou. That's hard to do. So how about we do it right now?
There you go.
We did it. I like how you pulled that, it looked like a visor,
It's like a toupee, right? I can do that. Yeah. This is like, all right.
Headphone toupees. That's not a good band name, so we won't even do that.
No. Although knockoff Lulus, I just did register that domain for my
smart. That's brilliant. Yeah. Okay, Lou, read us in. It's a new hour here.
It is. We are full 24. That is Slido full 24. If you want to get your questions in, we are here to give our opinions for educational purposes. We're not here to give individualized financial advice. Jason really wants to answer relationship questions, so you can get that in too. Again, I would say that's for educational purposes, but please.
I will give you personalized. I won't.
That's
even for relationships.
That's litigation waiting to happen.
Ooh, buddy.
Right.
Ooh, buddy.
But yeah, get your questions in. We can talk about all those great things in that weekly newsletter, and there's a lot to get to there. There's some fun things. I see some things on there. The Motley toupees. Oh wow, Lauren, you might have just nailed it. All right, sorry, not that I'm just stopping everything here because there's a good chat going on, but I did. There was a question real quick. Ed had another one. We're trying to figure out this geopolitical taxing scheme, but Ed said, do companies such as Meta, Google, other software companies have to pay a fee or tariff to be in international markets? Tariff, no, but the answer here is sorta. Europe has, and I believe other countries have, what they call their digital services taxes, the DSTs, and they generate basically a lot of it's on the ad based. Digital services is a very vague thing, but that can be advertising, social media, online marketplaces. Meta and Google are paying these DSTs. They are sort of a new frontier in free trade negotiations, but yeah, I think kind of a tariff by a different name, all the same, but it is kind of similar to a tariff. It's just kind of much more wishy-washy as applied, and people are still arguing over whether it's a tariff, a tax, whatever it is. But look, when companies make huge margins, governments try to find ways to get a piece of the margin, and that is true across the globe. And it's definitely true of these big software companies that are making gobs and gobs of cash. So I'm going to call it a tariff for our purposes, Jason.
I'll support that for also for our purposes. So we had a question about an hour ago. It was actually close to the beginning of the first hour that I want to be sure we get to in case you missed it. Let It Ride's question had a couple of stocks. I don't know if you saw that.
Yeah.
One. So
yes.
So good morning, WHR. That's Whirlpool.
Yes.
And TROW, which is T. Rowe Price, the big investment manager. They do like a lot of retirement stuff, and then they have plenty of mutual funds and ETFs as well. Great valuations and dividends. Value traps are quality companies to help diversify a market-beating portfolio. That's a great question, and I'm curious your thoughts on either of those. I can weigh in a little bit too.
Yeah, so of the two, I definitely prefer T Rowe, and Baltimore proud, so there might be a little bias here.
Long term, it has been just an exceptional business too.
Long term, although I bet you again, with just as I play, I bet you could pull up a stock and it's been a lousy 5 years or so for them. You need to look at this as a total return story because T Rowe basically is what it is. It's a decent player in kind of sub-advisory services. They do a lot of work kind of behind the scenes for a lot of companies and as well as kind of having their own business. Dividend is usually pretty good on a total return as ballast. I'd prefer this because what they make is much less subject to the whims. Whirlpool, decent company, but just in a tough business. You have steel tariffs, import tariffs, all sorts of things get in the way. This is also it's not.
I mean, they're going to get hit coming and going here, right?
Yeah.
I mean, I think that's just the reality for that business.
Yeah.
I love that you love T. Rowe Price, the business that's done 13.9% in total returns over the past 5 years. Should have bought Lulu.
Yeah, no, that's true. I mean, full disclosure, I don't own either, but of the two, I would definitely feel more comfortable with that. But to your point, I wouldn't. For me,
know why you own it and what the purpose of it in your portfolio is for.
Yeah, and I think there are better ways to diversify market-beating portfolios. One thing it's whatever they call it, diversification. This urge, you can find good companies in all sectors and that can fill out your portfolio. I respect these companies, but I do think you can do better than either of those in terms of whatever you're looking for. If it's income, definitely, I think there are better ways to get income. If there are sort of value stocks that you just think can appreciate or are significantly undervalued, I definitely think you can find other sectors of the economy for that. They are fine for what they are, but neither of them would really excite me as an investment, I think is my honest opinion.
Yeah. So broadly, I agree with you. I think, again, know why you would buy them and have a plan for why you would own them. And I do think with T. Rowe Price, it is a great business and they're very good at what they do. And there's a certain level of stickiness to it as well for their customers. And there's a good chance somebody watching or listening to this logs into T. Rowe Price for their 401k. Or other like corporate benefits, right? You're not the customer, you're the user. The customer is your employer, right? And they tend to be very, very sticky for those relationships. And they get to kind of double dip on the benefit because they'll offer, they get services for running that, but then they get a lot of the assets in there that you're investing in, they get management fees as well, right? So it's a great way to kind of double dip and also run a pretty solid business. The case for buying one of these businesses today, though, to me, honestly, is like a cigar butt, deep value investing sort of idea. I mean, again, you can make the case to own it for long term. And this is probably one of the better starting points over the past decade. But this is just for T. Rowe Price. I'm going to send a screen share over here, Lauren, if you can release it. From a valuation perspective, there's an argument that this is about as cheap as the business has been for, a decade. Just looking at the price to earnings multiple, it's knocking on 10 times earnings.
Mhm.
The average over the past decade has been right at 15 times earnings. So by that measure, just reversion to the mean says that there's 50% upside, right?
Yeah. And if you can capture that upside with a 5% dividend on total return, you could do just fine from here.
Right. That's the thing.
Yeah.
But then you're talking trading, you're talking buying with a plan to sell based on the multiple expansion, and also hoping that earnings hold up, right? For a period of time. So there's a lot of reasons why that's a challenge. And again, it's unfoolish to do. And 5% yield, and they do grow the dividend too. So you get that 5% yield and a little bit dividend growth. Does that serve your portfolio better than bonds? Maybe, that could be good if you're looking to hold long term and you don't need to sell to get the capital. Like with a bond, eventually it's going to mature and you get your money back, ideally. Sure, there's the case for it to be a long-term income holding as well. But I would not expect it to, over the next 10 or 15 years, to necessarily turn into a market beating investment, but probably better than a bond. Is that a good band name? Better than a bond?
Yeah.
It's not very good.
I like the Motley toupees better.
Oh, that's
I mean, there's almost an argument, and I don't like this argument, but I mean, I wouldn't personally do this, but people do, and it works out. I mean, I'm making about 4% on my LI savings account. If I believe in T. Rowe as just kind of a constant state, maybe I mean, the stock has literally gone nowhere this year. If you get a 5% dividend yield, almost to treat it as, stick a little of my savings there. I hate that. I think people get too cute when they do that.
Yeah.
But I mean, that would almost be, like that's taking ballast to a new level, where it's just saying like, all right, well, I don't think this business is going to go away. I doubt the stock's going to go up, but if I can get that, because remember, fools, very important. If you are looking at income investments, the only dividend yield number you care about is when you buy. It could go to the moon and you're still getting the dividend based on your cost basis, assuming they're still paying that dividend, right? So if you could basically, if you believe the dividend is secure, and I don't think T. Rowe is going anywhere, and you can lock in a 5% yield for a stock that you say, all right, if this goes nowhere, I mean, in a way, I've sort of done that with Realty Income over the years. I think that's a good example of that. But I mean, I would say keep your cash in cash and find stocks for stocks. And
well, the minute that you take that stock and that cash and you buy a stock, what do you no longer have, Lou?
The cash.
You no longer have the cash, right?
Yeah.
Right. And your capital is now at risk, right?
Yeah.
And if you need to turn that back into cash, you have entirely given control over to the whims of the market, right? Which we know can change incredibly. I mean, think about where sentiment was in November, right after the election, versus where sentiment is today, right? We don't really know how much the trajectory of the markets has changed and the economy has changed. We have some ideas, but we don't know what the outcomes are going to be with any more clarity than we had back in early November. So I think that's just an important thing to remember. As to Whirlpool, I do want to weigh in on Whirlpool because we haven't specifically talked about it very much. This could be a painful year for Whirlpool. You hinted at it a little bit. Big steel user, imported steel it's got a lot more. You know what? Domestic steel has gotten a lot more expensive because what did we see U.S. Steel and Nucor and AK Steel do with their domestic steel prices as soon as those imported steel tariffs went into effect, Lou?
I mean, the prices normalized to it. Yeah.
They raised their prices. They could raise their prices. So anybody that's using steel is paying more for it now than they were, whether that steel is being made in Ohio or Canada or being shipped in from China. They're paying more for that steel today. So that's that's tough for a company like Whirlpool. And oh, by the way, now what's going to happen with the appliances that they're manufacturing in China and shipping into the United States? Well, they're paying 10% more for those products to get shipped in the United States. And do you think that their steel prices in China stayed the same when the U.S. put in tariffs on steel imported into the United States? No, I guarantee that manufacturers in China are paying more for their steel now than they were 4 or 5 months ago, right? These are global markets and they are tied together. So all of those things together, I think Whirlpool has moved a little more in the too hard pile for me, that I think that their challenges could continue. And as much as the stock looks cheap, it could get a lot cheaper. So I don't think that it's necessarily a safe stock, a deep valued stock at this point. If that's a strategy you want to approach with a Whirlpool, I would be far more thoughtful about, building out that position over the course of a year, on the business being okay, but the market seeing more weakness and sending the stock down more. Again, this is a very unfoolish approach as an investor, where you're buying strong businesses and then just letting the market compound your results as the businesses get bigger and stronger and more profitable. With these legacy, older, cyclical businesses like this, it's a different style of investing. I hate to say game because I don't want to gamify what we're doing, but it's a different skill set than, buy and hold long-term investments, less focused on valuation, more focused on disruption and capability to grow and disrupt, and take a large move from the disruptor to the rule maker. Right, Lou?
Yeah, I have no problem sort of kind of investing, like, not long term. Like I talked about my portfolio is kind of barbells. I have my core holdings that are hopefully set and forget it, and then the bottom of the portfolio is mostly either very speculative ideas as far as young companies I think can grow, but sometimes they are just like ride the waves. I've been in certain industries for a long time. I think I can read the tea leaves. And so I don't mind just like going in saying, all right, I'm only planning on holding this for a while. But to me, that's just as speculative as buying a pre-revenue company. Even for that, Whirlpool, just the complexity of this business, I can't figure out why there are better areas to play for my brain. Anyway, I think that's, as you say, in the best of times, it's a really, really tough business. And with the current events, I agree it's going to be a really challenged year for them.
Yeah. Whereas with T. Rowe Price, I'm willing to say that I think it is an extremely safe, recurring cash business, right?
It's
the business implications are far different.
Yeah, it's a stock. As Jason said, you own the stock, not the money. So it isn't a bank account. But I think it's much more, what you're going to get.
Ed asked a question about home builders. I feel contractually obligated to give an answer here. Ed says, I have a loss of 15% with Dreamfinders Homes. The ticker's DFH. What do you think about selling it and buying Green Brick Homes? Ticker is GRBK. So first of all, Ed, as you know, as we've said ad nauseum, answering questions to you, but I want to say
the scroll.
Read the scroll. Read the scroll. Ed, I'm not advising you. And again, I know you realize that, but for everybody else listening, just to be clear, this is not individual advice. I will tell you what I have done. I have a small position in Dreamfinders Homes. I have a much larger position in Green Brick Homes. Recently, in the past couple of weeks, I've added to my home builder stocks. I added to Green Brick. I did not add to Dreamfinders Homes. Dreamfinders Homes is the stock in this industry that is done, of the ones that I own, it is the one that is done by far the worst over the past year plus. If I were buying today, I would buy Green Brick Homes before I bought Dreamfinders Homes. So your mileage may vary. Take that as what you will. Now, let me explain the why, because I think the why is incredibly important when I'm putting out blanket statements about binary decisions that I've made, why I've made those decisions. I think Dream Finders Homes is a perfectly good business. It's recommended in multiple Motley Fool services. So, hey, there's a little inside baseball for those of you watching on YouTube, a little freebie. Dream Finders Homes business model has some things about it that are very compelling. They have a finance business that they do where they originate some debt, so they make a little bit of money on the lending side, which is a great revenue thing that you can get if you can get it. It's a great thing to have. They also are a land light model, and they use exclusively land options to build out their pipeline of land. There are capital benefits to doing that because you're not borrowing money, paying interest on that money that you borrowed, potentially for years before you actually start to develop that land. They don't actually develop the land. They use third parties to do all their land development. So they're not carrying the cost of having a development operation on the books. You're having to pay the salaries and deal with finding the contract labor to do it. And all of, Lord, if you decide to own cement mixers and bulldozers yourself, that capital cost is a lot of money. So by third party outsourcing all of that, they keep their books a little bit lighter for that. So those are really compelling things. But all of those things to be said, Dream Finders Homes has, in terms of a mix of percentage of its business, if you think about the leverage ratios, is one of the most leveraged of the larger home builders. And they're small in the grand scheme of home builders. But in terms of, when I say larger, I mean publicly traded. They're very leveraged. They have a tremendous amount of corporate debt. They've used corporate debt to fund growth, to grow the enterprise larger. So there's a lot of home builders that use debt to acquire land as part of their land strategy, like Green Brick to some degree, LGI Homes, which actually has more leverage than Dream Finders, Meritage Homes, which is one of my favorite home builders that I own, Lennar, et cetera, et cetera, et cetera. But they have much lower debt leverage ratios than Dream Finders. And guess what they also have? If we go through a period where the housing market just crashes and we see a big pullback from buyers, enough so that we actually go through like a substantial decline, because a lot of these smaller targeted builders, Lou, they've been growing, even as all of the pressures on the home market have accelerated over the past couple of years. So all of those other builders that have debt but lower debt leverage ratios, they have an asset that they can actually sell if they need to deleverage their balance sheet. Dream Finders doesn't have land that it can sell to pay down debt if its cash flows get really impacted because of a slowdown in home sales. So the business model I love, I don't love the balance sheet, and that, because of their balance sheet, that's the reason I've been slower to add to that. Even though the stock is down and the valuation is compelling, that's the reason why I haven't been as compelled to add to it as I have to others. But I've held it. And the reason that I've held it is because I do think that they're a pretty good operator. I'm not terrified by their balance sheet. I don't think it's going to destabilize the business. But I do think if we go through a cyclical weakness, it could impair its business and its ability to grow more than its competition. So hence I've invested in the competitors more. I would not suggest to anybody that invests in home builders to pick one horse and hop on that one horse to try to ride that horse. I think it is a perfect industry where the smart thing to do is to have a basket of home builders and invest in that basket of home builders, 4 to 6. There's a lot of really high quality companies that you can invest in across it. And some might not do as well as others. Others can do exceedingly well. And overall, I think as a group, 4, 5, 6 high quality home builders from today, 5 years from now, I think are going to crush the market. I really believe they're going to absolutely crush the market. That's the most aggressive I've been with my predictions. Probably should be making it during that 7 p.m. hour. But I really do believe the tailwinds are so good, and these businesses have gotten so much leaner and less leveraged than the industry has been over most of its existence, that their ability to navigate these down cycles and then accelerate growth through the upcycle, factored in with the millions of houses that were underbuilt in those key markets, is strong enough that a basket of them is going to do better than the market, and is the safer way that most investors should try to build out that part of their portfolio. So Ed and others. I hope that's useful.
It's so interesting. 'Cause I don't disagree with anything you say on housing. I mean, I think, excuse me, the long-term thesis is staring at our face and it looks almost too obvious, but I have never felt compelled to jump in and buy housing either. Like I have this weird disconnect here. Maybe it's because, there's only so much of my portfolio I want in sort of industrial companies, and
Yeah.
I know other sectors later, but I agree with everything you say. And yet I don't own any of these guys, and really,
Well, I mean, this is
no
we're talking
interest.
about riding the edge of the cycle, and again, the leverage, because they do use a lot of debt broadly. I get that, Lou. I totally get it. I get
Yeah, but it's not even that I think it's bad. Like I actually think everything you say makes sense there, and yet I just
it's okay. It's not for everybody.
Yeah,
It's just for the people that want to make money, Lou.
that's fair. That's fair. Yeah.
And occasionally lose money. If you look at the stock prices over the past year, they're down a lot. We're talking 30% plus for most of the industry.
Frankly, I'd just rather be given money at this point. But I know that's not. Yeah. Anyway, neither here nor there. So a lot of questions coming. Good morning, fools. It's good to see so many people up with us. Slido Fool 24. If you want to get in, you get Jason for another half hour or so, and then we will upgrade to our smattering. That sounds weird. We'll bring it.
We're gonna trade Jason for Jeff.
Yes, we will upgrade our smattering. That's not a band name either.
No.
All right.
No. I mean, that could be like a B-side song.
Yeah.
What would it be? Would it be? I mean, that sounds like jazz to me, like improvisational jazz.
Yeah, I have long stated whoever thought of that wasn't really thinking it through when they decided to go by the smattering. But we don't need to.
I can argue that. I can argue that at all.
Let's talk, and this is painful for me, and not all of them work out. But about 25 minutes ago, Mr. Dunning-Kruger wanted to know about Chegg, the chicken or the egg company, the education. College cheating, education, whatever you want to call it, stock that looks so promising. It says Chegg. Oh, look at that. Maybe we should talk Chewy then, right? But anyway.
Yeah, so this is Biscuit. This is my hairless American Terrier, hence the clothes. It's 35 degrees still here. So she just came upstairs to say hello. So I want to say hi to her.
Yeah.
Say bye, Biscuit.
I have a hound, so she won't be up for another hour or so, or 5 hours.
And then not for long.
Yeah. There. Jason Chegg, company and share price really hit hard, but could there be deep value? And I'll tell you my answer. My answer is I thought so, and I bought in, and I'm down 90%. And I think for me that I think I was wrong. I think that this was value trap. I thought they could. There's all of these companies we look at. It's like, will AI kill them, or will they use AI to sustain? And it is a coin flip, and it appears, I'm afraid, that Chegg could not outrun AI. I hate making a bull case around, but they've sued one of the biggest companies in the world with their diminishing resources, and if they win that suit, it's going to all work out in the end, because they have sued Alphabet about the AIs basically stealing from them, which, whether they have a case or not, I don't know if that makes it a value. And to me, yes, there could be deep value, but the risk reward analysis for me is not favorable at this point.
Well, you just hit on something. I think I would suggest anybody that's even remotely considering Chegg, number one, continue to do some serious analysis, but also remove the word value from your vocabulary unless you're saying value trap. Because at this point, this is entirely risk reward, right? Because when you're thinking deep value, that means that you have identified assets that the business that can monetize that are worth more than the market is paying for the stock today, minus any liabilities that it has to cover. And that's not the case. If you look at Chegg's balance sheet, that is not the case, right? And looking beyond the balance sheet, and is there other intrinsic value that's not reflected in the balance sheet? You could make the case that the value of the litigation could be that thing, but there's no certainty in the outcome of that, right? So when you don't have certainty, you have risk. So if you want to consider this a high risk, some reward investment, more on the speculative side, I think that's a fine way to categorize it, and a much more accurate way to think about it, because we can talk ourselves into taking on risk because we think there's value, and we start to ignore the risk. But once you start acknowledging that risk, then you can do things like say, you know what? Sure, there's upside, but I really, I need that $1,000 to be $2,000 in 10 years. I don't need it to be $5,000 in a year from now. And I certainly can't afford it being $0 or $75 in 6 months, right? So you start to go through those mental exercises, which can lead to, in the aggregate across our entire portfolios and investing careers, you start getting better outcomes, because that scratch the lottery ticket itch that you might have, you go to 7-Eleven and you buy a lottery ticket instead of trying to scratch a lottery ticket with $1,000 in your portfolio, right? So I just think that's the key to and sometimes, what we have to do, Lou, and I think you were doing, it's like, you know what? Lou kind of admitted that Lou was a little bit wrong with his analysis, right?
Yeah.
And it happens. It absolutely happens. Not to me, but it happens.
Well, and look, I talked about before, there are, I did not make that a core position. I think I knew going in that this was speculative and hope. And I do think the odds have materially turned against me since I bought that stock. I still own it, full disclosure. I don't really know why. It might just be more of a housekeeping thing at this point, but I mean, I'm already in, I'm down something big. It's not really enough money to change my life if I put it into something better. So it's kind of just, if nothing else, to remember to see what happens. But I am not expecting much from it right now. I will say that.
I've got a weird one I want to throw in here before we move on to the next question and comment.
Weird is good.
So you remember Curiosity Stream?
Ish.
So Curiosity Stream was a SPAC that was launched, I think in 2020, maybe 2019. Might have been an IPO. I'm pretty sure it was a SPAC though. But anyway, the guy that founded the Discovery Channel is one of the backers, and I believe he's still the chairman of the board. Founded this. It's a fact-based, over-the-top streaming content program. So documentaries, that sort of thing. Mm-hmm. And you can log into your Amazon Prime subscription and you can bolt on for like $3 a month, Curiosity Stream. You can subscribe to it directly, get the app and stream it on your device, stream it through your streaming TV, et cetera, et cetera, et cetera. They have some deals with some airlines. You can watch it on the back of the seat in front of you thing. When they started talking about that as being a big growth driver, I should have probably seen that as a little bit of a sign that maybe this is not the best idea in the world. But needless to say, in a world of more streaming options, the guy that's charging $3 a month for their little edutainment program probably doesn't have a lot of moats.
Yeah.
Which was mostly right. And the stock fell down into penny stock territory. And I mostly just kind of wrote it off in my head. I paid over $7 a share on average. So I mostly just kind of wrote it off in my head. That, okay, bad idea. I'm just going to leave it in the portfolio here and let the story play out, because I do think it's interesting. And at this point, the few dollars that I could scrape up off the bottom of the barrel are worth it just as continuing tuition, right, so to speak, of keeping this in here to continue to learn. And the stock now trades for almost $3 a share, and they pay a dividend, Lou.
They pay a dividend. Wow.
Unlike Chegg, AI has been the financial savior of the business, because they're now licensing their video content to LLMs to be able to AI developers to use it for training their LLMs, their large language models. So they found a way to tap AI as a revenue source for the substantial amount of IP that they have control of and that they own. So it's interesting how sometimes these stories change for reasons that when we first bought, we had no inkling, like there was no way that idea could have been in your brain. Here's the summary. I'm still down 62%.
Yeah.
On this investment. So,
yeah.
You know,
it's going to take a lot of dividends to break even on that, huh?
Oh yeah. Oh yeah. Good morning, lovely Lily. It's good to see you commenting in here.
Yeah.
As well. What question do you want to take next?
So it's sort of related to the home builders, but Zach's a fool because it's a great question. Can you make a case for taking a speculative position in a company like Remax, RMAX, looking for an eventual rebound normalization? Jason, I just looked it up. Remax right now is off 80%.
Yeah.
From mid 2021. I'll tell you, Zach, every screener I have, Remax always comes up, and I sort of yada past it. I to some extent, they're big. Housing's a thing, and it is the bad point of a cycle. And so, yeah, I think you can make a case for it. On the other hand, it's a cutthroat business. It's tough to get right. The rules are changing with the kind of listing, the way fees are paid. So there's going to be an adjustment there. And I don't know if this is an indicator or not, but Warren Buffett is out trying to sell his real estate brokerage operations, right? Or has he already? Or is that just rumored?
Yeah. So it's a keep going. I want to circle back around to that because that's an important part of the conversation.
But I mean, yeah, I don't think that's it'd be like Buffett like that, but I do think it is. I keep staring at it too, and I think you can make the case for taking a speculative position. I don't think you can make a case beyond speculative, though. It's not. It doesn't like wow me like that, but it wouldn't surprise me that if I was to buy in right now, that as things eventually recovered, I would be very glad I did, because it's an established company in an important market that's going to get volumes as things eventually rebound, normalize, as you say. What am I missing, Jason?
I don't think you're missing anything, but I do think that it's a reminder that when we throw out something like the housing as a category, and homes and buying and selling homes as a category, you can have two perfectly valid, diametrically opposed theses at the same time for companies in the industry. What do home builders do? They sell homes. What does Remax do? Sells homes, right? One has a lot of tailwinds, home builders. One is facing the toughest environment, protracted environment in its entire history. And that's when your business is selling used homes. If you look in the US, we've seen a massive decline, and it's been the trend for 7 or 8 years now, a massive decline in homes listed for sale, existing homes listed for sale. Based on long-term data, a healthy housing market, we would typically have 2 to 3 months of inventory, 6 months of inventory listed for sale. And that works out to probably 2.5 million homes would be what we would have on the market at any one given time. We're less than 1.5 million homes right now. And I don't know when the last time we were above that. It's been 5, 6, 7 years. It's been a long time since we were consistently above that. So essentially we have half as much inventory available as we should. One would think that we normally would. So that, my dear friends watching this, is one of the two biggest reasons why housing prices have moved up so much. There is not enough available supply to meet the demands of buyers. It's supply and demand. That's why prices have continued to move higher, even as interest rates went up, right? So it's been a brutal market for anybody that wants to buy a house. And there are millions of people out there that would still be in the market if there was any semblance of inventory availability. So this is the reason why Redfin is a stock that and before the Rocket Mortgage acquisition was announced, I was right on the cusp of making the decision to go ahead and move on, because Redfin's business is Remax's business. It's selling homes, right? Their whole market is trying to be cheaper, and have a bigger market nationally with the app, and a place to find out how much your friend that just bought a house, is really worth, et cetera, et cetera, et cetera, right? All of those things. So that's their top of the funnel. For Remax, this is just a traditional real estate brokerage business, and they make fees from licensing the Remax name to agents and brokers. The flip side of this kind of a business, that I don't think this is like a speculative thing as much as I think this is more of a deep value thing. Because one of the good things about Remax is your cost structure is, you don't have a bunch of employees selling houses. Real estate agents, by and large, are a commission-based business. And that's the puts and takes of the way that industry works. And Remax is largely one of the biggest brands in it. So they help provide things like marketing services, training, access to MLS, different things like that they provide to agents and brokers that are part of the Remax network, right? So their cost structure is surprisingly variable. You go back to 2022, and operating expenses were $215 million. Over the past 4 quarters, their operating expenses were $183 million. So there's a certain amount of variability in its cost structure that you don't have with a lot of cyclical businesses. At the same time, it has consistently generated positive operating and free cash flow. In terms of turning operating cash flow into free cash flow, it's about 85% free cash flow conversion. It's extremely high cash flow conversion. That makes it a safer business, right? Here's the thing. If you're buying this based on the idea of a value play, which I think this is a reasonable consideration, it could take a very long time for you to be able to realize that value, because you have 2 factors. You have everything that I talked about with the headwinds that's facing the existing homes market, and then you have sentiment, which is affecting the price of the stock. Sentiment tends to follow the trajectory of what happens with the industry. So if the industry does start to improve a little bit, sentiment will get positive on the stock, and investors could make money. But it's in a tough position. And that's before we even factor in all of the realtor, National Association of Realtor issues that have happened with that industry being viewed as a monopoly, and all of the challenges that have been put around setting these fees. And can you actually set these fixed fees? Why not? Why can't buyers negotiate the fees that they want to pay? That have started to kind of upend and affect the industry to some degree. That could erode some of the value for a broker and the realtors that work with them from being part of something like a national association, right? Or a state association. So, but I think it's going to remain a regulated industry, and the power of a Remax, that brand power, I think that's one of the things that supports its value. There's a little bit of a moat there. And I could make the case for it. I mean, it trades for half times revenue. That this is deep value. This is the kind of business, because generally you get good operating leverage, and the asset kind of the asset light business model, it generally is going to trade for a multiple of its revenue, like 2 to 3 times revenue. That this could be deep value. I don't know how long before you might be able to realize that value.
Yeah,
because of the headwinds against the market.
I think that's fair. I am much more confident that eventually it can work out with them than say Chegg. It's
100%. Oh, absolutely. Yeah. Again, it's the difference between deep value and risk reward. I think there's it's buying Remax at this point, risk defined as probability of permanent loss of capital.
Yeah.
I think is much lower with Remax than it is with Chegg. It just could take a long time for you to turn that capital into more capital with Remax.
Mm-hmm. Mm-hmm. All right.
I'll buy options sometime next week. I'm kidding.
Short dated. Short
Yeah.
tail too,
Yeah.
right?
Hey,
Yeah.
before we take the next question, I do want to share Cena's question from the prior hour. I think it's a great not question, but comment.
Yeah.
Doing a little extra buying beyond 401k seems like a decent part of a deployment approach. Some into those and some into potential outperforms. So thinking about accelerating your 401k investments, but also accelerating investments right now during these periods of downturns, I do think it's a reasonably smart strategy to take, because market goes up most of the time. So we should always be buying most of the time for the long term, and maybe buying a little more when we go through periods like this.
Yeah. I mean, and I'm kidding. We're allowed to say this, but since we're a stock picking organization, it feels like it feels dirty to say, but there is nothing wrong with just buying the indexes and forgetting about it. And I think for the most
Absolutely.
part, and
Yeah.
look, folks, the best case scenario is you get old, you have a lot in indexes, and then you can sort of have a little more wiggle room to play around with stocks. So building that financial foundation of just tracking the market's return, when we can pull up the 100-year chart of the markets, and we won't bother, but we know the direction it goes. Building that foundation, whether or not that's in addition to buying individual stocks or just all you do, that's a good way to end up comfortable in life. And there's nothing bad for me to say about that. Nothing. That's my hot take for the day. Only do the rest of the stuff if you want to. And if you want to, I do think you can beat the market. I don't think it's guaranteed by a long shot, but that should be the choice after, this is plan A is a really good plan.
Yeah. Right. Absolutely right. Yep. Absolutely right. All right. What's next?
Do we want to hit? I mean, there's a Live Oak Bank question, Jason.
Go Habs go. Go Habs go.
Go Habs go. And it's directed at you. I mean, I have a couple of thoughts on this company too, but since he directed at you, I'll read it and let you start it. All right.
Okay.
He, she. Jason, I do not see anything that has changed in LOB, Live Oak Bank. Is this one business as usual, ergo dollar cost averaging into? What's going on at Live Oak Bank? The chart looks terrible, I think, right?
It looks horrible.
Yeah.
And for a couple of reasons. I think if we look at that 3-5 year kind of, how's the 5-year look actually? Is it, because that was from the beginning. Right now, this past week, for those that don't know, this was the 5-year anniversary of the bottom of the stock market, the S&P 500, the major indices, after the world went into lockdown during the pandemic. March 23rd was the bottom. So this is
when Live Oak temporarily found a totally legal free money machine,
free money. So,
and part of what's going on here, I do think, is that maybe people who were new to the stock then didn't realize this was permanent. But yeah, Live Oak up 88% on the 5-year chart.
Right.
Again, down.
So what's it down from the high?
From the high, late 21, 72%.
Yeah. So let's talk about that backdrop first of all, for anybody that's looking at the chart and just to know about the business. So the payroll protection plan. So this was part of the federal government's response during the pandemic, when so many people didn't have a job, or their companies were going to cut their job because those businesses no longer had revenue because of lockdowns. The payroll protection plan was basically free money for businesses. That the loans could be forgiven. Like, they would provide certain evidence of what they were doing with the money. It was basically to keep people working, right? During those periods where the businesses maybe were significantly reducing or even ceasing operations for a period of time. Now, the way that those loans were administered was through the Small Business Association, the SBA, or the Small Business Administration, I should say, the SBA, which it just so happens that Live Oak Bank, its business and its motto is to be America's bank for small businesses. You think they know the SBA program pretty well, Lou? I think they're still the biggest SBA lender. Like, they are really good at this. They're really good at this. And the benefit of doing this go ahead.
It was just one more, and relative to banks, because this is important too, they are pretty nimble, which helped too. So when you throw something new at them on the fly. Yeah. So go ahead.
So what they were able to do is by knowing this program and being one of the key SBA partners in it, is they were able to go out and get tons of free money, because they were underwriting these loans, right? They were originating the loans and earning the interest, and the interest rates were high, right? They were like 4%, I believe, when their cost of capital was zero, right? Interest rates were marked down to zero. So they were getting basically free money to administer these loans. And the money was free to the borrowers because the loans were able to be forgiven. And if something happened with the borrower, the SBA was backstopping it. So even if something went bad with the loan, the SBA was going to give the money and cover the cost to the lender. It was free money, right? So the growth rates that it reported for that period of time were extremely high. The profitability was extremely high. You normalize all that to where we are now, and you still have a Live Oak Bank that's a lot bigger than it was. It's acquired more customers. It's expanded into more industries. And its business model is to lend to small businesses and industries that it knows very well. And those industries are industries where there's good profit margins, stable businesses, and their ability to continue to grow is above average. So that's what they've done. They've built out their lines across these industries to small businesses that they know well and they're comfortable lending to safely, right? So that all of that has remained. They've also started to expand their banking relationships with those customers, and not just trying to just be the lender. They want to be the full banking partner. So all of their banking services, they want to accumulate more of those relationships with those borrowers as well, and start taking those banking relationships away from the local banks and also the big banks that do a lot of those the regular banking services. And they've started to do that. They've grown that part of their business, but still the vast majority of their capital comes from us, just regular people who have an online savings account and you want to get the most yield that you can. So the vast majority of that is below FDIC limit. So it's insured, it's safe, and they pay that higher yield. And they can, because small business loans are a higher interest rate than your average bear, right? So they can get the higher rates. Those loans tend to also be adjustable rate. So the variable rate, so they'll adjust up and down with interest rates. So even as interest rates have gone up and they've had to pay more on deposits, they've increased the rates that they're getting on borrowings at a faster rate. Maybe later, it doesn't adjust up as quickly, but it adjusts up more, right? So they benefited from rising interest rates broadly. Okay, all of that to be said, it's a bigger business, it's stronger, certainly a cheaper valuation, but the business category that is kind of first in line to start pulling back in periods of uncertainty when it comes to taking on additional borrowings is small businesses, right? So we're entering into a cyclical period. Banks are already very leveraged to the economy broadly, where uncertainty causes businesses to readdress their capital plans. And if I'm a brewery, a small brewery, craft brewer, and I opened a tasting room in this town, and it's done really, really well, and I've identified 2 or 3 other markets that I'm already selling into the retail and my brand is established, that I could open more tasting rooms and maybe expand my operations a little bit. Now with everything that's going on, I might be like, maybe I'm just going to open one this year, right? So instead of borrowing $30 million, I borrow $10 million, right? Or we could see it get to the point where it's even more protracted than that. I don't think there's a lot of default risk with their portfolio because, again, that relationship with the SBA, a lot of the loans that they have are SBA guaranteed, but they also just are really, really smart lenders. I think the bigger risk is that we're going to see growth slow, even to the point that the business could potentially, in a worst case scenario, we could see a decline in lending activity this year. But to me, that's a green light for a business like this, because how do you solve for growth if you're a bank? Just lower your lending standards, right? But then you start issuing more bad loans, right? And Chip Mahan's not built to do that. That's the founder and CEO. I think their underwriting standards will remain very high, even at the risk of the business not doing as well, because it's one thing to not do as well versus, as a bank, do bad, because when you do bad, you do something spectacular and it's usually blowing up. So That's my thought. I don't think I would just blindly dollar cost average into it, because you still want to manage position sizing. But I do think now we're entering into a period where accumulating shares of Live Oak are really compelling at this valuation, as long as you understand the reality for banks is that uncertainty is the only thing that's worse for a bank than uncertainty is certainty that things are going to get worse with the economy.
Right. Right. And I should say, I joked about free money. That was not meant as a criticism. I think I first met Chipman. I think I definitely had hair, Jason. I think we were in the 90s.
It was a long time ago.
Yeah. He was on his last. I think the world of this company, this is a good time to remind everyone of that scroll that this does not constitute personalized financial advice, because what I'm about to say is, for me personally, yeah, this is, I adore this company. It's a long-term holding. And look, what's going on at Live Oak is them specific. I just pulled it up. They are down. They are losing to the Dow Jones US Bank Index by almost 50 percentage points over the last year. So this isn't just, I mean, part of it is, a bad time for banks, but
yeah,
if you look at the real numbers, the cost of funds are high. You address that, like kind of where they get the funds. Net interest margin is deteriorating, and as one would expect, you do have some pressure on the loan book. You have net charge-offs, kind of not moving the directions we want. This is, and I love talking about this. Financial services is so important here. This is when your advantage is your time frame. Versus,
right.
Because two things, you said it before, two things can be true. I absolutely 100% believe that the next few quarters could be difficult for Live Oak to show wow returns. And I don't know how many quarters that is, but I do believe that, just kind of what you said, the nature of their customer base, the nature of what's going on in markets. But I also believe that this management team will not let this ship capsize. And I do believe that if your focus is well beyond this cycle, this is a wonderful company trading at, it's really hard to say. I like looking at price to book with financials, and they did have that stupid period, so the averages are all messed up, but they are trading at about half of their average multiple over the last 10 years. Now, granted, they got up really crazy there for a bit, so it's a little, but you're approaching getting this well-run bank with a nice niche, in my eyes, at book value.
Right. Yeah,
I think that's getting towards there. And I can't tell you what that'll do for you over the next 2 quarters or 3 quarters. But if your goal is to just, hopefully, all companies have risk. And again, read the scroll below you. But if you were hopefully just trying to find stocks that, all right, I can ride out the storm with a really good management team that knows how to win the game over time, I think the market is pricing it wrong for long-term holders right now, and that's exciting to me.
Tax accountant, I want just to share tax accountant statement here. The business, and again, tax accountant, it's easy for us to read too much into other people's written comments. I love this nuance though. Tax accountant says, I slightly disagree with Go Habs Go on Live Oak Bank. And I think what tax accountant's talking about is that nothing has changed. And tax accountant points out the business is getting stronger while the stock is selling off. And again, there's the business results, which again, the market conditions are part of what we're going to see with that. But if we actually think about the business, and I want to highlight a couple things that I mentioned that I think are the keys that I think tax accountant is pointing out. It's diversifying across more industries, right? It's still specialized on small businesses, but they started off, I think their first loans were to vet clinics, right? To vets that wanted to expand, buy out their competitor in the town next door, that sort of thing. And then they've spread into more industries. As they've spread into more industries that have different economic levers that affect them, you diversify your risk pool, right, across those industries as well. So that has made the business stronger over time. Also expanding their banking relationships with a larger pool of banking customers beyond just the borrowing and the deposits. I agree. I think broadly, those are things that will strengthen the business over time. But again, we could see the business deteriorate, the business results deteriorate because of the backdrop of the economic environment that it's operating in. So, all right.
And let's stay on that because, I mean, we're running up on time, and I think Jeff's already in here, and Jeff loves hearing talk about banking, so that's good. But just as far as understanding Live Oak Bank, I mean, the way they specialize on, be it vets or whatever, the value of that isn't just that they know these businesses and how to rate loans to it, and I can tell you this firsthand, if you are a vet, and your banker can not only get you a loan, but has talked to enough vets that say, you know what you should buy if you need a new x-ray machine, or kind of knows you on that level, that the soft stuff, the stuff I can't quantify, is so important to their business. Not only do they know how to price your loan because they know your industry, but they're talking to vets all day, and they are almost a networking.
Well, they can outprice your local bank, and they will give you a level of service that you're not going to get from a big bank.
Yeah.
No, that's spot on. That is exactly spot on. So a couple comments we can share before you kick me out and bring in that other guy from New Jersey. Seen it NYC earlier. I was talking about scratching the lottery ticket in your portfolio, which could be a Chegg or some of these others. Instead of a lottery ticket at 7-Eleven, buy the S&P or similar indexes in chunks and a little at a time. It's hard to argue with what's worked for decades and decades and decades. I also think an interesting thing to do I've heard other folks talk about doing, is instead of holding cash, because we can hold cash for years and years and years before the market gives us an opportunity to deploy it, use the index fund as your dry powder. Sure, we go through a sell-off and it's going to sell off, but if our goal during those sell-offs is to buy high beta stocks that are long-term winners that have fallen more, you're benefiting on the way up and you're getting hurt a little bit less on the way down. And in net, it could be a better way to, it's slightly more volatile dry powder, maybe is the way to think about that. But I think it's interesting. And John Gallegos, I would be remiss to not tell you good morning as well. Thank you for wishing me and Lou a good morning. John says, adding to my boring oil and gas companies and collecting a nice dividend, along with my Brookfield infrastructure additions as well. So I did two things I'm contractually obligated to do as we wrap up this hour, Lou. I responded to John Gallegos when he commented, and I mentioned Brookfield.
Mm-hmm.
So my work here is done.
Yeah, well, thank God we can get rid of that. Fools, I have exciting news because we are about to upgrade. Jeff, there he is. Yeah. Jeff, I had to put up with 2 hours of this. I don't know how
I'm so sorry. I don't often get called an upgrade, but now I understand why you said it.
Yeah. All right. Well, we're going to say goodbye to Jason, and we're going to pause ever so slightly in a subtle way that the audience won't even notice, and then start the 10 a.m. hour.
Hey, Lou, I'll see you around.
Bye, Jason. Thank God he's gone.
Yeah. Now we can really talk about him. All right, fools. It's Jeff. We're here. We're taking your questions. Slido Fool 24 is the key word. As I just mentioned when I was getting all hot and steamy about Live Oak Bank, we are here for educational purposes only, and this does not constitute personalized financial advice. We're not here to tell you what to do. We don't know your situation, and you need to think for yourself, but we certainly do have opinions. Jeff, I was thinking we could spend, the next 20 or 30 minutes with you opining on the banks, because I know that is one of your favorite topics. But we can hit that. We can hit all sorts of things. I did want to mention at the top at 8:00, and fools, if you've come on since, the weekly newsletter, there's all sorts of goodies in there we can get to, but there is a poll. We are ending the first quarter on Monday, Jeff, and absent a really, really good day Monday, we are going to have the worst quarter since 2022, which, honest to God, not that long ago, but it does sound, it was a few years ago. So we're coming out at a quarter, kind of just a temperature check. 3 choices. How do you feel now? What are you looking at? Is kind of the worst over? It's going to get worse. We asked, are your appetite for stocks now aggressive, moderate, or cautious? Kind of love this, but maybe it's a long-term focus, but we are right now 65% aggressive, only 6% cautious, with moderate in the middle. That's I think long-term thinking, which is really good. But get in there, vote on that. Really kind of curious to see what you're thinking with in the weekly news. I think I put the link in the Slido if you can't find it, members. And yeah, how you doing today, Jeff?
I'm good. I'm glad you started with that, the article, the weekly news, but also the poll, because that's kind of where I wanted to start this hour's conversation. Because as I was thinking, the show is called The Week in Review. So every Saturday when I come on with you, I think about where was my brain the past week? Like, what were the things that were on my radar? And
what happened?
What happened this past week?
Yeah.
And it's interesting because a couple of weeks ago, it was all the headlines were the market's down and everything's red, and then we had those, I don't know, about a week of up days, like, or more up days than down days, and then it seemed like everyone stopped talking about that. And then all of a sudden, another week where the S&P is down over the course of the 5 days, and here we are again talking about heading back into correction territory. And so it a couple thoughts on that. One is, it's just interesting to me how quickly the narrative out in the investing zeitgeist can shift. All it takes is a couple days of down market, and people seem to be right back into fear mode. But the poll is interesting to me, that so many people said aggressive, because a lot of this has to do with where you are in life in terms of your investing horizon. I mean, I could see the uncertainty in the markets right now being a lot less exciting and a lot more fear-inducing if you are within a few years of retirement, or maybe even in retirement, or if you're living off of your portfolio or anything like that. But if you're in a position where you still have a decade or two of being a net buyer of stocks, this is an opportunity. And it's the thing I learned going through as an individual stock investor. It was the thing I learned going through 2022, and how hard it felt to buy at times, how I hated my portfolio. I thought I was the worst investor in the world. But then when it was over and things recovered and we went through 2023 and things were back heading to all-time highs and feeling actually overvalued again, I remember feeling like I let an opportunity slip through my fingers because maybe I wasn't aggressive enough when the market was down. And that's easy to say when the market's up, right? Your mindset is completely different. So yeah, I've been using this as an opportunity to not change how often I buy. We've talked about this before. I'm pretty much a regular, once or twice a month I buy something. But feeling like there's a lot more opportunity in terms of the stocks I own and adding to them. I'm seeing a lot more value. I'm seeing a lot more companies I really admire at lower prices than the last time or times I purchased stock in that company, and trying to keep that long-term mindset so I don't feel the same level of like, oh, is this the right thing to do that I felt in 2022? Because the market there will be some time in the future, Lou, you and I will be sitting here talking about, wow, the market's at all-time highs, and it's definitely switched from fear to greed. And I want the choices I make now to be the ones I look back on in that time and say, well, I'm glad I did that, right? So right. That's where my mind's been this last week, because we had a week of more down days.
Yeah. And kind of getting back to what Jason was and seeing his comments from just before, even if it's tough to look at individual names right now, just the value of just kind of ending up in a total market index as things go down and seeing how that goes. You don't necessarily have to pick the winners if that's, which is hard to do when things are down, but yeah, to stay invested and to try to actually add to your totals if you can, kind of, even if it's just in index funds, it's so important. It's so important. Yeah.
Yeah, absolutely. And the other thing I'd say is, I said at the beginning of my little blurb there, it's probably more fear-inducing if you're near the point of needing that money, but then that's a reason to think about not having that much in the stock market to begin with, right? Being a little more in capital preservation mode as you approach, the time when you need that money versus, if you have a decade or plus until you need it. So
yeah, it's never too late to make the change, but those are the sorts of things that hopefully you want to be thinking about before. stocks go down. I'll say though too that it's funny with that poll. That poll is meant to be a trick question, and the members aren't falling for it, because while it's specifically being asked about kind of preview to second quarter for us, really the answer is who cares what happens in the second quarter, because I am looking well past that. And so I would like to think that some of aggressive winning there isn't saying like, oh, second quarter rocket ship emoji.
Right.
I mean, I think it's saying second quarter, whatever. I'm really excited about what the next X number of years will bring, which, is a good way to be. So good on you, those who have voted, right?
Yeah, for sure.
Yeah. All right, a lot of questions coming in. I'll take one real quick. Players Sluck asked about, good morning, does anyone follow ASTS, AST Space Mobile? I like Space Mobile better. Because
It sounds like it should be above a crib.
yeah. So these guys, what they do is they're going to turn all of our cell phones into satellite phones. They have a technology. I mean, we've had satellite phones forever, but they're big and clunky with these huge antennas. They have and this has kind of gone from, I always talk about A, is it a good science project? And B, is it a good business? They've done a lot better than I thought they would on the whole science project thing. They have actually launched some test satellites, and they have had success connecting their normal off-the-shelf smartphones with these things. And the promise is obvious. No more cell towers, no more, hard to reach areas, dead spots, cell service in the middle of the ocean, whatever. So it's a neat idea. That doesn't necessarily make it a great business, though. I mean, I think the jury is still out on that. The real thing here is that they are, maybe going to see trickles of revenue in 2025, but they are a long way out from having the satellite fleet that they need to really serve this market and generate consistent revenue. Meanwhile, they burned through $300 million in cash, and that's not going to slow anytime soon. They have a ton of cash that they need to go through. Also, you can't solve physics, or you can't change physics. Latency. It is always going to be a little worse option for most of the planet that has decent cell service. So while there is a huge market opportunity here, it isn't necessarily we're going to replace the cell towers, because cell towers are just are a better option. This one, I would say, if you if you want to get in, make it a small part of a diversified portfolio. I would be surprised if it turns out, but they've come a lot further than I thought they would just on the science side. So I might just be wrong on this one.
It's interesting. I don't know this company at all, but you had me hooked a little bit at turning all of our cell phones into satellite phones. It's an interesting proposition, but as soon as you said latency, I think that might be the difficult thing to overcome there, especially considering how we are so used to everything being instantaneous.
Yeah, it's just always going to cost more, and it's always going to have just the disadvantages of geography. It can fill a niche. But again, is that going to be a good growth stock if that is its niche?
Right. Yeah.
All
right. Question came in a couple of minutes ago, addressed to me. Howdy, Jeff. Outset Medical is now a better Outset Medical now a better opportunity than ever. Adequate.
It's a great looking chart now, right? Over the last week or 2 weeks. Yeah. I mean, that's not funny.
Adequate balance sheet. Management bought in, now 90% owned by institutions, 17 million shares float, and a tiny market cap. So this has been a running joke for those who know that I was a big fan of this company, and it has just been absolutely destroyed by the market. It did the kind of stock split that you don't want to see, which is a reverse stock split last week. And that's basically when you hit penny stock territory, you do a reverse stock split to get your share price back up. I think it was trading around 46 cents a share before the reverse split. So that's why they did that. But I have to say, Lou, in terms of, is it a better opportunity than ever? I will tell you what I think is still promising about this company, and then I will tell you what I'm waiting for before I come anywhere near considering adding to this position, which for me is down about 96%. This is about as close to something going to a zero as I have ever experienced. So first thing, I still think this company has a very compelling product. If anyone doesn't know, they make a mini fridge sized dialysis machine called the Tableau. It is it can be used in a hospital setting, in an acute setting, in the home setting, and it makes getting dialysis a lot more convenient and a lot less onerous. I mean, that is something you have to do for multiple hours, multiple times a week. It is not a great lifestyle, and anything that can be done to make it better, I'm a big fan of. So I root for this company. I want it to succeed. However, if you've ever looked into the dialysis market, this is not something that its competitors are going to lay down and let them start to break in on, even though they seem to have a product that is significantly less expensive to operate and to use for the hospitals and acute and subacute settings. And obviously it's one of its home use, I think, is compelling as well. So here's what's interesting and good. So the last 4 quarters have seen improving revenue growth. It is still year over year losses, but that's improving. Its profitability is slowly improving, although it is still very unprofitable. Its cash generation is slowly improving, although it is still burning cash, both on the operating cash flow side and on the free cash flow side. But that being said, if the trends continue and it works its way towards profitability and it works its way towards cash generation, and if it can slowly return to revenue growth, I could see this, working its way back into being an interesting company. I don't think I'd go anywhere near adding to my position, Lou, until I see it get real close to profitability. And I think it's such a small company now, and it's been beat down so much that even if I waited until it got to profitability and then bought more shares, I think it would probably still work out as long as it can continue on that trajectory for years to come. So, if you look at the numbers in terms of trends, it's not terrible. I mean, gross margin, just as an example, 2 years ago, 15.6%, 1 year ago, 25.3%, this past quarter, 36.6%. So everything's heading in the right direction, just really, really, really slowly. It absolutely got ahead of its skis in terms of valuation back when I bought it. That's part of the reason my position's down so badly. But, management mistakes with, they had a recall they had to fight through and get submit more paperwork to the FDA. So I just need to see much more progress towards profitability. I need to see some more evidence that they're able to grow in this market before I think it's a compelling opportunity. I would say that, but it's not. If you look at what the stock's done and then look at the results, you might say to yourself, like, interesting. It doesn't seem as bad as one would think. So I don't know. It's the running joke with me because I've been talking about it so much, but I really just want to hang on and see what happens.
It is fascinating how in some industries, and I think healthcare is one of them, and I get that doctors are risk averse by nature. You're trying to, but just even when something seems like better mousetraps and stuff, kind of just how slow the adoption curve can be. I think that that's a good investing lesson for almost medtech, and certainly it's not just. I mean, I think this is true in a lot of areas where the results can be catastrophic, fatal, or whatever. If that we don't embrace new technology as fast, it doesn't mean that it can't get there eventually. Whether or not that works out for shareholders or the original owners of the company, or that varies from case to case. But that is sort of just an interesting takeaway from here, is that why this should be everywhere, right? Because just it makes so much, but it is just there's, I mean, and with such a complex world as far as just how healthcare payments are done and all that, it's never as fast and as easy as your brain / common sense as it should be.
Yeah. And I mean, so there was a follow-up question here from Luxury Hot Dogs, which is a great name, by the way.
Yeah, another great band name. We were doing band names earlier, Jeff.
I love that. The question is, what was Outset Medical's plan for getting ahead of Baxter's entrenched home dialysis business? I don't know anything about Baxter's home dialysis business. I've not looked into the competitors of Outset that closely. I will say this. Outset only reports its install base every year. So when they do their Q4, the 10K comes out. That's the only place. But in the end of 2022, they had a total install base of 4,000. 3,200 of that was acute and subacute, and 800 of that was in the home. That grew 34% overall the following year, 63% growth for the home. But then in this past year, it slowed to 12% overall and 10% in the home. Now, part of that is they were fighting through this FDA recall and some other kind of headwinds. But because they only report it once a year, I have to wait a really long time to see if that is going to be is mid-teens, low teens percent going to be the growth rate? Is it going to slip further? Is it going to reaccelerate? Like that's kind of why I'm saying I'm waiting. If they can get to 20-30% growth every year, that's fine in my mind. Like I think that they'll get there slowly in terms of growing into a profitable business. But who knows how long that takes. So it's a wait and see for me. But this will be a nice little investing lesson for me to learn over time. Yeah.
And look, I mean, all right, fools, keep getting those band names in there. That to me is suddenly more interesting than anything else. But no, I'm kidding. For the Bees had, I think, a good question. And for the Bees, hope you're well, doing well. Hopefully spring has come to that part of the world. Is the stock market moved more by automatic AI type trades, large corporate fund managers, or collective panicking, or euphoric individual investors?
Yes.
Yes. Yeah. I mean, that's a good question, but it's actually a fascinating kind of behind the scene thing. A bunch of thoughts here. For one, you said the stock market, and I think that's correct. I do think that it does vary wildly based on the companies. There are some that we say has a huge retail base, and that is more going to be collective panicking or euphoric individual investors. There are some where there just isn't the float because either management owns it all, or there's kind of just it's very, very owned by mutual funds. So it does vary by stock, but inside the market, in a way, we're using the word AI now. We used algos a few years ago. We used programmatic traders before that. There has always been something. And ever since we invented mainframes, there has been especially sophisticated investors trying to use technology to get ahead of the market. That always, to some extent, moves the market. Is it more today than it was? I don't know. Probably to some extent because tech keeps getting cheaper, but probably, look, to some extent, we're all using technology to drive our trades a little more than we used to. So that's hard to quantify. Large corporate fund managers, I will say this. I do think that almost we came off of one of the least volatile years in history, Jeff, last year, although it didn't feel like it. And volatility has been largely trending down, with noticeable exceptions, mind you. Part of me, my grand thesis on that is that especially after 2008, just the wipeout of pensions and the rise of 401ks, there's an argument to be made that passive investing is actually what drives the market, and that is less volatile. And so that is, kind of driving things in the right direction. The further complicating here, and I mean, I'm just so determined not to answer your question for to be sorry, but if you look at it in one thing that technology has done is increasingly, especially sophisticated traders, be it AI traders or corporate fund managers, they don't need the exchanges. The so-called dark money or the dark pools are just trading off exchange. If I am a huge trader and Jeff is a huge trader, and we can just strike a deal and not go through the system, and that never gets reported really, so it's kind of not great for price transparency long term. But in that sense, in some cases, these big shops that maybe want to be a little discreet about their trading aren't moving the market at all. So I think the answer at the end of the day is what Jeff said. Yes, it's everything. I think the weighting varies by stock, but largely, I think it does all balance out. I think for any volatility added by some of these factors, there are factors like the rise of, just look at the size of passive index funds right now, and look at how much of those are in, retirement accounts where they're not getting redemptions all the time, right? I mean, they are, but their net growth. I think if anything, a lot of these factors can act as a calming effect on markets at times. And so the big thing is that, yeah, it's just a little bit of everything, I think. How's that for not answering a question?
No, I think you answered it. I mean, because that is the answer. And what I was thinking as you were going through that is like, when I think about the automatic, the AI type trades, like to me, that's where you see the volatility and the market movement that happens very quickly and in short periods of time. So here's an example. A company is reporting earnings on whatever day after the market closes. If you are, and you and I have both had to do this when we're trying to like report on earnings, either for Full 24 or to write something, where you're just kind of like clicking refresh to wait for the press release or whatever. Meanwhile, while you're still waiting for the press release to be uploaded to the website, the stock is up 12% or down 15% because
someone saw something, right?
and there's computers and algorithms that are scraping the internet and within milliseconds, it can process what it needs to process and make a sell or buy decision. So that's how you see, before really any human has a chance to even digest the information, a huge market move, right? So, and then of course, what happens? Well, then investors who don't either know any better or want to take the time themselves see, oh man, this is down 20%. I better sell. And that just adds to it. This is also why sometimes you'll see aftermarket moves really big in one direction or the other. But then by the time either the conference call is over, or by the time the market opens the next day, or maybe over the course of a market day, if it's a before market earnings release, it reverses or levels out, or it gets less severe in one direction or the other. So I feel like the automated stuff is what triggers the immediate response. And then I think over time, you said, it kind of shakes out, because then all the individual investors have time to process and think and make a decision. And then volatility, I think, is going to continue to slow over time as we see more passive investing, more index funds, more ETFs that are less actively managed and more passive. So yeah, I think it's all those things at all different times, and they all interact with one another. The humans, I think, kind of follow the trends that get set by the automated stuff, but then, after a month of that news event, it sort of settles to where it should be. And then I think the market gets about as efficient as it will over time.
Yeah. A couple more things, because you make some really good points. I do think aftermarkets is largely, or kind of when the market is closed, is largely driven by computer trading or the big funds. Right. And I don't even want to call it smart trading, because some of that is as stupid as just find keywords, sell, or something like that. So you do get in trouble with that. But just a combination of kind of the speed which it moves, and depending on your brokerage account, for a lot of individual investors, it's still kind of a pain to trade aftermarket. If you want to know sort of, and this isn't necessarily, I would call it a baseline case, but if you want to know kind of like a danger as a long-term investor, I mentioned the off exchange trading. It is growing. There's still plenty, and that is bad for price discovery, because basically the reason this market works so well is because we are all in this together, and the massive group is trying to figure out what they would pay, what they, or what they would sell at. Anything that goes off of these exchanges is just degrading that price discovery a bit. With all this talk, the other thing to note is that, the other side of this question is that the time of day matters. Mm-hmm. If you look, volume, like something I forget, but I think more than half of the volume in a day is in the last half hour, and some of it's at the top, and that is mostly the institutional money coming in and doing what they do. in a world where if we are moving to 24-hour trading and the aftermarket becomes the real market, a world where we don't have that volume spike or we have to reorient that, and we have an increasing amount of trading moving off the exchanges, there is a doomsday scenario where price discovery just becomes really, really crummy. I mean, I think it's still acceptable now, but moving in the wrong direction. I do worry, this is long-term. I don't know if I'll even be in the market here, but I do worry about unintended consequences about some of these, quote, democratizing the markets by, taking down fees, moving off exchange, opening it up 24/7. Could be a nasty side effect of just kind of sucking volume when we need it that makes price discovery worse, if that makes sense.
Yeah, no, it does. It is interesting to think about stuff like, the impact of passive investing, the impact of like expanding trading hours, the impact of making it easier to trade. Like there's all these second order effects that I don't think are always thought through, but it's interesting to see how it goes over time. All right, Cyber Mikey sharing a band name, Falling Machete. That's pretty good. I like that.
That's not bad at all.
That's a decent one. All right. If there's anything in the queue here you want to grab, Lou, if not, I can grab one, or we can talk other things.
And I tell you, and I shouldn't even share this because of what it says about me, but a high school band, just because we all thought it was really funny to say, sweating profusely. Just because we thought it was really funny to be up there saying, hello, we are sweating profusely. Anyway, there's got to be better content there than that. And I mean, look, if only we could have been the luxury hot dogs. God,
yeah. Maybe that'll be our theme next week, Lou. We'll just do investing related band names. That'll be the hour.
My life would have turned out so much better. All right. Now, what else we got? All right. Sorry.
So here's a question from Go Habs Go about Block that I think will be fun to talk through. So Block, ticker XYZ, which is just whatever, has been disappointing since 2020-ish. What do you see is Jack Dorsey's vision? So I'm gonna kick things off here because I this is not a stock I have followed recently, but I used to own it. I used to follow it very closely. And the reason I sold it is because I did not have clarity on Jack Dorsey's vision. Which is why I thought this would be a fun one to talk through.
Can I just interrupt you? I'm a little. I don't know if I want clarity into Jack Dorsey's brain, but anyway, keep going.
Well, and I put it's related to. It's funny. I was a time where I owned both PayPal and Block for kind of the same reasons, right? I thought digital payments is a durable trend that will, be here in the future. Again, like thinking about secular trend investing, right? What's going to be more popular, more in use, more ubiquitous 10, 20 years from now than it is now? And I thought to myself, people sending money to each other on apps and paying for things that way. And also point of sales, going into stores and just tapping your card on the screen and getting, and it felt like PayPal and Block made a nice little two stock basket in my portfolio to kind of play that trend. And as time went on, I got frustrated with both companies for similar reasons. They weren't doing well as investments, step one. And I could not wrap my head around how that was possible because of they were like the big players in peer-to-peer payments. They are big players in point of sales, in online payments. And I ended up selling Block mostly because it seemed to me like Jack Dorsey was a little too distracted by crypto things. And I thought he was taking his eye off the ball a little bit as it pertained to Block. And to my point, he changed the name of the company from Square to Block.
Yeah. When someone tells you who they are, believe them, right?
Exactly. And conversely, I ended up hanging on to PayPal, and I'm glad I did because now it's the company that I have a lot more conviction in with their new management team, and I think they're taking steps in the right direction to kind of go back to their core and not be going. They wanted to be an everything app at one point, and now they're just trying to focus on highly engaged users. And I don't feel like Block really had that focus or has come back to that focus. The acquisition of Tidal made no sense to me. Which was a streaming service that Jay-Z owned, I believe. I had a friend
really
who speculated that he only bought that company to hang out with Jay-Z.
Yeah, that's
So it just
yeah.
that's what I don't know what his vision is. This is exactly why I ended up selling the stock. Now I don't know. Again, I probably sold it 2 years ago at this point, so I don't know if the vision has gotten clearer since then. I'm not currently a shareholder, but that was my reason for bailing.
Yeah. I mean, I kid, but I don't. I have a rule that keeps me. I try to keep my portfolio away from Jack Dorsey and that which has touched Jack Dorsey, just because I not that he isn't a smart guy, but I think history has shown he's not a great business CEO. You know, I mean, he tends to do things on whims. I mean, even back in the Twitter days, it's there's a reason Elon Musk just was able to swoop in and say, "All right, you guys got any better ideas?" And you know, I mean, it just that business always was a great idea and a crummy business. Block is a great idea, and it's been a better than crummy business. So you got that, but I don't know. I mean, I get visionary, but visionary doesn't necessarily translate to market beating performance. I agree with you that other companies that maybe were behind the original Square have caught up and become what we all hope Square would be. I don't see a relevance there almost anymore. I mean I get there's an installed base. Maybe one day Jack will get bored of it and sell off that installed base to someone. But I really don't see a there in terms of like for investing. Yes, it's math, but I also want in my head, like, okay, over the next 5 years, they can do this, this, and this. This will happen, and this will happen, and this is why it will be a bigger, better company then. And I just expect Block to be doing weird stuff and continuing to be Block. And
Yeah,
I mean, maybe I'm showing my ignorance, but yeah, just that's their history.
and it's, you know, when you think about it, forgetting the peer-to-peer payment piece, right? They own the Cash App, right? Which to me is the lesser of the peer-to-peer payments because, like,
Yes.
and granted, maybe this is just me in my demographic, but nobody that I know uses the Cash App. Now, I know if you talk to younger people, they will tell you that a lot of their friends use the Cash App. So I fully recognize that.
But less so than before. Well, I don't know. At least in my daughter's,
It's also regional. I remember from when I owned it and I was looking into it, like there are pockets of the country where they are more established. But taking that off the table for a second and just talking about the point of sale system, right? Like they were the first mover in this space. That little thing that you could plug into the headphone jack of your iPhone 15 years ago and swipe a credit card was pretty revolutionary, right? Like that really opened up the opportunity for farmers markets and craft fairs and whatever to take, you know, credit card payments and not have to be carrying around cash boxes and things like that. And this is my point about management. That to me, that was an incredible first mover advantage that to me feels very squandered because when I think point of sale systems now, I think of Toast and Sezzle and Clover, and then all the other, you know, ones that have come along since. And it just feels like if they had a more focused management team, if they had a better plan to kind of capitalize on being the first ones out there to do it, I don't know. It just feels like a lost opportunity to me. And you know, I still see Square terminals out and about in stores and things like that. But I don't think anyone really has cornered that market. It's one of the reasons, despite its incredible results, I've not invested in Toast yet. I can't see a clear winner in this space, and maybe the numbers are slowly proving me wrong there. But just using that one company as an example for the point of sales part of the business, like I don't know if you told me I had to pick a point of sales business right now to buy, I'd pick Toast before I'd pick Square. And Square did it 15 years ago, right? So like that ties back to the Jack Dorsey thing, right? Like, why are you buying a streaming service? Why are you obsessed with crypto? Like, take advantage of your first mover status and be the dominant point of sales company, right? So
yeah, it's weird. It's weird. Yeah.
Yeah.
All right. So this is one, I don't know how much we have to say here, but Mr. Dunning-Kruger asked it. And it's funny, Mr. Dunning-Kruger, because I have a sort of weird, overly inflated sense that I'm an expert in anything you ask. Just something about your name. I don't know, but said thoughts on portfolio management strategies, and particularly the Kelly criterion versus buy and hold. Okay, I am not going to pretend to be an expert on the Kelly criterion. I Jeff, I don't know if you know it. It's the basis is it was a way to win at gambling that has been applied to stocks that kind of just picking out like what your goal is, like what the ultimate the best scenario is, and then figuring out how to invest or deploy money in a way to reach that scenario. It's kind of always argued as anti-diversification just because you're focusing on just one area and trusting the formula to work out. I'm probably not doing it justice. I have never really been compelled to not be lazy. And stuff like this has always been, to me, harder than just find good companies and hold them forever, which is more just diversification, buy and hold. I do not argue that you can find ways to maybe juice the process. I think you add more work and more risk obviously in doing that. But look, life is not out without risk, and finding good companies and holding forever just kind of is based on that huge and uncertain assumption that the companies you find on day one are good. And if in 10 years later you realize, wow, I was really bad at that, you're not, there was a lot of risk there too. I think to me, it's pick your poison. If you are interested in exploring, there's not just the Kelly criterion. There's a lot of different ways that people go about this. There's a lot of chartists that loves to do this stuff. Mm-hmm. There are a lot of different ways to go at it. And if one of them lights your fire, then go for it. For me, what lights my fire is again, lazy, or is to be as little to do with it as I have to, while also being a market junkie and enjoying the market on the other side. But what I buy on the low end of my portfolio and I play with, I don't even consider that almost my portfolio. I have dreams that these stocks will one day become something that I consider in my portfolio, the ones that are going to get me to retirement. But I don't have thoughts as in, I'm not going to tell you it's wrong. I am going to tell you, I think that it's a lot more work, and if you do it wrong, you risk of putting too many eggs in one basket. But if you keep that in mind and be smart about it, and you really want to figure it out, I think that's okay. There's nothing wrong with that. Just know what you're getting into before you do it.
Yeah, I mean, a phrase that I hear around the Fool a lot that I like is, investing can be as difficult or as easy as you want it to be. And I think when it comes to the Kelly criterion or any other, using charts, any other non-buy and hold sort of strategy for investing, my take on it is this: there's probably some people who can make any one of these systems or ways of thinking work for them. It's probably 0.3% of investors have the skill and time and energy and interest in spending that much effort to be a winning investor. So I don't think there's any system out there that can't work if the right person with the right brain and the right amount of time works on it. But are you that person? Probably not, right? Like it just, statistically speaking, any individual person thinking about this is probably not going to be the kind of person that can do that. So for most people, I feel like, and you and I included, the buy and hold method is probably the preferred way. And the other reason I feel pretty strongly that works is, and this is the lesson I learned about investing long before I became a Motley Fool member or a contractor or even a buyer of individual stocks, which is, if you just buy index funds routinely over decades, you'll have enough money to retire. Like, that simple concept. And that's what I learned from just contributing to retirement accounts from, basically the beginning of my working career, and then getting those statements in the mail every 3 months and being like, oh, wow, look how much more money I have, and looking back here now, 24 years into my working life as an adult, and knowing that I'm in good shape, on track to retire like I want to, because of index funds and mutual funds and ETFs, not because of individual stocks. And that's both in my account and my wife's account, right? It's not just entirely me. So um, I just know it can work. Just sort of the hands-off lazy method can work, provided it's time in the market, right? By the time I get to retirement, it will be 40-ish years of doing that. So yeah, I think anything can work for the right person, but for me, I'm in the boat with you. I try to be less active, to not kneecap my own results.
Right. Yeah. I mean, yeah. Again, I think it comes down to what you want to do. So, yeah. I mean, I would love to pan it. It makes better radio if we panned it. But no, I mean, if it's something that, I don't doubt that people have done quite well on it. But yeah. All right. It's just looking, the artist formerly known as Square down 80% off of where it was in 2021, which I didn't realize it was. For the Bee said, we use Square in our small farm business, still used by a lot of crafters and farmers we know, but I'm wondering about the stock. It's a loser in a basket. It's been tough. I was just curious, Jeff. I went on just at my transcript service that Jack does still participate in the conference calls. And fools, tell us what we're missing here, because this is the level of ignorance. This to me is Jack, and I'm sure we can just kind of do this. I'm picking on him because he could do this with probably any CEO, right? But Jack says, this is just a few weeks ago on the or February 20th call. Looking ahead, we are focused on connecting local communities block by block through our neighborhood networking strategy, investing in AI automation, open source innovation, and Bitcoin infrastructure, all with the goal of expanding financial accessibility globally. If you haven't yet, please read our letter for more details.
No idea what that means.
I still don't know what they're up to. Yeah, I was gonna say, but again, I'm that's probably unfair. You could probably pull up a Brad Jacobs thing for me, and kind of hear just as much gobbledygook.
Yeah,
right?
corporate speak is pretty ubiquitous. So but it is funny to tease a little bit.
Cyber Monkey says, Cyber Monkey, I keep doing this to you. Why do I keep calling you Cyber Monkey? I don't know.
Either one are cool names, but it is Cyber Monkey.
Yeah, but Cyber Monkey. My portfolio strategy is a cage match all in once when it's ready to build a position. Cyber, we've talked about this, and yeah, I definitely agree. Is that I get all of the formulaic stuff, and I get just people saying I'm going to buy in thirds, and I understand it, and I'm not dismissing the value. But every time I'm going to put money into a stock, it's going to be based on everything I think today and what I think is the best use of that money today. And even if you do have a big formula, and even if you do have like, I'm going to buy in thirds because I need to remain disciplined, all that's fine. But don't forget that part. I don't want you to be held hostage by what you were thinking 3, 6, 9 months ago. And when things on the ground could have changed, or your thoughts could have changed. So there is, the nice thing is, or the hard part is, there isn't one set formula for success. The good news is that you can have a lot of variables in your head, and no matter how you do it, at least keep this in mind. Don't make decisions based on all of the available information at any given moment.
Yeah, I mean, I'm the same. I feel the same way as you, Lou. I do the same thing. But I think, I think about this a lot, because like an investor that I admire, for example, is Motley Fool co-founder David Gardner, who has said very explicitly, like, buy in thirds and don't not do it, right? Like, if you're going to buy block, just to use the stock we were just talking about, and you're going to want to buy in thirds, and whatever your timeline is, commit to it and do it. And he's very, very insistent that you do that, right? Make the decision and do it, because that's how he invests. But the thing everyone has to remember is you also have to have the mindset to stick with that and not be shaken out of it. And I think if you're going to give David Gardner credit for anything, it's just being completely comfortable with his own investing style, right? Like, you and I were in the room, Lou, at Fool Fest last July, in the middle of NVIDIA blowing up stock-wise, just to the moon. And he stood on stage and said, I'd buy it today. Right. And I think anyone has like a little bit of a value investor bent to them was probably like, well, maybe not today. maybe let it cool off a little bit. But that's how he invests. And
Yeah.
the track record speaks for itself. But I think the point is really for him, that's just, this is what I do. It's normal. Just like for you and I, it's no, I'm going to make a more decision based on all the factors today. And I don't think any one is correct if the right person's using the right strategy, so yeah, I think a lot of these questions boil down to like, what can you as the investor, what can I as the investor, what can Lou as the investor sleep at night with, right? Like I could do anything that someone else does. I could buy in thirds, right? I'll just set a calendar thing, and I'll do it today and in a month and in a month. And I could do that. But if that third one rolls around and that stock has gone up 400%, will I really, and then I do it, will I kick myself if it doesn't turn out well? You know what I mean? Like I have to know me. And I think that's the big thing. One of the reasons we can't give individual advice, right? Because we don't know any individual person's mindset, temperament, ability to sleep through volatility, all that kind of stuff.
Yeah. I like that. So there's an air cap question, so I have to answer.
And it's tied to what we're talking about in terms of waiting for a lower entry price.
Yeah. So David at Oregon, maybe David's down there. Share interest in air cap, but waiting for lower entry. Fear some hit from interest rate rise on higher inflation data. Other views. Air cap is, I think, as probably people have been on here before, this is a large holding of mine. I don't, first of all, on the entry point, I wouldn't personally hold my breath. Okay. Just for a simple reason. They have traded for just slightly over the book value of their assets for the last 15 years. Almost, I mean, I could pull up a chart. It's a little shaky because there's like occasional counting things, but they're at about 1.1 times book today. Back in 2010 or so, they were at about 0.9 times book. All right. So you do get, I mean, the real time that wasn't true was when everybody was convinced the sky was falling with COVID. But if you take out basically the COVID scare, you will never get this for below 1 times book. And I hope we don't have another COVID. I certainly wouldn't wait for it. So what's the big deal with this company? Well, I think book value is up. Let me see. In that same time period, 520%. So you do actually get some growth from buying at book. As far as the interest rate hit, yeah, near term cost of funding can go up for them. I would note that as they take on more debt, they are buying new aircraft, and they have a pretty good track record right now of they actually have leases signed for the aircraft before they take delivery. So before they actually have to make payment. So you can price today's debt, or you can base your new deliveries. You can base the rates that you're charging airlines based on your cost of capital kind of in real time. I'm not going to say that it's not without hiccups, but if you're thinking about it, yes, if your borrowing costs are coming up, you have to make good on that borrowing at time of delivery, because that's when you have to give cash other than deposits to the manufacturers. If you have that plane already sourced out to where it's going to, you can set your 5-year or whatever it is lease agreement to the current cost of capital. And it doesn't, like I say, it doesn't totally mitigate, but it does sort of eliminate some of the fears with interest rates. This is always going to look like a heavily levered business, and it's always going to look scary from the point of view of its debt. Debt is their raw material. Debt is their tool. And I would argue that if you want to buy this company, you are making a bet that they understand their balance sheet and know how to handle it. And I think history has proven that out pretty well. But yeah, I mean, I would love to get a lower entry point. To me, I don't know. I always think, Jeff, we talked about this for a long time, I think one night, but every quarter they sell assets, and every quarter it seems, especially right now, they are selling assets at a significant multiple to book, like sometimes double the book value that those assets were held for. and those were the stuff they're disposing of. Sure, it's probably the stuff they thought they'd get the best price for, but I believe that, and the data backs it up, I think that they kind of are very conservative in their book value, and yet they are continue to only be valued at that low book value. I doubt we get a significant discount to today, absent another reason that all the airplanes stopped flying for an extended period of time, like we saw in COVID.
Yeah, one of the things I try to do myself when I'm interested in a company, but I'm sort of like worried about it being too expensive or waiting for an entry point, is I try to still buy a little bit, like now, like when I'm interested, because for two reasons. One, I don't like it. It's a way for me to not let myself try to time the market or wait for a dip, because sometimes you don't ever get the dip, right? Like sometimes a year goes by, you lose out on 100% gains because you were waiting. So I try to like just buy a little when I'm interested, right? When all of my little check boxes are checked in terms of what I'm looking for to make a buy decision, I'll buy some. Now, the amount I buy, the way I size that position might change if I feel like at the time it's overvalued, right? So for example, I've talked recently about how I finally bit the bullet and bought some Costco after waiting forever because I thought it was too expensive. And of course, as soon as I bought it, it went down like 15%. But I purposely only bought a little bit because A, I knew it was overvalued, and B, I figured there'd be better buying opportunities down the road. So I haven't added to it since, but at some point I will. It'll probably be cheaper than when I bought it, just because that's what happened since I bought it. So I might buy slightly larger amount now that it's cheaper, right? Like, so there's a way to kind of do both, I think. Buy a little along the way and learn and kind of not miss out, but then also don't back up the truck if you think you're waiting for that better value, right? So that's the way I think about it. That's what I've done, like with Costco as an example. All right, we had a question from Lovely Lily, which I assume it says, so would you the trade desk today? I'm assuming that means, so would you buy the trade desk today? I'm going to guess that's what she means. So I'm not going to say if I would or wouldn't today, because it gets a little close to personalized advice, but I can tell you how I think about the company and what I did in the past. And I think it would help answer the question. So just for perspective, after the huge sell-off that we saw with the trade desk after it reported its Q4 earnings about a month ago, it's down to a price that we haven't seen since early 2023, right? So it erased, almost basically 2 years worth of price gains, just from that one report. Now, on a price to earnings metric, it's still more expensive than it was even at its low point of 63 about 5 years ago. It's at 72 now, right? So the price has fallen significantly. If you look at like price to earnings just as one valuation metric, it's still expensive, right? It hasn't gotten cheap from that perspective. And I think this is tied exactly to what we were just talking about, but like in a different way, right? Like we were talking with AirCap, like what do you do when you think it's a little too expensive and you're waiting for a lower value? To me, the trade desk is the question. What do you do when it's fallen a lot? And I wouldn't say as much conviction in the business as I did before that earnings call, because I could be wrong. That could be the beginning of a bad trend. I don't know. I'm going to give the management team the benefit of the doubt right now, because they've had pretty much a perfect track record of setting and beating guidance. But I'm thinking of this the same way. Like whenever the question is, would you buy now? I think the answer is, for me, the answer is if all of the things I'm looking for in the business are still intact, I probably just buy a little along the way. And just sort of same thing. The size of the position for me might be the thing that changes as I regain confidence. I want to see what the trade desk does in Q1. They set guidance that was well below what it normally is. Sandbag might be a strong word, but I do wonder if they were extra conservative in setting that so that they don't miss 2 quarters in a row. Like that has to play into their psychology, I would imagine, after 33 consecutive quarters of not missing, right? I'd just be a little extra conservative to try to not have that happen again. So I want to see in Q1, like, is it that bad? Is it as bad as the guidance suggested, or will they beat that guidance and sort of get back on track? And I'll probably make another decision at that point. Like personally, I did buy a little bit after the earnings report. It fell significant, it fell significantly after I bought, because I bought sort of in the middle of the long downtrend. But it's fine. Like, I'm not like losing sleep over that. It was just a little bit. It was like a little bit of bet on the future that I think they're going to be okay. But I personally, when I do things like that, I usually wait till there's more information before making a second decision, right? Just to kind of make sure I'm not missing something.
This is such a great example why it's so hard to time the market in my mind, because I can make either case for the next few months, or actually we're basically to the end of the first quarter. So, the coming quarter, I can make the case that everything Jeff Green said that he has to do is going to take far more than 3 months. And so therefore the issues that were identified will not be addressed in this quarter. I can also make the case that the halo is off this now because it did drop 30%, and the idea that they can do no wrong has been eliminated. And they did seemingly try to reset investor expectations to a level that they could easily beat. And then look, everybody's happy again and the stock goes up. So I think both in the near term are totally reasonable. What I said before about them as a long-term holder who did nothing through this, I still like the potential here. And I actually like a CEO who I think it's very, very rare to find a founder who is also the perfect person to manage the day-to-day of a multi-billion-dollar enterprise. It's just a lot to get right. Mm-hmm. I appreciate a CEO who says, my bad, here's how we're fixing it, and actually comes up with concrete things. Now, I mean, yes, you have to watch to make sure they follow through on it. I'm not just giving them a pass. But my decision on the trade desk is to say, all right, well, I appreciate that they've identified these things. I appreciate that, the kind of the humble of a CEO saying, okay, I need to fix this. And I remain hopeful that the opportunity's there and we have the right management team in place for the long term. Whether or not that means today it's a buy, I don't know. I already own it. I'm not in any rush, but I think it probably turns out well from here over the long term. I hope.
Yeah, I mean, the question for me, again, if I fell asleep today and woke up in 20 years, do I think the trade desk is going to be better positioned than now? I would answer yes. Mm-hmm. The question is, what's the right price to pay for this company now? And what I wonder is, maybe moving forward, the idea of paying even 70 times earnings, which is what it is right now, is not correct.
Yeah.
Right. Like maybe it's just going to settle into a place where it's always an expensive stock, but not that expensive. So that's kind of why I'm not in a rush to add again to my position. I want to see, where does this kind of shake out in terms of like, what's a normal price to pay for this company? All right, we got 1 minute left. I'll answer this question that was addressed to me really quick before we hop off and turn it over. From Jeff M, asking me what index funds I hold, what have been the best performers. Do you buy hibernating stocks like Berkshire? Lou mentioned what I'd call a hibernating stock, TDG. That's TransDigm, right?
Yes.
So real quick, I don't own TransDigm. I do own Berkshire. I do think it's a hibernating stock. It's just ballast in my stock portfolio. Index funds, real quick. The biggest amount of money is probably in my wife's target date fund. The best performing is probably, it's not an index fund, but we have a lot of money in VOO, which is the Vanguard S&P 500 ETF. That's probably done the best because it's just tracking the S&P 500, and the S&P 500 has done pretty well. I have my retirement account in just 4 Vanguard index funds that track the total US market, total international market, total US bond market, total international bond market. Real simple, that they're not equally weighted, more heavily towards stocks. I don't know if that's correct or good or right. That's just where I landed when I set it up years ago. But we're pretty diversified across like my wife and I's total investments. So I don't really know which is the best performer, but that's just the big pot of money that I think is going to slowly let us retire. And the stocks are just a small part that I enjoy the most. So
you know what, Jeff? I don't know if it's perfect or not, but I am very, very confident it's good enough. And really, that's what matters.
What matters to me is what Lou thinks about it. So thank you, Lou.
There you go.
Appreciate that.
Good enough. All right, but what really matters, and let's bring Asit and Will in here, because look, stocks, blah, blah, blah. I'm sure they're going to get to stocks and they're going to do a lot better with providing insight. But we got to pick a band name now. So I don't know. Asit, Will, I'm going to give 5 choices as we end this hour. And I need an answer here if we can bring them in. We have, and Jeff, you can go first here, luxury hot dogs, weird people whispering, the knockoff Lulus, the Motley toupees, and falling machete.
Those are so good. They're all so good.
Yeah.
Yeah.
I think I'm a sucker for knockoff Lulus because I always wanted to be in a ska band, and that just sounds like a ska band to me.
I like the hot dog one. What was the hot dog one?
Luxury hot dogs.
Luxury hot dog. That might be my pick, but we'll
right.
let Asit and Will weigh in on the best band
Yeah,
name.
yeah.
Guys,
Come
this
on,
is
Asit.
brilliant. This is why you're having such a hard time, because all of these are fun.
Yeah.
This reminds me, I have a document. It's a Google Doc that's like 11 years old now. My best friend and I started for band titles and then song titles. Now, have we written a song together in these last 11 years? No.
No, Asit,
But
you and I should compare
I
notes because
like-
I have a list as well, and I'd love to know what yours are. So
There
we'll
you
do this
go.
one day.
But I like these. My vote, maybe knock off Lulu's. Will, what do you say?
I'm partial to falling machetes myself.
There you go. There you go.
That's me.
See, Will is metal. That sounds metal.
Yeah.
Will
I
is
had a
metal.
bad experience with a falling machete
Yeah.
a long time ago. So
Well, we
just
all
kidding.
have.
Don't
That's
anyone
why
get
it's
upset. I have
creative.
my 4th finger.
Yeah.
All right.
Yeah.
I'm glad
All
that
right.
we're setting things off super silly for you guys in the beginning of the
Yeah.
hour. So enjoy.
Well, if this is what happens when you get me for 3 hours in the morning. But Jeff, it's been fun. Asit, Will, we have overstayed our welcome, so we will say have a great show. And
All right.
good to see you guys.
See you
fools.
guys.
Come on, guys.
See you soon. All right. Well, here we are together. Will, I think this is our 3rd time together, maybe?
I think so. It's been a few weeks now, but it's good to be back with you.
Same. And I'm Asit Sharma, streaming from Raleigh, North Carolina. Will, remind me where you are coming from?
I'm in the Dallas area.
Nice. Okay. So is it hot there already?
Not yet. This is actually the time of year where the weather's near perfect, say for the massive storms that come in and do a lot of property damage. But other than that, it's nice right now.
Right. Well, stay pleasant and stay safe. So we're going to talk consumer goods stocks and tech stocks today. Throw those questions at us. I already see at least one in the queue. And there's some left over from an hour ago as well, Will, that we can tackle. I wanted to shout out to Luella, who's a frequent listener and member of the Mindset community, which is on Full 24 at 11 a.m. every Monday Eastern Standard Time, who says, in college, our floor hockey team was shut up and drink. Too much information. We'll give you a pass, Luella. I like that. And let me see any leftover band names. I think that's it. So, if you see one that you want to take, you can. I've got one that I can jump into as well.
Yeah, I have a few. So either way,
Go for it.
I'll take this one because I thought it was interesting. I hadn't followed this stock in a while. KSS, which is Kohl's. Jeff M about 15 or 16 hours ago said Kohl's cut the dividend significantly, 50%. Actually, it was 75%. So yeah. I used to actually shop at Kohl's, and I haven't been there in a while, and maybe I should visit again. But it's like, because I think they kind of changed their concepts as I was visiting regularly. But they've been struggling with declining revenue just on account of all the competition in the retail market right now. They've been pivoting into brand relationships. Can't get off that band theme. But yeah, they've been pivoting into brand relationships. I see their partners with Sephora in the store that's nearby me. So I probably need to visit that again to see what's going on with that business. But yes, they've been struggling with declining revenue for a while. Their stock price has fallen. Yeah, I don't have a good feeling about the stock personally, but yeah, they got to figure out a way to get a competitive advantage again. I don't know how they get there personally. So yeah, I'm not surprised by the by the massive cut in the dividend. Despite the massive cut, though, I think the yield was still above 5%. So let me see. Yeah, the yield's 5.9% right now, despite the dividend cut. So, but given its direction, I would frankly expect another dividend cut. If you know anything about dividends, a company can adjust or eliminate its dividend anytime it wants to, pretty much. So, I wouldn't be surprised if it was on the way to just suspending the dividend completely. But yeah, I'm not really optimistic about this. Despite the high dividend yield, I would not look here for dividend income.
All right, great. So I'll tackle this question from Lovely Lily, the most recent question, which is Wolfspeed crashed yesterday. What happened? So Lovely Lily, this is a company that I don't follow very closely. They do happen to be right here in my backyard in North Carolina. Wolfspeed is a very specialized company. It has a history that goes back many, many years. The Wolfspeed name is relatively new, but in essence, for those of you who don't know, Wolfspeed focuses on a sort of advanced type of substrate for semiconductors. They're called SiC materials. So silicon carbide is basically the substrate, and their semiconductor materials are used by the automotive industry. Now they're taking some technology that was developed by the predecessor company, which I believe traces back to Cree, if you all are familiar with that name. And they have been building these state-of-the-art facilities. There are two of them in North Carolina. One is here in Durham, and there's another one just outside of the Durham area, within about an hour's drive, I believe. And it's a company that, because it's still like proving out its technology, is relying on some funding from the CHIPS Act, and that they were like one of the last major grants of the CHIP Act, which was passed in the Biden administration, to receive their funding. And then the transition to power happened, and that was the last big grant that didn't get passed through. And the Trump administration is very skeptical of the efficacy of the act, so they're looking very closely at whether they should dole out the rest of the money or not. President Trump himself has expressed a lot of skepticism about the investment. So they're hitting basically a little bit of a liquidity issue. And I think the catalyst yesterday was the company terminated its CEO without cause, I think effective the 1st of May. And so while they're trying to work with automobile manufacturers and win contracts, waiting for that funding and building out these complex plants, you have really what's becoming a liquidity issue. So can you pay your bills within a year? And a solvency issue, which is they have a big note coming up that they have to refinance. It's a convertible bond that's due in 2026. So while I can't say that I understand the technology intimately, I spent a lot of time in the semiconductor industry. I just have never had or allocated the time really to Wolfspeed, because they're still, to me, more in development phase. I haven't spent the amount of time to be able to give you an opinion on whether it's worth holding on to shares. I know there's at least one service that had recommended Wolfspeed now probably 3 years ago at the Motley Fool. I think that was in Showdown. I would say if I were holding shares, I'd be looking at that balance sheet, looking at cash flow projections, trying to get some read on whether the company can remain solvent. Liquidity, usually you can skate for a while, but when notes come due and you can't pay current bills, it's a difficult situation. So when I saw that 48% plus drop, it signaled to me that it's really about the cash flow for the company, and that's where I would look next. Okay, back to you, Will.
Yeah. So another question I saw that was interesting. Sandy, about 19 hours ago, asked, what are the prospects for Snowflake, symbol SNOW, and Block, symbol XYZ, 5+ years? At one point, I was a huge shareholder in Square/Block. Basically, I love Square. Even though I sold some near the top in 2021, so I was very happy with this for a while. Turns out I wish I had sold more of it at that time, but that's a different story. I pretty much I got to a point where I love Square, but I did not care for Block. What it seemed like once Jack Dorsey, Jack Dorsey was previously managing Square and Twitter at the same time. Well, as you know, Twitter was sold to Elon Musk, and that became X. Jack Dorsey then became the focused exclusively on Square. He changed the name to Block. I don't know, and he did a lot of weird things. I mean, he did some things with Bitcoin that might pan out. He also bought a music service, which I thought was very strange for a fintech company. And I kind of also, at the same time, I kind of soured on American fintech in general. While I'm not going to say that there can't be new innovations, there certainly can. I'd like to go back to the story of a one-time head of the patent office in the 19th century who said that everything that could possibly be invented has been invented.
Right.
Obviously, that did not age well. So I don't discount the fact that new innovations can come from fintech. But when it comes to fintech needs of my own, I mean, some of these apps they may add a little bit more convenience, but they're not really game changing. And I find myself using Apple Pay more than any other fintech app at this point. Apple's not really investable from the Apple Pay standpoint. I don't even know if it brings in revenue, to be quite honest with you. So, for that reason, I've been kind of down on American fintech in general. But Square / Block is just I think they don't really have a lot of focus anymore. Their profits have been rising some, but their revenue's been sluggish. And they haven't really expanded the Square ecosystem like they had been in previous years. I think they added their last country, I think 3 years ago, and they haven't really taken it into new countries in the last 3 years. So, I just have not been excited about the stock. So I'm not really that optimistic over the next 5 years. I don't think it goes away, but I'd be surprised if it beat the market, to be honest with you. Snowflake, I'm a little bit more optimistic about. I know it trades at a high multiple. It had some turmoil last year because there was a sudden CEO change. I think that CEO change was geared at integrating more artificial intelligence into the platform, and Sridhar Ramaswamy looks like he's probably the right guy to do that. So I do think that was a good move, even though people were happy with Frank Slootman's management of the company. But I like this product because I like it from an investor standpoint anyway, because people pay Snowflake by usage rather than a straight subscription fee. So it has a very high net retention. I think in the most recent quarter, it was 126%. That means that the average long-term customer spent 26% more on the platform than they had in the previous year. So I was happy about that. And they are, like I said, integrating more AI into the platform. They're building more customer relationships. Yeah, there are some disadvantages. Like I said, it is an expensive stock. It's not profitable. And, if there's some issues with the economy, that could hurt the stock. But, 5 years from now, I like it. It is cash flow positive. So the reason it's not making a profit is because of higher stock-based compensation costs, which I don't like, but I'm not as concerned because at least the operation's bringing in more cash than spending. So I like that. But, 5 years from now, I think this will beat the market just because between the the integration of the AI, the way the business model is set up. I think it's set up well to pay off for investors.
Yeah, I think too, Snowflake has sort of an edge when you look around the landscape for companies that can get a yield out of AI and turn that into something tangible, which is rising profits and cash flow, because the thrust of helping other companies with AI in inference or within businesses becoming more efficient, it's going to come down to use of data. And I think companies that have offer great data lakes, data warehousing, and also have been working on AI layers, as Snowflake has, with important partnerships, that's sort of an easier business proposition to look at, Will, versus other companies that are trying to prove out some other value-adding idea, well, we're going to like have a gazillion agents that we're going to sell to the marketplace. Maybe something else will supplant the agent. So I sort of like Snowflake from that angle. And I think they've done a decent job after some missteps with product, getting into a better like go-to-market posture. And yeah, I think they're coming along. So I'll agree directionally with that analysis. So we've got some questions about retirement and dividends that we should take, Will. And I want to start with this comment from our friend Karen for the Bees. Hi, Asit and Will. Starting seeds, plugging mushroom logs, listening and adjusting Fool 24. Asit, I can still tune in with Canada Full Services. Back to mindset of fave. Well, welcome, Karen. What an inspiration. And this is how we all should listen to Fool 24 at some point. All of us are in different time zones, and we can't always listen on a Saturday morning, or not all of us maybe are retired, but my ideal way to listen to this very service would be the same, working in my garden or being out in nature and listening to my colleagues. So thank you very much for that, Karen. And Sergey Zaichenko has some responses to your question. I want to read your first question. I'm going to read Sergey's response, and then we'll both comment on this. So Karen asked, wonder if it's wise to sell stocks in thirds. I joined 2 retirement groups to begin learning how to sell stocks to live on. It is complicated to do yourself. I agree. So before I comment, let me read what Sergey said after that. Hi, fools. At For the Bees, I personally have a number of blue chip dividend stocks in my IRA so that I can take them out to pay for my retirement. Rather than selling actual shares, I've been reinvesting dividends up until now to get the snowball, but now they are pretty substantial. So, Will, a few comments here that I want to make. The question and the response both get to the heart of trying to reap your income in retirement. What kind of account are those stocks in? Do you reinvest dividends and maybe wait till later so you can build more of a yield on cost? So you have an initial cost basis of the stock, but you keep buying more shares, and so the dividend increases over time, and the yield that you're getting off of that original investment starts to look really nice, maybe well in excess of the 1 to 2 to 3% nominal dividend yield the company's paying out. That sounds like what Sergey is describing. But what if those aren't in a tax advantage account, or what if they're in a tax advantage account that is, say, not a Roth IRA, but a traditional IRA in which you're going to have a tax consequence? This is where it gets tricky. I sort of like the idea in principle. Now, I'm going to preface what I say from here that this is not personalized financial advice. As you all know, we can't give that. So I'm going to just move one step up to theory here. In theory, in the same way that we advocate purchasing stocks in thirds for those who want to try that strategy, or dollar cost averaging, being able to stay invested in certain businesses, if you're taking money out over an extended period of time, sort of makes sense that you wouldn't just sell all of your holdings in X company today because you need Y $1,000 worth of money for the next 6 months or a year. Hopefully, if you've got candidates that you really believe will be both nice dividend payers and sort of that mix of growth and income, you'd want to retain that ability for the growth portion, for that dividend to grow, which is what Sergey is getting to. Now, what we have to consider here is the complexity of cost bases, which is why Karen has joined not 1, but 2 groups to figure this out, because you have to keep track of where you purchased your dividend stocks or other stocks. If they don't pay a dividend, you're just selling them to access funds in retirement. You have to understand the tax implications. In some cases, you may want to hang on to a very highly appreciated stock because you've got another one over here that has less of an immediate tax consequence. Or you may have other income that came in during the year, which will, even though dividends are taxed at a certain rate of capital gains, there are scenarios in where a lot of dividend sales can have a higher tax implication for you. So some of this has to do with the rest of the income that's coming through. All of this to say that if you can think in terms of spreadsheets and scenarios, this is what I would do. And I think about this sometimes. I'm not that near retirement, but I'm on the other side of the 50-yard line, sadly, where I'm closer to retirement than I was to the beginning of my career.
Yes.
I would say that could be important is and it's a little bit of work, but trying to take every company that you own, just put it on that spreadsheet to see what your cost basis is, what would be the implication of selling a little bit, applying capital gains tax rate to that. And now so many of us can get good exports from our brokerage accounts. Maybe it's not that difficult as I'm making it out. Just export the CSV file or the Excel file. If you're not comfortable with that, do it by hand, make a ledger. I'm an accountant by training. I still sometimes sit down and do a hand ledger as much as I use spreadsheets and artificial intelligence to do my job. So no harm there. But let me pause now and get some reflections and thoughts from Will on this question.
Yeah, it kind of depends on the person's situation, which obviously we don't have a lot of insight on. Yeah, I mean, it depends on how much, frankly, how much money you have in the account and how much you would need as to what I would advise there. Obviously, if you have excessive amounts of cash, I would just look for dividend stocks personally and just try to live off the dividends. That may not be, if that's not realistic. I would probably look to sell shares in portions. I don't know if it's thirds necessarily. I'm not sure. I'm not sure quite the mix. It probably depend on how much cash you need. Also, if you're near retirement, you probably want to have a significant portion of your nest egg outside of the stock market. If you don't have that already, I'd probably advise I guess if you're 65 years old, you'd probably want to have, I don't know. Well, again, the percentage is going to depend, but you do want to have a significant portion of your money to begin with outside the stock market, because literally anything can happen, especially in the short term with the stock market. Long term, I still like it. I don't regard it as gambling like some detractors of the stock market, but in the short term, like I said, anything can happen. So I think you would have it. If possible, anyway, I would have 5 years worth of cash outside the stock market. But yeah, I think it would just depend on your situation, really. But I would definitely not sell it all at one time. I would kind of sell it as I need it, really. Assuming you don't have any cash left. But again, this really depends on the personalized situation. As Asit said, we cannot give personalized advice. So I would just my general advice would just be live off dividends if possible. If not, have a significant amount outside the market so you're not pressured to sell. And I guess look to sell shares slowly. But again, the amount of that lot is going to depend on your personal financial situation.
All right, great. So let's move on. We have a comment here from Jeff M. I guess I got my wolf from my Cree shares. Weird. Creed made CFL light bulbs. Didn't get the connection. And yeah, Jeff, I mean, totally. I didn't get this connection either. As you heard me say at the top of the hour, I'm from North Carolina and lived in New York for several years after graduate school, came back here and raised a family. So I've been familiar with the company Cree for a long time. And I still remember, as many of us do, when the blue emitting diodes, the blue light emitting diodes, like started appearing in like Home Depot and Lowe's, where we had LED light bulbs. I mean, we're going back now to this company was founded in the late 80s. So we're going back to, I don't know, the 90s, early 90s, mid 90s. But anyway, that technology that they developed is the same technology that they're now using for semiconductors. So it's the transition from what they perfected for like CFL light bulbs, as I understand it. And if there are any, scientists here or people who study this, you can let me know if I'm totally off track. But that core R&D is basically funding a brand new company which does something completely different. The issue is that, again, different approaches, they require time and investment. A parallel out in real life is Microsoft, which is competing with IBM and many other quantum companies to develop a quantum computer. It's taken this really highly theoretical approach. Microsoft had to prove the existence of a particle. So they basically took a physics question that was unresolved and decided they would build their quantum computer based on their idea that there's a high probability that this particle, a Majorana particle, existed, which I think is sort of cool. And I think I want to reach out to the scientists there to interview them on Full 24. But, Microsoft has these deep pockets, so they could afford to fund this whimsical approach to a quantum computer for the last 10 years. And as of a month ago, they've announced some progress after going back and forth with scientists each time they had a press release who were questioning whether they really had made any breakthrough or not. I'm just telling that story just to compare it to a company like Cree, which, it had its day. And I still remember Cree branded light bulbs on shelves of hardware stores. It had its day and then tried to reinvent itself, and maybe it still will. I'm not saying that the company won't make it, but it takes a lot of capital in this market, the semiconductor market. And I think they thought they had it with the CHIPS Act. Now that's in question. All right, back to you, Will.
Okay, well, I'm going to take Jeff's other question from 7 minutes ago. Snowflake and Palantir, symbol PLTR, IPO'd around the same time. Don't they do roughly the same thing? Both big data. That is correct. They are both big data. However, Snowflake is more the data cloud product, so it's going to be concerned with storing and managing data. Palantir is more directly an analysis tool, so it's the data storage is not really that tool's concerned. It just knows where to find the data and take it and come up with an analysis from there. So even though they fit under that big data category, technically they actually there's not. I guess maybe there's some overlap, but they mostly do not overlap in their with regard to what they do.
All right. There is a question here on Chewy and Lululemon, and Ed asked, "Who has the better future, Chewy or Lululemon?" So I'm gonna say that I think they both have a pretty bright future. Both are pretty established brands in what they do. Both have profitable distribution systems. Chewy has to pay more attention to distribution because it's an online retailer and it has many vendors that it works with. So part of the story with Chewy has been a build out of its logistics network and just trying to improve gross margin and operating margin. So with a gross margin that's somewhat constrained by its pricing power, I think the market has just been perhaps overly focused on customer loyalty and auto ship numbers. So auto ship is the loyalty program that Chewy has. And so it's a stock that seems to perennially have a little bit of a cloud over it, but it's also a scale business. And if you look, this is very interesting. If you look at sort of the statistics of where we spend our money, pets have a greater share of our dollar than ever before. And that is because we have, and I think technology has allowed this somewhat. We really have a trend of humanizing our pets. This is something that Chewy's management has talked about, and other companies have as well. The idea of pet humanization, that our pets can be as important to us as relatives. Anyone who's had a pet can understand this. I mean, we have an emotional attachment to them. But the technology piece is interesting because we didn't have so many models in the past which let us spend on extending pet lives. But if you look at different kind of diagnostic tech for pets that's available now, even models that provide insurance for pets, the fact that you can extend a pet's life for a long time, so they're living longer, and then we want to spend more on them as we have more consumable income. That gets challenged in recession scenarios. I understand this, but I think this is a part of the story about Chewy that's missed, that over time it's going to just grow in scale, and the trend is up for consumption. Again, that can change in near-term periods as people's wallets just get strapped, but there's a lot about this business to keep studying. Lululemon, I think similarly, I mean, it's got a very strong brand. I'll just talk a little bit. I hadn't had a chance to look at Chewy's earnings. I know they reported this week. I did have a chance to look at Lululemon's earnings, so I'll talk a little bit about this. Lululemon stock was down, I think, around 15%. I didn't see it at the very end of trading yesterday. It is a stock advisor recommendation. It's one that we've highlighted recently in our rankings. The company gave like a disappointing growth forecast for this year of 5 to 7%. The big drag there is the US. China is still growing very quickly. And in some ways, I've been saying that I don't like all the China exposure. It's very hard to do business in China over an extended period of time. But in a tariff environment, actually, if you're manufacturing in South Asia and then selling within China, you're avoiding some of the tariffs that you might otherwise be exposed to. So that becomes maybe a near-term plus. China is growing well. Rest of the world is growing well. Here in the US, what I think shareholders need to try to focus on and figure out is management story, the whole of it. Management is saying that traffic is down across the retail space in the US. We understand that because inflation is high and consumers are finally showing some exhaustion, even as consumers have carried this economy over the last 3 years. So they want to offset this with a lot of new apparel that they're having, that they're coming out with in the next 3 quarters. So these are like new technical athleisure pieces and also new assortments of color. That's seemingly very important to CEO Calvin McDonald. I think he feels that they haven't done as well in the color category. There's maybe a reason for that. And that reason is tied to the question that I'm asking shareholders should ask. Okay, is this the whole of the story? Because also we have colorful competition that is nipping away maybe on the margins of Lulu's market share, and that is younger upstart companies like Vuori, who just are offering a retail alternative. For a long time, Lululemon was the leader in this space, at least where yoga athleisure was concerned. And now they've got competition. So it's sort of our job to figure out, okay, how much of this is just near-term issues with macro economy stuff, and how much of it could be that the company's losing a little bit of ground. That's harder market share to grab back. However, I really like the company's acquisition of real estate. I like its expansion. And I think that this is another brand that's in scaling mode. If you look at some of the partnerships the company has been experimenting with over the last 18 months, they're going into very wealthy places of the globe where there's not a lot of competition. So stores with local partners in places like Dubai, where there's a ton of very affluent disposable income. That seems to me, along with sort of bread and butter expansion in China and South Asia, and a lot of attention still to the US market, I think over time that overcomes like the near-term effects of competition. Vuori is much smaller, but that's a well-run company. I admire it. It's private. You can't buy it in the public markets. And this is something you may hear me say about other companies. It's good to have a number two. I love buying companies that are dominant in their markets, a number one or number two position. Sometimes I buy a company that doesn't yet have competition. And I think it's actually good to have a challenger because it keeps you in innovation mode. It keeps your ear on the ground. It keeps you in touch with what customers want. So that's sort of my near-term take on Lululemon, along with how I see it longer term. But both are interesting stories. I don't think either of them is quite yet fully understood by the market. That can be sometimes to shareholders' advantages. Those who like these businesses and are building positions, say via dollar cost averaging.
Yeah. So I wanted to quickly get to Jeff M's comment from 6 minutes ago. I have a lot of dividend stocks in my accounts, including traditional IRA, maybe not smarter than traditional IRA, except not taxed for years. I have enough dividend income to pay my required minimum distribution. Well, first of all, congratulations. I would look at this as a positive. The fact that you have enough money to make that required minimum distribution is a huge accomplishment, and frankly, most people can't say. So I'm inclined to look at the positive here. I mean, yeah, if you could get that money into a Roth IRA rather than a traditional, I think that will serve you better in the long run. But I don't know your life circumstances, so maybe that wasn't possible. Maybe you didn't know about Roth IRAs. I would not, I would not hammer yourself over that. But I would just look at the positive. You have enough dividend income to retire, so congratulations on that. And then
Okay, good.
yeah, Dilf had a question from 2 minutes ago about actually touches on both consumer and tech. Consumer and tech seem both under pressure, temporarily cyclical, tariff impact worries, or end of 5-year COVID trends. Any new things on the horizon? Yeah, I think, I think you're right on that. I think that these stocks are suffering certainly because of the tariff impacts in the very short term. Every time there's a new tariff announcement, the stock market seems to correct significantly. And there are certainly cyclical concerns with stocks, especially some of these consumer stocks. I don't know. I think we're kind of beyond the COVID trends at this point. Even Carnival Cruises, which had to shut down during COVID, they're pretty much back to full capacity now. So I think we're kind of at the end of that. Yeah, any new things on the horizon? I mean, we really don't know. I mean, we have to really, we really have to see here. We have to really see where the tariff impacts are going to fall. That's ultimately going to be a political decision. We really can't predict political decisions, so I think we just have to wait and see. And the overall market, I think it's kind of, it's not bad, but it's uncertain. I think you just kind of have to work through it. If you're an investor for a long enough time, you're going to go through several cycles of this. You're going to have up cycles, down cycles, times like this where things are uncertain. I think it's part of the investing process. It's not, I don't see anything that's motivating me to sell. In fact, I've been a net buyer of stocks, at least stocks that have fallen significantly. The ones that have fallen to bear market levels and even well beyond. Well, I guess there's no limit to bear markets, but well beyond the 20% threshold that defines a bear market. So I would think I would just hold tight here. But yes, for now we're going to be dealing with some economic and tariff uncertainty for better or for worse.
Will, I read that question totally differently, so I'm going to take it from a different angle. So I read that to ask, are there any new things on the horizon, meaning like catalysts for the consumer and tech industries? So,
Yeah.
And maybe the question is a little ambiguous. We can ask Dilf to clarify, would be great. But I'll talk about sort of new things that are on the horizon that I'm looking at. And I think one place where we see the nexus of both consumer and techs benefiting is in robotics, because with the I won't call it commoditization yet, but with the advancements we're seeing in robotics from cobots, so these are robots which work beside humans, in places like Amazon.com. So think of logistics, to all these great ideas for last mile delivery to customer. There's a lot going on in the robotics world, which I think can have a pretty good impact on both consumer goods and tech. Consumer goods, because you have an issue in consumer or retail facing companies. Let's stay on the good side of it, consumer goods, in that it's hard to earn returns that are much in excess of the rate of inflation, but you're trying to earn 1% to 2% of return, both on the top, the revenue line, and the bottom line. So if you follow companies like McDonald's or General Mills or Mondelez, you're already familiar with that. Those companies don't accelerate their growth typically over a 5-year time frame, but what they're really good at is keeping up with the rate of inflation and then getting earnings to increase on the bottom line. And how do they do that? Well, companies like PepsiCo is a great example, and I'll stick with Mondelez. They invest in their distribution and supply chains. So if you have a method in which you can lower the cost of like sorting, the cost of packing, the cost of movement of goods, then you have a way to keep returning to shareholders. So those investments that we're looking at, okay, so a company has a pandemic hangover, that's in the rearview mirror. What's next? This is the place where many of the large multinational conglomerates are spending a lot of time studying how robotics can affect their business and bring those points of operating margin home. So I'd be studying that as sort of a new thing. There are other new things that they're new things, which may be fun to look at. There are some new protocols for dealing with the layer between agents and data that are on the horizon. So that's something that could help some tech companies. And then there's so many one-offs. I'm still avidly following on the tech side of things, the electric vehicle takeoff and landing space. So flying air taxis, which are currently, there's some that are already certified in China. There's a few companies here that are close to certification in the US. Those intrigue me a lot. And of course, as far as tech is concerned, new things, I'm always looking at the quantum industry, very fascinated by that.
Yeah, it seems like quantum is a solution without a problem, though. That's kind of where, yeah,
I
everyone
don't agree.
asks. I'm sorry.
I don't agree. Why do you say that?
Well, I mean, it's very impressive, how you can, how you can exponentially increase computing speeds. But it's been very error prone, except maybe for recently. And then, a lot of the funding is focused really on research rather than actual application. So, technology changes quickly. Maybe they'll come up with something that some problem that it solves. But I think it's kind of in the research stage right now.
Yeah. So it's going to take a while, and I'll grant you that. And I know that it seems like it's something that doesn't have a practical application, but the interesting facts on the ground are that there are several companies that are already realizing revenue from commercial applications. IonQ is one. There's a division of Honeywell, the big defense contractor, which teamed up with a company out of Cambridge. That company is very interesting to look at if you want to see like how companies are actually using quantum computation to outdo classical computers and derive revenue from that. Quantinuum is that company. It's sort of a private joint venture, but I guess you could indirectly invest in it via Honeywell. But the thing that to understand about quantum, it's not really about doing things faster than classical computers. It's about solving problems which have a lot of variables.
Mm-hmm.
So you need massive amounts of computational power. And this is why you hear like quantum being spoken about a lot in relation to like breaking the encryption code. So it has to do with how quantum computers are built. And this is a really cool thing. It has to do with the fact that we really don't understand how particles at the atomic level work. They have both particle-like qualities and they have wave-like qualities. And so if you all remember from like high school or college or just reading in popular science fiction or graphic novels, the uncertainty principle, Schrodinger's cat, these are like very popular ways to express this idea. We really don't have like determinism at the particle level, which means that an atom or like a photon can exist in a lot of states at one time. And so quantum computing is about harnessing what's called superposition. So the ability to be in many states at one time until you observe that particle. Once you observe it, the probability state collapses. So if you can do that, then you can handle problems which have many variables. We were just talking about logistics. This is a place where I think we will see in the next 5 years quantum computers solving logistics problems which are too hard today. Molecule discovery is another one. Portfolio optimization is another one. So how do you optimize someone's portfolio? It takes so much computational power to go through all the scenarios. A quantum computer could really crunch that a lot better. So it's not about speed. It's about trying to hit multiple probabilities and have a path that optimizes something. So I actually think it's going to be, again, new. Probably if we have to take some of the news off of that one. So I was talking about the new. So newish. And it's interesting too, because Jensen Huang, who crashed quantum computing stocks, I think in January, then had a symposium day, whole day devoted to quantum at NVIDIA's GTC conference. And he basically got up on stage and said, I'm the only CEO who's invited other CEOs back to explain why he was wrong. And he's admitted that the time frame for quantum is probably going to be a lot less than that 15 to 20 year window. I think looking at the Willow chip that Alphabet has put out, and even Microsoft's latest breakthroughs get to the heart of what you're referring to, which is the error correction.
Mhm.
And so those chips they're very impressive at how they're reducing the error correction rate. And I would say also the approach that IonQ uses is very stable. Their computer is built at room temperature, and it natively has less decoherence. It's less error prone versus other quantum computers. So I think that's a lot nearer than 10 or 15 years away. And I also, this is a common thing that I try to, at least, from my point of view, to describe to people that it's not a technology without like a problem. It's a technology that's going to solve our hardest problems. It's going to take some time. You have to be patient if you study this space, and it's hard to keep up with the tech. Honestly, it takes a lot of time just to understand it, but it's so fascinating. The world is so interesting. That the fact that we don't really understand it, the level that you would think is the most deterministic level of all, the atomic level, that's the one that's the weirdest. And if you can wrap your head around it, then this is just a little, okay, we'll take another 30 seconds. I know we probably have to get to some more questions, but this is so cool. So the lead scientist who's developing the Willow chip at Alphabet is a very decorated scientist, very respected scientist. And after Willow's latest advancements, he says, now I'm sort of convinced that parallel universities exist, the way that this chip arrives at its answers. And there are some scientists who say that the more we learn about quantum, the more it's probable that we have sort of the wormhole concept, so portals into other universities. Now, I know you guys are probably going to pull me off this show and never allow me to get back on Full 24 again. But this is to say, when we don't understand something, it's one of the most fun things in life is to try to understand something that is on the surface of it crazy. On the surface of it nuts. Anyway, all right. So that's my further 30 seconds on that. We'll get back to questions.
Yeah, I didn't want to imply that quantum would never get there. I was just saying it hasn't been there yet. But like I brought up that patent example from the 1800s, you never know what's going to be invented, and I think quantum eventually will be solving problems. I still think it's mostly in the research stage for now, but it is certainly something to watch.
Yeah, and I think too. So and I know we need to move on. This is for those who are interested, this is going to be in the next 2 years, probably quarterly announcements of more commercialization, since we had the first commercialized projects really in the last 6 months. Just going forward, for whoever's interested, keep your eye on that. These announcements from subsidiaries of Honeywell that are signing up customers, and the customer list is surprising. AstraZeneca is using quantum computing for molecule discovery, for example. So anyway, and there's a question here from Jeff M about Tesla and NVIDIA. Won't they both be big winners in robotics? And I don't know if you wanted to take that one first. I think we can maybe both take a crack at that one.
Yeah, I mean, they're both doing things that are very fascinating with with robotics. I haven't dug deep into it into a while, but if I had to guess who are going to be the winners, I would say Nvidia and Tesla. But I think we're still in the early innings of this, so I think anything can happen with this industry and with Nvidia's and Tesla's future in robotics and the futures of other companies.
Yeah, and I think Tesla is positioning itself to be a big winner. This is part of the thesis that Tom Gardner has been talking about for a long time, that Tesla has more to reap out of artificial intelligence and robotics than it really does from the vehicle business over time. And yeah, they're very close to being able to produce their humanoid robot in the thousands. With Tesla, interestingly enough, just like the EV market, the Chinese government is now focusing on sort of mass production of humanoid robots, and I think they're going to incentivize that. So Tesla will have a sharp challenge there, and not just Tesla, other companies in the US. Tesla's not the only one that's trying to now go from creating the robots and showing that they can perform tasks to producing them at scale. And in that instance, I almost like NVIDIA's position better, because NVIDIA is taking some of its core technology that you can trace back to when NVIDIA was first founded. So we're going back more than 20 years, 25 years. The obsessions with the physical world, how to make chips that would eventually be used in gaming more proficient, because those chips could sort of use physics to produce photorealistic output. They've carried that into how they understand the world of robotics, which is about taking physical input and then feeding that data into simulated robots. So NVIDIA has like freely available open source platforms. If you have a little bit of tech savvy, you can go and play around with their models, and they're very interesting. So being able to maybe provide for other companies that aren't Tesla the software part of it, the blueprint for how the hardware should work, the simulation environments to make those robots better, that's probably a good business with a lot of margin. So yeah, I think maybe we're both agreeing with Jeff here that Tesla and NVIDIA stand to be big winners in robotics. I can't say that, because these races at the outset, you can't see the challengers that emerge, and whether the big companies will keep their advantage. But are they positioned, Will, to do really well in this space? Yeah, I mean, I think so.
I agree 100%.
And fools, we've got about 7 minutes left, so let's give Jeff some relief. He's been doing the yeoman's work, asking some questions here, and then there's some others back in the queue that from the last couple of days we can also pick up if we need.
Yeah, I did see one from a couple of days ago from Aranda. So Aranda asked, what's going on with Vistra and Delo? Delo is D-Local. Any thoughts? I don't follow Vistra. Vistra's more like an energy company. So I know they've been doing a lot with nuclear, and that's attracted the attention of a lot of AI players. And I think they suffered a bit because with the DeepSeek breakthrough, there was some concerns it wasn't going to use as much power as a lot of people were predicting. As for D-Local, it's a payments platform based in Uruguay. It basically deals with the developing world. It helps merchants and consumers handle the payments. Looking at it, it looks pretty cheap, on the surface. A 21 PE ratio. There's about 15% revenue growth, 45% payment volume growth. There's a declining take rate. It looks like it's not deriving as much profit from these transactions. I think that's been a huge concern for investors. And of course the rising expenses will cut the profits. Not really sure what to think of this one, to be honest. I think it is cheap, so it's getting cheap enough that maybe it might be time to look at a starter position in it if you're interested in this part of the business. I am a little concerned about the lower margins, but It's an interesting and pretty well established business. So maybe it could be worth it. I think it's a bit. Yeah, I think his ad's gotten a little cheap for a reason, basically. But we'll see what happens with that one.
So, well, there's a question here on Joby and Archer information. Archer, sorry, aviation. My head is full of information I can't use, and I don't know how I called Archer Aviation Archer Information. Maybe if the aviation part doesn't work out, they can be an information tech company. But of those two, yeah, I follow them both glancingly, but Joby a little bit more, Jeff. I actually own some what I call peanut shells in that. I take sometimes peanut shell positions in companies. And I sort of like Joby's viability. And I'll tell you why. In this business, you have to have two things, right? You have to have the path to revenue, and you've got to have the funding. And one thing that Joby has, while it's burning cash to get through testing with the FAA and deliver its first vehicles, the U.S. government is a buyer. It's got a pretty solid balance sheet. Let me just double check here so I make sure I'm telling the truth here. I'm just going to read out loud since we're in just a few minutes later. I won't share my screen. But yeah, they've got, let's see here, current assets of roughly $1 billion, current liabilities of about 50 million. We'll call it 970 minus 50. So that's more accurate. $920 million, still roughly $1 billion in net working capital against 300 billion in total liabilities. So very solid balance sheet, but it is burning cash. So I'll just jump over here to the cash flow statement and give you a view into that. The company had negative operating cash flow of 436 million in the last trailing 12 months, and had capex, capital expenditure, of negative or 40 million. So you're talking about 475 odd million dollars of negative free cash flow. And I think with the money that it has on the balance sheet, plus the investment from Toyota, which it hasn't received yet, that's $500 million. They're going to get that delivered in two tranches of 250 million each. So really, it's like $1.5 billion in buffer against what looks like maybe close to $500 million in cash burn. But that is going to decrease as they start delivering and recognizing revenue. So I would say this is an industry where I would be really careful investing because it is pre-revenue, and that is a hard thing to pull off. In fact, the great Peter Lynch warned against investments in pre-revenue companies, and that's why I myself have like a very small position in this. I'm fascinated by the space, and Joby, okay, theoretically you could say it has some revenue on its books, but it's really, really, really tiny. So buyer beware here. But in terms of viability, that's one that I like because it has funding to keep getting its product to market and get through the certification process. So that's how I'm thinking about it. I could be wrong, which is why I have such a small position. But I like where this industry is going. I like the fact that the airlines are participating and making joint ventures with the likes of Joby and Archer. They're taking shares in these companies. So there's a vested interest in being able to transport someone from a smallish city that's 30 minutes away from a major airport to the airport and back. And I think we'll see, again, sooner than we will quantum will, but I think we'll see the emergence of this industry. I'd be careful here investing, but I would study it and I would watch it. It's one of those fun things to keep your eye on. It's future oriented, and it's always gratifying just from an intellectual level or a level of curiosity to try to see like where society is headed, where the tech is taking us. And with that, we're at 12 p.m. and I see two people who know pretty well where the tech world is taking us, and the world of science as well, between Corey and Jose. Oh, I see it's Neil. Well, okay, there you go. So we'll double down on the tech part. Two people who can speak about innovation in depth. but this has been a fun hour, and I appreciate it. And so we'll leave it to you guys. Hope you have a great hour.
Cool line.
Thank you, Asit. Thank you, Will.
Yeah.
Oh,
All right.
there we go.
I'm left alone.
Hey, good afternoon, Neil. How's it going?
Good. How about you? I think it's morning for you, or maybe lunchtime for you, close to evening for me.
Yeah, just hit lunchtime. And first, hello to all the fools watching today. My name's Najarro. I'm joined by Neil. And today I think we're doing kind of just a typical Ask Us Anything, right, Neil? But like Asit and Will mentioned earlier on, we do focus a nice amount in the tech space. So feel free to have any questions in the tech industry. I know we both follow the semiconductor industry, and we have Neil here who also follows the fintech. But we can definitely talk about big tech players, anything dealing with the tech industry. We might have some thoughts behind it. So yeah, make sure to get those questions to us on Slido.com, code FOOL24. And a quick reminder, whatever we're going to say here is not personalized advice. It's just our own thoughts. Neil, I mean, we're going to get into questions in a few seconds, but late last night, something interesting happened. Elon Musk mentioned that his AI company, XAI, has completed. I believe it said it had completed, right? I think it's already done. Has completed, acquired the social platform X. And his reasoning is kind of the joint companies together would make an amazing AI company. Initial thoughts from this, Neil? I know these are both private companies, but we are kind of seeing a lot of thoughts in the AI market, and maybe we'd love to hear what are your thoughts here, Neil.
Yeah, so late last night, I got off a plane and I looked at I opened X, I looked at my feed, I'm like, whoa. What just happened here? So yeah, it's, to be honest, came out of nowhere. There were already some people that are speculating why this is happening. This might also mean that Elon does not have to sell more Tesla shares to fund X, since XAI is worth more than X, and the shareholders of XAI, well, maybe are taking the debt on them, or I don't know. It's a whole structure. I'm not really familiar. I didn't dive into the whole thing, but to be honest, it makes sense, no? I mean, you're on X, you already have Grok, so I'm pretty sure that the data that Grok is trading on has to do with X as well. So putting that into one company, I never understood why those are separate companies. Let's just put it that way.
Yeah, I think right now, I think most people who have seen Grok, Grok has been using X information for a lot of its training, right? So I feel like that's been known. Again, maybe it's a lot of things happening with the structural change of the company, but as a top level overview, to me, I don't feel like much changes. I think it's going to be more of like structural talent, maybe shifting and easier to maybe pass over information. But this does kind of bring me in an interesting thought, Neil, where just a few weeks ago, I don't know if you noticed it, a few weeks ago, there was a report online that came out that Meta Platforms, not Meta Platforms, Meta Platforms was thinking of creating a pure AI application, just how kind of like a ChatGPT. And ChatGPT's CEO, Sam Altman, actually responded to that report and said, hey, if they create their own AI application, we will try to create our own social application. I don't know how much he likes to troll a lot, but it does show kind of this need of the AI universe has already gathered a lot of the information that is known. Now, how do you gather the information that is still not known, or that new information coming in? And I think the easiest way to do that is via some form of social application. So do you see this as, if Meta ends up creating an AI app, Grok has X now, is OpenAI kind of lagging behind by not having some form of social application to be able to grab real-time news as it comes in, or real-time data?
I mean, for Meta, it's basically taking what they already have, right? The Meta AI in Instagram, in WhatsApp, and putting it in a standalone app, just like Grok, just like we did with Grok. First, it was available on X, and then it became a separate app. So from that standpoint, it makes sense. It makes sense. I think there were also reports saying that Reels might be a standalone app as well to compete directly with a TikTok. Okay, fine. But yeah, I mean, that was the question from the start, no, for ChatGPT. Like, how are they training their models? Where does the information come from? Do they have licensing agreements, or are they just taking things without asking? That was always the big question. This is something that a Google, for example, with Gemini, they have no issues with that. Meta, same thing. XAI, well, XAI, today is the same thing. So that's their big advantage, I would say. With ChatGPT, you could say they were using Bing. But then again, how much information are you getting from that? I don't know. But creating another social media app is, I think, going to be way more complicated than just taking a feature that you already have inside your social media apps, inside Instagram, inside WhatsApp, which finally us Europeans got access to a week ago. We finally have Meta AI available. Doing that, putting that into standalone app is way easier than suddenly, well, what are they going to do? Another image sharing app, another short form video sharing app? I just don't see that happening, to be honest. But I mean, this week ChatGPT did get the spotlight because I guess spending hundreds of billions of dollars makes sense if you can just create an image styled in Studio Ghibli style. So I guess it's worth it.
Yeah, definitely they got pretty popular, and this is probably one of the reasons that maybe OpenAI right now has been releasing a lot of features to free users where maybe they know, hey, we can't compete in the social media application, so we're going to need to drive users as quickly as possible to our platform. And one of the ways to do that is they've started to reduce the friction of being able to use their applications. I think back then you didn't even need it. I think now you don't even need an account to kind of use some of the free things, where back then you even had to sign in. So this allows kind of that easier flow of consumer, but it's definitely an interesting time here in the AI market. Neil, we have a question that just came here from Roger, and we have one from Rama. Maybe you can take the Roger one first. I don't know if you have open. If you can see, if not, I can read it for you.
Actually, before we answer that, I just want to go back to what we were talking about, because I think Sam then said something about the fact that their GPUs are melting because everybody's been using it to create images this week. Doesn't this just reinforce the inferencing bull thesis for the likes of an NVIDIA, of an AMD, and the such? Or they should be able to optimize their software better, because, I mean, is an image generator so compute heavy these days?
I think it's also not just I think two things need to happen, right, Neil? So first, it does showcase the bullish thesis for GPUs at the moment, right? I do also believe it shows the need for these AI companies to find better optimizations for these image solutions, Neil. But I think one of the things that's also critical with this image generation is that it is kind of based on that multimodality. So it's kind of integrated into GPT-4o and some of the other models as well. And that allows it to understand a lot better. So I use Midjourney, right? So Midjourney is kind of purely image generation, but because it's gotten better, but because it doesn't have kind of that large language multimodality with it, you have to be really specific or descriptive of how and what you want. But now with this kind of multimodality ability where it's integrated within the large language model, you can just kind of explain it in your own words, and the model does really well at explaining. So I think that's the added layer of why it just seems like an image generation, but why it requires optimization. The other thing is it's optimization, but right now, even as a super pro user, the ones that pay $200 a month, sometimes, I still get hit with limits. It's very rare, but I still get hit with limits. So I do believe it still continues to give that bullish thesis on inference, because eventually I'm going to want to be running this without any limitations at all. So I think everything needs to happen. I mean, it's bullish for GPUs, it's bullish for the inferencing, but it also is kind of a showcase that these companies need to have better optimization tactics, but it's also kind of showcasing that as models get smarter, for them to become easier to use, you need to do this multimodality, which in the long term needs more types of tokens or more type of computational power. So it's a race, and it's like, which one do we get to first?
I agree. And I think, this goes back to one of the concerns that I think both of us had about an Adobe. Because like you said, ChatGPT releases these types of features to attract a lot more users to their service. Even if those are silly new features, but those are the ones that get the most traction across the internet. And this is something that we've spoken about when we talked about Adobe and all the competition when it comes to image generation, text to video, and all of that. Adobe should be doing things like this a bit more aggressively as well, if it doesn't want to lose customers to a ChatGPT or something like that.
Yeah, unfortunately, Adobe had their event, during the same week as GTC. I have yet to watch it, but if we haven't heard much from the event, there's probably nothing too crazy. But one of these days, I'll probably sit down and kind of, I think it was like a 1 to 2 hour keynote explaining. So maybe I'll take a look at that later this week.
Yeah. So touching back on Roger's question from 6 minutes ago, does Neil have any thoughts as to why PayPal has performed so badly, and is this a buying opportunity? Now, of course, this is not personal financial advice, it's just my opinion. I personally own a position in PayPal. Now, of course, the stock does underperform the market. I am just looking to remind myself what has happened specifically yesterday, because I think yesterday something happened with regard to PayPal in Europe. Let's see. Yeah, so the EU could charge fees on US companies directly to retaliate to tariffs. So could happen to companies like PayPal, for example. I don't know if that's really going to happen or not, but that might have been one of the reasons why the stock got hit specifically yesterday. Plus yesterday, the overall market was down quite heavily. So a name like PayPal gets dragged down as well. A name like Google, Nvidia, all of the big players were down as well. But yeah, PayPal has underperformed. Some fintechs have underperformed as well. You can say, okay, it's because maybe we're going into a recession. Maybe rates will stay higher for longer. Maybe this, maybe that. But if you look at PayPal's business, I'm very bullish on PayPal's business. If you missed last week's bold prediction episode, I said that by 2030, I think PayPal reaches all-time highs again. So shows you how bullish I am on that company. New management that came in a year and a half ago with Alex Ries as CEO, I think they're doing everything necessary to drive this business forward. For those that say nobody uses PayPal anymore, only the young folks, only the older folks use PayPal. Well, Venmo is extremely popular with the younger generation, and Venmo is owned by PayPal. And then it's always important to look at the data. The data shows that more and more people are using PayPal today. More and more people are transacting with PayPal. And the business is now becoming more and more profitable. And to be honest, as a shareholder, I see the stock price go down. Of course, this isn't great. But on the flip side, seeing how big their share buyback program is, I'm like, okay, that means they can just retire more shares so long as the stock does, well, does not reflect reality. So that's basically it. It's not the only fintech player that has been beaten down. Actually, it's not the only player that has been beaten down. A company like a Google, an Alphabet, for example, something we cover here a lot, has also been beaten down, has underperformed the market by quite a lot. So it is what it is. In the meantime, I think with the tariffs deadline, April 2nd, that's when we'll have a bit more clarity, see exactly what's going on. In the meantime, we know stock markets, Wall Street doesn't like uncertainty. And we've seen that in the last couple of weeks. We can go up 2-3 days, then we can go down 2-3 days. It is what it is. But remember, we did come off 2 years of bull markets, right? 2 years of, I think, above 20% returns from the S&P in 23 and 24. So maybe we were due for some pullback.
Thank you for that, Neil. We also had a question here, Neil, from Rama about 11 minutes ago. How much percentage revenue does Micron get from China? Impact of tariffs on Micron's business. And any thoughts here, Neil, on Rama's question? I do have some thoughts, but I would love to hear yours first.
Yes, I don't know exactly how much of a percent is China for Micron. If we can find that, then I could be adding a little bit more info. But for Micron, impact of tariffs on Micron's business, I think impact from tariffs on semiconductors businesses. That's the bigger question, right? We don't know how big the tariffs will be across the board, who gets hit, what gets hit. Remember, Micron also produces in the United States, so that's already one big difference compared to many other players. But you can have reciprocal tariffs, of course. Remains to be seen, but the percent of revenue, I don't know, Jose, if you have that or a number. If so, that would be great. If not, then I'll just continue.
Yeah, I don't have any numbers right now. I tried to look at their 10Q report. That didn't have the information, Neil, but maybe their 10K would. One thing that I would say though, Neil, is remember, memory is not the finished product of a technology, and sometimes you might see like heavy amounts of revenue going to like a Asian country, being Asia or other parts of that world where the finished product gets built. Right. So let's say, random example, I don't know if they have a facility in China or somewhere, Dell Technologies. So Dell Technologies, a company that sells the laptops, that sells other types of consumer electronics, while you sell them all over the world, they would buy them from their maybe China facility to build that finished product, as it is kind of cheaper to build them there. So I think all these other players do have a lot of facilities elsewhere that they can probably, if tariffs are a major impact, that they can send it to other parts of the world instead. But at the moment, I haven't seen too much from the management. So here I'm looking at their most recent earnings call, Neil, and the CEO mentioned on tariffs, Micron serves as the U.S. importer of record for a very limited volume of products that would be subject to newly announced tariffs on Canada, Mexico, and China. So overall, they already mentioned that they are going to be very limited on some of the products that they ship into those markets. They don't ship them too much as a U.S. importer. They are going to continue to monitor the possibility of future tariffs and are prepared to work with their customers and suppliers to understand future tariffs effects and supply chain options. Where tariffs do have an impact, we intend to pass those costs along to our customers. With that, now we will turn into, so then they follow on. So first, they said that they're limited in where these tariffs are going to hit. They still obviously don't know the impact of any future tariffs, but right now they are going to be passing those along to their customers.
I do have something that might help us here. So they did talk a little bit about the supply side of things. So they said the supply in the past month have been from China, mostly DDR4, LP4.
Yeah.
We're looking ahead, only about 10% of our revenue is exposed to that portion.
Yeah. And Neil, sorry, I'm looking here, and it seems I was looking at some more information. Micron, roughly about 12% of its total revenue is from China in fiscal year of 2024, accounting for roughly $3 billion. And this is kind of historically where it's at. In 2023, it was around 14%, Neil. So a little bit lower than that, but still around that low teen rate. In 2022, it was about 10%. So historically, it seems to be in the low teen volumes, and that's where it's at. But again, like I mentioned, and I'm reading more information here, Micron does believe that they have only limited direct exposure with very limited volume of products subject to tariffs on China, Canada, and Mexico. So at the moment, it doesn't seem like it's a major impact. But that's just what I'm reading from management. Obviously, the actual story could be a little bit different.
Yeah, and I mean, like you said, I think they're building a facility in Singapore. They have one in the United States. So whatever happens with tariffs, they are in the US and they are in that Asian region as well. So just in case, I think they can work things out, but they probably have some parts that come maybe from Mexico, maybe from China or whatever, and maybe those parts might be hit because of tariffs.
So and one thing, right? I mean, right now in the Micron market, one of their big growth opportunities is still kind of like the AI accelerator space. We're still kind of in the bottom in the consumer market, so maybe this might consider that consumer cycle if we start to see some effect to maybe just stay at the bottom a little bit longer than expected. But overall, I think this is more short-term pain, Neil. I would expect long-term thesis to still pretty much be intact for Micron.
Yeah, no, I agree. I think so far, so good. I mean, everything is still on track, so no bubble popping at the moment.
So, Neil, I like this question from For the Bees. So, For the Bees, about 2 minutes ago, please elaborate more what happened with XAI, what it means for everyday people, and what is Grok? Explain, help non-tech folks like me understand importance. So, For the Bees, our apologies if we sometimes assume, or we maybe break it down as everybody knows who these two companies are. So, first, let's kind of understand the two companies at play. So, there's X and there's XAI. So X, For the Bees, is your social media company that used to be known as Twitter, right? So I think that was pretty straightforward. It's pretty much just a social media competitor, and it's formerly known as Twitter. We have XAI, Neil, and XAI, I think the best way to explain it is it's just an AI company, very similar to OpenAI, ChatGPT, where their main goal is to try to create the best AI solution possible out there. Some maybe not important information, but some interesting thoughts from it is XAI is also run by Elon Musk. It is also a company that has built a lot of these data centers with supercomputers pretty quick compared to some of the other players, and has been using its AI solutions on the formerly known Twitter platform. Now, that AI solution that they created is known as Grok. Just how OpenAI solution is ChatGPT's, Google's AI solution is Gemini, Meta's AI solution is Meta AI or Llama. I think you can kind of go a little bit between those two. XAI is Grok, which is kind of their AI model. Yesterday, they were two individual companies before. One acquired the other, and now they're now unified as one company. I think for your everyday people, Neil, I don't think anything's going to change because in the past few months, Grok, X, and XAI have pretty much been sharing a lot of information, a lot of data, and they've been integrated pretty they've been integrated to kind of work seamlessly with each other. So I think this is more like Neil was discussing, maybe more of a change in the structure to finalize that final bonding of the two. But in forms of technology, in forms of what the everyday person is going to be doing, I don't think there's any major change here.
Yeah, so just to add to that, some information here from Elon's post. So XAI has acquired X in an all-stock transaction. The combination values XAI at $80 billion and X at $33 billion. That's $45 billion less the $12 billion in debt. So, I'm always skeptical with the valuation of the privately held companies, the XAIs, the whatever ChatGPT, $300 billion, maybe something more than that. To me, that's a bit much, but okay. He said the following: XAI and X Future are intertwined. Today, we officially take the step to combine the data, models, compute, distribution, and talent. So probably consolidation, less cost, since now they're both the same company, which from the start, I thought that would have been the case, but fine. This combination will unlock immense potential by blending XAI's advanced AI capability and expertise with X's massive reach. He said that X has at the moment 600 million active users, whether it's daily or monthly, is not mentioned in that post. The combined company will deliver smarter, more meaningful experiences to billions of people while staying true to our core mission of seeking truth and advancing knowledge. This will allow us to build a platform that doesn't just reflect the world, but actively accelerates human progress. And by the way, you can have access to Grok on X, or there is also now that standalone app on Android and iOS.
Random thoughts here, Neil. Do you think this is in the next few months we might see XAI kind of go for another kind of investment round? And now with the bigger valuation, it'll be able to secure more money and in theory use that for more data centers. Does something like this kind of, when you see something like this, Neil, do you see any bullish or bearish takes on the overall AI market?
I mean, I think more recently they did a raise, of $6 billion or something like that, where Nvidia and even AMD invested in XAI. So technically, we have a piece of the XAI pie at the moment. Would it surprise me if they raised more? No, it wouldn't. It wouldn't just to buy more GPUs and expand the data center build-outs. But I mean, what's the end game here? Because we know that with Tesla they also have a huge GPU cluster, and they are working, of course, for FSD, full self-driving, and the robotics side of things, the humanoid robots. So some people are already saying, okay, why isn't Tesla taking a stake in those companies, right? Which I'm a Tesla shareholder. I think you are as well. It would have made sense, but okay. Now Grok, are they only going to play the social media / standalone AI app game, or are they going to do something else? Are they also going to launch their own humanoid robots? I don't know. It wouldn't make any sense since, Elon is here and Elon is at Tesla. So I don't know. I don't know what's the real end game here. I mean, yes, you can have more GPU because, inferencing compute goes up. You need more and more tokens. More users will probably use it in the future. Fine. But how are you monetizing all of this? Just by the X subscriptions? There needs something extra needs to happen. And the only two things that I can think of, Tesla is already tackling those issues. So yeah, I don't know. I don't know what's going to happen in the future. If you have some other ideas, let me know.
Yeah, no, Neil, I think I feel maybe eventually we might start to see kind of like a Tesla Grok integration. And then maybe eventually very similar to how we saw X and the XAI integration, and then it pushes into that. Maybe once you get to see, hey, look, this actually makes sense, then maybe when you start to see maybe some integrations there, more integrations between Grok and some of the Tesla's solutions, then maybe that becomes a discussion for future acquisitions. We have another question here, Neil, about 10 minutes ago. How do you view AI spending, data center plus chip demand, aside from tariffs over the next 5 years? Any recent data point indicating boom bust worries are correct or overdone? Neil, let me jump on this one first. So first thing I would say is the AI market is so new, Neil. I think we've only are in year 3 of this massive data center demand, maybe even just year 2. I forget if it's year 2 or year 3. So looking 5 years from now, it's pretty intense because we still don't even have data for the past 3. We only have data for about 2 to 3 years. So first, I think with the AI market, thinking 5 years out, it's normally seen as a long bullish thesis for investors, and it's usually what one should look at. I think right now this technology is evolving at such rapid levels that maybe even looking at, I prefer maybe looking at 2 to 3. So that's kind of the mentality I'm going to be discussing. So within the next 2 to 3 years, I believe the data that I'm seeing indicate that these boom and bust worries are a bit overdone. And some of the data points that we have is less than 2 months ago, we got earnings, and most big tech players said that they're continuing to see strong demand for AI solutions. If they had more compute available, they would be able to grow faster. So right off the bat, I don't think things change that quickly for big tech players, where 2 months ago they say one thing, and then 2 months later things is a bust worry. So that's the first data point. The second data point, Neil, is kind of like what we talked about with OpenAI just a few minutes ago, where OpenAI mentioned that their GPUs are melting. And even I kind of explained a little bit of how, like, maybe some of these AI models seem like things that we were doing a year ago, but in the back end, there are some things that are improving, like that multimodality, which help a lot, where now your more normal users can use a lot of these solutions, where back then you had to do like a lot of prompt engineering to be able to do a lot of these things. And now you're reducing the restriction. And this multimodality, time of thinking that we're seeing is very, very crucial for the amount of capacity needed. So that's number 2 for me. I think that's the second biggest data point. And the third data point is we're still just seeing I think it's just going to go with the same point. It's just the innovation of AI. I believe this is not the end goal. And as an avid user on a daily basis, I still can see vast improvements that are needed and can help this market grow dramatically. So, and any thoughts there, Neil? Final point. Everything is a cycle, Neil, right? Everything is a cycle. There could be a quarter where we might see weakness, but I think the long term, at least for the next 2 to 3 years, is still pretty much intact. In the short term, things like tariffs, things like just emotions and stuff can create a lot of volatility on the stock. But in the long term, I'm still pretty much bullish. Thoughts there, Neil?
Yeah, no, I agree. I mean, it's pretty clear, like we just said with ChatGPT, for example. 1 week where suddenly a new image generating feature comes out and this thing really explodes, goes viral, and well, Sam Altman basically says, guys, you need to limit yourself to a couple of pictures because our GPUs are melting. Then when we go back and look at the reports that Microsoft might be pulling back some leases, we also have to remember that Microsoft was ahead in the CapEx spending cycle. So when we compare Microsoft to all the rest, Microsoft was already investing way more than all the other players before. So maybe they are ahead, and maybe, like you said, these things do work in cycles. Maybe they're not at a point where, okay, we've invested so much, we're still going to invest, but maybe we're going to choose wisely where we start to open up new facilities, where we're going to invest a little bit more and where we're going to invest a little bit less. I still think, like you said, I mean, ChatGPT came out end of 2022. So yeah, 2.5 years ago. 2.5 years ago is nothing. Is literally nothing, because in the first year, what happened in the first year? Not much. Let's be honest, not much. Now in 2025, you can really see, I mean, we're in March, at the end of March right now, and it's been week after week after week of new releases, new model releases, new features, you name it. So now things are accelerating way quicker than before, because most of these companies needed to build the capacity, needed to have that compute power. Didn't really happen in 2022, didn't really happen in 2023 either. 2024, we started to see things accelerate, and now things are moving even faster. So I mean, we're early. I understand that some are saying, okay, we have spent hundreds of billions of dollars. What do we have at the moment? And it's true that at the moment, for most normal users, let's say, other than a nice chatbot, image generator, coding assistant, we haven't seen much. But once we start seeing these things evolve in the health space, in the autonomous vehicle space, robotics, then I think people will say, oh, okay, actually, it makes sense.
Agreed, Neil. And here we got a thought from Pauly D. So Pauly D thoughts: my friends think AI has a few business uses. Says Wall Street doesn't understand the tech and just likes it as a buzzword. Says it's useless for his job. Curious, Pauly D, if you could just share what the type of work your friend does. Maybe I can think of some random use cases there. But I do believe AI is. There's so much in AI, Neil, right? I think there's so many different solutions in the AI market that it is seen as a buzzword, but I think it's always like the easiest way to kind of just say, hey, look, we have a solution that we have data on, and we can use machine learning algorithms and kind of these AI models to be able to find better efficiencies. Instead of saying all that, it's kind of just, hey, look, I have an AI solution ready in place. I mean, you have AI for advertisement, you have AI for supply chain, you have AI for just the typical large language models. But I think right now, the world is just looking at it as AI as ChatGPT, that large language model. But there's so many ways that AI can be used in all types of business. I would find it very hard, Neil, for some form of AI solution to not be applicable in any type of job. Like anywhere, I think you will be able to find efficiencies improvements through AI.
Yeah, I mean, I agree that since ChatGPT came out, there is a huge increase of AI mentioned, even though you can say that a lot of times you shouldn't really be adding the word AI in whatever you did, right? You might have said software solution before or cloud solution before, because that was the buzzword, software as a service, etc., etc. And now because AI is that buzzword, then we see a lot of companies where, let's be honest, if you said AI or if you said SaaS, who would have been the same?
That's a great point, Neil. There, right? Every era there is kind of a buzzword to kind of umbrella the type of solution. And just because you're using AI doesn't mean you have to invest crazy amounts of money in infrastructure or anything like that. It could just be as simple as a SaaS AI application added into a SaaS solution you already use. So there's definitely a lot of plays there. Neil, I actually like this question from Pauly D 29 minutes ago, and it made me do some research on it. So if someone is mainly buying low-cost index funds, should they diversify the managing companies? Example, let's say Vanguard went under, would all their ETFs go to zero? I honestly didn't know the question of this one, Neil, so I had to do some Googling, some AI perplexity, and I found out I found something new today. So first, there is a legal separation between the ETFs. There's a between the entities from their managers and the underlying assets. So with the underlying assets, is kind of like that asset under management, whatever. Let's say you have $1 million asset under management invested in some ETF, and that ETF kind of has all those different holdings. That $100 million, those assets under management, is legally a different entity than the ETF manager. So in theory, when the ETF manager goes down, the asset under management, because it's a different entity and based on regulations, you have to showcase, hey, look, this is the asset under management. You can look at our portfolio. It showcases that this is the money there. So there are checks that check that number is the true number. So if in theory the manager goes under, the assets under management are still a-okay. And what normally happens is if an asset under management goes under, there's going to be not an asset. If the managers go under, there's another entity that would kind of come in and take manager ownership of that portfolio. So I mean, there might be a random apocalyptic scenario where a Vanguard ETFs would go to zero. But no, in theory, there are puts and checks to protect that the managing company is a completely different entity from the from the underlying assets. So even if the managing company went down, your assets under management should still be perfectly okay.
Yeah, I mean, it's basically a custodian. So Vanguard manages, and the custodian holds the asset. Now, what if the custodian goes under? Now, that's another question, which maybe I'll find the answer in just a couple of seconds. But I think there is a system in place that protects investors' assets, even if the custodian also goes under. So. Yeah, I mean, good question. Very good question.
Neil, we have another one here from Luxury Hot Dogs, and I haven't even had breakfast yet, so I'm already. I just want to get this so we can get the name out of Slido so I don't keep getting hungry. So, do Tesla's humanoid robots operate without human intervention? I think yes and no right now, Neil. I think there are cases where they are operating without human interventions, but I wouldn't say it's 100% of the time. This is still a product under, it's still research and development in this stage for Optimus. And most robots in general, where I think there are certain scenarios where there's still plenty of human interventions, not just for Teslas, but with any other robotics company that you see out right now. When they show you a video of them doing it without human interventions, those are probably the workloads that they feel safe that they can do those without human interventions. But when training new types of task or whatever, I think there's very, very much human intervention, at least until they can guarantee that that's going to succeed from there on out.
Yeah, I'm pretty certain that last year during that Tesla robotaxi event, you had humanoid robots walking around the whole place there in Warner Brothers Studios, which was pretty awesome. You had humanoid robots walking, you had autonomous vehicles driving. Was a pretty cool event. But yeah, I think some of the robots for sure were remote controlled, which makes sense. At first, you don't want these things running around wild, but I would expect that to change this year for sure. I mean, Tesla themselves said that they want to produce, what did they say? The goal is 10,000, but they'd be happy with 5,000, which I think is fine. A 50% haircut there in the expectations. And I think those robots should be fully autonomous. If they're going to be doing one boring, repetitive job, I think that's possible since, most of their factories are already robot enabled, although not humanoid robot, just robot arms, which is another question, to be honest, because we're talking about humanoid robots working in factories. But today, most of those big factories already have robots I mean, robotics in them, right? Those huge robot hands basically take one part, goes to the next one, picks something up, put it, pulls, whatever. Is it just more efficient to have what they have right now? And what would the humanoid robot do? Just picking up stuff? I would guess that picking up an object could be done by the robotic arms that most factories have today. So I'm always asking myself the same question. In factories, what could humanoid robots do that the non-humanoid robots today are doing? I mean, a humanoid robot for someone's house, if you can teach it to clean, cook, fold laundry and stuff like that, mow the lawn, I mean, that would be great. But in a factory, it's not like everything's still being done by humans. No, a lot of things, and especially in a Tesla factory, a lot of it is already automated and robotics enabled.
Yeah, Neil, you brought up a great point here, and I didn't think so. First, yeah, we kind of heard that 10,000, 8 to 10,000 number for Tesla, and many people would say, so from 10,000, Neil, you would be okay with 5,000, a 50% haircut, and still be bullish. I agree with you, Neil, that yes, because if you can perfect 5,000, pretty good. If you can perfect them and have them showcasing real solutions, the rest is just manufacturing push. First is kind of perfecting that technology, and all you need is 5,000 to perfect that technology. And after you can perfect it, you can kind of jump into mass production. Then as an investor, that would be okay with me, even if they don't get to that 10,000 number. So it's more kind of that long-term game. But obviously, I would say that Wall Street would really care about those numbers, and kind of those numbers could create some volatility in the short term of things. Now, the other point that you made there, Neil, is I think right now we are kind of getting excited for humanoid robots, but in a factory, very true. I don't think you need a humanoid robot for everything. You are going to have efficiencies. I think you're going to have a fleet of robots. You're going to have robotic arms that are, because if you want to just move something from one location to another location, you could just have a robotic arm, and then those mobility robots that you see all over some of these centers already. So I think the end game is going to be then the goal. Is it cheaper to have an arm robot and a mobility robot? It's not only cheaper, is it faster? Or is it more efficient to have a humanoid robot just doing all that? So I think there's going to have to do some analysis behind it. But more than likely, I'm going to say it's going to be a fleet where it's not going to be completely humanoid robots. It's going to be a mixture of everything. And AI is just going to increase the solutions that each of those robotic solutions will be able to do. So right now, robotic arms just kind of do hard-coded task, where with AI solutions, they will be able to do more multi-layer task.
Yeah, fair enough. Because I mean, you've probably seen the videos from the Chinese companies, from Figure AI as well, right? They jump, they do karate kits, cool things on video, but I don't think that's what we want. You have Figure AI with their video where they basically sort your grocery shopping into and put it into the fridge. Again, videos can be manipulated. It's all great, but yeah, for the factory, I'm still surprised. I don't know what's going to happen, but yeah, starting off with 5,000 robots. I mean, 5,000 is a big number, and if you can have 5,000 robots do useful things, you can tweak whatever. The other 5,000 is going to be much better, can produce and probably faster as well, because you're going to know exactly what needs to be changed, what needs to be reinforced, and all of that. So we'll see. They still have 7 months left. So
yeah, Neil. And here, Paulie D did give us some information 5 minutes ago. His friend is in computer engineering and specific niche. He's frustrated with AI weakness in math for his use cases and says it's not good enough at coding. Neil, if I was back in my engineering field, I would love to have the AI that I have right now. So to Paulie D, I think there's going to be two things here. First, I would recommend, if they could, to use one of those, or talk to their managers to use one of those paying AI solutions. For example, math cases, OpenAI's $200 a month model. If I was back in the engineering world, that would be a must for every engineer. The amount of math that it can do, your calculus, your differential equations, everything beyond that, it is insane. And then for coding, again, paid solutions are really good. Again, if you mention your friend is in a very specific niche, I'm gonna guess he might be in something like Department of Defense or something with clearance. And usually if you're dealing with those types of markets, it takes a little bit longer for them to pass security verifications on some of these AI models. So some of those AI models, he might be using some of the outdated models. But eventually, if they pass kind of the clearance stuff, I think as an engineer, AI for math and coding, those are the most crucial use cases where I see AI being amazing in right now.
Yeah, no, I agree. I mean, I'm neither an engineer nor a coder, although I did manage to code a simplistic Flappy Bird game, so maybe I am a coder, who knows? So, but it's true that, I mean, it was a year ago, so of course, the last 12 months, things got much better. But yeah, so sometimes it gives you a code. I don't know much about it, so I assume it's correct. You plug it in and you're like, actually, just a blank screen. So you're like, okay, it's a blank screen, check for errors. So it checks the errors, debugs the whole thing. Of course, you will still have some errors, but I think I still feel even if it's not perfect, you can just move faster. Because if you are good in engineering, coding, whatever, you already know what you're doing. So you're just accelerating the pace of your work. And I think that's just amazing for the people in that field.
I agree, Neil. So Neil, there's this next question here 4 minutes ago from JBL. I don't have any thoughts, so maybe let's not, if we don't, let's leave the question there. But can you give an example where a company has free cash flow of over 1 billion that they are still not a good investment because of the business, not just their valuation? And any thoughts here, Neil? Do you have any in mind, or should we just leave this question for maybe later throughout the day?
I mean, we still have another hour, so maybe in the next hour we will think of a company, but it's a very good question. A company that already generates over $1 billion in free cash flow, and they're not a good investment because of the business, not just their valuation. I mean,
the first thing, I would try to think of a market that might be kind of dying down. And that competition might start to get closer to it, where it's a company that might look safe right now. Like maybe Intel 7 years ago would have been like that perfect example where you saw competition coming in and you saw kind of like it's still being in the positive, and obviously hindsight 2020. But I think it would be something like that, Neil, where it looks good in the financial numbers. And I think that's what JPL is trying to find, a company that looks great in the financial numbers, but based on the overall market trends, how would you kind of push away from it? If I was to guess, Neil, maybe something in the retail space. I think I would try to find something in the retail space for this example, somebody that's doing so my best guess would be I don't know, Nike. I don't know.
Because Ed's comment from a minute ago. So I was like, actually, maybe Nike, yes. But then again, valuation wise, they did take a hit, so it's not like it's super expensive. But the business could or could not recover. That's the big question, I think, with Nike at the moment. So yeah, maybe some retail business that somehow still generates $1 billion in free cash flow, but maybe they generated way more in the past, and now it's getting less and less and less. Maybe pharma companies, maybe some of the tobacco companies that could also be on that list. But yeah, a very good question, actually. Very good question. And maybe in the next hour or so, we'll think of a company that pops up that generates $1 billion in free cash flow, which, by the way, the fact that we cannot find one name, we said a couple, but really find a couple of names here for sure, already shows you that not that many companies also generate over $1 billion in free cash flow these days, other than the huge companies.
I agree, Neil. And this kind of just shows, I think, opens up kind of like that investor mentality where when you're looking at a company, it's also not just purely looking at the financials, right? You also have to think about a lot about just the overlying business, because sometimes financials could look great, but if you're not bullish in that market, it's just one that one wouldn't want to be invested in. So I think it also just showcases the importance of your investment style, and it's not just purely on financials.
Agreed. We actually have tax accountant who wants to chime in on that question. So for the free cash flow question, I'm not aware of any example. My general thought is free cash flow is not sustainable. How does it relate to the other financial statements? I mean, it depends on the company, right? Because usually free cash flow, if you are generating billions of dollars in free cash flow, should be sustainable. And if not, then maybe it's a one-time thing. But okay, if it's not a one-time thing, like a one-time positive effect on your business, and that's why you suddenly generated $1 billion in free cash flow, okay, I would agree. But most of the company, I mean the Coca-Cola, the Pepsis, it's been years and years that they generate billions of dollars in free cash flow. Yes, sometimes that might fluctuate. Same with a PayPal, for example. PayPal, although previously revenue was growing faster than today, free cash flow did not. So free cash flow was quite stagnant for a couple of years. But since Alex Chris came in, you actually saw that free cash flow goes up and is expected actually to go up more than revenue in the next coming years. That's because the profitability profile is changing. So they're becoming more profitable, but at the moment growing a little bit slower. So the top line growth is slowing down, bottom line is accelerating. So that's one example. Free cash flow growth not sustainable. Maybe it could be those tobacco companies if they're taking a hit, if, I don't know, smoking suddenly gets banned and vaping takes over. But then again, these companies also have a vaping department. So,
But yeah, so general thought here is free cash flow is not sustainable. How does it relate to the other financial statements? So I think free cash flow, Neil, is probably a little bit more lumpy than some of the other numbers, right? If you look kind of like at revenue, I think revenue, you can see more of a line and you see like free cash flow either going up and down. At the end of the day, it all depends on the business, right? I mean, even a Coca-Cola needs to expand its manufacturing lines every so often, or it needs to make some random investments where you will see kind of those dips and hits on free cash flow, where it kind of messes over up the line. But in theory, right? In theory, Neil, in that long-term trend line, you should kind of see it. Well, it is a little bit more noisier than the revenue. You should be able to kind of follow that same trend.
yeah, and I mean, for me, free cash flow growth is more important than a lot of other financial metrics. Because I mean, okay, revenue growth is of course it's easy to track, but earnings, EPS, of course, can be manipulated, whether it's GAAP, non-GAAP. Sometimes you have one-time hits, sometimes you have one-time benefits. You can put things under a line, over a line, but free cash flow can show you the true strength of a business, the true profitability of that business. Because with free cash flow, you can see, okay, actually, we can maybe increase our buybacks, we can maybe even do some M&As. With an EPS, that doesn't tell you if you can suddenly increase a buyback or an M&A, not all the time.
Yeah, I agree, Neil. I mean, I tend to look for strong free cash flows in companies. And I understand that there are going to be certain cycles. I mean, I think a perfect example in the semiconductor industry is Texas Instrument. So Texas Instrument even is known to be a nice free cash flow machine. But in the past few years, it has kind of focused a little bit more in increasing its manufacturing capabilities. So for the past few years, it has kind of seen a weaker free cash flow than expected. But as an investor, you should expect that to go back up. So I think free cash flow is harder to maybe. With revenue, it's very easy. Okay, yes, revenue is going up. That means it's selling more. With free cash flow, I think it forces you. It's a lot of volatility, and it forces you to understand what's happening with the business. Oh, there was a decrease in free cash flow these past few quarters. Why is that happening? And I think also that's why I enjoy free cash flow right now. It forces you to learn more about the business. Why, if this company's revenue is going up, why is free cash flow dropping? Oh, it's increasing its manufacturing capabilities. Oh, it's doing this and this with its equipment or something else. And it gives you a more understanding of the company's process of its business plan.
Yeah, I agree. And I think with that, we are at the end of our hour. But we're not going anywhere. We have another hour. Both of us are here for another hour, for another Ask Us Anything team, actually. I don't know if we are doing a quick break or not.
Nope, Leo, I think we're straight on it. I think we're all in the platforms that we're supposed to. But like always, for any fools joining us, feel free to join us on Slido. The code is fool24. Again, just for those that might just be tuning in, my name's Najarro. And I'm joined by Neil. Both of us are full contributors. Whatever we say here is not personalized advice. It's just our overall thoughts. We do focus a lot in the tech space. I have my hand in the sand of the semiconductor market. Neil also follows me there sometime. Neil also does focus a lot in the fintech space, and we can definitely talk about the big seven and kind of anybody in the tech space. So feel free to get those questions to us on Slido.
Yeah, and to continue on the Nike aspect, because Ed did ask two questions, but one is here. Is it game over for Nike stock? So, I mean, we don't own it. Of course, we're more in the high growth tech space. Nike is an iconic brand, of course. It has its own issues. I mean, you could say Nike could be an equivalent of an Intel, right? Intel was the big dog for many, many years. Suddenly, it was mismanaged for a couple of years, and then other competitors just popped up, started eating up their market share. With Nike, it's a bit of the same. I think the business was mismanaged, especially during the pandemic. And then you've got players like Hoka, which is under Deckers, and On Holdings, which just popped up and are growing extremely quickly year over year. They're taking market share. On is, I think, last quarter, they're still growing 50% or so year over year, while Nike is struggling across the board, whether it's footwear, apparel, or one of the other businesses out there. It's not just in the United States, it's China as well, it's Europe. But they've got a new CEO, and with the new CEO, it's someone that knows Nike inside out, Elliot Hill. So he's been there for he was there for quite a long time, left a little bit, now came back. Could be a turnaround story. But as I said in the past, if you are, you're buying Nike because you're probably interested in that sector, or maybe you want a turnaround play plus a small dividend. Okay, fine. But if you are interested in that sector, why not have a look at the players that are eating up their market, right? Why not look at the On that is in the footwear and apparel in the business, growing much quicker, of course, from a smaller base, since it is a smaller company. Why not just look at those players rather than see whether or not Nike might turn it around? Now, Nike has that big advantage that it is Nike. Okay, it's worldwide. You can see it everywhere. Everybody knows the Nike brand. So I don't know. I don't think it's game over. But me personally, I also don't view it as a super attractive opportunity at the moment. Maybe it's just because the sector, because then again, I mean, I'm saying it's not attractive, but it is a turnaround story. But then again, I am also an investor in Intel, which is also a turnaround story, but maybe the sector is way more interesting, the semiconductor industry, foundry. So yeah, I don't know. That's just my rough thoughts on Nike at the moment and whether or not it's game over. I don't think it's game over, but for me, it's also not that exciting.
Yeah, Neil, the shoe game, the apparel industry scares me as an investor. It scares me a lot because I feel in the tech space, Neil, I can really see the competition, right? I can go to performance and see, hey, look, this chip is this times better than this chip in these types of workloads. I can't go to something and say this shirt is this times better than this shirt in any type of real benchmark. Same with the shoe. I can't say I'm pretty. There might be. I can't say this shoe helps me run 5x times faster than these other shoes. And it's you're at the mercy of the trend of the world. You're at the mercy of one TikTok going extremely viral and making your competitor extremely, extremely popular. And I don't like that complete uncertainty and lack of control. So it's weird, right? I think most people would say, oh man, the tech industry is too risky for me. I'd rather stay in the industrial space. But at least in the tech world, I can see which one is literally the better product than the other. So yeah, this is definitely an industry that I tend to stay away from.
Yeah, no, and I mean, I'm sure there are some shoes that make you improve your pace, but I highly doubt those are the high volume shoes. It's probably those that marathon runners use, and that's not the mass market that Nike is going after. Plus, I mean, everybody forgets that you have the competitions, right? You have the On, you have Adidas, Puma, and all the other players. But there is one huge competitor that nobody mentions, and that's the market that sells fakes. Not everybody is going to buy the real ones. And the fakes, they're getting better and better. So that's, yeah, you cannot fake a H200. Let's put it that way.
Leo, I actually, you remind me of something I saw on X, Twitter a few days ago. So there was this is going to be a completely random thought, but you know how we have it in video games, you can purchase skins for your character or your avatar. And skins, for those that are not familiar, it's like, let's say you have a character that you play with a lot, and you want to put extra clothing on that person or extra kind of accessories that mean something to you. Normally you pay kind of a price for it. In a world, Neil, where we kind of enter augmented reality, do you believe that we will start seeing kind of like skins, like everybody would just be wearing the same type of clothes, but if you put on your augmented reality glasses, you'll be able to see the skins that they've selected? Is that some form of possibility of sci-fi realistic world in the next, let's say, 10 to 15 years on your mind?
Today, in Fortnite, you can get Nike sneakers for your character, for example. They even had a collab with, I think Montclair.
Yeah, I meant the other way, where it comes to the real world, Neil, where like the real person
with your
like,
glasses.
Yes. So let's say I put on my glasses and I get to see what skin you've actually chosen to wear today.
No, it could make sense. Like, yeah, it could make sense. Your avatar. It's a huge industry, right? Because it's not physical, so doesn't take up space, doesn't take up anything. Super high margins for all of these brands, right? I mean, the Nike pair in Fortnite. Well, what does it cost Nike to do it? Nothing. I mean, not much, because I'm pretty sure Epic Games does the design and Nike just says, yes, okay, we'll take a cut from every virtual shoe that you're selling. But in a AR world, yeah, I could definitely see that happening. In a VR world as well, because a VR one, that means you are completely transformed. Like in Ready Player One, you are just an avatar, and you can definitely buy skins, cosmetics, or I mean, the gaming cosmetic industry is huge. Whether it's Counter-Strike, Fortnite, you name it. It doesn't enhance your gaming capabilities, by the way. It just makes your gun look better, your skin look better, your character look better. But there's like I don't know how it works today, but previously there was that huge second-hand market, maybe not second-hand market, but third-party market where you can just list your skins on it and somebody can pay you and they get it. It's that's a huge market in the future. I just don't know how they're going to make it work across all platforms. I mean, in an ideal open internet, open gaming world, would be great if you can just exchange stuff from one game to the other and make it really the metaverse. Whether that's going to happen, I don't know, because everybody wants to have their piece of the pie. So we'll see.
Neil, again, we're gonna go back into the questions, but I feel like five years ago when we had this whole metaverse craze, I think it was around 2020 when it was like kind of like the metaverse was the future. Many people said that the end goal of the metaverse was kind of like that movie that you just mentioned, or the book, Ready Player One, which in theory, for those that are not familiar with Ready Player One, is you're fully immersed into this digital world when you put on some form of virtual reality or some form of equipment. I think if you were talking to a few tech people in 2020, you would say, hey, look, VR games like Ready Player One, 5 years away, not possible. Maybe by 2030, a little bit closer to maybe happening. 5 years later, now, Neil, coming into here 2025, thoughts on ever coming into this Ready Player One world? Is that something that we will see maybe not in 2030, but in the 2030s, or something that you maybe we will see in 2030?
It really depends which company is going to take this on, because you're going to need a lot of investments, a lot of capex, not just from the GPU side of things, but building that equipment, right? It's not just the VR glasses that Meta has. It's that there is a company actually that already makes it today, where you can just walk where you walk, but you don't move, just to make it feel as if you're moving in the game. You're going to need that if you want to have that full Ready Player One experience, plus the thing that you put on yourself in order to I don't know, feel something, get hit or whatnot. The company that does it has to be a big one, because you need a lot of money to make that happen. You need to do it at a super large scale in order to make it affordable for the masses. 5 years from now, I mean, I hope so, because I do expect 5 years from now Meta to come out with affordable AR glasses that are useful, VR glasses that probably weigh less but are also super sleek and all of that. Maybe Apple as well. Hopefully some other players out there compete. But yeah, 5 years from now, I mean, a lot can change. To have that full Ready Player One experience, you need a lot of things to work. And yeah, I mean, if you want it takes space, right? It's not, like I said, it's not just the headset that you put on your head. You will probably need like 2 meters by 2 meters. I don't know how much that is in your metric, but you will need a little bit of space in your house to have it. Which, again, there are some studios, some places where you can like rent it out for an hour, which is pretty cool experience. Not gonna lie, pretty cool experience. But mass scale 2030, I think so. 5 years in the AI space is quite a long time from today.
And Neil, I'm gonna save this for the prediction show. I think me and you have tomorrow, but I do have some predictions now thanks to this. So let's jump back to the questions here. About 8 minutes ago, Neil, for the bees mentioned, thank you so much for explaining tech, AI, companies term, increasingly news, tech, social media. We don't comprehend racist fear, bad choices. So for the bees, I'm pretty sure any fool would say the same, but whenever you have Neil and I on, feel free to have any tech questions that you might have, and Neil and I will try to do our best to explain it as best as possible. Because one thing that does suck, Neil, right, with kind of the big tech world that we're in, there's a lot of good, but the bad is you hear a lot about the noise, and the noise always seems pretty bearish. And sometimes we have to find out which is really just noise and which is the type of news that we really maybe should kind of keep a closer eye on.
Yeah, especially today when things move very, very quickly. You can have one day, oh, suddenly XYZ happens, stock goes up. The next day, XYZ happens as well, and stock goes down. In those types of moments, sometimes the best thing is just to do nothing. Just do nothing. Pausing definitely helps.
Neil, then we have we have two questions here from Foolish Motivated. Doing some research, foolishly motivated on the second question, but I want to jump on the first one. So 9 minutes ago, Microsoft at current valuations is at a 52-week low. The price to book value is the same it was as 2022 pullback, but its other ratios are still a little elevated. Neil, any thoughts here on Microsoft and sitting at that 52-week low?
Yes, I'm just pulling it up so I can see where we're at. Okay. Microsoft 52-week lows, correct. If you look, actually I have here forward PEs. Maybe I can actually share this. Let me just share this to make it even better. Let's see. Okay. Just waiting for the screen to get shared.
I find that wild though, Neil. 52-week low on Microsoft. I do know Microsoft was one of those that got a little bit ahead compared to some of the other cloud players because they had kind of that early OpenAI boost. But for it to be hitting a 52-week low, I didn't think the market was this wild right now.
Yeah, I mean, it wasn't the cheapest stock out there. It wasn't the cheapest stock out there, but right now market cap back under $3 trillion, $2.8 trillion. Forward PE that I'm seeing right now sits at 27.4 times, and the 1 year mean 2.3 times. So definitely it was a more expensive name than, I mean, before was more expensive than where we're at today. And even if we go back 5 years, if I look at the 5-year mean, it is cheaper. It is cheaper. The only one that's a bit more expensive is the price to free cash flow. But if we're looking at forward metrics, forward PE, forward EV to EBITDA, forward price to sales, we are currently under the 5-year mean for all of them. Price earnings to growth, so the PEG ratio, is elevated. I'm not gonna lie, is elevated. It's at 2.29. So that's still quite high. And the mean for that, the 5-year mean for that, yeah, it was always high. The 5-year mean was 2.5. So it wasn't a cheap stock before. It's not the cheapest stock today, right? If we go and look at one of our favorites at the moment, a Google Alphabet, for example. Let's see. A Google right now, forward PE 17.3 times. I mean, compared to a Microsoft 27.4, much cheaper. Price earnings to growth for a Google just over 1. Price to free cash flow 26 times. Price to sales 4.9. So yeah, it's much cheaper. A Google is much cheaper, and actually it's growing faster. It's growing faster, or expected to grow faster than a Microsoft. So yeah, it's at its 52 weeks low, but that doesn't always mean that it is super cheap, a no-brainer, or something like that, because it was never that cheap. Like the last 3 years, forward PE closer to 30. But it is a quality company. It is a quality company. It's one that probably will continue to do very well in the future. But yeah, I agree. It is still a little bit elevated, especially if you look at companies like a Meta and an Alphabet that we've been looking at, which are even an Amazon, for example. It's cheaper and expected to grow faster. So yeah.
Yeah, I mean, I was looking at forward PE ratio for Amazon, and I saw it was forward PE, which is the end of this current fiscal year, is now trading at 30s. I never thought I would see Amazon that cheap. So I think right now it's most. I think during bear markets, we're not even a bear market, but during these massive downturns, I really like to look at these big tech players, because these are the ones that I believe have a higher chance of success and still have a high chance of producing some great market beating returns. So I'm a fan of a lot of the big tech players right now. Amazon, one that I don't own, has become very, very attractive for me.
Yeah, I mean, Amazon, as you can see, the forward PE has been coming down quite rapidly in the last, 12 months or so. If you look at the 5-year mean, we're basically cut in half for that forward PE. Price earnings to growth also not undervalued. It's not under 1. It's at 1.45, but it's a company that's expected to become more and more profitable. And yeah, Amazon, Google, Meta, even Nvidia, for example, right? Nvidia, despite its rise and its size, and Nvidia right now is also not the most expensive name, right? Forward PE 24.2 times, and price earnings to growth is actually under 1 at the moment for Nvidia, which by definition, price earnings to growth, PEG ratio by definition under 1 is undervalued. So yeah, there are definitely a lot of deals to be found, even with the huge player. Especially with the huge players.
And then, the next question comes here from Foolishly Motivated 23 minutes ago. Are either of you familiar with House stock and your thoughts on the company's outlook? As I don't understand why the markets have punished it so much. So I kind of just did a quick overlook of some of the risk foolishly for this company. And based on various articles online and based on kind of earnings calls, these are some of the fears that investors are having. Right now, it seems that I don't know if anything has changed within the past few weeks, but recently, this company has had its role vacancy in the president. So the president role has been vacant for some time, and their current CEO is about 72 years old. So many people are wondering, hey, what happens if the CEO starts to leave? So there's fears of kind of leadership uncertainty with already the president role vacant and the CEO already kind of being such a up there in age. Obviously, we've seen plenty of CEOs go way beyond that age, but leadership uncertainty becomes more of a question. The other thing is, this does seem to be a company, Neil, that focuses a lot in kind of like providing enterprise solutions for contact centers, telecommunication network solutions, and remote work infrastructure. It is a Canadian-based company traded under TSX as ticker ENGH. And right now, the AI market is one that's kind of creating worrisomes for the contact centers, especially. I think the contact centers has been one of the markets where AI is seen as maybe where the lowest hanging fruit opportunity is for the AI space. So that's also creating a fear there, and depending on how you can move into that. And outside of that, there's also some worries of a lot of companies used to run a lot of on-premise solutions, and now those on-premise solutions are shifting into they're trying to move it into the cloud, Neil. But usually when you're giving your customers a chance to change, they sometimes take the opportunity and maybe go with another player. So whenever you're changing something, if you're going from on-premise to on-cloud, it opens up the window for these customers to finally say, hey, look, maybe back then we weren't thinking about switching from you, but now that we have this opportunity, we might go with another player. So there's a lot of tailwinds with headwinds with that company right now. And that's what I found, right? There could be other reasons, but I do believe those are three crucial things that investors should know about the company.
Yeah, thank you for that. First time I'm hearing about that name, but that's always good to learn about new companies during the live stream. There was a question about the one and only Microsoft, the one and only Nvidia. So is Nvidia falling below its support level next stop $100? So right now we're at $109.6, which I think we've been there 2 weeks ago, if I'm not mistaken. Yeah, we've been there 2 weeks ago. We actually went under it. We went to $104, $105, and yeah, could or could not go under $100. To be honest, I'm not a technical analysis expert or something like that. I just look at the business, and if it's valuation wise, if it makes sense, it makes sense. But yeah, it does seem like sometimes when you look at those round numbers, the $100, $150, $200, sometimes those things get lots of buying or selling activity. Some reasons investors like round numbers. I could agree with that, to be honest. But yeah, I don't know. It's been Nvidia and some other tech companies have been in a down cycle, I would say, since the peak. Some a couple of weeks ago, some a couple of months ago. I think it's important to focus on the business, right? Because the business keeps on doing quite well, even for the size that they're at right now. You're a big Nvidia shareholder, Jose. So, what do you think about Nvidia at these prices?
I mean, I'm still very much bullish on Nvidia Neo. I do believe a lot of the discussions happening online right now of like data center slowdown are misrepresented of the AI space, and there's other reasonings behind it. I think it's also funny, Neil, how you mentioned, right? It's numbers play an important role in just the emotions or the way or investor sentiment. Like, I think if Nvidia was $100.01, the market would be like, oh, still over 100. But if it was $99.99, just the 2-cent difference between those two prices that I just gave, 2 pennies, the market would be like, it's game over. It's under $100. And it does play a crucial role in short term, right? Like, and you mentioned that, right, Neil? It's like in the short term, it could imply there's some opportunities to maybe buy, but I saw, like you mentioned, long-term investor, you're looking for if the business is still intact and outside of those prices. But I really do like Nvidia. I mean, I think forward PE ratio, Neil, it was below or near 25 for this company, where some other big tech giants are a little bit more expensive than that. So again, you have to be very, very bullish in the AI space to be bullish in Nvidia, though.
Yeah, no, I agree. I mean, personal question: do you put buy orders at round numbers or not?
You know, Neil, I don't tend to have like order numbers on for future. If I'm buying, it's usually buy at the moment, and it's just buy the market. So it's very, very rare for me to have an order out that would last a few weeks, unless maybe I might go on vacation. and excuse me, and I might not, and there might be a stock I wouldn't mind entering into, and it might be like the close of it might be the weekend at the moment, then maybe I might put a buy order. But I don't know, Neil. I think I would just put like something and put it with a penny. I think, Neil, I would do this. I would find a round number, and then I would add about 5 or 10 cents to it, because I know that round number for some reason will not get hit, but it will get hit a penny ahead of it. So I try to mess with Lady Luck.
No, I completely understand this. I've had my fair share of these types of examples where I'm like, at $50 or at $100, I'm buying. So you put that buy order at $50 or $100, and there were literal cases where it went to 100.04 or 0.5, and you're like, yeah, should have put in a market order and not just a buy one. But yeah, to be honest, for long-term investors, if it's 100, if it's 101 or 99, doesn't really matter much.
Neil, there's a question here on Salesforce, but I don't want to grab it. I don't follow the stock, but I don't know if you do.
No, not close enough at the moment.
Right. So let me see any other stocks here. Any questions that you might see, Neil, or any topics that you might be excited for this that might have happened this past week, Neil, that we didn't discuss, or anything that you're excited for this upcoming week? I know earnings season is slow, but sometimes we do have some conferences, and I think we're eventually going to get closer to that new earnings season as well.
Yeah, I mean, for the upcoming week, we have Intel Vision, I think 2 days from now, 31st and then April 1st. So first time where we're going to see Lee Bhutan as CEO of Intel speak, share his vision, talk about the state of Intel, the design side, the foundry side, where he sees the company going from here. So me as an Intel shareholder, I think that's a pretty big event. And I think for the semiconductor industry, that's a pretty big event as well, to see an Intel, maybe a revival of the Intel, the big company. So that's one. The other one, to be honest, I mean, other than the April 2nd tariff deadline, which will probably move the market as we've seen in the last couple of weeks. Other than that, I'm sure there is an event happening, but I just can't think of one. But yeah, like you said, I think 3 weeks from today, we are already at the start of the next earnings season. So that's going to be an interesting one. But now in the last couple of days, what did we have? We had, well, like we said, XXAI, new image generator feature from ChatGPT. Google Gemini came out with a new model as well, which, to be honest, I mean, Google is on a roll, I would say, since the start of 2025. And yet the market doesn't like the stock, but that's probably has to do more with the DOJ case that's starting pretty soon. Actually, that's starting in April as well, I think. So that's something to look out for. Other than that, I mean, it was an eventful week. We started the week well, stock market wise. But no, I think that's about it. If you have anything that I'm missing here.
Yeah, no, I think that for the semiconductor space, Neil, which is the market that I follow the most, is Intel Vision. You're a shareholder, so you're definitely going to be paying super attention to that. So I wonder if we have a show, maybe a few days after that, maybe we can kind of share our thoughts here on Full 24. But that's the one I'm keeping a closer eye on. While I am not a shareholder, Neil, I just love to see where these companies are heading. They also, even if you're not a shareholder, they also like to paint a picture of the overall semiconductor industry, so they can kind of give you a lot of great knowledge of maybe you might be a Micron shareholder, you might be an AMD shareholder, even an NVIDIA shareholder. I think events like these are crucial. Very curious to see thoughts on their manufacturing push, right? That's the big question. I wonder, or I'm gonna guess, I'm gonna assume there's gonna be a form of analyst Q&A day or questions for that, where we might get some more thoughts from the CEO. And outside of the foundry push, Intel Vision is usually kind of like focusing on upcoming technologies or innovations. I would also love to hear more about kind of their AI accelerators and AI GPUs. Maybe they might share some of the roadmaps and some of the current products that they have there, and any thoughts on how that market is going. So for Intel Vision, and then like you mentioned, I think this past week was pretty fun for AI hobbyists. Gemini, I just saw a ranking, Gemini 2.5 experimental is beating even ChatGPT's O1 Pro, which is the one you pay $200 a month for. So two things. It showcases how strong Google is in this AI space. And I feel people are sleeping on it. I really do. I think the market is overlooking how strong AI can be for Google. The second thing is, I think OpenAI is not going to like those benchmarks, and within a week or two is going to release a new model or something to help kind of showcase that, hey, look, we're still the best in town. So this is what I'd love to see in the innovation race for the AI market, where companies just continue to battle it out on a weekly, monthly basis, showcasing what they got. And at the end of the day, us as consumers end up being the real winners.
Yeah, I mean, I've said it time and time again. When you look at OpenAI, the valuation that the private sector is giving it, the private market, $300 billion, maybe plus 16%, maybe now even actually more than 16% of Alphabet's value with the current market cap, just doesn't make any sense to me, right? Because Google just released a model that's better than OpenAI's Pro one, where you have to pay $200 a month. And yet I don't see the market recognizing Google in that space. It's very, very strange to me, very, very strange. But then again, I think for long-term investors, this is going to be a huge opportunity, because still very profitable company, and the concerns that the market had 12 months ago that Google is falling behind, I think they're proving them wrong in 2025. So there is that. I remember an event. The Robinhood Gold event happened this week. I don't know if you probably saw some posts, maybe some of my posts as well on X about that event. So Robinhood had their gold event in San Francisco, talking about the gold subscribers, how many subscribers they have, new features that they're launching. So Robinhood Banking, Robinhood Robo Advisory, but a bit better than that. An AI that they're launching, also called Cortex. Tesla also has an AI called Cortex. Well, their huge GPU cluster is called that. So there was that event. In the fintech space, of course, there was some drama. Robinhood, SoFi. Is Robinhood going to destroy SoFi's business because they announced Robinhood Banking? Just an FYI for those that don't know, SoFi has a bank. Robinhood does not. So Robinhood has to deal with, I believe, Coastal Community Bank or something like that for all of the banking needs. Some of the features that Robinhood has built and offers is on top of Galileo, which is the tech platform that SoFi owns. So there is that as well. It was an interesting time, but to be honest, I'm a SoFi shareholder. I don't own any shares of Robinhood, but I've been bullish on Robinhood. I did have shares before. Was quite bullish at $8, $10. I think they're going to do well in the future, but it is so far a business that does extremely well during bull markets, will not do that well during bear markets. Of course, they're diversifying more and more, which will help them in the future, But I mean, last quarter they had an amazing quarter because crypto revenues exploded. I mean, 2 quarters ago they did 61, and then the quarter before that was $81 million in cryptocurrency revenues. Last quarter, Q4, was 360 million. So quite a huge increase. I don't know if that's going to happen each and every quarter, but a SoFi, if we go back to 2019, 2020, if you look at revenue grew steadily. So there was not one year where it went up, then the other went down. So to me, SoFi, nothing really changed much. Yes, maybe they should be accelerating the pace of innovation. Maybe they should be releasing more consumer-facing features and products, things that customers want. A business account, why isn't that already available on the SoFi platform? Joint accounts, some people really want options level 1. These are things when you call yourself a fintech company, when you call yourself the AWS of fintech, these are things that consumer should be expecting already on your platform. Maybe that's going to happen in 2025. I have a lot of confidence in Anthony Noto and the team because they've been really executing quite well, even when a large part of their business, their core business back then, the lending side of things, was basically paused for a couple of years because of the whole loan moratorium thing that happened in the United States. And yet they managed to come out of that a stronger company and a profitable company. So yeah, there was some drama in the fintech retail community because both SoFi and Robinhood are retail heavy company stocks. So that happened. Did a couple of video articles about that as well. I am not shaken by these announcements. I mean, you probably remember the post I made about the fact that, okay, you can order someone to deliver cash to you. I find this the most useless feature of the year.
I agree there, Neil. Neil, so do you wait? I don't know if you mentioned. I know you own SoFi. Do you own Robinhood as well, or no?
Not anymore. No, I
Not
owned
anymore.
Before, but not anymore.
Yeah, and like one thing that I saw again, I'm very. I sometimes just scroll through the FinTech community or the X community, and like you mentioned, both are very retail heavy. So you do kind of get a lot of these X, or just a lot of people discussing it in general, because it does seem like it's a real retail space. If you had to give maybe 1 or 2 reasons why one would prefer SoFi over Robinhood, and maybe vice versa, because obviously every company has a bullish reason behind it. What would be like one or two of the biggest reasons to be bullish in SoFi, and one of the 2 biggest reasons to be bullish in Robinhood?
Yeah, so first up, retail heavy communities in the stock market act as sports teams. Okay, I think we can all agree. This is not normal. Okay, this is not normal. This is an investment, not the Lakers versus the Clippers, although who follows the Clippers anyways. But yeah, I am bullish on both. Of course, now only have a position in one and not the other. But top level, very easy explanation. One stock has gone up a lot, the other one has not. Okay, Robinhood has gone up a lot since, I started talking about it at $8-10. At one point, I think it was even closer to $70 not so long ago. Now we're back down to around 40. But still, from 10 to 40, that's a 4x. Whereas SoFi went from $6 to now $11-12. Yes, it did go higher a month or so ago to 18 or something like that. But for retail, they, not all of them, but a lot of them look stock price equals good business, bad business, right? I think both we contribute on the full and on YouTube. We can see that in the comment section as well. When a stock goes up, great business, stock goes down, bad business. Sometimes that is true. A lot of times, especially in the short term, not true at all. So that might be one of the reasons why some might be more bullish on Robinhood, just because of the stock performance. But business performance, like I said, SoFi has been doing extremely well. Even when they had plenty of headwinds, one huge headwind, The business has continued to grow. They became profitable. They also introduced a new product 2 quarters ago called the loan platform business, where they basically, this is a high margin, low risk, fee-based business. Capital light as well, since they're working with third parties, so they're not really increasing their risk when we're talking about loans here. That was introduced 2 quarters ago. That is growing extremely rapidly. Now, some say, okay, that's great, but the company promised, tech platform Galileo, AWS of Fintech. Why isn't the tech platform growing as fast as previously expected? Now, remember a year or maybe 2 years ago, there was that whole banking crisis, right? Or that period where there were fears of a bank run or a run at the bank or something like that. So suddenly a lot of these banks were under pressure. And if you are a company that offers a solution to basically modernize all of your banking systems, well, of course, you're going to go into a period where a lot of these banks are going to say, okay, look, right now we are pausing everything. Once we get everything back on track, we are going to come back to you. And that's what's been happening. So it's a bit out of SoFi's control that the tech platform has struggled a little bit, although there were some deals already in place where we will see the effect only in 2026. Okay, fine. But like I said, in the meantime, they've launched that loan platform business 2 quarters ago. High margin, lower risk, fee-based revenue, great business. I think that's going to be one of their biggest products in the future. And then Robinhood, what they've been doing very well, one, marketing, okay, retail heavy Robinhood. Everybody knows what Robinhood is, although at first it was not such a positive thing, because remember what happened in 2021 with GameStop, AMC didn't allow you to sell your position. Lots of people were locked in, they lost a lot of money, and there was that whole drama. More recently, Robinhood as an app, very, very user-friendly, probably the best UI UX out there, releasing quite a lot of new products. So lots of new products and features, consumer-facing ones. And that's the thing, consumer-facing ones, which means the customer, the user, sees the, improvements, sees that, okay, this week we actually have a new product that makes my life easier. A month from now, another one, and another one, and another one. You add value. With a SoFi, even though they've made improvements, you're not always seeing those right away. SoFi is more right now in raising brand awareness, whether it's through the SoFi Stadium, whether it's through being, I think, the bank of NBA, if I'm not mistaken. And more recently, they had that little golf tournament, TGL, presented by SoFi, which was, I think, a pretty good success. But SoFi, Robinhood, I think SoFi is focused way more on long-term success of SoFi becoming a top 10 financial institution in the United States, whereas Robinhood right now is really chasing momentum, marketing heavy. They released those sports contracts. So a type of betting, but betting through contracts, which I think is already getting banned in a couple of states in the United States. So they're trying to do things fast, break things fast, see where you fail, where you're successful. That's Robinhood's way of playing things. Sometimes it works very well, sometimes not. SoFi is, I think, more of that chill, but growth and a profitable growth type of fintech player. Might not be as attractive as a Robinhood, but me as a long-term investor, I rather have a SoFi right now where bull market, bear market, they're still going to do well. A Robinhood might not, because if we enter a bear market, hopefully not, but if we do, I can see transaction-based revenue coming down quite drastically. So,
thank you for that, Neil. I have some questions here, and first, I don't follow the fintech space, but I think it's also crucial what you mentioned there last, where it's important to understand which one could get more hit in forms of market sentiment. And I can definitely see the case that you made where Robinhood has a little notably more risk in that space. So thank you for that, Neo. We have two questions here, Neo, that just came in. First, foolishly motivated 6 minutes ago. What are your thoughts on CrowdStrike as it seems to be running away with the cybersecurity market? Neil, do you follow CrowdStrike? Do you own CrowdStrike? And I can share points here, but would love to hear just at least initially if you own the company or not.
I do not own CrowdStrike or actually any cybersecurity name, although you could say as Google shareholders we might own part of the whole Wiz company, which is a cybersecurity player. So I don't own CrowdStrike. It's an amazing company. Even after that outage of last year, they've proven that they are doing quite well, because since last year, okay, now the stock has pulled back a little bit, but it has proven that their platform, the Falcon platform, is best in class. That's how they attract more customers, and that they're making sure that the existing ones are staying with them and adopt more and more modules, more and more products inside of CrowdStrike. It's not the cheapest name out there, not at all. It is a fast growing one, and I think they're still facing some headwinds from that outage, whether it's contract negotiations or maybe they gave out freebies to make sure that the customers stay inside of the CrowdStrike ecosystem. But no, it's an amazing company. I'm not looking to buy that company per se to get exposure to the cybersecurity space. I'm not willing to pay the price either. And now that Google might be buying Wiz, I think I'm covered.
Yeah, Neil. So I do own CrowdStrike. It's one of the direct cybersecurity stocks that I own. I don't think I own anything else directly. Like you mentioned, indirectly, I think a lot of these big tech giants do have some form of cybersecurity solution. So CrowdStrike, definitely not definitely not a cheap company, right? Market cap of $88 billion. And we did see that in their most recent quarter, they mentioned their annual recurring revenue was for about $4.3 billion. So if you do the quick math, that's about for companies like this, I don't like to look price to sales ratio. I like to look price to ARR ratio, right? That annual recurring revenue. And based on that, it's still trading north to 20. So definitely pretty expensive. I would definitely kind of follow suit to some people looking at at somewhat near price to sales ratio. I just think ARR is better here, but closer to maybe those 10 valuations. So right now we can see it being pretty expensive. Luckily, though, like you mentioned, this is a high growth company. ARR did increase by about 23% year over year. So we are still seeing that double digit growth. And they believe that they can get to 10 billion ending ARR by 2029. So about 4 years from now. So if you believe those numbers, right, Neil, then that very forward price to ARR metric jumps to way below 8 or around 8-ish number. So then it starts to 8 to 9. So it starts to look a little bit more attractive based on those expectations. So it's one that's, annual recurring revenue is growing, still positive, super amount in cash and cash equivalents. Overall, they are also kind of continuing to grow in some of their main markets. There's 3 markets that they kind of put under this pool of kind of high growth, and that is the identity, the cloud, and next gen SIEM. And collectively, those kind of represent a nice 1.3 billion opportunity right now for them in annual recurring. And recently, they've just hit about 300 plus in there, so 303 million. So there's still a nice amount of growth there. That grew about 115%, and it's representing about 8% of their total annual recurring revenue right now. I believe this is going to continue to grow, Neil, and being such a high growth run rate for them, I think it's going to accelerate their overall annual recurring revenue to grow at faster levels. Some other things that have been bullish for them is they kind of created kind of these flexing licensing models, and that flexing licensing model has kind of created contract value converted to about $2.5 billion now, and seeing strong customer commitment here. So for, again, more future growth opportunities. So it is trading at expensive plays. I think this is going to be a stock, Neil, that is always going to be highly volatile. And because it's highly volatile, I believe there's going to be plenty of buying opportunities in the future. I am currently happy with my position sizing in this. And if I was to buy any now, it would be very, very small dollar cost average. But overall, plenty of growth opportunity, exceptionally run. And with the whole outage thing, I think management did, from what I saw, a great job at communicating, not to just their customers, but to investors as well, of what was going on. And I think that's crucial to see, especially in the software space.
Yeah, I mean, if we look at the ARR multiple, Google is paying for Wiz 32 times forward ARR, because Wiz is expected to generate around $1 billion in ARR in 2025, but growing much faster than a CrowdStrike, for example. And I mean, it is a very, very big premium, but a combined Google and Wiz, if of course it gets approved, even if it gets approved, it's only going to be for 2026, for those that are wondering. It would make also Wiz a more powerful company, because you can combine all the expertise, compute power, cloud usage, and all of that from Google, which is probably something that Wiz had to pay for before. And if you can do that, cut costs, improve margins, but still continue to grow maybe 100% a year, I mean, that could be a formidable player in that field.
So it seems we've got about 4 minutes left for the show. I think we can take maybe one or two more questions. I like this one from Cyber Mikey 9 minutes ago, Neil, and I think we both can touch on it. AMD claims that their RX 9070 has 10x the stock of previous launches, dwarfing the underwhelming NVIDIA 50x series launch. Thoughts? Cyber Mikey was able to snag the 5070 Ti and a 5070. Some nice GPUs there. Thoughts on AMD? I think AMD right now, the GPU market is getting a little bit bigger, so they're able to maybe secure a little bit more inventory. I think I'm gonna say, Neil, in the consumer race in forms of GPU, at least for the gaming space, AMD is definitely a competition to Intel, to NVIDIA in the consumer GPU. I think this, we saw it in their last earnings call, Neil, that Lisa Su mentioned that the GPU market for the consumer space might start picking up. And I think this is a great indication that this can help AMD maybe provide some decent numbers outside of the CPU and outside of just kind of like the data center space. So it gives them, it's kind of giving some indication that they might do really well in the consumer space right now.
Yeah, I mean, I agree. I think we've also talked a little bit about that report from Japan, where they had that little event in Japan, and they said that they're sold out already, and they're going to take, what was it, 45% of the market at the moment, but they're eyeing maybe 70% market share there. Again, this is just Japan. I don't know what's going on there. I think a year or so ago, I also saw that the Pixel is quite dominating in Japan specifically, if I'm not mistaken. But AMD specifically, I mean, if it wasn't for Lisa Su, I don't think I would have had a position in AMD at the moment. So I am curious to see the next earnings report and listen to the call, because of that gaming side of things that might maybe already rebound, and hear what they're seeing, what they're thinking about the launch of the more recent ones. Of course, for the quarter, we will have what, a month and something for that launch included in the quarter. Of course, most of the people that bought it early on, and it is out of stock. So I guess you will have a small impact from that. But yeah, for the stock market, it's all about data centers at the moment.
And I would say just one final thought here, Neil. It could provide great guidance, right? And even if we might not see the numbers in this quarter for whenever they report earnings, we will be able to see, at least they have some guidance of, hey, look, we are actually starting to see strong orders on the GPU space. In regards to NVIDIA, Neil, like you mentioned, it's all about the data center space. So consumer was a crucial part for NVIDIA. I think NVIDIA and everybody else knows that right now, at least for them, the data center is where the most noise is going to come out from.
Yeah, no, I agree. I think it's going to be an interesting year with lots of releases from NVIDIA and from AMD as well, whether it's the MI 500, MI 350. They've got the Blackwell Ultra. I mean, still ramping up of Blackwell. So yeah, very interesting year, very crucial year for both of those companies.
Yeah. So, Neil, that comes into the end of our hour or our 2 hours. I appreciate all the fools joining us and all the great questions. Hopefully, we were able to provide some great information. Following up, we have Tyler and Rachel. So, hello and take it over, guys.
And goodbye.
Hello.
Thanks for holding down the fort, guys. Have a good one. Rachel, it's good to be on with you. We have a nice 2-hour block together here on Fool 24, both for Fool members as well as anyone on live TV. And you know what? I'm going to start out with a little word of advice for everybody. Hey, guess what? Do you know if you go up to 10,000 feet and spend a few hours on a glacier in a sunny day, your face will get torched. And that's why I look like a tomato right now. So apologies to anyone who's like looking at it like, what is there some saturation from? No, I didn't put on sunscreen and got torched. So stay out of glaciers with that sunscreen.
I mean, that sounds like a great story though, Tyler. So I still appreciate the backstory there. I feel like there must
It's not a big story. I took my kids skiing. I just went skiing for the day, and all of a sudden
okay.
I look like I burned my face off.
It's all good. You could have just said it was the lighting. I would have believed you.
Well, you know, people only believe that until like, hey, it's Wednesday. Why does his face still look like he, inhaled steam?
Well, hopefully it was still a fun time skiing though.
It was. So we gotta ask us anything for people who want to hit us up. I don't know if we'll be able to answer everything, but we will do our best. I think Rachel and I have some overlapping and some non-overlapping topics that we can cover a pretty wide gamut of topics here. But as every hour and shift changes that we have here at Fool on Fool 24, we do want to remind everybody that Rachel and I are here to share our thoughts, our expertise, our experiences. We can give advice like not going on glaciers. That's like personal advice, but we can't give personalized financial advice. That's the stuff that we're going to have to stay away from. If you're looking for personalized financial advice, please go seek out the advice of a professional. This is purely for educational purposes only. I'm sure everyone that is a Fool.com member knows where to go with Slido, but for those of you who are joining us on Fool 24, you can go to slido.com, enter the code Fool24. You can see it nice on that little scrolling chyron on the bottom there telling you what to do. But if you go there, you can get your questions in and we'll do our best to answer them. So at the top of the hour, long form weekend time. Rachel, was there anything this week that was we had a lot of news stories, individual company wise, macro wise. Was there any one or two, maybe one that you're like, yeah, this was a fun one. This was an interesting one for me.
Yeah, there were a few different ones. Maybe one I'll talk about, and I've talked about a bit this week, is Lululemon's earnings. We're sort of at the tail end of earnings season and having a bit of a lull before things start up again. And maybe over the next hour or two, we'll get a chance to talk about some companies that we're looking forward to as well that will be releasing earnings in April. But Lululemon, I think, was one that was really widely watched and anticipated. I think for a few reasons. I mean, we've been seeing a lot of different results that have come out from big retailers over the last few months. Some of those have been much more, favorable than others. But one of the biggest things I think that has been very consistent is that management of a lot of these companies tends to be giving, words of caution about the consumer spending environment and trying to really moderate expectations for the months ahead. And, Lululemon is a company I follow pretty closely. One of the biggest things that I've been watching with them is they have been really on the tail end of their multi-year Power of 3 × 2 growth plan that they announced a few years ago. And that involves sort of several steps that they want to achieve by 2026. One of them is, doubling their revenue between 2021 and 2026 to hit full year revenue of 12.5 billion next year. A huge part of that strategy has been their international expansion, which is something that I'll get into here in a minute, something that's going quite well for the business. They've been really concentrating their expansion across Asia, including in China. That's been a huge area of success for them, but also within Europe. They've been opening up, new stores. I think they have or are about to open up stores in Italy, where I am, in Spain. They even launched their own, Spain-specific e-commerce site. So growing international revenues has been a huge part of their overall way of achieving that revenue growth by 2026, but also really expanding more heavily beyond women's wear. They have athleisure lines for men, and that's something that has been expanding a lot the last couple of years, as has their children's products. And that's been another area that they've been expanding for the business. So it's been, a transformative time. And a couple months back, they had released some guidance before their results, which just came out a couple days ago, and they had updated their guidance saying, hey, we actually thought gross margin was going to decline slightly. That is going to be elevated. We're raising our guidance for diluted earnings per share as well as revenue. That was all positive. So I think that going into this, there were certainly some solid expectations for the business. The stock reacted a bit negatively after the earnings report. And I think part of that was not so much due to the numbers that they reported, because they actually beat what analysts had been projecting. But broadly speaking, like a lot of companies in this space, had to do with the guidance that they gave. And I think that's where some investors are a bit worried as we're looking ahead into, what could be a more difficult spending environment that impacts a lot of companies in the retail space. But getting into the numbers a bit, their net revenue in 2024 increased 10% year over year to about 2.6 billion. Their Americas net revenue increased 4%, but international net revenue increased 34%, or on a constant dollar basis, 36% compared to 2023. In the Americas is the area where Lululemon has its most, mature presence. That's its most mature market. And I think that they have exhausted a lot of their growth runway there. And so I think the biggest goal for them is to really maintain their market footprint there while expanding into these more nascent markets for them. One of the things as well that's worth noting is, there was the 53rd week of 2024. So excluding net revenue from that, their top line increased 8% in 2024 compared to 2023. Comparable sales increased 4% year over year. They also reported income from operations of about 2.5 billion. That was a 17% year over year increase. One thing that's worth noting, they said, this is another solid year of performance. We surpassed 10 billion in annual revenue for the first time. So they are not far off from their goal of delivering annual revenue of 12.5 billion next fiscal year. Now, looking ahead to 2025 for Q1, they're looking to deliver net revenue growth that's anywhere from 6 to 7% year over year. That would be compared to the 13% Q4 revenue growth they just reported, or if you exclude that 53rd week, net revenue grew 8%. So actually right in line with their most recent quarter of growth. Now for 2025, they're expecting net revenue to be in the range of 11.15 billion to 11.3 billion, which would be up about 5 to 7% year over year, or actually, because there will not be a 53rd week, 7 to 8% growth. So broadly speaking, in line with the growth they've been reporting. But investors did not, seem to like those figures. Now, it's worth noting there has been some growth deceleration for the business. This is a more mature business, but they reported, double digit 10% year over year growth, single digit if you take out that 53rd week in 2024. In 2023, their net revenue increased 19% year over year. So there's definitely been a deceleration in terms of the pace of growth from a year or two ago, but the business is still in really solid shape. A couple other things that stuck out to me, looking at the final 3 months of the year, again, as I mentioned, the Americas is really the most mature market for this business. But if you look at their revenue in the China mainland, which they broke that out, revenue in that market increased 46% year over year in Q4. And then their revenue from the rest of the world, which is basically everywhere that's not the Americas or China, increased 30%. So they're seeing their strongest growth in these newer markets that they're targeting, while even as overall, top line growth is still robust, but is more muted compared to what it was a few years ago. They're continuing to open new stores. They opened 13 new stores in the China mainland last year alone. And that continues to be a heavy area of focus for the company. So I think it's interesting. I like this business. I think over the long run, they'll be just fine. I do think that there are, it's reasonable for investors to expect that single digit growth rates might be what to expect from this business for the near future, at least on the top line, particularly as we're seeing them achieve more maturity in some of their core markets, even as they're expanding into these newer markets where growth is the strongest. Athleisure is a diverse space. There are a lot of different use cases for consumers. But I think this is also very much a company that is, going to be affected by changes in discretionary spending, if in fact those changes, continue to occur. We're really seeing some shifts right now where in some markets, consumers are scaling back on discretionary purchases, and others they're actually spending a bit more. It's hard to see right now with clarity how that will shake out. But a solid business. I think that this was one of many where there were quite a few numbers that were notable and above what analysts have been projecting, but the market hates uncertainty, and that slowdown in growth that they're projecting for this next year, despite the fact that they still seem to be well on target to achieving their long-term growth goals. Investors didn't really seem to like that very much.
I mean, somebody who's a little bit more, I would say a little bit more value oriented than, I lean that way. 20 times earnings for a company that's still growing at a decent pace certainly sounds like a much more attractive,
it is more attractive than it was.
Something that was like 59 times earnings as recently as like 5 quarters ago. So I want to add, this is like the serious question, and then there's like we'll call it like the boots on the ground the question as well. One thing that I've just casually observed from Lululemon is kind of there's been like the attacks from both sides. I would say on like the slightly less price point for Lululemon, you have like the Gap's Athleta brand, and there's obviously several trying to, you've also got loads and loads of direct to consumer internet only brands that you get 5 social media influencers and all of a sudden you spun up a athleisure brand. So you've got like that, you got that side of it, but then you've also got like the higher price points, the Fiore, Alo Yoga, things like that. With it burning, people kind of taking share from both sides of that market, is the middle market that Lululemon is going to probably have to like protect.
do they are they still protecting that? Like, I know a while it wasn't too long ago there was some like concerns of like, well, some of their designs had gotten a little stale. Maybe people were looking for a little bit more from them. Do they still have like the innovation kind of that, like I mentioned with Jason, like in retailing, you really can't like let off the rope in terms of like, with staying front and center with your customers and things like that. Do they still seem to be having that cachet with that particular market where they're going to be able to dominate? I'll call it like the middle market of that athleisure brand without ceding too much from the upper and lower end.
I think that that's something that they're working to do, but you're right that there are a lot of these maybe very small nascent brands, as well as bigger leaders like, Nike's struggling, but they are technically a competitor. You've got the Under Armours and other these types of brands. And then you've got these companies that are, not all of them obviously are publicly traded, like Alo Yoga is a major competitor to Lululemon. Fabletics by Kate Hudson is another brand that has certainly been one that has I think been working to sort of seize market share there. One of the things we have seen is they are working to innovate. There were comments in their earnings call this last Thursday where the CEO said, quote, "We're operating within a dynamic macro environment that has really contributed to a cautious consumer. We've seen material impact to traffic across the industry. And while we've experienced some of these traffic trends, the guest who is visiting has responded really well to our newness and innovation." They said they've seen response in terms of positive units per transaction, or UPT, an average order size. They also said that they're really working to maintain this, as they call it, pipeline of innovation. They've had a range of recent introductions and products that they've launched. So there's new fabrics that are designed specifically for training workouts. There's some new casual pants that they've launched that deliver more of the comfort and versatility angle, as well as some additional, yoga products. And so that is something I think where they are really working to position themselves. And one of the things that I've noted as well that I find kind of interesting about their expansion, particularly in Europe, is depending on where you are in Europe, certainly where I am in this part of the world, athleisure is not as widely adopted into day-to-day society as it is in North America, right? It's a fair statement.
It's not a thing.
So where I am in Italy, but certainly Italy is not the only example of this, in, I would say, Western Europe predominantly, but elsewhere, these types of products are seen as really having their place within the gym, and not so much the sort of thing that you would wear to, say, go grab coffee with a friend or go run errands. Now, there's obviously exceptions to that. Everyone has their own habits and styles, but as a cultural phenomenon, this is something that's much more broadly adopted in North America. And so it's been interesting to see. Can confirm, right? So this is something that I have found interesting as they've been expanding in Europe, and also other markets outside of Europe. As I said, Asia and China specifically is a huge area of concentration for them. Seeing how they are working to sort of angle themselves as having a wide range of products that appeal to a wide range of consumers and also fit within the dynamic of that unique region that they are targeting. They are wanting to become a dominant global brand with eventually having 50% of their sales outside of North America. And right now they are seeing a growing number of sales attributed to those China segment, the rest of the world segment, still somewhere in the ballpark of 11 or 12% of overall sales. But they are seeing their fastest growth in these areas. So, new markets, like I said, they're opening stores in Spain and Italy and as well as other European markets. I think the versatility angle that I highlighted and that the management highlighted in their recent call is going to be key for that, because the use cases for their products, vary widely. Now, obviously, if the consumer is sort of strapped for cash in their Americas market, and particularly in the US, that does not mean that that's going to be the case in these other markets that they're targeting in Europe, in China, and broadly speaking, some of the other international regions that they're working to expand to. So maybe the fact that they are, continuing to experience strength there will help sort of be a barbell, balance a bit between some of the slowdown in growth they might very well see in the U.S. and in North America in the coming quarters. So we'll have to see. But I think those are good points you raise. I do think management seems confident in how they are reaching their target consumer right now. I think their ability to continue doing that and continue diversifying their products is going to be how they succeed in what is a very dynamic environment right now.
All right, we're gonna do one last one. There are questions coming in. We promise we're gonna get to them, but you know what? It's the weekend. We get to have fun. We get to take some extra time. Let's go into our personal shopping bags, because I know that a few years back, Lululemon came out with like a men's golf line for a while. I picked up a few, and I gotta say, at the time, it seemed pretty good. It seems like they haven't actually changed anything since they made them like 3 years ago, which is pretty typical for men's clothing. Let's be real here. It's not like we're reinventing the wheel with collared shirts and polos and chinos. But I do have to say, like, at the time, I like them. They've actually been quite nice. I haven't bought anything in like years, but I haven't exactly seen anything from like their men's golf line. Doesn't look like they've been trying too hard and trying to get that customer too much. So, personal shopping bag. Are you a Lululemon shopper? What are your current thoughts on some of the things that you bought from them, if you have?
I haven't shopped from them per se recently, but I do look at these types of products. I do like some of the things they've come out with more recently. It's part of it's because of where I'm based. So I wear this stuff at home or when I'm working out, but it's not really socially acceptable for me to walk around Rome in some of their products. But I do really like some of the like fitness dresses that they've come out with more recently. Like their Align products have been really, really popular with a lot of their target demographic, including someone like me. Their Align cami strap dress is something I've really liked as a consumer. And they've also been releasing, I've noticed, more dresses. So again, talking about their female, apparel that are sort of designed to be not necessarily fitness specific. Like they have some stretch maxi dresses and other products that really are not for the gym. They're much more like casual, but still nice, put together type of apparel that you would wear out and about. So those types of products that they have been launching, as well as the expansion of their Align brand, which again is incredibly comfortable and diverse in terms of potential uses. That is something that's resonated with me a bit more as a consumer.
Well, we did a nice 21-minute opening on Lululemon, and in the true spirit of ask us anything, we're going to go from athleisure apparel to heating, ventilation, air and air conditioning units.
There you go.
Foolishly motivated asked 11 minutes ago about Carrier Group. Question was, Carrier Group has pulled back. It has been a great performer over the last 3 or so years. How do you feel about it moving forward? So Carrier Group is, I think, one of another points in the direction of, hey, all those like big conglomerate companies that like do a whole bunch of different stuff, and then they all break up because, I don't know, maybe like some rabble rouser and activist investor tells them to do so or something like that, or an investment banker. Turns out that stuff actually tends to work. Carrier Global used to be a part of what was then United Technologies, but broke up into three things. It broke up into what became is now Raytheon, or RTX, which used to be Raytheon UTX. They took the aerospace part of United Technologies, combined it with Raytheon. Carrier Global spin off in its own thing as this heating and ventilation, cooling, business, standalone business. And then Otis, the elevator company, standalone business, trades on its own. So all three of them have kind of pointed to the thing that, like, hey, when you actually focus on like one or two things and try to do them incredibly well, it tends to work out better for your investors rather than trying to be these big sprawling conglomerates. Berkshire Hathaway aside, I'm always going to put that in a special place. But Carrier Global
from the time that it went public a couple of years ago, has had a very good run. If you look, income, revenue has been, it's lumpy because, again, it's a cyclical business, which, kind of expected. But at the same time, profitability has been increasing. Margins have been decent. It went public with a little bit more debt than probably it wanted to, but it's getting that under control. I'm trying to best articulate what I've seen. It's been a decent performer, and I think people that have been in this industry or have been following this industry have been roughly impressed. Yes, there are tariffs now. Yes, there is global trade issues. There are, some things that would make investors a little bit more nervous about it today than it used to be. And we could maybe attribute some of what Foolish Made Motivated was getting back to was this pullback here, is kind of this idea of hey, maybe things aren't going to go quite as well. And certainly Chinese real estate and Chinese construction has slowed down precipitously. HVAC is a big component of that. So overseas sales, we could go in 15 different directions. But I want to kind of focus in on the part about being a great performer over the last three or so years, and then starting to talk about pullback. And one of the things that we have seen with Carrier that's been a large part of that great performance is multiple expansion. And I think that's one thing that a lot of people may not necessarily consider when they're thinking about how well a stock does over time, is just how much of the performance of the stock is not just the earnings itself, but also kind of the, how would we say, the valuation of it actually expanding because of greater expectations, if you will. So I'm looking at a chart right here. And so in 2020, this from my data provider that I currently use, in fiscal year 2020, which I think is roughly at the time that Carrier went public, right? It came public at about a trailing price to earnings of about 16 times. Today, even after the little bit of a stock drop that we've seen in this pullback, as we referenced, stock trades for 51 times earnings. So in addition to the higher earnings that we've seen, in addition to the, free cash flow returns, whatever, and maybe the story you want to talk about, multiple expansion has been a huge component of the company's growth, of the good performance that we've seen over these past few years. So when you're looking at companies like this and you see, hey, stock has gone up a lot. Why has the stock gone up a lot? Because that can really influence what could happen in the future. So if you have a business that has gone from, a decent earnings multiple to, in my opinion, a slightly absurd one, 50 times earnings for a cyclical business is a pretty hard pill to swallow for most people. I know that cyclical, there's some additional things to consider here, but when you think about it this way and be like, wow, it's gone up a lot, but most of that comes from the market just bidding the prices up at a higher multiple versus, seeing its earnings, grow 50%, its earnings grow doubling or something over a 5 to 10 year period, then you can start to contextualize and better understand, hey, why would, a stock drop like this? Well, when you have baked in very optimistic expectations from this very large expansion of the multiple, it makes it more likely to see multiple contraction. The market goes through these manic times, or the participants of the market, you and I and institutions and whoever. Some days we're euphoric, some days, we think the world is going to collapse. And so depending on the collective attitude of everybody participating in the market, if everyone's feeling great, yeah, sure, why not? I'll pay 50 times earnings for a HVAC company. Why not? That can't go wrong. And then all of a sudden, a couple days later, it's like, oh well, we've got got tariff tensions, we've got supply chain problems, we're talking about nearshoring, we've got slowing down on Chinese economy, U.S. European trade is starting all of a sudden look shaky. You start factoring those things in again, and it's like, oh, maybe I don't want to pay 50 times earnings for a HVAC company because some of those promising green shoot things that I saw, maybe they aren't going to materialize. And so the Carrier is one example of many where when you look at the business itself or the stock and wondering why, like, hey, it's done so well and now it's going down, what could it be? Sometimes you do need to look at like what the stock valuation has done, because perhaps the market or the people participating in the market have bid it up to such unachievable expectations that there's not a whole lot of places that it can go other than sideways or down.
Awesome. There was a question I saw.
Oh, no thoughts on HVAC companies? Come on now.
I know. This is not a space I know very well, so I'm going to let it lie. But I think that was a good summation of it. There was actually one about a company I follow really closely. I was talking a lot about this one with Brian Orelli yesterday. Luxury hot dogs. Boy, is that a fun handle. What's going on with Vertex and its diabetes candidates? So this is interesting. I talk a lot about Vertex Pharmaceuticals and their new non-opioid pain candidate that was just approved, the triple combination therapy. Don't get a lot of questions on their diabetes candidates. These are still very well far away from being approved, but there's a couple different ones that they're working on. One is called VX264. That's its name currently. This is an investigational stem cell-based therapy for type 1 diabetes. And essentially it involves surgically implanting a device that contains encapsulated stem cell-derived islet cells, and those are designed to shield them from the body's immune system and avoid the need for immunosuppression. So this is a novel cell therapy where fully differentiated pancreatic islet cells derived from stem cells are encapsulated in a proprietary immunoprotective device. And the device is then designed to protect those cells from the body's immune system, which in patients with type 1 diabetes attack and destroy the insulin-producing beta cells in the pancreas. That is surgically implanted into the body, this device. And then the goal is to restore the body's ability to produce insulin, which could potentially eliminate the need for insulin injections or other diabetes treatments. So this candidate, VX264, is currently, I believe, still being studied in a phase 1-2 clinical trial to evaluate its safety and efficacy. They had completed enrollment and dosing in parts A and B of that study, but the study did not meet its efficacy endpoint. So they plan to conduct further analyses, including of explanted devices, to better understand these findings. So that was the biggest issue there. They actually just announced an update for their type 1 diabetes portfolio last night, and I'm pulling it up now because I had not had a chance to fully dive into this. But that VX264 candidate I mentioned, they again completed enrollment and dosing in parts A and B of their phase 1-2 trial. It was generally safe and well tolerated, but the efficacy data is not supportive of further clinical advancement, essentially because it did not meet their endpoint. For example, they said that increases in C-peptide, which is a marker of insulin production, were not observed at levels necessary to deliver benefit. And so that candidate is not going to be advancing further in clinical trials. They plan to conduct further analyses, including, as I mentioned, of explanted devices to better understand these findings. So that was one of two of their kind of major candidates. And this just came out last night. And as I'm reading through it, that is no longer going to be progressing. Maybe some of that data will be used to develop another candidate. But I think that it's also something that would be, far down the line at this point. Now they have a different therapy called VX880, or they have a name for it, zimislecel, which is very hard to pronounce these names. So we're just going to call it VX880 because it's easier for me to say. This is one that is slowly but surely progressing. So this is a different type of therapy. It is stem cell derived. It's a fully differentiated insulin-producing islet cell therapy. It's being evaluated for people with type 1 diabetes with impaired hypoglycemic awareness and severe hypoglycemia. So how VX880 works, So it's therapy that basically aims to restore the body's ability to regulate blood sugar levels by replacing damaged insulin-producing cells with healthy transplanted beta cells that are derived from stem cells. So it works very differently than VX264, which is the one I just mentioned that has essentially been scrapped as of now. There's no further trials planned for that. VX880, I believe, is still being studied in their phase 1/2 clinical trial. That therapy has shown promise in restoring insulin production and improving glycemic control. Again, this is an investigational, fully differentiated islet cell therapy. They just announced yesterday that they were in the phase 3 portion of the phase 1-2-3 study, specifically in patients with type 1 diabetes with severe hypoglycemic events. That pivotal trial is on track to complete enrollment and dosing in the first half of 2025, which would mean that they would potentially be on track to set up for global regulatory submissions in 2026. This candidate has already been granted numerous designations, including fast track designation from the US Food and Drug Administration. They've also secured an innovation passport under the Innovative Licensing and Access Pathway from UK Medicines and Healthcare Products Regulatory Agency. Vertex is already investing in expanding their manufacturing and commercial capabilities to ensure launch readiness. They think that the initial approval of VX880, if that approval was reached, could serve as many as 60,000 people with severe type 1 diabetes. They also have numerous other type 1 diabetes programs that are in the research stage to evaluate additional approaches that could provide benefit for patients with the disease. These include gene-edited stem cell therapies, as well as other novel devices that could encapsulate islet cells, which is essentially what that prior candidate, VX264, was trying to do, but did not prove to be efficacious or effective enough for them to advance it beyond the phase 1-2 study. So the biggest one for investors to be watching, and probably the most likely of the next of Vertex's candidates to be commercialized is this VX880 islet cell therapy that is now in the phase 3 portion. Again, they have that pivotal trial underway. They think they're going to complete enrollment and dosing in the first half of this year, and they're planning to start regulatory submissions by next year. So that would be the one to watch most closely, and that is the most advanced within their diabetes programs. And then, as mentioned, they've had a range of other, promising updates for the business recently. Their new pain medication, Journavax, which is a non-opioid. It blocks pain signals at their source in the peripheral nervous system. And it inhibits the sodium channel that's developed that's involved in transmitting pain signals. So it provides pain relief without basically having the same triggers that cause the risk of addiction associated with opioids. It was the first new class of pain medicine approved in over 20 years. So that will be very interesting to see in terms of the expansion for that line of the business. They think that in the US alone, this approval opens up an addressable patient market of roughly 80 million acute pain patients. And then, of course, there's their new CFTR modulator, their new triple combination therapy, AlphaTrek, which is sort of the latest generation of their cystic fibrosis drugs that was shown to be basically in line with their flagship blockbuster drug Trikafta in terms of improving lung function for cystic fibrosis patients, but it actually had superior performance in clinical trials for lowering sweat chloride levels, which is another key marker of CFTR function in these patients. So a lot of good things happening with the business. Their diabetes program, as I mentioned, has been having a sort of a lot of changes recently. That portfolio now sort of lacking one candidate that they had been working on. The VX880 is the one to watch. And then, any other of their type 1 diabetes programs are still in the research stage at this point.
I cannot say I know a dang thing about diabetes
all good.
environment. I mean, I might be able to like give like 2 cents on GLP-1s, but that's anything outside of that. I feel like I am venturing into waters I don't want to touch, but that's okay because there's a couple questions that are coming in that are asked to me specifically. So I'll hit them. And you know
Go
what?
for it.
I bet you'll be able to participate in this one too, because I'm sure that you have your own list. Because Maria asked, Tyler, which stocks are on your break glass in case of recession list? She mentioned Cintas because it's something I've mentioned before.
Mhm.
And so for those of you who may have not heard this one, apparently Maria is a avid follower of me on Fool 24. I'm so flattered. So I kind of have this running gig where basically right off screen over here, there is a box. It's like, in case of fire, break glass. Well, on mine, it says in case of recession, break glass. And it's a list of stocks that's like, go buy these in a recession because everyone's going to be freaking out. Valuations are going to be in the tank and nobody's going to want to touch them. And to me, these are like quality businesses that I would love to own, but every single time I look at them, they are far too expensive for one reason or another. Pay for quality, or maybe is too involved with people who are like on social media pumping compounder stocks or something like that. That of course it's compounded. It trades for 60 times earnings these days. So as you mentioned, Cintas, one of them, a uniform rental company, spectacular business. I can't say enough good things about Cintas. Ticker is CTAS, and there's a lot of them, and I'm sure I'm forgetting a whole bunch of them, but I'll just list off a few of them that immediately come to mind when I think of like in case of recession, break glass. Waste management, ticker WM, or you could even say Republic Services as well. Taking out the trash, it's a fantastic business. I dare anyone to go on like a stock or company data provider and look up returns on equity for waste management, because it's like, how in the heck does owning a fleet of trash trucks and landfills get like 20-30% returns on equity? Well, the nice part is you're pretty much run geographic monopolies, so it's really, really hard to like beat a geographic monopoly, right? Things like that. They're excellent operators. It's one of those businesses. It's really, really hard to screw up. So waste management's fantastic. Always trades for a high price. I don't know why. Well, I know why. It's a quality business. I just wish I could buy it at a cheaper price. Another one, Costco. I don't think I need to explain why I would want to own Costco. Every single, like Jim Gillies is on here, I think every like once a week saying, I wish I owned more Costco. I wish I owned some too. I just don't know if I want to buy it at 50, 60 times earnings today. Sorry. I'll just keep waiting. I'll sit and wait for a long time. Automotive retailer parts companies. O'Reilly Automotive, ticker ORLY. Our AutoZone, AZO. I'll take either depending on valuation. Auto parts retailing is an ungodly recession resilient business. You know what people want to do in the middle of recession? Not buy new cars. What happens when you don't buy new cars? You got to keep repairing the one you got. And when you have to repair it, you got to keep going to these auto parts retailers. Maybe you got to like keep, and it's not just things like new wipers and things like that. All of a sudden we're talking about more suspension parts, more like exhaust parts, things like that. The real big money makers, especially in recession times, people are going to shell out the money to make the repairs on their older non-warranted vehicles. And that sort of stuff is going to come from the O'Reillys and the AutoZones of the world. Like spectacular businesses. They're operated incredibly well. Like the auto parts retailers are kind of like distributors where like they own nothing but giant piles of inventory. So if your entire business is owning piles of inventory and you could turn over inventory really, really fast, you have permission to print money. And this is what these companies done for a long time. And they reward shareholders with spectacular buybacks. I think over like the past 15, 20 years, they've bought back close to like 50% of shares outstanding, both companies. So fantastic recession break glass kind of businesses. I could probably name a bunch of other ones. I could go even to really obscure things like aggregate quarry, rock quarries and things like that. But I think that's a pretty good list. Cintas, Waste Management, or Republic Services, Costco, and the auto parts retailers. That's 4 or 5. That's plenty for now. Maybe if Maria wants to come back next week, I'll see if I can go deeper down the list.
That's awesome. Yeah, Costco is one I'd really like to own. The valuation is steep. I've talked about this a lot, how sometimes a steep valuation is rarely something that keeps me away from a business. But one example of a business, this is probably a very different approach than what you're talking about with this break glass method, but one that maybe the valuation would come down a bit if indeed market sentiment were to shift, is Mercado Libre. That's one that I have been fascinated by for years, and just have invested in other businesses. My approach to this would almost be to want to buy shares of stocks that are beaten down because the market in the short term turns negative towards them in terms of sentiment, because they might not be the most recession resistant, but that I think over the long run could be, portfolio winners. So Lululemon is one I would maybe want to scoop up. Chewy is another one. Mercado Libre, Costco. Yes, definitely Costco. That's just a great also dividend business too. I mean, their dividends low, but then they every so many years will pay these great special dividends at like $15 a share. Yeah, that's one on my list.
The thing too with the ones I mentioned, and I think why I'm much more sensitive to valuation than Mercado Libre is growing way, way faster than any of the companies I mentioned. These are all like on a really, really good year, they're going to do double-digit revenue growth, right? These are not companies that are huge growth where you can grow into a much higher valuation. These are like, I know Costco is a spectacular business, but if you look at their revenue growth over the past several years, it's not like knocking it out of the park. And that's kind of by design, right? They want to turn inventory, they want to sell a lot of products, but the bulk of their earnings and income comes from their membership base, membership sort of thing. So all the companies I mentioned, relatively slow growth, but resilient growth through the ups and downs in the cycle. And so that's why I'm much more sensitive to valuation for these companies than say like a faster growing company. Like, I mean, I know we were saying that Lululemon's growing slower, but its earnings per share growth was like what, 20% year over year. So yeah, that's a slightly different story than, recession times. Everything's going to go on sale. All of it. I can, Lululemon, Mercado, everything's going to be on sale. You can pretty much guarantee that. But there are some companies that are going to weather recessions much, much, much better. And those are the kind of companies and have been spectacular winners in and out of cycles. And so if I can go into a recession and be like, hey, Costco's trading for like 24.3 times earnings, that's a deal I want to take versus, I don't know, 50, 60 times earning.
Yeah, absolutely. Let's see. There was a question from Cyber Mikey. Rachel, I'm becoming a bit bullish on Gilead Sciences. What are your thoughts on it being a market beater while also offering a nice dividend? So let's look into this company a little bit. And this has been a pretty solid performer over the last year due to just a lot of really positive updates with the business. The stock's up about 50% over the trailing 12-month period, more than 50%. Now, prior to that, this had not been a really high-performing stock. If you actually pull the graph back like 5 years.
That's being generous. That's a generous statement right there.
Yeah. Basically, shares were not moving for years. And then over the last year, due to numerous positive updates with the business, that sent shares higher. And I'll get into some of those. And their dividend yield is up a bit as well. I mean, so the average S&P 500 dividend paying stock yields about 1.2, 1.3% right now. Their dividend yields about 2.8%. There's quite a few dividend oriented businesses in healthcare that I think are probably a little bit more compelling than this one. But Gilead Sciences is a company that I have been a bit more interested in recently, just given some of the updates they've had, in their pipeline. And they had been dealing with some issues over the last few years, including major drops in sales of their COVID-19 drug Veklury, but then they've been seeing a lot of positive signs with strong, momentum in their HIV products, oncology advancements particularly. has been a major area for the business. But for anyone that maybe doesn't follow this one as closely, they're really renowned and known for their antiviral drugs, particularly those used to treat HIV, hepatitis B, and hepatitis C. Truvada was originally developed for HIV treatment, but it's now also used for pre-exposure prophylaxis to prevent HIV infection. Descovy is another one of their medications used for these purposes. They have a single tablet regimen, numerous for HIV treatments, including Atripla and Biktarvy are two major drugs there. And then they've got medications like Sovaldi and Harvoni, which are used to treat hepatitis C. Products like Yescarta, which is a basically CAR T drug. So a wide range of drugs in their portfolio. That some of the things that they're working on that I think are notable. They are a leader within the HIV drug space. So they continue to develop treatments targeting this specific patient population. They're currently working on seeking FDA approval for a drug called lenacapavir, and it's essentially a twice yearly injectable HIV-1 capsid inhibitor, and that's for the prevention of HIV as a pre-exposure prophylaxis. They're also working on other long-acting injectable HIV treatment options. Their oncology pipeline is something that has been particularly of interest to me. You know, they acquired a company called Kite Pharma. That's focused on developing cell therapies for different hematological malignancies and solid tumors. They're exploring various immunotherapies and targeted therapies that could really transform the way various types of cancers are treated. They have a program focused on a candidate called magrolimab, which is an antibody that could unlock a range of opportunities across different blood cancers as well as solid tumors. And they are also working again on developing new treatments for chronic hepatitis B and D. They have the goal of globally, eliminating this disease over the long run. And there's kind of numerous catalysts that could be real drivers of growth for the business in the near term. They're looking towards regulatory approval for that drug, lenacapavir, which, as I mentioned, it's a twice yearly injection for HIV pre-exposure prophylaxis. They're looking to garner approval for that in the US and Europe in 2025. That medication in phase 3 trials was very efficacious at slashing the risk of infection, but it also showed superior results to one of their flagship products, Truvada, which is once daily and is sort of the current standard of care, gold standard in that space. But they're also looking for updates from these two concurrent phase 3 clinical trials involving their drug Trodelvy. So Trodelvy has been given a breakthrough therapy designation for patients with extensive stage small cell lung cancer. But these updates would also be concerning its potential as a first-line treatment for metastatic triple-negative breast cancer. So there's a lot of good things happening with the business, and because of that, I have been a bit more interested in it than in past periods. This is one I'm still watching from the sidelines right now. In terms of their financial performance, in 2024, their total product sales increased 6% year over year to about $29 billion. And that actually, if you exclude their COVID-19 related product, Veklury, which has been just seeing a complete, downward trend in sales the last few years for, I think, obvious reasons, that their sales increased 8% year over year if you exclude that. And that's primarily because of the demand they're seeing in their HIV drug segment, their oncology business, and their liver disease portfolio. Their liver disease portfolio saw sales increase 9% year over year. Their cell therapy products like Yescarta and Tecartus both had solid sales growth, leading to overall 6% sales growth in that area. And Trodelvy, which, as I mentioned, is sort of the current gold standard in HIV prophylaxis, sales of that drug increased 24% year over year in 2024. So there's a lot of good things happening with the business. They're still dealing with, I would say, some bumpiness on the bottom line, partly due to some recent acquisition costs, although they have certainly improved in profitability from what was going on with the business a few years ago. As a dividend stock, I think for me personally, if I'm looking at this business, I'm more interested in what they're doing with their HIV pipeline, their cell therapies, their oncology business. The dividend is maybe added icing on the cake. I think some of these other companies, like Johnson and Johnson, like Pfizer, like Eli Lilly, like AbbVie, like Abbott, are to me more compelling as dividend payers. Gilead, I think, first started paying a dividend maybe about a decade ago at this point. And I do think they have the earnings to sustain it. But some of the struggles the business has had the last few years have made this less of an intriguing dividend stock for me. But the business and where they're going and where their HIV and their liver and oncology businesses are going is what I find a bit more compelling right now as compared to a few years ago.
There's not a lot of like pharmaceutical companies that like I can't say anything to about like the pipeline or anything like that, but I do find Gilead is a very fascinating study in the promise of a blockbuster drug and then the wilderness that a company might have to wander post blockbuster drug. Because here's a fascinating stat for anybody. I know there was like a lot of one-time things in this current year's numbers to skew this a little bit, but this just kind of like hammers home. In 2015, Gilead Sciences brought in $18.1 billion in net profit, largely on the backs of its hepatitis and HIV, which were on patent, which were selling as fast as they could possibly make it. And I believe like some of its hep C treatments were so effective, they basically like people stopped eating it. And it was almost like, I wouldn't say they cured hep C, but it was like one of those like, man, this is so good. Like it's actually like causing patients to not actually need treatment anymore. So fantastic drugs. Like, and if you look at the run up in its stock when HIV and these hep C like blockbusters were hitting, I mean, monster returns. And it's one of those things where it's like, if you're a biotech investor or healthcare investor, these are the things that you're looking for, right? Flash forward, we're in 2014. So this is like 9-10 years later. We went from $18.1 billion in net profit to $480 million. And it's this wandering the wilderness after that you have this one blockbuster drug of trying to find the next thing and spending billions upon billions of dollars to make it happen, sometimes to little effect. There was, they've been spending $5 to $6 billion a year on its development pipeline, just in R&D expenses. It made that massive acquisition of Kite Pharma, all to try to like develop these pipeline products. But pipelines are pipelines. There is no guaranteed commercial success from pipelines of pharmaceutical products. What is it, like 30% of stage 2 clinical trial, something that gets to a stage 2 actually like makes it to commercialization. So, this is the challenge. Like sometimes I don't want to say it's all luck, because obviously some of these are much more promising than others, but this is one of the reasons that I do get scared sometimes with like healthcare investing, especially in not the big Pfizers, the ones that have these very, very, I would say more complete suite of products or drugs or whatever that is a little bit more diversified than a Gilead. I could mention one that I've personally invested in recently is Lantheus Holdings. Like that's my biggest concern is it's a Gilead now, and it continues to be a Gilead for like the next 15 years, where it's like this, we've had this blockbuster radio diagnostic drug that or diagnostic agent for detecting prostate cancer. And it's getting adopted really fast. Prices are going up. Center for Medicare, Medicaid gave it its own pricing regimen. Like everything is trending in the right direction, and it's got a long patent for it. But what happens when you start spending billions upon billions to try to find the next thing? And that's my biggest concern with Lantheus Holdings, is that it becomes Gilead Sciences from 2015 to 2024 of spending billions upon billions and not having a whole lot to show for it until like maybe 10, 15 years later.
Yeah, well, and ones like Gilead, they had also this sort of period of years where there seemed like there was a never-ending drop in their hepatitis C drug sales, and that was such a huge problem for the business for a few years. And there was some concerns at the time. This is 7-8 years ago or so, about the durability of their core HIV franchise, which, as I mentioned, has been doing quite well the last several years. They had some management changes as well. Just a very difficult time for the business. They have faithfully paid a dividend for about a decade now, and I think they've raised it almost every year in that period of time. So, that's worth noting as well. They sometimes in the course of doing business, there is a lot of the pharma industry is not cyclical so much in itself, right? In the sense that these are businesses that tend to do well in a wide range of economic environments. But the life cycle of blockbuster drugs for these companies does come to an end. And all of these companies initially, inevitably deal with patent cliffs, generics, competition. And these are things that these companies plan for years or a decade in advance. But you do sometimes see these growing pains and these periods of lulls, if you will, where these companies are transitioning. And I remember, years ago, 5 or so years ago, looking at Gilead and just what they were struggling with. And this was just not a business that I found compelling. The last few years, I have been much more interested in the businesses. I've seen them sort of come out on the other side of that and really continue to boost, their overall portfolio and see the success of their more, older franchises, as well as these newer lines of growth for the business. But certainly, sometimes even in the life cycle of holding these businesses for the long term, there are these inevitable periods of just difficulty for these businesses. And Gilead seems to have come, somewhat on the other side of that and is doing quite well now.
Well, yeah. So here's a fun thing. We're at the top of the hour, and normally we would be doing a shift change here to bring on the next one. But guess what? We get to do a whole another hour together. So let's just keep on going. I'll relieve you from having to do anything more on Gilead, because I think we covered that one pretty well. But so at the top of the last hour, I asked some of the stories that you were covering, and you had mentioned Lululemon earnings. So I'm going to do mine for the top of this hour. Before we do, I'm sure that there's some new Motley Fool members, premium, who might be just joining in, people who are joining us from YouTube Live. So, the top of the hour disclosures, we're gonna bring them in as we always do. I want everyone to remember, Rachel and I are here. We're to share our thoughts, our ideas, our expertise. We might be giving some opinions on Lululemon clothing, or what not to do when you're on what not to do when you're out skiing on a Saturday to not get a face torch like this. We can give advice on things like that, but definitely cannot give personalized financial advice. If you're looking for that, please go seek out a professional. It'd probably be worth the money and the time to do so. And also, if you're joining us from YouTube, please go to slido.com, add in the code FOOL24, and you can ask any question you want. We don't have comments open on FOOL24. We like to try to aggregate them all into one place using Slido. So please get in your questions, and we'll try to answer them as best as you can. Now, we said this is a valuation hour, but it's the weekend. It's long form. We'll definitely do some stuff on valuation. I did a little bit of valuation talking about stocks to buy in a recession earlier in the last hour, but we can definitely get into that again. But the story that I wanted to touch on at the top of this hour as we get going was IPOs, because for those of you who are premium members, there's the weekly the weekly news, I think it's newsletter that anyone can get. So I'm just going to pop it open, and hey, if you're on YouTube and you're not a premium member, you'll be able to get a little sneak preview of what's behind the wall and give you a little bit of things there. And obviously, if you're a full member, you'll get to see this as well. So Lauren, when you get a chance, if you could pull up the screen share that I'm trying to share here. So this is our weekly news. There was a lot of things to talk, obviously tariffs was the big one, but I want to focus on the IPO one, which was number 5 on our list on this week list, and that was CoreWeave IPOing. And the IPO is a little bit of a fizzle, and there are lots of explanations that the market is giving these days when it comes to, well, why did CoreWeaves fizzle out? Is it because the AI bubble's popping? Because every single day we're always trying to find, hey, is the AI bubble popping? Did it pop today? No, yes, no, who knows? So, but there's that. And then there's also this little mention at the top too, because there was the 2 very large, I guess, if you will, IPOs so far this year were for liquefied natural gas company Venture Global, and kind of like how do I call this? It's like it's a security company, but it's more like a access and governance kind of regulator, SailPoint. They're a software as a service company. There's so many software as a service companies. It's hard for me to keep track of them these days. But well, maybe that's being a little too telegraphing my thoughts a little much. But I think some people will look at this and see these tepid IPOs and these stocks that have gone down since, and be like, oh, it must be the IPO market, right? Interest rates haven't come down and yada, things like this. I have a very different view, which actually is pretty common around here. So, but I think all 3 of these were deeply flawed businesses that investors like you and I can invest in. And I don't necessarily just mean it from the business perspective, but also the asset that we would be able to acquire as investors, the shares that they're actually available. So both Venture Global and CoreWeave have what are called dual class shares. Meaning basically, like, the type of equity that is available is in 2 different types, and one is publicly traded, one is owned by the founders. It's typically, class A or class B. I'm not sure which one is which in either case, but both of these have dual class shares. And with these dual class shares, the owners of these companies have what it's called, they have like these shares typically have like equal economic interest to you and I, like the earnings per share are the same, but they will have much larger voting control. And in the case of both of these, certainly in CoreWeave's case, their share class was like the founder share class got 10 votes to every 1 vote that we all had. And so this was a business that went public where the founders had maybe 25% ownership, but economic ownership, but had like 80% of the voting. Same thing with Venture Global. They were actually only issuing 11% of shares available to the market. Like it was like they wanted $100 billion and were only offering $2 billion to publicly traded investors. And so like what, 89% was going to be held by founders and original investors, but apparently 89% of voting interest wasn't enough. They had to have a dual class share so that they had 97% of voting control in this business. And I detest dual class shares. It is, in my opinion, disrespectful to individual investors. It's kind of this idea of like, well, we're founders. We need to, maintain control because we have long-term visions and we need to be able to control our vision and see it all the way through. But that's fine. You're trying, I think it's trying to like drum up the concern that like an activist investor can come in and like disrupt the board and get us minority shareholders all rabble roused, be like, yeah, you guys are wrong. Come on, what's going on here? But I don't necessarily buy that anymore. Like, look, if you're coming to the market, you're coming to the public markets these days, you're looking for money. You're trying to bring in new partners, and we as shareholders, we are your partners. We are giving you capital to do this. And I find it disrespectful because you want your cake of capital from the markets, but you don't want to give up any control. You can't have both. Like we should be equal even if it's a smaller amount because we own less of the company, we should have an equal seat at the table with those shares. It's our money too. We are, in a sense, the owners of the business, and to be treated like second-class citizens, I find distasteful. And part of the reason I wouldn't want to invest in these kind of companies, for the most part, you have to do something exceptional in terms of your business and what you're doing for me to consider a dual class share. So those two, I think, are flawed in that way. I don't know if a lot of people on Wall Street or other people agree with that, but I wouldn't want to touch a company. SailPoint came public because it was a company that came from private equity. Thoma Bravo this was a company that Thoma Bravo started. They IPO'd it. Thoma Bravo bought it back and now is IPOing it again. And so private equity has a very up and down relationship with companies that go public. Like, not all companies that public equity foists onto the markets end up being successful things. They're trying to create exit liquidity for the most part for these businesses. They don't want to own them forever. They want to, cash out a significant portion of that. And in this case, SailPoint, Thoma Bravo, I think, owns more than 80% of the shares outstanding when this company goes public. And Thoma Bravo is going to sell its position. Like, it's not going to own 80% of this business for eternity. It's a private equity. It's going to want to recycle that money into another private equity deal. Who knows? Maybe they'll buy SailPoint again in 5 years, because that seems to be the 5-year tradition that they do. When you have a company like SailPoint, where it's like, hey, you have a 80% private equity owner, that they're going to be selling that down, and it's probably going to drastically impact the price and the valuation of this company over the long term. Now, SailPoint, the business, there are some challenges. Yes, it's a software business, it has really high margins, but all of a sudden, like, you start talking about customer acquisition costs and all that stuff, and before you know it, it's not profitable. So there's challenges in the business itself, but there's so much when it comes to IPOs and corporate structure and what you are buying that really matters. And I think, at least to me, and again, maybe I'm just the angry old man screaming at clouds at this stuff, but I think those things matter. And I think that for those three companies, despite them being the big ones, I find those as fatal flaws for these, as an investment for these businesses. And it's not surprising to me that they have fallen flat because of that. And it doesn't necessarily mean because the IPO market is weak. Maybe if you want to go public, offer common shares that everybody can own, and maybe we'll want to buy.
I think that's a really interesting breakdown of these different companies that I haven't heard a lot of people get into, because we've talked a lot about the IPO, but not some of these very unique particulars. With CoreWeave, it's kind of interesting. I've been watching the business a bit. I think, it is obviously because it's been a pretty tepid IPO market. It was the biggest tech IPO we've seen since 2021. The thing that's been kind of given me pause, we know that their revenue growth is substantial. It was something over 700% last year. They're still unprofitable. But their revenue is highly concentrated among just a few key customers, Microsoft being something like 62%, I think, of their entire, top line. And Microsoft is also sort of a competitor as well as a customer. And that's a point I've raised before, but I'm watching this one from afar. I don't usually invest in new IPO businesses anyway. And that's not something that I see changing in the near future. One company that is about to go public that I'm kind of intrigued by is Klarna. I'm not necessarily a huge proponent of the buy now, pay later space, but Klarna's particular business model is intriguing to me. They have their own, bank license in the EU. They operate as a bank in the EU. That's interesting to me. So some of these other companies that have filed recently, and admittedly, there's been quite a few, less than a few years ago, I find a bit more intriguing than this one. But, CoreWeave also, they were anticipating a much higher IPO price. And then, the sort of the 11th hour brought it down to $40 a share. So I don't know. It's a strange time to be looking at the IPO market, because I think that there's a lot of companies that have been wanting to enter the public markets for a number of years now, but it is just nowhere close to being the same environment it was in 2021. And I think companies are hesitant right now. Even the ones we have seen file in anticipation of an IPO, I have been surprised at the timing with which they're doing that. So it'll be interesting to see what the response is as some of these other companies enter the markets. I think StubHub is another one that just filed their prospectus, and then we've sort of got ones that have been rumored for a long time, like Discord has been talking about a long time about going public. There's been reporting that they are partnering with various banks right now to prepare to file their S1. So we'll have to wait and see. It's an interesting space to cover.
I feel like I have been reading the IPOs to watch in year, put in brackets.
the same ones every year.
Yeah, the same. I think 23, 22, 21. I feel like Klarna has been on that list the entire time.
It's been there a minute. Yeah.
I can't tell if it's they just don't want to go public, or the journalists that are writing this oh, I bet if I put Klarna in here, everybody will read it. But I've heard rumors that Klarna might go public, but again, that might just be waiting for Godot. Who knows here?
They did file. They did file that they're planning to. So there's it seems more of a near-term reality than a few months ago.
Yeah. And also, there's been also a lot of ones that withdraw too. So there's always they could flirt with the public markets and then just walk back away. But the interesting thing you mentioned about CoreWeave too is saying it's one of their major customers. I think part of the reason that CoreWeave, the IPO was actually kind of sudden. I think part of that is because Microsoft declined to take up a $12 billion contract with them in future revenue. And it was kind of one of those, again, it was hey, is the AI bubble popping? Microsoft didn't buy this CoreWeave product, but it was actually, it was also, Microsoft was like, no, we're going to spend $80 billion a year. We also, hey, guess what, folks? We have our own data centers over there. Maybe we'll just use those instead of going to CoreWeave. Of course, OpenAI said, tried to snap it up and say oh, we'll take the contract. Don't worry about it. But there was part of that where it was hey, maybe the people that are signing up for maybe the big hyperscalers, instead of going to the CoreWeaves of the world, they'll just keep building their own. And I think another part of if we were to add a chalk up another reason that's hey, maybe this CoreWeave thing isn't so hot, was that one of the biggest IPO buyers was their biggest vendor in NVIDIA. I know NVIDIA owned some of the shares beforehand.
Yes.
But if your vendor keeps buying your stock, I think the Financial Times called it the AI Ouroboros. Just keeps kind of eating itself. So
pretty much.
Yeah, it'll be. I don't even know if I'm fascinated by it, because again, I was so sick to my stomach when I read the terms that are available to individual investors. I was just nope, I don't want anything to do with this.
There was switching gears, back to retail. Cyber Mikey was asking about Ulta versus Lululemon for a retail foolish approach. I don't know if you have thoughts.
Well, my hope is here, because it is the valuation hour. Can we bring some valuation consideration into Ulta versus Lulu? Because it's two stocks that are both down quite a bit. And so everyone's probably hey, cheaper stocks, right? That must be better, right?
Yeah, well, I think these are two interesting businesses. Looking at the beauty space, I've talked about this a lot, but I'll kind of reiterate some of my thoughts that I've shared in recent weeks on both of these as well. Ulta has been dealing with, I think, some very specific challenges the last few years, and they're now under new leadership. We'll see what the new CEO is able to do in terms of returning the business to more solid levels of growth. And, by more solid levels of growth, I mean, maybe mid-single digit year-over-year revenue growth instead of less than 1% or flat sales. This is obviously a very mature business. Now, they are one of the largest beauty retailers in the US. And they've been known for a long time for their, brick and mortar model. They obviously have an omni-channel presence, but it's much more that old school beauty retailer approach. And then they also have all of these different salon services that they offer in store. And some of their stores, they have partnerships with other bigger retailers like Target, like Walmart. And that is something that has helped with their growth. But that they've been dealing with this dynamic for the last few years now, where growth has just really stagnated. And I think that is probably down to numerous factors. I think one, you have a majorly competitive space in which Ulta Beauty is operating. You've got the likes of Sephora, which is also a major international enterprise that is doing well. You've got Elf Beauty, which I talk about all the time. They are rapidly expanding internationally. The market's been quite hard on Elf Beauty as well, for some different reasons, but Elf continues to grow really notably on the top and bottom lines, even though growth has slowed from a few years ago. And they are also more asset light in the sense that they do not own and operate their own retail stores. And they are instead expanding through really extensive partnerships with international brands like Sephora. They've been expanding through partnerships with retailers like Douglas here in Italy, with the Rossmann stores in Germany, with Kohl's in Australia, just to give some examples. Ulta Beauty is primarily a brick and mortar retailer, and they are a domestic enterprise only. And I think in an environment where competition is steep, operating costs are high, and consumer habits are shifting, we are seeing consumers being more hesitant to spend on discretionary purchases. I think it's sort of created a kind of a perfect storm for Ulta Beauty. They're still a profitable business. They still have a fair amount of cash on hand. Their growth has slowed to all but a screeching halt. But then one of the things that has kind of stuck out to me is they do have a very loyal shopper base. They have said that most of their in-store sales and traffic comes from their loyalty members. And that's something that I think they can tap into over the long run. But I think this is very much anyone investing in this. This is much more about a turnaround story because of some of the struggles they've been having. Lululemon is obviously, I think, growing at a much more notable pace. This is a very different type of business in many ways. They are obviously an international, global retailer, and they're focused on athleisure rather than beauty. So I like both of these businesses. In the beauty space, I'm probably more inclined to look at the likes of Elf Beauty and Sephora and some of these other ones from my own personal portfolio. But I think Ulta Beauty does have the potential over the long term if they can effectively execute this turnaround. And, the new CEO, she just took that role, I think, in January. And so it will take some time to see really what her strategy is and what that implementation is going to look like over the long run. And then, of course, we've talked a ton about Lululemon today, but I'm curious if you have thoughts, Tyler, on this.
Well, I'm gonna ask perhaps an unanswerable question, at least for both of us, because we live overseas. But just kind of, I want to throw this question out in the ether. There was this model of like Ulta Beauty being the, having the salon and having kind of like the services integrated into the brick and mortar retail to increase it. In running some errands for people in my life and going into Ulta Beauties, in the 3 or 4 that I've been into, I have never seen the salon component. And so I'm curious, is that still a thing? Like, is every Ulta Beauty have this? Because I've gone in like 3 or 4, and it's either like behind a curtain or something that they're like hiding it from me, but I have yet to see it. And so like the question I've kind of like supposed is like, is perhaps there's a little bit of brand dilution, or what their signature thing getting diluted with that really, really high growth component where they couldn't kind of fulfill that mission. It's like, yeah, we're going to open an Ulta store. It might not have the salon component maybe yet. I don't know. Maybe they were just new stores that hadn't, been able to hire into it. So I just, it was an observational, from my own shopping bag moment at Ulta that does make me curious, because there are a lot of companies in retail that grow very quickly. And one of the biggest problems is the challenges that companies face when growing at really, really high rates is maintaining that like either that signature component that made you unique and made people want to go to you, in this case Ulta with its salon business, versus, you know, just kind of growing for the sake of growth, end up like diluting the quality of your offering, creating like managerial and bureaucratic headaches that can't be overcome, and, you know, end up being like a little, that even though there's growth and there's income and stuff, it actually ends up being value destructive because you start seeing declines on returns and things like that. I mean, I can there's hundreds of retail companies. I mean, I've got Peter Lynch's book over here on the shelves, and one of the ones he talks about from the 1990s was Boston Market. It was a, you know, a food retailer that, you know, grew so fast that it's just basically its food offerings, you know, went to crap. And, you know, as a result, and took on way too much leverage and did all the dumb things that companies do when they try to grow too fast. I would posit that I think Dollar General probably did a little bit of the same thing. They were so obsessed with increasing their store count that, you know, they'll blame, oh, is the customer is like, well, maybe nobody just wanted to shop at your stores anymore because it became a miserable experience. Did you ever consider that? So
could be.
It to me, that like for Ulta, it's a little bit of an unanswerable question, at least for us, is like it is, you know, maybe there's a little bit of brand dilution with its growth. So that, but then let's go on the spot here, because right now Ulta trades for about 13 times earnings, 14 on a forward basis, Lulu at 20 times earnings. Of those two, if we were to just look at it from a valuation perspective, which one looks more attractive?
I mean, I still think Lululemon looks more attractive because I think its growth prospects are better over the long run. And I'm saying that as my own kind of growth oriented investor lens shines through here a bit. You know, maybe Ulta trades at a somewhat more favorable valuation, but there's other factors I think to take into consideration, obviously, when you're looking at this business and where they're at. The thing you mentioned with Ulta and their salons, not all of their locations have those beauty services. For example, all the Ulta beauties at Target do not have those services that are integrated in there.
Yeah, I should be clear. The ones that I did go into were not like, you know, the sub stores in the Targets or the Walmarts. These were actually like the Ulta Beauty,
some
like
of their,
in the strip mall.
And some of their locations don't either. Well, it's kind of interesting to look at Ulta now, and this is, I think, something else that feeds into the valuation we've seen and the decline in shares. You know, they're facing competition from really established retailers like Sephora that have famously, you know, partnered with Kohl's, which Kohl's is struggling immensely, but Sephora is doing pretty well. And then the growing presence of companies like Amazon in the beauty space. There's that too. And then consumers are becoming more value conscious. They're prioritizing affordable products over premium ones. That's something where we've seen e.l.f. Take market share. There had been this really rapid growth in the beauty industry that, just broadly speaking, has slowed. And they're really also approaching an issue where they faced a lot of market saturation in the US. And then there's all these added factors that they can't control, like inflation and economic uncertainty. But there's actually studies that, and some data that's shown that more than 80% of Ulta stores have seen a competitor open nearby in recent years, with more than half of its stores having had more than one competitive location open in that time frame. So you have a situation where the competition is steep and growing, and they have sort of reached a base of saturation in their core markets. You know, prestige beauty continues to post pretty strong growth, but Ulta's losing share in the prestige beauty category. Mass beauty, where Ulta's stronger, is growing much slower. So these are some of the dynamics at play, I think, when you're looking at this business. It's not a bad business. I do think that they can probably turn around in the next few years with their new CEO at the helm. And as I mentioned, you know, something like 95% of total sales come from members. But there are some fundamental issues here that are not going to be an overnight fix. Both of these companies could see, you know, impact if sales, discretionary centric sales continue to wane in the current environment. This is not the same environment as, say, in the 2008 recession, where Ulta Beauty had a really resilient performance during that time. They kind of defied industry trends at the time. They opened dozens of new stores despite the economic downturn. They saw increases in customer traffic. They expanded their retail space, and their sales only dipped pretty modestly. This is a much more mature business. This is a much more saturated and competitive market than, 16 years ago or so. And so there's some elements playing into that valuation that I think are important to take into account if you're looking at these businesses side by side.
Yeah, as somebody who was a longtime shareholder in Estee Lauder and was infinitely disappointed the past couple of years, I can say that the beauty has been a much more competitive space. So, hey, don't forget about what we mentioned earlier with Lululemon. Don't forget about the one person that's a direct to consumer that bought five Instagram influencers, because those businesses in beauty exist too.
Right.
So, I want to hit another. I'm going to hit a question, transitioning completely from beauty to Mexico, because
there we
Let
go.
It Ride. Yeah, Let It Ride asked about Mexican stocks in our last hour, and I hope that he, she, or however chooses to identify is still listening. So the question was, Tyler, valuations of Mexican stocks appear low compared to most other countries. Thoughts on investing in Mexico as a whole, and specific with a company that I own, ticker is TBB, which is BBB Foods, and others. So, yes, I mean, compared to the American market, there aren't a heck of a lot of markets out there that trade to a premium to the United States these days. I think that's been kind of the case for the past 15 years, and anybody who is, looked at international markets like, oh, it's going to turn around, because, it happened. It happens in cycles. And this cycle has lasted like twice as long as the typical, international outperformance. But Mexican market, I find this one absolutely fascinating. In large part because there is a lot of baked in competitive advantages that Mexico has built up over the years. A lot of the conversation right now with Mexico is like trade with the United States and tariffs and things like that. And there's obviously some short-term concerns there. But one thing to consider, Mexico has free trade agreements with 100 countries. It's not, Mexico is their biggest trading partner is the United States, but they're not the only trading partner. They are looking to become a globally competitive manufacturing base, and manufacturing bases are going to be growing business places of growth over the near term. In terms of competitiveness on like our labor cost ratio, Mexican labor costs on an all-in basis, so you start including like insurance and pensions and things like that. Mexican labor on an hourly basis is cheaper than it is in China. It's actually much closer to like the faster growing manufacturing places like Vietnam. So you have a labor component advantage. For the longest time, I know it changes a little bit with tariffs now, but they have a massive energy advantage that not a lot of other countries share, because we have so much interconnected energy with the United States. They produce a lot of their own oil, but they have a lot of access to natural gas in North America, especially like Permian Basin in Texas, and North American natural gas in general, where the prices for natural gas in Mexico are much, much cheaper because it's piped in, versus actually having to like put it on a liquefied natural gas cargo ship and then do all the liquefaction, the regasification. That's a costly process. It adds like double, triple the price that it is in the wellhead, or what you can get out of a pipeline. So Mexico's got a huge energy advantage. It's got a huge cost of labor advantage. It's got 100 free trade agreements. There is, I think, a real opportunity in terms of not just manufacturing growth, but then also like GDP per capita growing a lot. I think we're still very early in this. There are some pockets that it's doing fantastically well. The state of Monterrey in the north, where it's just been one of the big manufacturing centers, GDP growth is becoming on par with like middle income countries, versus Mexico being considerably lower for some time. So there's really tangible progress there. Oh, the Mexico market in general is nowhere near the complexity and offerings that are available in the United States. If you actually look up and down the market, it's pretty small. It's a lot of things. It's a lot of real estate. It's a lot of construction. It's some hospitality stuff. There's maybe a couple banks. There's some consumer products, FEMSA, which is basically like the biggest Coca-Cola bottler in the country. They're publicly traded there. There aren't a whole lot of offerings. You don't see a lot of pharmaceuticals. You don't see a lot of financials. You don't see a lot of insurance, some of the things that you see in the United States. So, but most of the outperformance in the Mexican market over the past like 5, 10, 15 years has come in the real estate and the construction market, because we've been in this, I would say the early innings of this build up to becoming a manufacturing powerhouse. And in doing so, that's going to come from the construction and real estate industries. Most of the manufacturing isn't done by local companies. It's international conglomerates. It's the John Deeres, the Caterpillars of the world. BYD is setting up shop. Obviously, North American automotive manufacturers have been there for a long time. So you're not, if you're investing in Mexico, you can't really like pin it on like some individual manufacturer, because most of them are coming from the conglomerates. So what you get are the construction, the real estate. I've talked a lot about the Mexican airport industry. It's been a fantastic business to own. They're all publicly traded in the United States. They're kind of like this hybrid somewhere between a utility company and a real estate company. Fantastic returns. I think there's a lot of long-term potential there. There's just a lot I like about the Mexico market. And in terms of like corporate governance and like, corporate protections from the Bolsa Valores in Mexico compared to, maybe some other middle income countries, I think there's a little bit more robustness in terms of governance and disclosures and things like that. Yes, I need to brush up on my Spanish to read them, but they're there. So there's certainly that component to it. To get to the part about valuations, yes, they're much, much cheaper. Just to give some examples, like real estate companies there, where we'll see something trading for like maybe 1.7, 1.9 times book in the United States, book value. In Mexico, they could be trading for 0.6 or 0.5 times or tangible book value, while having way less leverage, and in my opinion, making them look considerably safer. So I think there's a lot of opportunities here. I think investors should do a lot of digging. Like there's obviously duds. There's some good ones. I can't say that I can name all of them, but they're there. And so definitely do some digging. And most brokerages, I know that with my Fidelity one, you can buy stuff traded on the Bolsa Valores relatively easy. There are fees, but they're not excessive. You might have to be on the phone with somebody for a minute, because it certainly took me a while to figure it out. So yeah, I really enjoy it. And one company that I recently invested in, that's actually publicly traded here in the United States, is BBB Foods. They are a hard discount grocer, and it's kind of a play not just on like, I've waxed poetically about like the business itself, but if we're kind of coming back to the theme of investing in Mexico, GDP per capita growing, there's going to be more money into employees, people working there, that they're going to have a little bit more discretionary income for groceries and things like that, that is going to allow companies like BBB Foods to thrive. So that's my soliloquy on Mexico. Rachel, I don't know if you have any thoughts on the Mexican market. I know that you invest in the international markets, but
that isn't a market I have followed as closely, but I feel like I've learned a lot whenever I hear you talk about it, and I find myself more and more intrigued. I actually want to hit a healthcare question. Shocker, I know. There was a question.
Flip. Yeah, here we go.
There was a question that came in actually like 20 hours ago from Jeff about Novo Nordisk. Are they the first out of the gate with a weight loss pill? No, actually, they are working on one, but Eli Lilly looks to be the first out of the gate and potentially first to market with this. I talked about this a bit yesterday. I wanted to talk about it again in response to this question. So Eli Lilly plans to release the initial results from numerous concurrent late-stage clinical trials on their once-daily obesity pill this year. That is probably one of the most critical sets of results that we will be seeing related to a weight loss pill this year. It would also bring them a step closer to essentially being the new needle-free alternative for weight loss and diabetes in this space, and could also very much broaden access for patients both in the US and abroad, and alleviate some of the constraints that have plagued the GLP-1 injection side of the market. There's obviously a wide slate of other drug makers that are working on their own pill-based formulations, but Eli Lilly has said they expect to release data from 5 studies in patients with type 2 diabetes and 2 trials in people with obesity in 2025. And again, this is about their late stage once daily pill, orforglipron. Analysts are expecting the pill to be, broadly speaking, as effective, safe, and tolerable to take as semaglutide, which is the active ingredient in Novo Nordisk's Wegovy and Ozempic. And again, these trial results are probably some of the most watched in this space this year. Eli Lilly is close to being about 3 years by some estimates ahead of some other drug makers that are developing pills. Pfizer's one, Roche's one. There's obviously Viking Therapeutics that has been working on developing their own pill version. And obviously this is a fast and rapidly growing addressable market. And Eli Lilly and Novo Nordisk have really been, neck and neck in terms of the way they are working to release these new, products to market. Eli Lilly's pill, it's not a peptide medication, which is, it operates in a similar way to Wegovy and Ozempic, as well as Novo Nordisk's diabetes pill, Ribosys, but it's not a peptide medication, so that means it's absorbed more easily in the body. It's unclear exactly what the pricing structure for Eli Lilly's new pill would be, but in January, the CEO of Eli Lilly, Dave Ricks, had said that the pill could receive regulatory approval in the US as soon as early 2026. And then in their annual report, which they released just last month, they had a nearly $550 million pre-launch inventory charge for this pill, orforglipron, which would indicate that they are preparing to manufacture the drug, even before it is approved. Eli Lilly is obviously one of the biggest players in this space. Now, Novo Nordisk, they are working on an experimental weight loss pill called amycretin. That would be a once daily oral medication that stimulates both the GLP-1 and amylin receptors. It has showed promising results in early trials. There was, for example, a small phase 1 trial where amycretin led to a 13.1% weight loss in participants after 12 weeks, which was 11.9% above the results of the placebo group. And early trials have also shown that has similar side effects to some of these other medications like Wegovy, like Zepbound. So Novo Nordisk certainly does have, a foot in the door there, but they are much further down the line in terms of getting that particular product commercialized. So Eli Lilly is the one of many to be watching in terms of the one being first to market with a GLP-1 oral drug pill. This is probably where Eli Lilly will be the winner. But there are many of these other companies that I mentioned, like Novo Nordisk, like Roche, Viking Therapeutics with their pill formulation. I think they're also working on an injectable one. The one to watch with Novo Nordisk that is probably much closer to commercialization is CagriSema, which news about that, their next generation obesity drug, has sort of been the subject of mixed reactions. It's part of why we've seen so much volatility in share prices of Novo Nordisk recently, even though trial results met their primary endpoints in the redefined late stage trials. They helped adult patients who were overweight with type 2 diabetes lose 15.7% of their weight over 68 weeks. And then there was also in a previous trial where that had led to a 22.7% weight loss in patients without diabetes. That was still below the roughly 25% target that management had previously outlined. So notable levels there, and again, met the endpoint of having statistically significant changes for the patient. But because it was slightly below the target that Novo Nordisk had previously outlined, market sentiment following the release of those results was, tepid and negative at best. Now, Novo Nordisk is also planning to file for regulatory approval of CagriSema in the first quarter of 2026. So it is very possible that you could see CagriSema, which again is injectable, and then this new pill that Eli Lilly is working on potentially get approved and commercialized around the same time. So it's a very interesting and highly dynamic, evolving space.
All right, I'm going to barge to the front of the line for everybody in the Slido queues. Apologies, but I'm going to ask questions now too. It's my turn. So I've asked this one before to Brian Orelli, because talking about GLP-1s. I get that, weight loss, obesity drugs, diabetic drugs, and seemingly like there seems to be a bunch of other stuff that GLP-1s seem to be accomplishing in addition in outside of just some of the studies that are coming out afterwards. So here's my question. I get that it's a blockbuster upon a blockbuster upon a blockbuster in terms of market size relative to what you would normally see for a blockbuster drug.
Mhm.
It's huge, and there's obviously room for multiple. But as you mentioned, you just mentioned like 5 with pill forms coming out, and that's just the pill ones. I know Amgen, basically didn't even finish their phase 2 because it was so effective. They're like, oh, we're going straight to phase 3, baby. And that was like in November. You mentioned Pfizer. One company you didn't mention that obviously that went public earlier this year is Metsera. They're also, working in phase 2, and they had some very promising results in their phase 2. It seems like everyone and their sister, and who knows, maybe there's even some private ones that's got 5 Instagram influencers that also have found a GLP-1. But my point is like it's getting it's crowded, right? Like and as promising and as large as this potential market is, at what point do you start to look around and be like, everyone has when does pricing competition actually maybe start to impact the profitability of this? Because so many are rushing into this, that maybe we actually start to see pricing competition despite the fact they're all on patent.
That I'm not sure about. I mean, we know, for example, that many health plans cover GLP-1 drugs for certain types of, diabetes. Most insurance plans cover, for example, Ozempic, Najarro, and prescribe for type 2. And there's been a lot of changes there in the last couple of years, but there's still not a uniform response in terms of, coverage by payers. Now, you do see actions by big players like Novo Nordisk, like Eli Lilly, to be more competitive and sort of get ahead of some of these, smaller non-pharmaceutical companies that are selling, say, GLP-1s on, I don't want to say on TikTok, but you know what I'm saying, where you have these kind of sometimes dangerous formulations that are entering the market, right?
The 5 Instagram influencer ones.
The 5, yeah. And they've launched their own, direct to consumer platforms, which sell a wide range of drugs, but also sell at a much more accessible monthly cost directly to consumers their own GLP-1 medications. Novo Nordisk recently came out with an update on that front. I can't remember the exact monthly cost. I was talking about this earlier this week, but essentially they're offering a cheaper version of Wegovy for all cash paying payments. So all cash paying patients can purchase an Wegovy injection doses up to 2.4 milligrams at their local pharmacies for, I found the price, $499 for a 28-day supply. And that is a further cut from their prior policy that offered self-pay patients Wegovy at a cost of $650 a month. Now, this is a massive addressable market. I mean, there's some analysts that think that this could be like $150 billion addressable market for GLP-1s. And there are use cases that are being studied far outside of the current ones of, diabetes and obesity, things that some disorders which are related and some which are not. Metabolic liver disease, peripheral artery disease is another one. Different neurodegenerative disorders, maybe benefits for type 1 diabetes as well. It's also being studied. So it is a crowded space, but not everyone is progressing at the same rate. You obviously have these 2 major players in Eli Lilly and Novo Nordisk. I mean, some of these other companies are years away from having a GLP-1 product commercialized. And maybe there will be a space for them there. I mean, Viking Therapeutics is one I've been watching pretty closely with their once daily oral GLP-1 drug they're working on. Pfizer's also working on an oral GLP-1 drug. I think that there are room for multiple players. I do think you probably will start to see price and competition at some point. I think you're already seeing some of these companies like Eli Lilly with their Lilly Direct platform, like Novo Nordisk with their direct-to-consumer platform, working to get ahead of the competition by providing their own lower-cost alternatives, particularly in a dynamic where, legally now under FDA requirements, the pharmacies that were compounding GLP-1 under the provisions that when there's a shortage in place, they're able to do so, should no longer be doing that, should be winding down operations, but there's loopholes for that. And so there are ways in which some of these companies like Hims and Hers Health are still able to offer some versions of GLP-1. So I think that it's going to be something that evolves. I think you're going to have multiple players. I think some of these really big first to market players are probably going to take the largest chunks of market share, so to speak. I think some of these players that are developing their GLP-1s might enter into a market in which there is not much room left for them. But then it's also going to come down to the individual trial results. Are patients responding better to some of these? Are there less things like GI distress and other of these really common side effects sometimes from taking these drugs? So you look at the pills, right? Eli Lilly's for sure, based on what we're seeing, going to be first to market. But then you've got Novo Nordisk coming in with their new, next generation option, which could still be a multiple player, a huge player concurrent to that. I think that it's going to change over the coming years. I think that it's one of those situations where the pricing dynamics we see now are going to continue to evolve. I think more and more payers are covering these drugs. But in the meantime, you do have sometimes these illegal formulations that are entering the market and competition from some of these smaller players. And I think you're going to see more and more actions by some of these larger big pharma companies to try to undercut those smaller players and also offering more safe and accessible, versions of the drugs.
Fair enough. So just to get a comment out here, and I think we kind of hinted at it earlier, Michael Barrington issued a comment when we were talking about, development of drugs and things like that. A statistically significant result does not necessarily translate to a clinical effect that is relevant and important. Yes, relevant and important to a patient. Yes, that's very true. I think we mentioned it a while ago. Statistic is like, what, 30% of drugs that get to a phase 2 clinical trial actually become a commercially viable product. And most of the time, phase 2 trials do have a statistically significant result. So yes, anybody who's looking in healthcare, just because a press release says statistically significant result doesn't necessarily mean it's good news. So do keep that in mind. I want to hit another one really quick. Newbie asked, how should we understand estimated annualized return rate mentioned in our recommendations? And this is for somebody who has a full premium. And so people listening to YouTube who are not members, some of the things that we offer with recommendations are things like annualized return range. Neither Rachel and I can actually speak to that directly because we are contributors to the Motley Fool kind of on a contract basis. And so when it comes to specific components of recommendations, specific things of why stuff is actually recommended, we can't give comment to it. But I do want to direct you to a place that you can. And so what I would suggest is there's either the community boards that you can either ask these questions to and try to get in touch with customer service, but also we do almost every week there is what's called a membership hour on Fool 24, where if you have questions related to your membership or some of the services that you are a member of with the Motley Fool, you can ask it during these hours. The next membership hour coming up is going to be on Wednesday, February 2nd at 11 a.m. So if you want to tune into Fool 24 and you want to get in any membership related questions like the one that you asked, I would suggest re-ask. we'll try to keep this one in the queue, and hopefully they'll get to it then. But if for some reason we had to tidy up our Slido queues and it gets lost in the ether, I would suggest tuning in at this time and giving a chance, and you'll get to ask that question, and you'll get a much, much better answer than what either Rachel and I can give. And now that I've hit those ones too really quickly, I'm going to go and do something nice and esoteric, because that's what I love to do. Because what was it? Yesterday? I think it was yesterday, day ago. Yeah, it was yesterday. Matt asked a question. And I hope that Matt is able to get the answer later on. He asked the question, the ticker IIPR, which is Innovative Industrial Properties, offers a 9% callable preferred shares. Could you talk briefly about the pros and cons of products like this? And I assume that products meaning callable preferred shares and not stock of IIPR. So let's focus on the callable preferred share. Innovative Industrial Properties is a warehouse REIT that specializes in leasing to cannabis companies, either through growing or dispensaries or things like that. Kind of an interesting business. I've had my qualms with it before. I'm sure that we could go on long debates on the merits of Innovative Industrial Properties, but I just want to focus on the callable preferred shares component of this, because what is a callable preferred share? It actually kind of is in its name. Preferred share is basically like typically a type of share that's not a common share. They're preferred in the sense of like they will often like pay a dividend that is different than the dividend that you would get for the common shares. So, in non-dividend paying companies, there might be a preferred share that pays a dividend or something like that. In this case, these callable preferred shares at 9% are technically have a lower yield than the current yield of Innovative Industrial Properties, which I believe is about 11% today. I think there is a theory that preferred shares are a little bit higher up the capital stack in the capitalization in a business. With the capitalization of the business is basically, you have your assets; those are all the things that you own, and then you have your liabilities, and it's how you own them. That's what liabilities are. You have debt. You could have mezzanine debt. You could have preferred shares. You could have, you can carve up the ownership of a business in 15 different ways. Typically, it's just equity and debt, but a lot of other people slap in a couple other things in there. Preferred shares happens to be one of those things. Warren Buffett has been actually, kind of famous for buying preferred shares in companies, but that will be, I'm going to put that aside and we'll revisit Warren Buffett and preferred shares in a minute. The callable component of a preferred shares basically means that the company itself can call these shares and buy them back from you at a set price at any given time when they want to. So it's kind of it's a financing vehicle because they have to pay out the 9%, and they were able to, it's not quite a bond because they can call it at any time. It's not debt, so it doesn't like, it doesn't have like recourse. Like you can't claim it. It's further down the capital stack than debt. It's junior to that. So I don't know. I don't see the pros really, because you're still equity. Like if a company goes bankrupt, the equity gets wiped out. You're still equity when you have preferred shares. So you don't really have the downside protection, if you will. Like, yeah, sure, you get your preferred, which sounds nice, and you'll be getting dividends, but in this case, it's a lower dividend yield anyways. And if for any reason Innovative Industrial Properties stock goes way up, like the valuation expands, everyone gets really bullish about the business, and say like the dividend yield for its common equity is below its preferred equity, it could call back that preferred share, so you have limited upside, and you share the same downside in the event of bankruptcy. So I don't see the benefits really. I'm sure there's somebody out there that could explain the pros of callable preferred shares. I just don't see it personally.
There was a question that had come in a couple days ago that I thought I'd hit real quick. We only have a few minutes left, I know, in the hour, from Lovely Lily about VeriSign, asking what do they do? What are their prospects the next few years? I don't know if you follow this one, Tyler. This is one I know only slightly.
Nope.
Yep. So VeriSign, they're a key player in internet infrastructure. They are the sole registry operator for the .com and .net domains. This is kind of an interesting business. So they're a global provider of domain name registry services. They manage critical parts of the internet's what's known as the domain name system, or DNS, including the authoritative registries for .com and .net, which is 2 of the 13 internet root servers. So they operate the authoritative registries for some of the most important top-level domains. They're responsible for maintaining the security, stability, and resiliency of these parts of the domain name system, or DNS. They are a primary technical subcontractor for .edu and .jobs top-level domains. And they play an active role in, industry operational security forums. It's such a fascinating business to think about. And they also act as a wholesaler. They sell .com and .net domain names to registrars like GoDaddy and Network Solutions, who then resell them to the public. That's one element of their revenue, is this wholesaler role. But they also, their role as registry operator for .com and .net is based on contracts they have with ICANN, which is the Internet Corporation for Assigned Names and Numbers. And those contracts are renewed every 6 years. And then the wholesale price for domain name renewals is set by the ICANN contract, with there's specific increases that are defined over the contract period. So their business model, which is managing critical domain names, leads to a pretty predictable and reliable revenue stream, as you might imagine. And then obviously, as a major player in internet infrastructure, operating as the sole registry operator for .com and .net domains, that's been a major growth factor for the business. They saw like 4% year-over-year revenue growth in the most recent fiscal report. They reported on the top line about 1.6 billion. Earnings per share rose about 1.3%. Operating income of about 1 billion, net income of about 786 billion for 2024. I've seen different estimates from some analysts. Analysts have been saying that they expect 5.5% average annual revenue growth for the next few years. Earnings per share are forecast to grow about 8% annually. Because they're a key player in internet infrastructure that is obviously expected to see continued growth, though potentially at a slower pace than the broader IT industry. It is a pretty reliable business because of the way they operate and the ways in which they derive revenue. So yeah, that's a little bit of an introduction to VeriSign and some of their growth prospects.
And that brings us to the conclusion of our 2-hour marathon here. And Rachel, this was a lot of fun.
This is super fun.
Yeah, got to talk about DTC companies that are just run by contract manufacturers and 5 Instagram influencers. That's my favorite. It's my favorite simile for businesses these days.
There we go.
Did you guys set up a water station and like a fruit station along the way, that 2-hour marathon?
It was pretty close. I mean, my face is burning. It's not from the 2 hours. It was actually from too much sun today. But it's funny. You guys are going to be doing earnings on BRZE, SailPoint, and Lulu. We did quite a bit of content on Lulu and SailPoint just recently.
Excellent.
So, yeah.
Nice.
Can I ask one perhaps a cynical or sarcastic question?
Do it.
If I set 5 years for Thoma Bravo acquiring SailPoint for the 3rd time, would you take the over or the under?
I'll take the over.
Take the over. Okay.
And we'll get into this, but they still are holding a big chunk of shares, right?
Yeah, it's like 88%. It wouldn't take much to reacquire.
Yeah, for sure. Excellent. Thanks, Rachel.
Thanks, guys.
Good tee up. Appreciate it. Fools, welcome to another hour of Fool 24. I'm Tim Beyers. With me for another earnings hour on the weekend, Asit Sharma. Asit, how you feeling today?
Great, Tim. Got to bed relatively early for a Friday night for my wife and myself. I don't want to make us out to be party animals. Did Fool 24, but Tim knows, he's heard me say this a million times. We watch some Turkish serials, so we often will stay up late on the weekend doing a bit of binge watching. But we were disciplined. I did some Fool 24 at 11 a.m. We got outside, did some gardening things. So I'm feeling pretty good. How about you, my friend?
I'm outstanding. Great sports ball day.
Nice.
Palace moving on to Wembley in
Yay.
the FA Cup semifinals. We're waiting to see whether or not Brighton or Forest is moving on as well. Rather not see Brighton, but for reasons, if you know anything about those teams and you know anything about English football, you'll know what I'm talking about. If not, doesn't matter. But yeah, good day. Was up very early, 5 a.m. for the lunchtime kickoff in the UK. So yeah, early day. But we've got earnings to cover. Go ahead and get questions in. Thank you for the thumbs up there, Lauren. I am going to ask you to go ahead and push the screen share from the background because we are going to start talking about BRZE. Thank you for that. So BRZE, for those who don't know BRZE, so ticker BRZE, BRZE is essentially a marketing automation platform. It's more than that. You could also call it a customer data platform, but essentially what it does, Asit, is using real-time data, so streamed data. They will take data into their platform, and then they will let a client structure responsive messaging off of that. Maybe you set some rules about how you will interact with a certain brand, and BRZE will let you decide how you want to interact, for the customers for that brand. So, for example, long-time customer of BRZE is Ibotta, the kind of the cashback app. And so this makes perfect sense, right? If you're at a certain location that your phone can see, or if you have bought a certain category of brands and made a redemption via Ibotta, by virtue of that BRZE relationship, Ibotta will let you set up and say, I see Tim, buys a lot of pasta, let's just say, and it will start pushing the offers into my phone. It's responsive. It's based on real-time data, and it's well integrated with these platforms. It's a very smart underlying system, and the real-time nature of it, using streamed data, and streamed data meaning that data doesn't come in it doesn't come into a system and sits in a database. It comes in and then it is populated. So like stream data really became a thing in the social media era, right? Social media era, you could think of a data stream as a feed, right? A social media, that's a data stream. So all of this is to say, BRZE is becoming increasingly important for doing real-time marketing. And some of the numbers have been pretty good here. This is last year, Asit. Overall revenue up 33% there, you can see. And the dollar-based net retention, 117%. Let me show you the next year. And I want you to pay attention to something that's pretty important. So revenue growth was up 22%. The total customer count, see, I underlined this year, was up 12%. There is deepening usage of BRZE. Even though that dollar-based net retention rate is going down, it is still highly significant. There's plenty of usage here for BRZE. Some other things I'll note here. Total revenue, again, up 22% and up 5% from the third quarter. That's quite good. They are doing a fairly good job of broadening their customer base. That's something they talk about. However, the stock was up a little bit, but one of the reasons, even though these results were quite good, Asit, The reason they weren't up more is because during the call, they did talk about this, that there's just a longer sales cycle. That is not surprising when there is any kind of economic uncertainty and you are talking about a product, in this case, BRZE, requires a bit of upfront development, upfront customization. You got to put it in place. We use it here at the
Yeah.
Motley Fool. It did take us some time to get it working the way we want it to work. And so it's just a longer sales cycle. So now those sales cycles are a little bit elongated. So that seems to be one of the reasons the stock wasn't up more. It was up during the week though, Asit, up, 1.3% in a pretty bad week for the market. So it did okay. But I do think that's one of the reasons here. They do expect operating income to be positive for the full fiscal year in the year ahead, but they do have some dilution coming. They made an acquisition. We can go ahead and pull this down, Lauren, when you get a chance here. We don't. I've showed ready to show here for the moment. I'll bring it back up in a minute. Thank you for that. Something I just want to kick over to you for a comment quickly, Asit. So they made a bid. It's not too long ago for a company called OfferFit. And the OfferFit acquisition, let me see, I just want to get the date exactly right here. This was March 27th. So this week, 325 million in a mixture of cash and stock. So what management said is that they do expect operating income to be positive, but there will be dilutive impact in fiscal 2026. And we are closing up, fiscal 2025 here. So, they're going to have to deal with this. It is going to have some impact, not immediately, but this does seem to be like it's a small cash offer and a big equity offer. We're going to have to see when the deal closes, we're going to have to see exactly how much goodwill there is. I'm going to assume there's a fair amount here, Asit, but generally, I would say this is a good quarter for a well-positioned business. And the thing that makes OfferFit so interesting, and I'm just going to talk to this briefly. This was a quote. Let's see. I think this is right. So they work on what's called decisioning agents. So this is from the George. I can't pronounce this person's last name, but this is the co-founder and CEO of OfferFit saying, OfferFit focuses on the decisioning layer. So it replaces the manual work of A/B testing with reinforcement learning agents that autonomously experiment and learn optimal actions. In other words, Asit, this is an AI story. OfferFit gives you some autonomous AI agents that are throwing in some small experiments, gathering some data, and then fine-tuning the decisions for how to update an offer in real time. Now, that's going to be a very good narrative. That's going to be a really good story. What BRZE is convinced of, and they said this during the call, is that provides lift. Even though this is not a cheap acquisition for us, we can see right here that OfferFit is going to give us an opportunity in every client engagement to offer lift from the get-go. In other words, bigger spend, better margin for customers, for clients. That makes the decision to use BRZE more natural. I hope they're right. It's a good narrative. And I think that is another one of the reasons why BRZE didn't take a hit this week when so many other things did. All right, enough from me. Your thoughts, Asit?
Well, Tim, first of all, I'm so excited because we're going to cover between today and tomorrow 6 companies. Out of those companies, I know one of them well. I know another one sort of well. And there are 4 that I really haven't looked at carefully. And BRZE, unfortunately, is one. I have seen you talk about BRZE, and I must say I'm pretty impressed. And I'll tell you why. So there are companies out there that deal with sort of streaming data as a generalized strategy. They're presenting tools to use streaming data. Confluence, I think one that many of our members might know of. But to have a use case for streaming data is pretty interesting, especially one word you said at the very beginning, which is responsive. To be responsive in this era is very powerful. Just look back, many of us understand how the trade desk works. Before the trade desk came along, so much of advertising was just completely manual. And trade desk allowed the automation of advertising based on a budget. And in some ways, BRZE is doing something analogous to that, in that a company, as I understand it, from what you explained, Tim, and what little I've been able to learn about it, you sort of give those rules beforehand. So you set up the rules, and then you allow BRZE to accept if it's third-party data, and then place offers. Of course, you can place offers yourself. You can make the rules on your very own site, as we do. We have something that we want to pop up when a person is on a certain part of a page. We all get that. But the ability to make that sort of autonomous is very powerful. And I don't really know of any other companies that do the exact same thing. And to answer your first question, why OfferFit sounds interesting to me is I think it's pretty strategic. I finally found the metaphor, Tim, to help explain how I look at acquisitions. So think of a gas gauge. On the left side is purely financial acquisitions, where you are acquiring a company for the financial benefit first and foremost. So you pay a certain amount, it should be a fair price, and you're going to get a yield in earnings and cash flow from that. On the other side of that gas tank, just put that to the left side where the E is on a gas tank, but let's call that F for a financial acquisition. The other side is, for me, is strategic. So something where you are trying to do a lot with the parts and pieces because it fits into your own core strengths. There's something that you can make greater if you acquire those pieces versus the company that's already created those pieces and is using them. And if it is 3/4 of the way to that strategic part of the gauge, Tim, I'm much more tolerant of goodwill. But for the investor, that puts the onus on us to sort of understand how good the fit is, how much yield we think the acquiring company can get out of those assets, to be comfortable with some dilution and with some goodwill that'll hit the books. But it does sound to me pretty interesting, Tim, especially because there is still a manual part to this whole process, which is the testing part. So we do a lot of this ourselves at the Motley Fool. We do a bunch of A/B testing to figure out what is a strategy for a particular marketing campaign, or what type of pages on one of our websites, either a premium site or Fool.com site, will be more responsive or draw people into our content. So to be able to automate some of that with basically a decisioning layer, so it's an agent that has the ability to take in data and make those decisions through reinforcement learning, I think that sounds conceptually pretty powerful. I'm saying this without taking any kind of deeper look, but I agree with you. The narrative could be good here. It's, two ways to figure this out. One is time will tell. Second is, as management talks about the acquisition in the coming quarters, we'll be able to get a lot more color on that. And we can also go out into the real world and take a look at OfferFit because I'm sure it's got its own pages up and description of the assets. So it's pretty interesting, Tim. This is one out of probably the 6 that I am most sort of interested in learning more about. And the numbers look very decent as well. I'll wrap this up with this last thought. It's deceptive sometimes because really great SaaS companies take breaths, meaning thereby you don't see dollar net retention, for example, just climb linearly over time. They'll take a pause. It will go down a few percentage points. Newer customers will test out the technology. We've seen sales cycles elongate for companies that are very stellar long-term performers, and those can sort of shake you out of the thesis. It's always scary for me. I think, well, is this company just now, they've peaked, they're going to slow down, they'll never hit that gap profitability if it's unprofitable, or they'll never hit my free cash flow targets. But being able to sort of think through those waves and understand that there are many peaks and troughs in the SaaS world for the highest quality companies, I think is helpful to us who want to be able to invest a little bit better in this space. But yeah, I mean, first blush, Tim, pretty good quarter. Really looks like they're doing many things that are creating value, and we can see if OfferFit is the fit that they need. To,
Yeah.
Yep.
No, that's fair. And you're not wrong in making a comparison to the trade desk. It is different. Like
Yeah.
the trade desk is a demand side platform.
Yeah.
And
Analogous for members who are trying to understand the automated part of it. Just a rough analogy.
Yeah, I would say there's the customization piece and sort of setting it up and setting up the rules for how that is analogous, but otherwise you should think of it as, where do you want to meet somebody with an offer? Is it best if it is a pop-up on the phone? Is it best as an email? Is it best as a text? Is it best as a phone call? Like what is it? And then sort of structuring that, pulling out all of the different data points, and then delivering the right offer at the right place. They won't do that as a substitute for something like, say, an Ibotta. They won't do that. That's really is Ibotta's business, is the data piece of it. But as an execution engine, BRZE is the execution engine on that, and they do it exceptionally well, and they do it in real time, and that is different. But something, Lauren, you can put up the screen share again quickly. I just want to give you mentioned the numbers, and you're right, the numbers aren't bad. Here's the CFROI. This is the only CFROI I have for today. But this is BRZE. This is what we have. We can see cash flow from operations is up substantially, even though it's not a ton. It is up substantially from fiscal 24. And your overall CFROI number is 6.53%. Your return on invested capital is still negative. That is well below the cost of capital, though. So as of this moment, BRZE has not yet scaled into delivering value on the basis of all of the capital that it uses to grow. It's not delivering value yet. So I think we could say BRZE is doing okay, but they are still scaling. They still have some things to do. On balance, I like the product. I like the positioning. I like where they're headed. They have not arrived. We should be clear that they have not arrived. And that's okay. They don't need to be arriving yet, but they are directionally doing okay. And for those who don't know, because I've been asked about this before, so why do I do this? And what is this? The reason I do this to calculate CFROI is because there are companies, and BRZE is one of them, that are not yet generating consistent profits. And so I wanted to know, if a company is going to use equity as capital that it is investing for the purpose of generating long-term growth, I want to take the cash available for investment, that is everything that goes into cash flow from operations, including expenses that are deferred by equity, and then divide that by all of the capital that has been employed. That includes all of the equity, including equity for employees, that, to cover compensation that would ordinarily be cash, but is instead given as equity, and then all debt, and then come up with a number. All of the cash available for investment divided by all of the capital employed. Because it is not automatically bad that a company employs equity for the purpose of funding its growth by hiring a bunch of employees to do hard work. That is not always bad, but it can be bad. So we want to measure it. That's why I do it. And in this case, BRZE is going in the right direction, but they just ain't there yet. So we can stop sharing the screen there. Maybe take a question or two, and then we'll keep moving. Yeah, what do you got, Asit?
Yeah, so I was seeing if there were any questions related to this one. So I'll go ahead and pose one to you. So gross margins are decent, around just under 70%.
Yep.
I like the growth rate of this company. So, I mean, guesstimation here, Tim. At this growth rate, revenue growth rate, and with a healthy like gross margin, what do you think where do you think we are in terms of 2 to 3 years starting to generate enough cash flows where you're getting some scale, some operating leverage, and where we start to see better like operating cash flows, better free cash flows, and then a return on that weighted average cost of capital? Is it a 3-year deal, somewhere between 3 and 5 years, would you say?
I would say between 3 and 5 years, we should start to see see things turn a little bit. This is going to be a macro affected company. So do not feel like you have to rush here. It will be
Yeah.
a macro affected company because most of the users of BRZE are consumer brands. So just keep that in mind. They didn't talk much about tariffs. They're not really seeing that, but I did say at the during the conversation about this asset that they are running into longer sales cycles.
Right.
If you are selling the consumer brands that are taking their time and conserving cash, those elongated sales cycles could continue. So just the economic cycle will have an impact. You don't need. I would not be trying to time this one, but I also wouldn't be rushing into it either. I don't think you need to rush. Not necessary.
Got it. Got it. Well, Tim, that was a brazen explication of this company
Very
in the
good.
first 23 minutes.
Very good.
Just a
Well
pun
done.
there.
Well done. Well done. We're gonna go.
Okay.
We're
Go
gonna go
ahead.
faster on SailPoint and Lululemon, but let's talk about SalesPoint. Let's talk about what SailPoint is. So I'm going to come back to sharing my screen again in a minute, so we can see more stuff. But this will be shorter, and then we'll leave plenty of time for questions here. So right here, when you're ready, Lauren, let's pull that up. Okay. So SailPoint is a company that is in the identity governance business. What does that even mean? What does that even mean? Identity governance. Here's what it means. I don't just want to know that it is Asit on our network. I want to know that Asit, who has very specific permissions, is only going where Asit is supposed to go. And I want to be able to see that. I want to be able to govern the places that Asit goes. And I want to be able to audit whether or not that is somehow not happening, that Asit is finding his way into places that he shouldn't be. Because Asit's he's not really a sneaky guy, but let's say for this example, let's just say for this example that Asit is a sneaky guy and he's going to places that he shouldn't be. Like, identity governance allows you to set a framework of rules for what kind of permissions are attached to an identity. I want to be able to identify who somebody is in a network, and I want the rules to be in place that govern where that identity has access. So, as analysts for the Motley Fool, there's a lot of stuff we should have access to inside our company. There's also a number of things that are like sensitive financial data that should be only for the CFO, for Kira, and our financial team. I shouldn't really have access to any of that. Neither should Asit, unless it's been given to us very specifically by the CFO who has control over that data. That is good governance of the business. And so SailPoint is in the business of providing that governance. However, and here's why I circled this piece. You can see this here, Asit, that we're talking about rapid recurring revenue growth. Recurring revenue. You can see here that ARR, so that is annual recurring revenue, was up 29%, and SaaS ARR, so software as a service ARR, up 39%. It is super important for SailPoint to be selling fewer just straight licenses of its product and more access subscriptions in the cloud, things like that. And not every customer wants that. SailPoint historically has been the type of product that you install and manage, and then you pay maybe some support fees for that, but you are not paying a subscription for it. And SailPoint has been trying to be like, no, 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 we'd like you to buy the subscription here. So this is what they're pointing out here, to saying, look, we are moving in this direction. How good is it that they're moving in this direction? Well, overall revenue was up 18%. So they still have a ways to go. It is not that SailPoint is dominated by its subscription business. They still have a lot more to do to get this right. But it is getting better, and that's a good thing. But I just want to point this out. The reason they are telling you, like, hey, look at these big numbers, it's because they are trying desperately to get customers to buy subscriptions instead of licenses. And it's not always working. It works sometimes, but not always. Not everybody wants a subscription. And there's good reasons for that, by the way, Asit. Like a CFO and a CIO may be like, look, I'm going to have a controlled environment where I want the SailPoint. I'll buy the license. I ain't buying your subscription. Because they just would prefer to keep it that way. And that's a real thing that does happen. But just some other things here. They did make a point of saying they are now FedRAMP certified. If you don't know what that means, it means you have access to accounts inside the federal government. How important that is in the current administration, that's a shrug emoji right now. But they did call that out. I also want to say they expect revenue to be 225 million in the coming quarter, and that is an increase of 20%. So a little bit of revenue acceleration. So it was surprising to see the stock down a bit. They did close their fiscal Q4 in terms of double digits of number of customers in the low millions in terms of their ARR contribution. So they want to bang that drum because they want to point out to investors that we do have big customers that are committing big long-term subscription revenue, big commitments to SailPoint as a technology. That's a good thing. They're going to need more of those. Expect them to be asked about this a lot. And let's see, just other things. There really isn't too much here. They do believe, and this is something that, again, everybody has an AI story. So here is the SailPoint AI story, Asit. They believe their identity governance is actually really well positioned to identify, say it with me, AI agents. Non-human identities.
I hadn't even read that. I knew what was coming. But go ahead.
Yeah, right? AI agents, because they are in the business of identifying entities operating in networks. That's what they do. They govern identities. And so agents theoretically have identities inside networks. And so it's an interesting thing. Like some of SailPoint's businesses is we have more agents that are deployed into more networks. That's more stuff for SailPoint to identify and layer rules upon them so that AI agents don't go running amok and just screwing it up for everybody inside of a network. Not that they would, but you want to be able to, particularly with AI agents, it is probably a good idea to set them probably to least privilege status, meaning that least privilege, meaning you get access to basically nothing.
Yeah.
And that is probably a smart thing. And it's a decent way to provide maybe some protection, data protection inside of your environment. But that's the SailPoint story. The market didn't seem to really like what SailPoint had to say. It was down about, but that might be unfair. Lululemon is the one that really, I think, is the one that's going to take a bit of a beating here. They were down 3.51% for the week, SailPoint. That, given where the market ended the week and just how bad it was, I'm not so sure that's anything other than the market saying like, yeah, all right, it's okay, but nothing really special to see here. Any follow up on Sale Point, and then if there's a question, we can answer it.
Sure, Tim. So SailPoint is a name that's familiar to me, but I scratched my head when I saw the symbol because I had missed that it was coming public again. So it's just really a few weeks public. And I want to counter a little bit of the transition snark from our great smart colleagues to say there's another side of the coin too. So here's what Tyler was referring to. This company was acquired some years ago and taken private by Thoma Bravo, which is a private equity firm.
A very good private equity
firm. Private equity firm. So this is one of the few private equity firms that actually works with management teams of companies they acquire. They know the software business. They focus on the SaaS market. So it's a company that you shouldn't think of as being people who gut the core out of a business just to make money. They often improve the businesses they acquire. And what I see in this from when SailPoint was public last time is they've really been able to increase the addressable market, much higher sales level than before. And yeah, this 86% owned by Thoma Bravo. But on the other hand, that means that there's 13, 14% of float, meaning thereby there's not a lot of common shares out there. So in a period, this could be a more volatile company because of that, because there are fewer shares available to trade. But it also means in a volatile period, you might be able to get a pretty fair price on this company if you think that the business is solid. And it almost has to be. It competes without getting into the nuances of everything it does. I mean, right off the bat, we know it would be competing with Okta, which is a big name in the identity government space. But I liked what I saw, Tim, after you scheduled this ticker. Just a brief look to see what's changed since when I was familiar with this company before. They're into the kind of old school AI that you and I like. They use a lot of machine learning to determine whether you, to put a metaphor on what Tim said earlier, in identity governance, if you're at that like least permissible area, that's like coming into a water park and having to stay in the kiddie pool. You can watch the slides, but you can't get in. But they use a lot of machine learning to determine, okay, maybe Asit can go into if the organization doesn't have a rule for me, they can sort of tell by lots of observations, not just of me, but of other similar users who come in, where they should apply restrictions if anything looks amiss. And so that's sort of a more modern approach than when I saw the company last time. So I think the tech on the surface looks pretty good. Again, we have another SaaS opportunity. The margins that you showed, they're adjusted, but still, if it's 84% adjusted gross margin, I'm sure if I picked apart what's adjusted in there, it's probably still a pretty high margin, 18% operating margin. Pretty good net retention rate of 114%. So this has, the makings of sort of an interesting story. And I, for one, wouldn't just discount it by the fact that a private equity firm is putting a little bit of the shares back out there in the public markets. It could be a fun one to follow along this year. Here's what I would want to know too, Tim, and this might not even be their part of cybersecurity. It could be something where a Zscaler has more of an approach, but how do they deal with prompt injection? Is that even taken care of at the identity phase, or is that more, when you're monitoring the network? But that's a new thing. When you have agents, you also have people who are bad actors with LLMs and can manipulate LLMs and agents by a lot of prompt manipulation and then get into a network. So that's something that I'd like to learn more about. I don't know enough about this business to even know if that's something that they handle. But yeah, I mean, this is a interesting company and the tech is solid. So we can move on, but now I've got, one more ticker to sort of dig into and follow along next quarter. I didn't see much in terms of, because they just have become public again. In terms of conference calls, because I wouldn't. I think this is their first quarter as a public company, But I do want to now go back to the S1 and maybe look at the roadshow presentation.
Yeah. I mean, I think it is essential technology. I mean, you raise a good question about things like, a SQL injection attack is something that's very well understood in data environments. A prompt injection attack inside a network, especially a network that's using agents, that's interesting, and I hadn't thought about that. I imagine that's something that SailPoint is thinking about. I imagine that's something that a lot of cybersecurity companies are thinking about, but they are a specialist in identity governance. Um, and I'm going to answer Beyond's question super quickly, and then we're going to go to Lulu's Lemon, just asking me, is there any stock that has a ways to go to get this right? It's better, volatile value versus really got better premium valuation, right time to build positions. You could argue that SailPoint is in one of those types of positions because it is still building. I do think that BRZE still has kind of a premium valuation, but between the two that we've talked about, Beyond, SailPoint is probably closer to what you are talking about. So I just, for what it's worth, we could probably take that question down. But let's move on to Lululemon, and then we'll get to the rest of our questions here.
Sounds good.
So let's go ahead and pull up the shared screen again. Lauren, when you get a chance, okay. Here's what happened. Like, if we want to talk about what happened with Lululemon and why, so it was down a little over 9% for the week. I think this explains why. So for the next quarter, revenue growth of 6 to 7%, and for fiscal 25, 5 to 7%, or 7 to 8% if you exclude the 53rd week. So if you normalize year over year, that is not great growth for a company that has been known for growing at a brisk pace. And let me tell you, Asit, for Q4, overall revenue was up 13% or 14% in constant currency. So you are talking about cutting the growth rate. I mean, roughly, I don't think it's too much of a stretch to say this. You're roughly cutting the growth rate in half. Not quite, but pretty close. So why was it down? That's why it was down. And they had to answer a lot of questions about the macro during the quarter, Asit. Their adjusted operating margin did increase. Still a good business. Adjusted operating margin of 23.7%. It's really good. But foreign exchange and tariffs are having an impact. And they were clear about this. This is why the guidance is what it was. So not good guidance. And I would say also, let's see, there was, right. So the CFO, Megan Frank, did talk about this, that they are trying to come up with some mitigations because tariffs are going to be a problem for them. They mentioned this multiple times. They got asked about it multiple times. They are a retailer, they are a premium retailer, and they import a lot of goods. So they import a lot of material. They're going to get hit. So something that Frank talked about that is potential, it's not fully inoculating, but it's something that she noted, which I thought was interesting. A breakdown of revenue by geography. So the Americas, which is going to get hit. Americas is going to grow at a low to mid single digit rate. It's just going to get crushed. That is, I'm not making a political statement here. This is Lululemon saying, like, hey, we know what's happening, but the tariffs are going to eat our lunch for a bit here. That's what they are saying. However, China is expected to grow 25 to 30%, and rest of the world expected to grow about 20%. So will they be investing more internationally? It will be interesting to find out, because these are areas where they believe that will, at least to some degree, um, they're going to need to navigate this while they also get through these headwinds, and these headwinds are going to be brisk. Hence their guidance. That's what really killed them. So I come out of this, Asit, with a fairly simple proposition for Lululemon. I still think it's a great brand. I still think it's a very good business. This is one where I think the short term, the macro, is really going to punch them where it hurts, and it's going to hurt pretty bad for a while. But once that's done, they should be able to just get back on their feet and keep delivering, and they will it'll probably force them to diversify more than they might have otherwise. But they're a big company, they're a big brand, and I think this doesn't feel like any kind of killer blow, but it does feel like this is unnecessary pain, and they're just going to have to get through it. So thoughts on Lulu, and we'll take all your questions on all three of these, but thoughts on this one, Asit.
Tim, I'd agree with that. The quarter was fairly strong. Outlook going forward is disappointing, but look, the US and Canada, so the Americas, make up some 70% of this business, rough
Big
numbers.
chunk of the business, yeah, for sure. Yeah.
That's a drag. And then
Yeah.
the expansion that I've recently criticized, so we have this in Stock Advisor, we follow this and recently highlighted it in our rankings. I've always been a little wary of that growth focus in China, because it is very difficult to stay in the good graces of both the Chinese government over time and Chinese consumers. They have
Yeah.
nationalistic swings where they want to buy local.
Yep.
But Lululemon has been pretty successful there, and lo and behold, that actually may be the expansion in China. They have very strong growth there, and they're still building out stores. That's maybe a short-term, near-term plus in a world where if you can manufacture within China or South Asia and sell within China, you can avert the tax, the tariff hit. So that's actually not a bad strength that they have.
Yeah.
And the other thing that is interesting, they talked on the call about traffic, like lower traffic being one of the reasons that sort of the macro is hanging over, the big macro is hanging over this company. And I buy that to an extent, but I'm curious too, just about a little bit of like the competition. Tim, you alluded to something which is going to be very powerful for the company long term, which is expanding into new apparel lines. They're in the shoe business now. They have a much wider variety of clothes online than their original offerings of yoga-based athleisure. So looking forward, even though they're expanding and taking a little bit of focus off the core stuff that brought them to the dance, I think that's very powerful. The question is, with competitors like Vuori, which is a privately traded company, but has recently received, I think, like $500 million to expand. They're going to try to get to, it's more than a handful of stores now, but maybe 100 by 2026. Where Vuori is expanding actually isn't in the US. It's in the growth markets for Lululemon. So they're going to be more of an international retailer with a combination of like online commerce and word of mouth through physical stores, sort of that flagship type of branding exercise. So I want to try to figure out in the coming quarters if there's some growth at the margins that Vuori and other competition might be taking. Because for a long time, Lululemon didn't have any real competition in the athleisure / yoga space. And as they've grown, everyone's coming after that market. But I like this management team. I like Calvin McDonald. I think he's absolutely right to spur the company to innovate faster. He's rejiggered the management team so they can be more agile, in his words. And so I think long term, you still have a brand leader, and they themselves point to the fact that although you and I and members watching may be very familiar with this brand. Their unaided brand awareness is very low around the world. So they've got some opportunity there to impress customers, bring new customers on. And one thing we know about Lululemon is customers tend to be pretty loyal to this brand.
Yeah, they do.
I don't know how that holds up if we do hit a recession, and consumers finally are starting to show some strains. But historically, once people start buying Lululemon, they really like the product and want to just stick with them. So a few cents there from me, but I generally agree with your analysis.
We'll see what happens. I mean, they do need to diversify. They do need to innovate, and they are going to have to survive this short-term period because they're gonna get hit harder than most. At least they're being upfront about it. I don't think this, it would be more worrisome to me, Asit, if they were in denial about it, but they're not.
Yeah.
They're just being upfront about it, so that's good. All right, your questions, friends. We'll just hit them. We'll just hit them quick here. Thank you. Good to see Karen back for the bees. Hi, Tim and Asit. Y'all make earnings and business listenable. We'll be watching March Madness basketball. Very good. Hope your bracket's okay. Both brackets if you got them.
That's so Tim. I should say that is so Tim Beyers. Hope your brackets are okay.
Yes.
Such a supportive person.
I hope your brackets are good. And Inter Miami tonight. I mean, good team. Let's see what they do. And then back to Mindset Monday. Good. We'll see you tomorrow, Karen. Let's each tackle this one, Asit.
Sure.
Newbie. How should we interpret estimated annualized return range? How often is it updated, and any plans of making it dynamic in future based on the daily price changes? I'm going to make a reckless statement here, Newbie, because Tom Gardner may very much disagree with me, in which case I defer to Tom. But what I will say is I hope it's not dynamic based on future daily price changes. Monthly, maybe. Quarterly, I think that would be better. But I think it's probably quarterly now. But how should we think about it? I think one way to think about estimated annualized return ranges is as a measure of risk of total loss based on what we say about the structural advantages of the business, Newbie. So like if the estimated annualized return range is, let's just make up a number here. Let's say it's like -5 to -15% annualized. That is a statement about two things: about the amount of growth that can support the valuation and the advantages that the company has to outgrow its existing advantages. So if we're giving you -5 to -15%, that's the algorithms, the quantitative team, what they're saying is like, this one is priced as if its advantages are already well cooked in, and we don't know that it can expand its advantages appropriately to support the valuation we're seeing here. So it's more like an indicator of risk you are accepting in order to come into that business, because risk of loss may be higher, based on a number of factors. But I wouldn't expect it to be updated much more than quarterly. Asit, any more you want to say about the return range?
Yeah, I like that, Tim. That's a great way to think about it. We have to remember too, it's based on like backwards price data. I'm sort of with Tim, like update that thing 4 times a year. Let's not get into a situation where we're going back to check the estimated range of a stock every day. That's
I think that'd be too much. Yeah.
And then too, so what Tim says is key to understand. You're thinking about maybe the probability of total loss, which is one way to think about risk in general in finance. And you're trying to see as the business results manifest how the market is going to treat that company based on the way it's treated that company in the past. And as far as we understand it, as Tim and I do, I think, because we were both at the same presentation, I believe the quants made, this has been a year ago.
Yeah.
Don't expect this to be like a real precise range. They're actually lopping off some probability distributions from either end of the curve. So
Yes.
just think of it as like roughly like directionally what the price performance from the past indicates, given what we know today and given the potential for the company to perform according to whatever its advantages are. And so you sort of take it with a grain of salt. But the other thing is, if you do see extreme ranges, I like to use it as just a signal for risk. If I see one that looks incredibly good on the upside, but whoa, could be also the downside, looks significant. And there aren't a lot of those, but those wide ranges, it's a signal to me, okay, Asit, like maybe be rational about your position sizing here. And I'll be honest, because I'm so business focused, the times that I don't consult it, I would say are fewer than the times I do. Not to say that this is something you can't use as a very useful tool as you decide on position size and trying to gain an understanding of the business. But I just tend to be so focused on the outcomes of what a business is producing. The second step for me is to say, okay, now let's look at the price, buddy. How's it priced? Is it volatile? And work backwards from there.
Yeah. I'm going to answer Karen's question really quick, just to give you a description of how these things fit together. In cybersecurity, the reason the cybersecurity market is so hard, Karen, but yeah, that's a good answer on the return range. The reason it's so hard is because there are different companies that are addressing different parts of the value chain. They're doing different things. So let's just compare Okta and SailPoint. Maybe what we'll do is we'll compare Okta, CrowdStrike, Zscaler, and SailPoint. So what Okta does is it provides you a key to the door. It's single sign-on. You have a password to get into, to get past a door. Right. So it's a key. That's roughly what it is. I have said Zscaler and CrowdStrike are like, if CrowdStrike is like the bouncer out front of the club and keeping you from getting behind the velvet rope, because it doesn't just do endpoint security, but that's where it started and it's its biggest business. It's at the endpoint and the outside of the club trying to get in. And Zscaler is once you're inside the club, it's, that's the bartender that checks your ID to make sure you don't, you're cleared to drink. Or if you've been drinking, maybe doesn't, keep serving you if you are actually getting thrashed. So that's SailPoint is identity governance. So you've been let into the bar and you have, like one of those little, those bracelets that they put on you, like at a concert or whatever it is, Asit, and you're like inside the bar and you got the bracelet on. It's like the little yellow one. And so the people that have like the green bracelet are able to go into the back room, into the, the special place, but you got the yellow bracelet on, you can't go there. Like the yellow bracelet says what permissions you have, what privileges you have, and you're not privileged enough to get into the back room. I'm sorry. That's not a judgment, Karen. I'm just trying to explain how these things work. So SailPoint says who you are and what privileges or permissions you have to go in certain places. So that's how they all do very different things, but they're all part of a sort of a suite of security products that are meant to work together to help protect a network, data, all this different stuff, applications and so forth. So that's a way to think about it. Hold long and prosper. We can end on this one, Asit. Thanks for spending your Saturday with us. Arista has slid pretty badly lately. I don't see any significant changes in their prospects. What am I missing? I'm not sure you're missing anything, to be honest. I think it is. I think they're doing fine. I mean, and honestly, there is a couple of things that may be impacting it, Osset, and I'll kick it to you here before we got to go. It could be that NVIDIA is building like whole systems, including baking in the networking and the network routing. And so that's a bit of a threat to Arista. And, we might be nervous about the valuation. That too is also a possibility here because they are concentrated in a couple of very big customers in Meta and Microsoft. So thoughts on this one, Asit?
Yeah, I see it very similarly, Tim. I mean, Arista Networks was a company that sold off a bit when NVIDIA started really in earnest taking the technology it got from acquiring a company called Mellanox and putting that out into data centers. And then it got like a very nice relief rally when folks realized, okay, the Ethernet standard, which is a consortium standard that Arista Networks operates on, isn't going anywhere. And there's a place for both of these technologies to exist in the data center. And then the promise of data center build-outs is very big. And now I think, it got ahead of itself valuation-wise. So it's getting a little bit re-rated in that sense because there are concerns that build might slow down. We have seen Satya Nadella sort of started this off in an interview he did several weeks ago. There's a little bit more data that Microsoft is still building a lot, but not quite as much as they had anticipated. So they're giving up some leases that they were reserving for data center space. You take all of that, and I think Arista Networks is still going to be a player. It's still sort of like best in class for networking on campuses, on physical premises. It's going to have a place. And even, it could be, Tim, and this would be maybe fun. I just might pick your brain on this later during the work week, but NVIDIA's latest signaling on its own networking technology is it's focusing more on GPU to GPU communication. This
of course it
technology.
Is. Yeah.
Yeah. So, and that's sort of unveiling, okay, maybe it's not really trying to take Arista Networks out. It's even going in a bit of a different direction. So I think, the member is probably on. It's a very great company. There's some risk, as Tim points out. There always has been. I mean, for the last at least 5 to 7 years, because those hyperscalers, they buy the most of what Arista Networks offers, but it's an incredibly well-run company with very high margins. They are very careful with how they allocate their capital, amazing capital allocators. So there's a lot to like about this. I think it's, a little bit of just the market trying to get a more precise trading multiple on the company than anything else.
Yeah. I mean, as long as there's a need for clustered compute, there's going to be a need for these networking technologies, and that's going to be true in NVIDIA. It's going to be true of Arista, and then Ed, we can just kill this one off quickly. Ed, we were talking about Lululemon and the short term. You said that Nike's at a 7-year low. That doesn't bode well for Lululemon. It may not, but we said yes, you should expect. Because Lululemon is telling you should expect there to be some real volatility in the short term. So that is absolutely going to happen. Do you believe in the brand long term? That is the question. I think there's real brand value here for the long term, but there is unquestionably going to be some serious volatility in the short term. With that, we are going to pass it off to Rachel and Dan. There's more stuff to come. So let us get out of the way.
It's getting dimmer on the East Coast now, but we're gonna have some brilliance in the hour ahead. Some lights
There
gonna
you
come
go.
on.
There you go.
There we go.
That's a
Move on,
high
everyone.
bar, Asit. Come on.
I know.
Manage
Leaving us on that
expectations,
note.
people. Come on, we were supposed to be stock analysts. We know those companies, they set the guidance low, then they beat the guidance. They sound great. Now we got Asit and Kim setting the guidance high, Rachel. It's hour 3 for you. So you got to dig deep. You got to finish strong. Cool members, thank you for joining us. It's Saturday, you can tell. I'm Dan Caplinger. Appreciate you watching us, listening to us here. It's going to be a healthcare hour that although I mean, don't look, the topics are there for us and for you if it helps you, but really we're here to talk about anything. We are going to be talking. I've prepared some stuff about healthcare, exchange traded funds. We're going to talk. Rachel always wanted to talk healthcare stocks, but really, if you want to talk about just about anything, we are happy to do it here in this 5 o'clock hour here on the East Coast. Slido.com, #Fool24. Rachel, what's up with you today? What's on your mind?
Oh, just thinking about healthcare stocks, a space I talk about all the time, right? I did 2 hours yesterday with Brian Orelli, and we had different themes, but we ended up mostly just talking about pharmaceutical and biotech stocks, which I love it. So I'm not.
I've got a couple hours with Brian here in the next after you call it a day. I'm heading into the after hours with Brian.
Awesome.
We're gonna be doing some general stuff, and then we're gonna be doing the predictions show. So hopefully, looking forward to that. As always, these different themes. Viewers, I hope you like them because we try to have fun with it. We try to mix stuff up, try to see what works, what's interesting, what falls flat. Always tell us, even if you don't have a question to ask us on Slido, just tell us, say, Dan, your stick is terrible. Just cut to the stocks, brother. That's fine. I'm good with it. You cannot offend me, folks. I'm here for you.
I guess if there's a specific theme also that you want us to cover. But yeah, healthcare. There's a lot to watch right now. One of the things I'm watching in the week ahead specifically pertains to, we've seen a lot of discussion around potential tariffs, specifically as it relates to pharmaceutical products. And I think there's not a lot of information about that right now. And so I think companies are sort of, I've been hearing about European pharmaceutical companies sort of putting together tariff task forces, if you will, to try to prepare for the fallout of increases on U.S. import duties. And obviously, we've seen different sweeping tariffs that have been announced over the last several weeks, but we've seen numerous hints from the new administration that there's going to be pharma specific tariffs, which is, I think, something that will be covered a lot on our shows as that develops. But there's a lot of confusion about that, what that would look like in practice. I mean, we know that, for example, under the World Trade Organization's 1994 Pharma Agreement, many, if not most, pharmaceutical products and the substances used to produce them are exempt from tariffs, which binds them at duty-free levels. I've been talking about how you already have companies like Johnson & Johnson, like Eli Lilly, like Pfizer that have been talking about expanding their U.S. manufacturing. Obviously, these are U.S.-based companies with an extensive international presence, but they have the capabilities, they have the manufacturing know-how to be able to pivot. But that is still a multi-year process at best, and there's a lot of details that go into that. It is not an overnight occurrence. And something I talked about a bit yesterday as well was there was a survey that was done by a healthcare-centric trade organization that essentially surveyed a range of companies from smaller biotechs all the way up to bigger commercial players with annual revenues of over $1 billion, unnamed. So we don't know which companies were respondents, but basically asking, what is the impact? How do you think this is going to impact the business? What is this going to look like in practice? And obviously, there's concerns about how the costs are going to play out across the board, not just costs on tariffs from products being imported from the EU, but also how tariffs on Canada, China, and other countries could impact this space. But about 50% of the companies polled had said that they expect that some of these proposed tariffs will kind of compel them to search for new research and manufacturing partners. There was also questions about how long is it going to take these companies to alter their supply chains. And again, we don't know the exact companies that were included in the survey. Some of them are probably smaller players that have far less flexibility than the likes of Eli Lilly or Pfizer or Johnson & Johnson, to name some examples. But 44% of respondents said the process is likely to take more than 2 years. And 36% said they expect it to take between 1 and 2 years to implement any meaningful, supply chain changes. So we know that a lot of announcements are expected on April 2nd. I'm sure more will follow that day, but we will have to see what, if anything, comes out that might be healthcare specific, because I think that that's something that, as a healthcare investor and someone who covers the space, I'm really paying close attention to.
Yeah, a couple things I want to pick your brain on that, Rachel, and I try not to put you on the spot here, but I do remember, I think it was with Brian that we were talking about this, and if I'm remembering right, and I may be mischaracterizing him, so if you know and I'm wrong, tell me I'm wrong, because I don't want to spread misinformation, but the sense that I had is, and what you said about these timelines being so long seems consistent with it. Is it correct that if a company has an approved drug and they have a given supply chain, like they have a given manufacturing arrangement, and they want to change that manufacturing arrangement, is it true that they have to get some kind of like FDA approval basically for the new manufacturing agreement? Do you know?
Yeah, that's something Brian talked about a lot yesterday as well, and it's a process I'm a little bit less familiar with than him. But yes, that is very much the case. There are certain supply chain changes that they don't necessarily require the green light from the FDA, but manufacturers of, for example, certain medical devices, they have to notify the FDA if there's a permanent discontinuance or an interruption in manufacturing that's likely to lead to a meaningful disruption. And that can happen, of course, during or in advance of a public health emergency, which is a little bit different. But yes, it is not as simple as let's just go and build, or let's just go and re-navigate the flow of manufacturing of the specific product to the specific plant. There are very specific steps involved, and it does take time. And that is another thing to be aware of as well, even with some of these larger companies that are, really, they have their supply chains very well integrated into these different regions. They can adjust. There's still a process involved. It's not as simple as, tomorrow we start manufacturing in the US.
I think too, it's going to be really interesting to kind of see like who's making what where, because we've seen this in the auto industry where it's sort of like, your gut instinct is to say, well, okay, if you're going to put tariffs on autos, then Ford and GM are going to be great, and Honda and Toyota and all these foreign automakers are going to be hurt. And it isn't that simple, because U.S. automakers, U.S. headquartered automakers pass a bunch of stuff across US, Canada, Mexico, and conversely, you've got Japanese headquartered automakers increasingly, with plants here in the US, manufacturing plants in the US. And so, the cars that we used to think of as foreign cars are not necessarily foreign, and the cars that you think of as domestic aren't necessarily domestic in terms of what's going to get hit by tariffs. And I assume, the same could well be true for pharmaceuticals as well. You could have U.S. pharmaceutical manufacturers who have found it cost effective and it works for supply chain efficiency to locate some of their manufacturing facilities overseas. And conversely, you probably have some European manufacturers who might have manufacturing facilities here in the U.S. So, it's kind of a nice, in some ways, like a nice window into the process to kind of remind ourselves, okay, yeah, we identify these as U.S. companies or as European companies or whatever, but like that doesn't mean that, these are international businesses with an international presence, and finding out kind of firsthand, okay, so I think we might be surprised when those final reports come out, and or when we start seeing actual bills getting paid, to see like who's paying the tariff and whose goods end up being subject to it.
Yeah. Well, and the thing that's interesting is, thinking outside of healthcare, we know that traditionally speaking, the cost is usually passed down to the consumer in part or in whole. I mean, most of these companies are not going to ultimately bear that cost because of the impact it would have on their margins. But thinking about, healthcare, for example, something like 90% of US biotech companies rely on imported materials for at least half of their FDA approved products. So there are a lot of different factors at play here. And then, of course, something that is not always clear is, how agile are some of these enterprises in their ability to adjust? There's the companies I've mentioned that have had very kind of specific comments on here's what we're doing in terms of manufacturing. But it's not always that cut and dry. It's not always that clear, and particularly with some of these, smaller, biotech and even pharmaceutical enterprises. So, it's a dynamic thing, and it's certainly not something that is going to be resolved by any of these companies in a short period of time. It doesn't mean great businesses won't succeed. I think they will, but there is very much a reality to think about how that's going to impact them, and how does that also impact the cost of development and ultimately translate into the cost of drugs as well. That's another thing to consider.
And of course, the fact that so many people, when it comes to pharmaceutical drugs, when it comes to healthcare equipment, when it comes to medical equipment, it's not usually individual consumers that are bearing those costs directly. It's often a third-party payer, whether it's a government entity or whether it is a private health insurance company. And so, one can see consumers as sort of being inelastic demand, and so not very much bargaining power when it comes to when the pharmaceutical company raises the price. If it were coming right out of your pocket, then you might be sort of like, well, I need the drug, so I guess I'm going to pay it. But what we've seen, oftentimes those big insurance companies that are footing the bill, not just for you and me, Rachel, but for everybody, for millions of people, they might be in a better position to say, yeah, you know what, there's a tariff and you're going to pay it, and we're not going to pay it, and
raise premiums happens. Or yeah,
see what happens. I don't know. It'll be an interesting thing to see, because we see that with big retailers who have the ability to, they can switch suppliers. And so it may be a situation where in retail, it's a situation where some suppliers will eat the cost because otherwise they lose a relationship with a major customer. Here, the insurance companies are often kind of the big customer. And so then the question becomes, all right, who actually has the purchasing power here? Or who has the pricing power? Is it the manufacturer? Is it the pharmaceutical company? Or is it the buyer? Is it the insurance company on behalf of you and me and a whole bunch of other people?
Yeah.
Interesting stuff.
It is. One other thing I'll mention that I'm watching, but that was just sort of an interesting story in healthcare and totally unrelated to tariffs, was anyone who's followed the acquisition of Bluebird Bio, which had been known for their gene therapies like Livgenia for sickle cell disease, as well as a drug for beta thalassemia, and they have been in the process of being acquired and then going private by Carlyle and SK Capital in a deal valued around $30 million. That was announced, I think, a couple years ago. Obviously, shares will no longer be listed on any public market following that period. And Bluebird had faced really significant financial challenges in the period of time leading up to the news that they were being acquired and taken private, including the risk of defaulting on some of their loan covenants, which ultimately led to their acquisition. But I saw this story that came out yesterday. I don't think that they're going to pursue it, but Bluebird Bio had apparently received a rival M&A bid worth 50% more than the Carlyle SK offer. A rival bidder, a company called Aramed, has offered to buy Bluebird up for $4.50 a piece up front, plus a one-time contingent value right of $6.84 a share, tied to a sales milestone. And that would be 50% higher than the $3 per share selling price that Bluebird had previously inked with Carlyle and SK Capital partners. And that private equity duo, their buyout offer also includes a $6.84 per share contingent value right, or CVR. Based on what I saw for now, the board at Bluebird has not changed their mind, and the company, of course, remains bound by the original merger agreement. But maybe they're willing to look at this new, seemingly unsolicited written proposal. They commented on Friday that, consistent with our fiduciary duties, the Bluebird board of directors is carefully reviewing the Aramid proposal in consultation with its legal and financial advisors. There's been major, I'd say, challenges that Bluebird has had in terms of commercializing their gene therapies. And that's somewhat cast a bit of a shadow on some of their rivals and other players in the space. Famously, Bluebird's gene therapy for sickle cell disease was approved right around the same time that CRISPR Therapeutics and Vertex Pharmaceuticals garnered FDA approval for Casgevy, which is essentially a one-time functional cure for sickle cell disease and transfusion-dependent beta thalassemia. If Bluebird were to decide to go with a rival bid, they would have to pay a termination fee of about $1.5 million, which, based on the offer we're seeing from this company, Aramed, that would be more than covered. The original deal values Bluebird at around $29 million. The new offer is worth about $45 million upfront. I don't know that they'll actually pursue this, but it's kind of interesting. Aramed, they're a UK entity. They're the parent company of a company called Gametacell, which is basically a company that creates different products for various blood cancers. So kind of interesting, for anyone that has followed or looked at this business or perhaps owned shares. I don't know that they're going to pursue this rival offer, but I thought it was worth noting. And it's kind of an interesting development, in this space, and particularly for a company like Bluebird that has been, quite afflicted by troubles in the last couple of years.
Yeah, I mean, we haven't. I don't know. Correct me if I'm wrong, but I feel like we've been in sort of a lull when it comes to like a whole bunch of major merger and acquisition activity in the healthcare space. It just, we've just kind of been sitting still. I mean, all the activity here seems to be, really, frankly, a lot of it just seems to be on the private side. And a lot of it in technology more than on the healthcare biotech side. Just just not a whole bunch of major deals going on among publicly traded stocks. And and certainly that's not going to be helped with, a 10% correction in the NASDAQ and almost that in the S&P. And
right.
That kind of stomps the brakes on a lot of deals like that. So I almost feel like it is a positive sign to have what looks like a bidding war in the space. And like, is it a one-off, or is it something where we're gonna start seeing a move towards consolidation? Hard to say. I mean, I think that you're going to need to have more certainty on all of this macroeconomic stuff, impact of tariffs and that kind of thing. One hopes that it will at least come to some kind of stable status quo once. Yeah, I just that word doesn't mean what I want it to mean there, but we'll come to some stable resolution, a new equilibrium, let's say, so that things work out the way. It's predictable enough that businesses can consider strategic acquisitions and combinations and say, if a reasonable set of assumptions comes true, then this combination makes sense, and we can move forward aggressively with that.
Yeah, one final note I'll make is, deal making has definitely slowed, particularly in the healthcare space. There was a really interesting study, by PwC. You've always got these big consulting firms that'll come out with numbers that help kind of really, dissect what's going on in these different industries. And in 2024, according to this report, global healthcare M&A activity saw a decline in both volume and value. Healthcare services and biopharma remained pretty active, but mega deals were subdued. High valuations still being an issue, regulatory concerns being another one, but global M&A volumes and values in the health industries declined, with volume down 20% in 2024 compared to the prior year, and value down 29%. And fewer mega deals, which is deals valued at over $5 billion, occurred in 2024 compared to the prior year. And there's been high multiple expectations and margin pressure for payers and providers, limiting the funds available for acquisitions. So it's interesting to look at. We've obviously seen some changes. For example, medtech transaction value. You think about Johnson & Johnson's roughly $12 billion acquisition of Shockwave Medical being a notable example. Oncology is a particularly active therapeutic area in biopharma M&A, according to that report, but it's definitely a less active space right now than it was a few years ago.
All right, let me do a quick few minutes here just on ETFs in the healthcare space, just because I promised viewers that I would do that. We do have a few questions, so Rachel, take a look at those, and once I'm done spouting for a little while, you can jump back into those. But I just wanted to kind of point people to, if you are intimidated by healthcare stocks, and there's a decent number of people who are, it's a complicated space. There's a lot of science involved. It's an area where you can kind of feel like, if you don't have the scientific knowledge to be able to compete with institutional investors, that it might seem like a good idea just to steer entirely clear and stick with another area that you may know better. But nevertheless, if you're in that situation and you still want to invest in the space, but you may not be as comfortable picking individual stocks, well, I'll tell you, that's one reason why being a Motley Fool member makes sense, because many of our, in fact, just about all of our services will have some exposure to healthcare stocks in one form or another. But I have shared my screen, and on the screen, when that gets pushed up, is the holdings of the Spider Healthcare ETF, which ticker XLV. It's one of the major players in the ETF space for healthcare. It is one of the sector Spider ETFs where where State Street Spider takes a look at the 11 sectors as defined by MSCI and has an ETF covering each of them. This one, I'm showing the top holdings. This one is a market cap weighted ETF, which means that the largest companies in the index that the ETF tracks have the highest weighting. And so it should come as no big surprise that you're going to see companies like Eli Lilly, ticker LLY, United Health Group on the insurance side, you ticker UNH, Johnson & Johnson, ticker JNJ, AbbVie, ticker ABBV, and Abbott Labs, ticker ABT, as the 5 largest companies in this ETF. Doing the math in my head real quick, looks like about 40% exposure to, or weighting, about 40% of your fund assets are going to be in those 5 particular stocks. Sounds like a high concentration, but for these sector ETFs, that's kind of par for the course. But you can kind of tell it gives you good exposure to a number of different trends in the marketplace. Eli Lilly, of course, in the news for GLP-1 exposure. United Health, the biggest health insurance company, private insurer, and in the Dow Jones Industrials. Johnson & Johnson, well known for its consumer products, even though it has spun off those consumer products into a separate company, Kenvue, which ticker KVUE. But Johnson & Johnson retaining its bigger pharmaceutical business as well as medical devices. Those companies, pretty obvious picks. They're stalwarts. They are mega cap stocks. They are relatively solid compared to the small disruptive companies. Plenty of approved treatments and pieces of equipment. Definitely not the sort of thing where you're worried about a binary event having a really big impact on them. Doesn't mean they aren't subject to patent cliff issues from time to time, but nevertheless, something to take a look at. An alternative among healthcare ETFs is the Vanguard Healthcare ETF. That's ticker VHT. Follows a slightly different index, but as you can see here, it's the same stocks, although they're in different order. Lilly and United Health still leading the pack. AbbVie passes up Johnson & Johnson, though, with a slight edge, and then Abbott again as number 5. Again, here doing the math, it's just a little bit less of a concentration. You're in the 30 to 35% range among those top 5 stocks. The top 5 stocks as a percentage of the holdings of the overall ETF. But exposure to hundreds of stocks in this particular ETF, and that's just a function. Different fund families tracking slightly different indexes. As I mentioned, the select Spider folks tend to follow Standard & Poor's S&P type indexes. The Vanguard Healthcare using a different one. And then I wanted to close out with another SPDR fund. It's the SPDR S&P Biotech ETF. Slightly different because it is focusing on biotech stocks rather than on pharmaceuticals overall, healthcare stocks overall. But as you can see here, this fund is more of what we'd call an equal weight ETF rather than a market capitalization weighted. Notice here, you can kind of see if the type is too small on your screen, I do apologize for you, but what I'm looking at here is the top 10 holdings as of, it looks like close of business on Thursday. And you can see just about all of these stocks are in the 2.3 to 2.7% range. That is just a function of minimal changes in stock price between since the last time that this ETF rebalanced. These equal weight ETFs, they tend to rebalance on a periodic basis in order to keep the exposure equal, but they don't want to keep it equal every day, and that would cause a whole bunch of transactions, things like that. So what you'll generally see is, one stock or another is going to outperform over a week or a month, and that'll end up making that stock the biggest holding in an equal weight ETF. And then when they do the rebalance, they'll bring everything back to the same. And so for a day or two, all those are going to end up being the same. But I would say, and I'm going to stop sharing my screen here, when it comes to like generic healthcare ETFs, they can be helpful if you don't really want to deal with the space. You don't really want to take a closer look in the healthcare space at all. If you just want to know that you've got exposure to some of the biggest healthcare names in the market, and you don't want to think any further than that, then something like the SPDR Healthcare or the Vanguard Healthcare ETF, either one of those should get you the exposure that you need. The biotech space, I think, in many ways, there's a better argument for an ETF in the biotech space, and that's just because, especially with smaller biotechs, there are a decent number of situations where a binary event can have a really big difference for a company. You've seen some companies, when they have a successful trial, their stocks will double in a day or do even better than that. Conversely, you have a bad trial for a stock, it can fall 70, 80, 90%. If that's the only drug that they've got in their pipeline, or if it's the only one that they've got in an advanced clinical trial, everything else is like back in phase 1 or just getting enrolled, then it can be devastating for a company. And so if you're uncomfortable, like trying to pick and choose, which one's going to double and which one's not going to drop 90%, then an ETF can kind of give you a little bit more of a balanced approach where hopefully you get some that double. And unfortunately, you might probably also get some that are going to fall sharply. But ideally, the ones that do well outweigh the ones that do badly, and you end up ahead in the long run. Downside of the ETF is kind of the flip side of that. If you think that you can do a better job of identifying stocks that will do well and that will avoid big problems, if you think that you can pick those stocks better than the index or the ETF manager, then you might want to do it yourself and avoid the whole ETF spectrum. But these things are available, and they can be helpful depending on your sophistication level, depending on how much exposure you want to the healthcare sector generally.
Yeah. I think that that's a really good way of kind of laying out the basket approach to this space, because it is such a diverse space for investment. And if you are going to invest in individual businesses, it is really important to understand the fundamentals of how those different sectors of healthcare operate, right? You've got the medical device companies like Intuitive Surgical, which I saw on a number of those ETFs lists. And then you've got the bigger pharmaceutical companies like the AbbVies, Pfizer, Eli Lilly, many others, Johnson & Johnson. You've got the biopharmaceutical companies that are, or biotech companies that are maybe on the bigger side of things, like Vertex Pharmaceuticals, like Regeneron Pharmaceuticals. And then you do have a lot of these smaller biotech enterprises, which, as you mentioned, Dan, can sometimes present, tremendous opportunity, but can also be quite inherently risky. They're not for everyone, right? And it's also really important to be able, you don't have to be a scientist, but it's important to be able to kind of go in and understand a little bit about what the candidate or candidates are that they're working on, what the fundamentals of the business are, what are the growth drivers, how do these trials work? So there is a certain level of analysis that goes in. There's lots of other ways to invest in the healthcare space too. Obviously, medical device businesses are a little bit more easy to kind of understand and value. I think especially, for anyone that's newer to investing in healthcare, health insurance companies are obviously another example of having a different model. And often, specifically, this is something you mentioned as well, when you're investing in some of these bigger pharmaceutical companies, you have a range of really established businesses that often have a wide portfolio of profitable, sometimes older drugs. And then also it's important to be looking at their pipeline to see what's advancing, what's going to be the next blockbuster, say 5-10 years from now, because all of these companies inevitably deal with, the patent life cycles, products that are major drivers of growth for maybe up to a decade and then go off a patent cliff. A great example of that is a company I own, AbbVie, right? For a long time, they were known for having the world's top selling drug, Humira, in their portfolio. And that is a drug that went, was off patent over the last few years, both in the US and in Europe, and is broadly speaking facing, extreme competition from the generics market. And AbbVie has worked for years and planned for years, as these companies do, to offset that. But there's still been, an impact and a transition phase that has trickled down to financial performance. Now, a company like AbbVie, they have a wide-ranging, portfolio of various immunology drugs, as well as different cancer drugs that are major money makers for them. For a business like that, they've got ones like Skyrizi, Rinvoq, Imbruvica. They're also, because of their acquisition of Allergan a number of years back, they own Botox, both cosmetic and therapeutic. They are known for some of their other drugs like Vraylar, which is an antipsychotic medication. And then one of their newer additions to their portfolio that is broadly expected to be a blockbuster in the coming years and garnered accelerated approval in late 2022 is Elahere, which they acquired in their acquisition of Immunogen a few years back. And that is a drug that alone is expected to bring in peak sales of around 1.5 billion annually by the end of the decade. And Elahere is an antibody drug conjugate for ovarian cancer. So some of these types of things are normal to expect in the life cycle of a business, but it is kind of important to try to understand, what are maybe some of the competitors for these companies and their drugs? What are the disease areas they target? And sometimes you have time to do that. I, of course, since this is a space not only I invest in, but I study for my job, I have a lot of time too. But that's not the case for everyone. And so that's where I think that a basket approach can be really helpful, or even really well paired with investing in individual healthcare stocks. I think it really comes down to one's, individual interests and just personal inclination towards the space. There was a question that had come in about Pfizer that I wanted to hit. A few hours ago, actually. Let It Ride was saying, Rachel, any insight as to the profits of drugs in the pipeline for Pfizer compared to the profit loss due to patent expirations? And we actually do have some, targets that management have provided to that end, right? They've been in the midst of a multi-year cost saving effort. Over the last year, they've saved about $4 billion or so based on their different cost saving initiatives. And then they went into a stream of acquisitions, M&A activity at the latter, part of the pandemic period, knowing that two things were going to happen. One, that inevitably sales from their COVID-19 products were going to wane at some point and impact the business, as we've seen in the last several quarters of financial results. But the other piece of it was they knew that they were going to be having anywhere from 17 to 18 billion in revenue losses in the latter part of the 2020s, so coming up here in a few years, related to loss of patent exclusivity on some of their key products. But one of the things that management has said, and I think continues to affirm by all accounts from comments we've seen recently, is that the outcome of these different acquisitions that they made, and I'll name a few and dive into what that meant for the business, we're going to drive a 20 billion or more in additional risk-adjusted revenues, to the top line by 2030. So helping to really offset that roughly 17 or 18 billion dollar decline that would come from generic competition for some of their older drugs. They went into really a stream of acquisitions. Seagen was their biggest one. That was a $43 billion acquisition that just concluded in December of 2023. And that acquisition alone effectively, doubled Pfizer's oncology pipeline. It's part of their much longer term vision of having 8 or more blockbuster cancer drugs in their portfolio by the start of the 2030s, bearing in mind that Pfizer has already been a leader in the oncology drug space with products like Ibrance, its CDK4/6 inhibitor that was sort of a first to market and is broadly seen as a first-line treatment for patients with metastatic breast cancer. But the Seagen acquisition gave Pfizer access to 4 major medicines that are already now in their portfolio, in which they're really just starting to see the profits from. One is Etcetras, another is called Padcev, there's Tivdak, and then there's one called Tuxa. Padcev is a drug that in 2024 alone brought in about $1.6 billion in revenue for Pfizer. Etcetras, 1.1 billion. And again, these are just added really to their portfolio within the last year because that acquisition closed in late 2023. That's just a couple examples. And those are also part of, again, that longer term goal of having 8 or more blockbuster oncology drugs in their portfolio by the early 2030s. The company is really looking at their oncology portfolio as a leading driver of their growth over the next decade and beyond. And just from the Seagen acquisition alone, they said that in the final quarter of 2024, they had global revenues of almost $1 billion from the legacy portfolio from the drugs that they acquired from Seagen. So that is really just starting to impact their business. Another drug that they acquired, as well as a portfolio of different peptide receptor antagonists, is the migraine drug Nurtec. They acquired that through the acquisition of Biohaven Pharmaceuticals in late 2022. They also added the sickle cell drug Oxbryta to their portfolio in 2022 by acquiring a Global Blood Therapeutics. And then another major acquisition was Arena Pharmaceuticals with their drug Atresimode. So they have very much said, we're seeing this 17 to 18 billion impact by the latter part of this decade is what we expect from the impact of generic competition, but we think we're going to add 20 billion or more in risk-adjusted revenues to the top line by the early 2030s. So that should help, broadly speaking, offset it. Nurtec is another example of a drug that has significant blockbuster potential for the business over the long run. There's some analysts that think that drug alone could reach up to 6 billion in annual revenue at its peak. This is a small molecule drug. It's approved for the acute treatment and prevention of migraines in adults, and it was the first oral CGRP receptor antagonist approved for acute and preventative migraine treatment. So it has a very, very unique position in the market. This is a drug in which, Biohaven, which made the drug originally, and now Pfizer, which owns it, has invested heavily in marketing. And there's been reports that drug captures roughly 57% of the oral CGRP market share in the US. So those are some examples of some of the most notable, more recent additions to Pfizer's portfolio. I think this is a business, and I've said this a few times, that broadly speaking is being really underestimated by the market right now. I do think it's trading at a more favorable valuation than in the past for that reason. And again, their focus on oncology is a driver of growth in the coming years, particularly in the areas of blood cancer, thoracic cancer, breast cancer, and genitourinary cancer. Those 4 areas, all of which, by the way, Pfizer already has successful commercialized products in, are really where the company is training their growth over the next decade and beyond. And I think they seem well on their way to do that. They are already outpacing their pre-pandemic growth based on the recent financial reporting we've had from them.
Yeah, I just think that these companies, it's too easy to with Pfizer, it's too easy just to kind of get caught up on Paxlovid and Comirnaty and just to say, yeah, we have a problematic pair, and so it's going to be a problem. It's sort of like, guys, you know, Pfizer's quite a bit bigger than some of these other vaccine stocks. And so you're overestimating the impact it's going to have. The stuff that Rachel, you know, the acquisitions that Rachel was talking about, just a portion of the pipeline that Pfizer has. And so, you know, like, don't get confused. You know, Pfizer's in a different class than some of these other companies that, you know, have market caps that are less than 10% of what we're talking about with Pfizer.
Yeah.
A question from Pro Shop Guy about half an hour ago. Are there any heuristics to determine whether active ETFs, which will charge additional basis points, additional expense ratios for their active management, to determine whether those might be worth it versus passive index ETFs? Pro Shop Guy, I think the simple rule to follow is that if you can find a performance chart that will tell you how those actively managed ETFs have fared compared to some relevant index-based ETF that covers the same space, then you can just weigh those together and say, basically, did they clear the bar or not? I mean, in my view, the index ETF is kind of the good benchmark if they are pursuing the same kinds of stocks. And sometimes you will see that, and sometimes you won't. It may well be that if you have an actively managed ETF that targets a certain portion of a sector, well, whether it outperforms or underperforms a broader based healthcare, you know, a broader based sector ETF or a broader based full market ETF, like, that might not be dispositive. I'll throw you out an example. ARK Invest does an ETF on, I think it's genomic stocks, and I think it's ARKG. I can't remember exactly what the official name of the ETF is, but it's something like Genomics Innovation or something like that. You can compare the performance of that to an index biotech ETF or an index or a healthcare index ETF, and it'll do better or worse. But I wouldn't necessarily draw conclusions about whether the active management was worth it there, because the investment objectives of the two ETFs aren't identical. Where I think you can get the best sense of whether active management adds anything is if the company, if the active manager sets a benchmark that they are trying to outperform, and there is an ETF, an index ETF that tracks that benchmark, then you can just compare the two and say, hey, they achieved what they were trying to achieve, even after paying a higher fee, because those performance numbers should be, double check, make sure they are, but they should be net of any fees, net of expense ratios that you pay. And so if, as a Pro Shop Guy points out correctly, the expense ratios on those actively managed ETFs are in fact higher than what you would pay on a similar index ETF, then yeah, you want it to make sure it's a higher bar. They've got to beat the index by a certain amount just to pay that extra fee. But once they pay the extra fee, anything on top of that is gravy. So, but that's the first inquiry I make, is if they're underperforming and they can't give me a good reason why, then like, that's it. I'll just do the index ETF and feel good about it. If they are outperforming the index, then I kind of look closer and I say, well, okay, how are they doing that? Are they investing in what I'd say are more volatile stocks, higher risk stocks? Am I taking on heightened risk by following this active management strategy compared to what I would have if I just followed the index? And then I can make an adjustment. If I'm comfortable taking that risk and I want that extra return, then fine. If I would like to manage my risk a little bit more, then I might say, yeah, this ETF's done better since I've been looking, but I'm not sure that it's worth the extra potential volatility going forward. So Pro Shop Guy, that's kind of where I'd take a look at that.
Okay. There was a Let's see. There was a couple questions I wanted to hit. Well, this was interesting. This came in. Maybe we could both kind of lend our thoughts here. But there was this
Sure.
question from For the Bees on saying Lululemon consumer brand market seems incredibly fickle. Do you buy to diversify among different types of stocks? I remember Stitch Fix. Yeah, I talked about that one recently. Only need 35 stocks, maybe pizza, and then cited the Domino's ticker. You know, as we talk about at the top of the hour, we can't give individualized investing advice, and we can't tell you what stocks to add or not add to your portfolio. I know we talk a lot about, you hear at the Motley Fool, of diversifying eventually over the long term between 25 to 30 stocks is a good benchmark goal. Again, for those investing in individual businesses, obviously you can take a basket approach as well with different ETFs, and some people prefer to do that, and that can be a great option as well. Speaking specifically to Lululemon, I talked about that a lot in some of the earlier shows today and kind of shared my thoughts. I mean, consumer sentiment and the consumer, specifically consumer discretionary segment of the market, is a place that can be fickle. It is an industry that is often very much going to be affected by changing consumer spending patterns. So you look at the management of businesses like Lululemon. We talked about companies like Ulta. Talk about TJX companies. A lot of these other types of businesses, Elf. With exposure to discretionary spending. I think all of these are pretty solid businesses over the long run. But I think anyone that's investing in this space, it is important to understand that it is a highly cyclical space. You're not looking at the same type of resilience that you might witness in a company like a Costco or a Walmart or other businesses that, while retail focused, consumer focused, derive a lot of their growth from fairly consistent sources of consumer spending. And that's also why a lot of these types of businesses, especially in this most recent earnings season, have been issuing quite cautionary guidance for the coming year. Pretty much all of them citing the macro environment and changing habits of the consumer as it pertains to spending as having an impact on the brand. Does that impact the value of great brands? I think Lululemon is one of them over the long run. No, not in my estimation personally. But I do think it's important to understand that any type of investment in this space might face volatility, particularly in the short term. Now, in diversifying, investing in a wide range of stocks that represent different industries, I think, and I've seen this in my own personal portfolio approach, is a really important way to be able to derive growth from different types of companies in different types of market environments. I've talked a lot about how I love healthcare businesses. I invest in healthcare. I also tend to invest in a lot of more volatile tech-oriented businesses. And I have found that has been, in my portfolio, a really interesting pairing of companies that tend to face more cyclicality and volatility, both sometimes from a business perspective, but also from a share price perspective, up against some of these bigger healthcare companies like pharmaceutical stocks, medical device stocks, that tend to have more resilient and inelastic demand because they are providing the services, the products, the vaccines, the therapies that people need, really no matter what is happening with the economy or the world. Domino's is an interesting business. Since you mentioned the ticker, one of the things I have found most intriguing about that one, and obviously there's a wide range of food and beverage stocks, which again are impacted by changes in consumer sentiment and spending. But with Domino's as a massive, franchisor, one of the things that's notable is that so much of their growth comes down to their supply chain business. It's not about selling pizzas, even though at first glance that might seem to be a key driver for the business, but it's franchise and royalty fees. And then it is this supply chain business they have where they're selling, the ingredients like the pizza dough to their franchisors, and that is a huge source of revenue and profits for the business. And that's actually given them quite a bit of resilience in different economic cycles because they're not so reliant on actual, transaction volume.
Yeah, for the bees, I am a shareholder of Lululemon, ticker LULU. And so, yes, I was the beneficiary of that, 15, 20% drop. I can't remember what it was on Friday. So, but, it's been up and down. I think that to answer your question, do I diversify my portfolio with other stocks? The question is definitely yes, or the answer is definitely yes. But I don't hesitate because I have such a strong foundation of index ETFs, largely S&P style or total market ETFs. I've got that beneath me. So I don't necessarily worry too much about, okay, should my only high-end retail stock be Lululemon, or do I need to invest in something else in order to be diversified? I don't worry about that too much because my S&P fund has shares of a bunch of other companies, and it has shares of Nike, I've got the exposure there. I don't necessarily have to worry so much about diversification in my portfolio. But if you've got an individual stock portfolio that is most of your assets, you don't put a lot of money into ETFs. If you're in that situation, then yeah, I think that considering diversification within certain sectors or within certain industries, it's worth considering. It doesn't mean that you have to do it each time, because as Rachel pointed out, if you got a portfolio full of other stuff and you got some tech stocks and you've got, whatever you got, maybe you got some utility stocks, maybe you got some energy stocks, maybe you've got some consumer, but on more of the necessity side. And yes, I know some of you are going to tell me that the $100 yoga pants are in fact necessities. I get that. And as a shareholder, thank you, because I appreciate that.
They can be, Dan.
But, my point just being that there are certain things that are exposed to macroeconomic pressures in different ways. As Rachel pointed out, some goods you just have to have, some goods you can at least kind of put off a little bit. Some goods you might say, another day. And having a mix of those stocks, I think, for the bees can really help out in that situation. But it doesn't mean that you have to own, you don't have to own Lululemon and the Gap and Nike and On Holding and Decker's Holding for Hoka. And you don't have to own them all. If you do that, you might as well just stick with the index fund and call it good. So, but that, when you make a concentrated bet, then there's going to be that day. There's going to be that day where you're sort of like, oh, down 20%. Boy, I really would have been happier if I hadn't done that. And yet, I'll tell you too, when I owned Lululemon and, Nike had its day and it was down 5.5% or whatever it was, I was sort of like, okay, well, Lululemon didn't lose anything today. So, that wasn't as big of a deal as it might have been. Otherwise, just felt the pain indirectly in my index ETF. Let me take Vihan's question because it's not going to age well. Few additional healthcare ETFs complementing what you covered, citing a U.S. News report, gold, silver, bronze of the lot. Vihan, I'll tell you, I know a lot of people do this gold, silver, bronze with you. I'm not going to do it. And the reason I'm not going to do it is because gold, silver, bronze to me, like, I don't know who I'm talking to. If I'm talking to Rachel and Rachel tells me what she's looking for in her portfolio and what her goals are, I might have a different gold, silver, bronze for her than I would if if you were my client and I were talking to you, then you would tell me your goals and dreams and I would come up with something to do. That's not my job here. And so I will comment on the ETFs, on the other funds that included. It did include both the Vanguard and the two Spider funds that I talked about. The Invesco Equal Weight, RSPH, I talked about the Spider Biotech looking like it was pretty close to an equal weight fund. And a lot of people, they are more comfortable with these equal weight funds. They are not comfortable buying an ETF where Eli Lilly and Johnson & Johnson and Abbott and AbbVie and United Health are like 30-40% of their portfolio. They're sort of like, why would I buy an ETF with several dozen or even several hundred stocks if 40% of the money is going into 5 stocks? And so a lot of people like these equal weights because you get an equal amount invested in each of the shares, each of the stocks that are included, regardless One stock might have a market cap of $250 billion. Another stock might have a market cap of 25 billion. You get equal exposure to both. A lot of people like that. Now, it is the case, and I would refer people to the US News report that you were talking about. Those more specialized ETFs have higher expense ratios. You're paying more on an annual basis. And just to be clear, you don't pay it annually. It comes out of your returns every day on a pro rata basis. But over the course of the year, you know, yeah, it doesn't look like much, 0.1% or so for those two, you know, for the Spider Healthcare and for the Vanguard Healthcare, compared to like 0.4, 0.5 for some of these other ETFs. It doesn't look like much. It does add up over time, and it can make a significant difference over a long-term investor, which most of us are going to be. The other two, the ETFs, the other two funds that were mentioned, Fidelity Select Healthcare is actually a mutual fund, an index mutual fund, and not an ETF. So I'm not really quite sure what US News was thinking, including that in an ETF list. And then iShares Global Healthcare, that has more of a global focus. S&P 500 is not strictly limited to U.S. headquartered stocks, but it has a definite preference for them. And there are only limited circumstances where you're going to get kind of these international headquartered companies. The iShares Global, a little bit more international exposure there, but with a higher expense ratio. So there's pros and cons there. The three that I picked are three that I kind of like. The biotech one, Spider Biotech does have a higher expense ratio, but it's harder to get the specific biotech exposure. So I kind of feel comfortable with that. So yeah, I'll just leave it at that, Vihan. I hope that does help.
There's just a few minutes left, but there was a question that was kind of interesting, unrelated to healthcare, that I wanted to get. But Ed was saying, what do you think of ticker KTOS, which is Kratos Defense and Security Solutions? Is it one of the stocks in a market that will grow? What do you think of the price today? And this is a stock that has seen shares skyrocket by more than 60% over the last year. But this is a company that focuses on defense, national security, commercial markets. They specialize in unmanned systems, satellite communications, cybersecurity. For example, they develop and provide high-performance aerial target systems and advanced unmanned tactical aerial platforms. They have a range of cybersecurity warfare solutions, and again, they work a lot with government clients. The U.S. government is one of their big clients. They also are involved in various missile defense technologies. They're developing and testing hypersonic systems. They're also developing advanced engine technologies like next generation turbojets and turbofan engines. It's kind of interesting. They are working to expand to commercial clients, but they're still heavily reliant on the trajectory of government spending. They work a lot with U.S. national security related customers, as well as allies, other governments around the world. And then they have some commercial enterprises that they cater to, but they primarily currently serve the U.S. government, including the Department of Defense and its allies. And they generate revenue through contracts with government agencies for the production and deployment of its technologies and systems. They sell various products as well, like unmanned aerial vehicles. In terms of, like, for example, the valuation, which is something like 280 times trailing earnings, this is a business that has struggled with profitability. So it's important to take that PE ratio specifically with a grain of salt. For example, they reported, I believe, a net loss in both 2022 and 2023 for the full year. They did report a profit, a GAAP profit of about 16 million in 2024. Revenue's been growing steadily between the upper single digits and lower double digits for a number of years. They had revenue of about 1.1 billion in 2024. It's an interesting business. It's one I've gotten to know a little bit more recently. Not one I follow super closely. I do think this is obviously a company that would benefit from the increased trajectory of defense spending, given that the U.S. government specifically, as well as other allies, presumably in Europe and other parts of the world, are indeed its clients. So you could see this being a business that could benefit from that. over the long run, and certainly seems to have benefited from an increase in investor sentiment and in recent months. But its biggest issue has been a very inconsistent profitability over the years.
And fools, that brings us to 6 o'clock on the East Coast of the United States, 11 p.m. in Italy, and 3 p.m. on the West Coast, where Brian Orelli is going to be joining us in just a minute. We will say good day to Rachel. Have a great night. Thanks for joining me. Appreciate it.
Thanks so much. Have a good evening.
And Brian, hey, welcome. And Fool members, if you're just tuning in now, we are here. We're doing an Ask Us Anything, and then Brian and I are sticking around, and we'll do a bold predictions in an hour or so. But in the meantime, please do get those questions in for Brian and me. We are on Slido, hashtag Fool24. No individualized investment advice, but we're happy to share our thoughts on stocks, on funds, on investing generally, whatever you want to talk about. We will do our best to answer it. Brian, how are you doing today?
Good. Ref 3 soccer games this morning, so I'm feeling a little parched, but otherwise ready to answer questions.
What age group are you doing refing for?
I did 10 and 11. I did one game of 10 and 11s and 2 games of 8 and 9-year-olds.
That's fun.
So I can keep up with them, which is good.
Exactly. All right. I don't know if Brian, were you looking at the question queue before you came in?
I haven't.
Okay, let me then just kind of jump in here, and there were a couple here from a little bit ago that I wanted to take a look at. Besties from 1 day ago. Constellation Energy, ticker CEG, was talked about a lot in the past year. Power for AI, etc., but it has dropped 40% from its peak. Is anyone following this? Any expectations for the next 2 to 4 years? So, besties, yeah, my understanding, not a utilities guy necessarily. So, take all this with a grain of salt. But my understanding is we've all heard about artificial intelligence. We've all heard about companies, especially the hyperscalers. We're talking about like Amazon.com, ticker AMZN. We're talking about Alphabet, tickers GOOG, GOOGL, Microsoft, ticker MSFT, all of them trying to develop and invest in infrastructure for their AI applications, leading to huge uptick in construction of data centers and that kind of thing. What do you need for a data center? You need electricity. Who provides electricity? Electrical utilities like Constellation Energy. And specifically, when do you need that energy? You need it all the time. And so Constellation has the benefit of bringing two things together that have been interesting. One is they are a nuclear powerhouse, have a huge fleet of nuclear power plants that provide zero carbon energy that is not reliant on the sun and the wind, and is therefore relatively dependable in terms of not being intermittent. You don't have to worry about nuclear power plants in the dark, and you don't have to worry about nuclear power plants when the wind is not blowing. Now, admittedly, you have to worry about nuclear power plants in certain other circumstances. My concerns, and let's everybody take a pause for those in Southeast Asia who had to deal with a major earthquake today. But that aside, nuclear power making a comeback just because of it, of that having that element of it. So why did Constellation Energy fall as much as it did? The Federal Energy Regulatory Commission came out with a ruling in early November that basically said, you know what, we're going to maybe put the brakes on some of this level of activity. It was not Constellation's project directly. It was a competing utility. But it kind of spoke to, you know what, maybe we're not going to hit fast forward on capital investment in this area as quickly as we thought that we would. And so since then, we've been trying to figure out exactly what's going to happen. Also, since then, we've seen some, volatility in those hyperscalers, in AI stocks, in technology stocks more broadly. And for good or bad, I think you wouldn't necessarily have thought Constellation Energy would trade like a tech stock, but I think because its long-term demand structure is such that you have this exposure to, you have major customers who are tech players who may be responsible for an outsized portion of future electricity consumption. You may well have a period where it's going to trade kind of in line with these tech stocks, which is interesting. Are you really getting the reward for that? That's another question to ask. But the other thing that's going on with Constellation Energy, they have a pending merger to acquire Calpine. That deal, Calpine, is mostly natural gas powered power plants, a little bit of geothermal, a little bit of solar, but mostly natural gas. And they have a different geographical exposure. And so that combination seen potentially giving Constellation really truly nationwide exposure. It's also drawing a little bit of antitrust scrutiny because of concerns that because a combined Constellation and Calpine would control not only a sizable part of the nuclear generation fleet, but also a significant part of the natural gas powered fleet, that you may have decisions inside the company about whether to generate power in one area that could have consequences on pricing in another area. Some advocates saying that could raise anti-competitive concerns, but we still have time to, it's early in that process. That deal announced in January, still going through all the regulatory stuff that they would need to consider in whether that deal is going to get finalized or not. But besties, I think that's kind of where we are with Constellation Energy, again, ticker CEG at this point.
All right. Luxury Hot Dogs asked 56 minutes ago, do you think that Peter Marks' exit from the FDA will slow the rate of new biologics drug approvals? So Peter Marks was the head of CBER, that's with a B, which is the Center for Biologics Evaluations and Research. So it turns out that the Center for Biologics Evaluation and Research doesn't actually review biologics anymore. They used to, but they don't anymore. They moved the biologics drugs. So think protein-based drugs and antibody-based drugs. Those all are all considered biologics, and rather than getting a new drug application, an NDA, they get approved under a BLA, a biological licensing application. And so while the name says Center for Biologics Evaluation and Research, they don't actually do the biologic drugs. What they do is vaccines and cell therapies. So those are still under CBER, but CDER with a D, the Center for Drug Evaluation and Research, is actually the one that does the biologics drugs. Again, biologics are protein-based drugs and antibody-based drugs. So that's a majority of the drugs are both small molecules and biologics are a vast majority of the drugs. The rest of the drugs are cell therapies and vaccines, which do fall under CBER. So then the question is, will Peter Marks' exit result in less approvals of vaccines and cell therapies? And I think the answer is no, but it could. So no, the one guy leaving, even though he's at the top, I don't think that's a major issue. The bigger question is, I guess, who steps in, and I don't think we know that yet. And then do other people leave, and could that cause a delay in the evaluation of drugs and the movement of drugs or vaccines and cell therapies from phase 1 to phase 2 to phase 3? Because each one of those steps, the drug companies or vaccine makers and cell therapy makers are meeting with the FDA. And so if other people leave because Peter Marks left, then that could become a major problem. If there's a loss of knowledge of all, of the way that CBER approves things, and that could be a major problem. The people at the top, generally don't make the final decisions. It's generally they usually keep it at the analyst level, where there's a whole bunch of people, there's statisticians, there's different people analyzing different parts of the application, and then they come together and they make their own, they bring together all their knowledge and make the decision. And it doesn't usually get to a point where the head of CBER, the head of CDER are actually making the decision. And so I don't think that the person at the head, whether it's Peter Marks or somebody who's maybe a little more vaccine unfriendly, I'm not sure how much that's going to affect the vaccine and cell therapies that would get approved from CBER. But if this is a sign that other people are going to leave CBER and possibly even CDER, then that could cause a major problem for drug makers. And so I think we're sort of in a wait and see. We also got news this week that the FDA is cutting some of their staff. And so it wasn't really clear who was going to get cut. At one point, I heard one report that said it was mostly going to be people who do the same jobs as people at the CDC. So, basically vaccine people who are making decisions on vaccines that the CDC is also making. And so, that obviously probably isn't going to affect companies that are trying to get approvals. Remember that drug companies actually pay for their approvals. They pay more than $1 million to get their drug applications approved, reviewed. And then the FDA just makes the decision, but they're funding a vast majority of the CBER and CDER salaries are funded by the fact that drug companies have to pay these user fee acts, fees to pay for the drug, or pay for the application. So I'm not sure how much it makes sense to cut those people if if the government isn't even paying their salary, isn't paying their salaries indirectly at least. And so, I think we're still sort of in a wait and see is how I want to, decide to answer this question.
Yeah, no, that makes sense. You just never know until these things play out just a little bit more, I think.
Yeah.
Trevor Bartkowiak from a day ago asked, what's your opinion on our real estate market nationally? We have seen the market pick up here in Michigan. Wondering if 2025 is going to be a strong year. Trevor, I'll just share my views. Housing markets had some challenges in recent years. We had that big increase in interest rates, mortgage rates went up. That kind of put a lock on real estate activity for a while, because if you bought your new home when short-term interest rates were down close to zero and you could pick up a mortgage for 3-4%, somewhere in that range, whether you bought new or you were able to refinance your mortgage at those lower rates, right now you have a nice monthly payment. And if you sell your home, unfortunately, the way the U.S. system works, you can't expect to take your mortgage with you. That mortgage gets paid off when you sell your home, and you have to get a new one if you buy a different home. And if you are buying a different home and you're taking out a new mortgage these days, then you're paying 6% or you're paying 7% or somewhere in that range. You're definitely not paying 3 or 4%. As a result of that, that can mean that even if you are borrowing the same amount, which, let's face it, a lot of people don't. A lot of people, when you trade homes, you trade up and you're in a position where you're paying a higher purchase price. Irrespective of that, even if the purchase price were the same, difference on a monthly payment between 3 to 4% and 6 to 7% is enough to price a lot of people out of those markets. And so that has had the impact of kind of locking a lot of people in place and saying, you know what, maybe we'd move ordinarily, but not going to find a deal like what we've got now. Let's stay put and enjoy it as long as we can. That is one reason why some policymakers are saying, can we get the interest rates down, please? Because if interest rates come back down enough, then yeah, sure, maybe you're not going to get back to those 3% mortgages, but you might get 5%. You might get 4.5%. And at some point, the difference is going to be small enough that hopefully it's going to loosen up the existing home market a little bit. Because right now, I don't know, everybody I've talked to who has been looking at buying a home tells me inventory levels are still terrible. There just aren't that many homes to buy. And the ones that are there, like, you understand why they're there. We'll just leave it at that. And so because of that, you're in a situation where, yeah, you know, like everybody's kind of stuck. And I think if the interest rates do come down, as a lot of people are foreseeing that they might, then, you know, once the floodgates open, once these things become affordable again, then I think you might see a lot of activity. And as a result of that, you might see the real estate market open up a little bit. Now, what's that going to do with pricing? Because pricing is a different question. That I'm not so sure about. You know, we still have affordability issues. We have a situation, you know, a lot of people are concerned about macroeconomic impacts. There are a decent number of people who are losing their jobs, that kind of thing, you know, obvious deterrent to home buying demand. But at the same time, you know, so we have a negative consumer confidence picture at this point. Does that last the entire year? I think it's too early to say. There's a lot of uncertainty right now. I think that uncertainty will at some point go away one way or the other. And it may well be that even if the news is adverse, at least having a firm sense of what that adversity is going to look like is going to be more comfortable than this current state of, well, we don't really know what's going to happen. On the other hand, it may well be that we stay in an uncertain area for quite a while. And so I think that, you know, to answer the question on the national level, I think real estate, personally, my opinion, going to continue to see some of these same trends play out. I think that the you know, where I will be a little bit more optimistic is that I think that you are going to see a continuation in some of the demand shifts in some of the regional activity. And so to the extent that you start to see changes in local economies, whether it's because of onshoring of manufacturing, whether it is just kind of prevailing migratory trends, differences in state policies, that kind of thing, I think you will see some local real estate markets outperform others. But, you know, if you don't have those things going for you, then, yeah, it could continue to be a challenging environment. Brian, let me put you on the spot. Last I heard, I think you're in the San Diego area. What's that real estate market looking like? Any ideas on whether things are good, bad, or kind of wherever?
I mean, the last thing I've looked, they're, you know, okay. The prices are, you know, fairly stable, have been for, you know, maybe 3 or 4 or 5 months. I haven't really heard they're going down. We haven't really been in the market for, you know, I don't know. I tend to not look and see what my the value of my house is all that often, just because it doesn't really, you know, it's a paper number. And so it doesn't really matter. We've been sort of looking at potentially for investment, you know, real estate, and it's pretty expensive compared to the rent prices still. So that doesn't make very much sense to buy in San Diego right now. If, you know, your whole purpose is to rent out the thing. So we've been looking at some multi-generational properties too, because both of our parents are getting older. You know, I think that you know, I'm in the same boat where, you know, like it'd be great to move into a multi-generational property and you know, and even before my in-laws or my mother would need to move with us. But right now we had refinanced at such a low interest rate that, you know, the amount that it would go up in terms of the mortgage amount is, you know, that amount of extra payment is minuscule compared to the amount that's going to go up for the total, the difference in the interest rates on the total amount of the value of the new mortgage, right? So, I mean, I think we're sort of actively hoping that interest rates go down and then possibly going after, you know, buying then versus buying right now.
Only thing I'll add to that before I pass it off is just that I have seen some evidence. I live in sort of this ex-urban area where a decent number of people came up from New York City or came over from Boston in the early years of the pandemic and said, you know what, maybe a little bit of countryside, maybe a little bit of land would be a good idea. Starting to see a little bit of what I'll call commute fatigue. I did read an article in the Wall Street Journal, I think it was earlier today, I can't remember when it was published, just kind of talking about, you know, when you only had to go into the office like once a week or once a month, then a 2-hour train ride might not have seemed like a big deal. But now that some companies are starting to want you a couple, 3 times a week, people are getting tired of doing that train ride, as often. And so you're starting to see some of the folks that left urban areas to come out further start to reverse that trend and go back into the city, whether that's going to have a positive impact on inner city real estate at the expense of suburban, ex-urban properties. I think it's probably too early to tell, but that's an interesting trend as well.
All right. Molly Fool asks about Soleno Therapeutics. The ticker is SLNO. So the company jumped like 40 or 50% on Thursday, and then was up another 6.8% on Friday due to the fact that the company gained an FDA approval of their first drug. It's a drug. It's called a VYKAT, VYKAT. And if I didn't say it, the ticker for Soleno Therapeutics is SLNO. And so this drug is the first drug that's approved for Prader-Willi syndrome. And so Prader-Willi syndrome, what happens with, it's a genetic disease, and what happens is the patients can't be satisfied, basically, and when they're eating, and so they'll just continue to eat and eat and eat, and there's no off button that says, oh, hey, I'm full. They just keep eating and eating and eating, and they would eat and eat if somebody doesn't stop them. So obviously there's, it's a genetic disease, so it's happening and starting in infants and moving their way up. So obviously parents have a lot of control over this here, although literally there's they have to put locks on all the cabinets and all the refrigerator and the freezer, because these children would just go and eat whenever they wanted, because they're just not satisfied. So this drug seems to be able to satisfy the patients. What they did is they did a reverse clinical trial, where what they did is they put everybody on the drug, and then everybody who seemed to be responding to the drug and had their caregivers described them as having less issues with eating. Then what they did is they took all those people that were positive, where the drug seemed to be work, and they switched half of them onto placebo and left half of them on the drug, and then continued to monitor it, and so then they were able to show that people who stayed on the drug continued to not have as many problems with their wanting to eat constantly, and people who got switched to placebo had their issues come back. And so that's how they measured it. It's a neat trick, because it seems to reduce the placebo effect. I mean, you could just imagine you could just give it to start patients on the drug, half on the drug and half on the placebo. But the problem is, if people think that the placebo works, in this case the caregivers, they may think that it's working on their child, and therefore not end up scoring. They may end up scoring higher on this test of whether the patient is having better control over their eating. So it's approved now. They're expecting to launch it in April, so presumably in a few days to a few weeks, and the list price is like 500 and let me find it here. It's $5.92 per milligram, and it's given based on weight. So they looked at the average weight of the patients in the clinical trial. These are mostly children, and the cost will be about $466,000 per year. So a substantial cost. It's technically an orphan drug, and orphan indication, but not a super small one. They think that there's about 12,000. There's 1 in 15,000 live births patients have. 1 in 15,000 live births. Those children have Prader-Willi syndrome, and they estimate that there's about 12,000 in the U.S. based on verified claims of people living with Prader-Willi syndrome, although there's probably some that haven't been diagnosed properly, because a lot of times when there's no drug available, doctors don't necessarily see that as recognize the orphan indication when because they're not looking for it because there's no drugs available. They think that there of those 12,000, about 10,000 could actually take the drug. So there's about 2,000 of those 12,000 where they have possibly some comorbidities that wouldn't allow them to take the drug. But if you take $10,000 and you multiply by 200, what was the, let me find the number again. To $466,000 a year, that's a substantial potential market if they can get a majority of the patients on the market, on the drug, majority of the patients that have the disease on the drug, and that doesn't even include outside the U.S. So the market cap's only $3.3 billion. So if you figure an 8 price to sales ratio, they're only factoring in like 500,000 in 500 million in sales, right? So then that's, or less than 500 million in sales, maybe 400 million in sales. So, and they could potentially have 5 or 4 billion, in sales. So, they only need like 1/10 of their current market, the potential current market at the potential cost to actually end up with a potential, valuation that it seems reasonable. So I think it's an interesting company. I hadn't looked at it until it got approval, and I'm going to look at it further before I make a decision on whether to invest. But I think it's definitely a company that it's one of these companies. There's so many biotech companies that are developing these one drugs that it's there's no way to follow them all. So I literally just saw this Thursday morning and went and started looking at it, and I like I like the company. The one question that I have is the drug is an extended release version of a drug that's already been on the market for a long time. And so when you get that sort of situation, can be some weird things with patents, right? Because the drug that's been on the market for a long time is no longer under patent. So maybe they have a formulation patent that they can use that may, or that for the extended release part of the tablet, if that's under patent, then they might be okay. And then also the fact that they got it approved for an orphan drug indication, that gives them some like 6 or 8 years of exclusivity, regardless of whether they have a patent at all. So I think that's the one question that I haven't gotten into it, and you got to get into the weeds to figure that one out. But that's the one thing that I really want to understand before I would ever invest in this company is whether the patent, when is this going to expire? Because it looks like it's their only drug on the market. I mean, it's the only Prader-Willi syndrome drug on the market, but it's also their only drug, and it doesn't seem like they have any of the drugs in the pipeline. So basically, it's going to be valued on obviously the sales of the drug, but also when at its termination. And the other thing is it's going to be valued based on what the potential buyout price would be for a biotech who wanted to just buy this as just to have this one orphan drug. And so if that's the case, then what's the value there? It depends on how long the pharmaceutical biotech that would buy Soleno, how long would they be able to continue to get those revenues? That they're going to just backtrack and figure out what the value is right now based on the potential free cash flow from the drug over however long the patent is going to last.
Hold Long and Prosper 22 minutes ago asked a question for my favorite pilot. Have you seen the earnings report for Sky Harbor, ticker SKYH? Looked great to me, but do they have the resources to support their new project? So I'm going to share my screen here, and we're going to be looking at fourth quarter financial results. And you can kind of see, although it's a little bit misleading, folks, because the scales on these graphs are very different. So over here on the left, you've got the cost of construction and constructed assets going up. We're up to $250 million in the fourth quarter of 2024. That is supporting an accelerating pace of acquisitions and construction activity. Just a quick reminder, Sky Harbor Group is a company that focuses on building out infrastructure, primarily hangar space at some of the major feeder airports, general aviation airports surrounding some of the biggest metropolitan areas in the country. So we're not talking about like a JFK or a LaGuardia or something like that. We're talking about like a Teterboro, or in Denver, we're not talking about Denver International. We're talking about Centennial. These are airports that you're not going to get a commercial flight in and out of for the most part. But if you are flying, whether it's a private jet or a dinky little single engine piston like mine, then you know some of these airports pretty well. So you can see cost of construction going up. Quarterly revenue is going up too, but let's be careful here. Quarterly revenue, the top of this graph, is $5 million. Now, again, $250 million of spending, $5 million of revenue. You can do the math. We're still in early stages here. Operating expenses, $4 million. And you can see operating results well in the red. These numbers, it's the bottom center and operating results. These are all negative. The top is the zero line. And you can see outgoing cash flow as well is an issue. So from a financial standpoint, we still have a long way to go. So Hold Long and Prosper sitting there telling me, okay, well, that's great. How come the stock's now back up towards like $14 a share? And the answer is that this is expected. This company is at this stage in its development. It is building out these things. It is putting agreements in place so that they will start to get rental payments once the properties are built, once the projects are complete. But until the projects are complete, nobody's paying them anything. That's why your revenue is not on the very high side. So yes, revenue rising, good. Still losing money, bad, but not unexpected. In addition, they are making some acquisitions. They are making some improvements. In addition to a whole bunch of planned stuff, they have expanded their presence at the Camarillo Airport, northwest of Los Angeles, in the western part of the valley. They see a lot of potential in Camarillo, in part because the Santa Monica General Aviation Airport is the city of Santa Monica has been looking to close that airport for years. It looks like they're finally getting the process together so that it will close there in the next couple of years. I actually made a special trip out there so I could say I landed at Santa Monica Airport before they closed it. Prime real estate. I mean, you can understand why they're doing it. It's kind of, if they break up that airport and sell it as housing or sell it as commercial property, like the return is going to be huge. So I totally understand that, but
could they also, does that make the surrounding area, potential for larger high-rise buildings
yes.
too, right?
You can put buildings up, right? Because you don't have to worry about obstacle clearance in the flight path. The flight path often extends several miles in either direction and puts limitations on how tall a building can be. I don't know what it may well be that, Santa Monica being Santa Monica, they might already have restrictions like that for non-aviation things, more for sightline and things like that. But totally opens up all kinds of development aspects. And so Sky Harbor sees that as potentially driving more aircraft traffic north. Van Nuys is up there, but it's busy. And so Camarillo, a little bit further west, not necessarily as convenient from a ground transportation standpoint, but let's face it, if you live in LA, you're used to the ground transportation being lousy anyway. Also, new investment in Trenton, New Jersey, which serves to some extent both the New York and Philadelphia markets, as well as at Boeing Field, south of Seattle. Very well placed for general aviation stuff, and obviously Seattle's still a center in the technology world, maybe not quite the status that it had once upon a time with the with Silicon Valley kind of getting back its reputation, but still an important thing. And so I think that the model for the thesis for investing in Sky Harbor still intact, and that's rarely going to change from quarter to quarter. because it would take a major change in strategy. This was always a multi-year play, and so I don't see any change in the trends favoring general aviation, favoring private aircraft ownership. If anything, just look at the commercial airport horror story du jour, and you'll understand why anybody who has the means to do this is going to prefer private jets, and that's playing to Sky Harbor's strength, I think.
All right. Newbie asks, any thoughts on HealthStream? The ticker there is HSTM. And then at the other end of the spectrum, Johnson & Johnson, ticker is J&J. So HealthStream is about a $1 billion company. So not 975 million. So market cap. So not that small, but compared to a lot of biotechs, and it's not actually a biotech in and of itself. But obviously Johnson & Johnson's a large pharmaceutical company, so if we're comparing the two sizes, substantially different. The HealthStream, I don't know a whole lot about it. It's pretty thinly traded, so if you're going to buy it, you definitely want to use limit orders, because if you look at the daily chart, it's they're moving around like instead of going up nice and steady and going down nice, and it's jagged because there's nobody buying for minutes on a time. So definitely thinly traded. So keep that in mind if you just do decide to buy it. It's a pretty slow grower. They've guided for growth of 5 to 7% organic growth. So what this company does is they sell subscriptions for nurses and doctors to make sure that they're compliant with whatever they need to do. So whether that's making sure that they're credentialed and they've kept it up with the government, and making sure that they're doing their individual hours that they need to do to have learning for every so often to make sure that they're keeping up with things. That sort of thing is what they do. And then they provide some of the learning, and then they also have a scheduling system where they can help with nurse scheduling for these hospitals and other institutions. So I don't know. I think that it's pretty slow. It's not something that I'm super interested in because it's pretty slow growing at 5 to 7%. I think they've been trying to increase margins a little bit, which maybe will help the bottom line grow faster than the organic revenue growth of 5 to 7%. But it doesn't seem like there's much to get super excited about. I think that I don't know. It's just not something that I would be super interested in. But the one, I think, main advantage to it is that you could see how there might be a moat here where, once a company was one of their customers was using this system, changing it out and trying to track everybody with a different system might be too much of a hassle. And so maybe maybe that keeps people in. And so while they don't seem to be putting much effort into getting new clients, maybe they're not also losing very many clients. And so maybe it becomes a very sticky business. I don't know. So, and then on the other side, Johnson & Johnson, obviously, big pharmaceutical company, big medical device company. They spun off their consumer healthcare, so that's no longer that's now traded as Kenvue, and so that provided some stability, but also grew at a slower rate than their pharmaceutical products and their medical device products. So I think that the company will grow faster, but will also be more volatile over the next, 5-10 years, because they don't have that consumer health division that was providing steady revenue and growing in the low single digits. But, it provided, when there were down quarters for drugs because they ended up having generic competition, or the medical device slowed down because they had competition from another competitor that was taking market share from them, that consumer health division provided some bolus that was moving up into the right, even if it was slow and up to and to the right. And now that that's not there, the down issues are going to be more severe. Of course, the up issues, when they get a new drug that becomes a multi-blockbuster, a multi-billion-dollar blockbuster, that will also drive it higher, and they don't have that holding them back. So I think that's the pluses and minuses for spinning off Kenvue.
Yeah, it's an interesting spinoff, and it was one that I'd be curious. Full members, if you're watching, if you own Johnson & Johnson, if you have owned Johnson & Johnson for a while and you got that, Brian, was it a distribution? Did Johnson & Johnson shareholders get Kenvue automatically? It's ticker KVUE.
I think they had I believe, if I remember correctly, they had the option. They could buy them. They could trade their Johnson & Johnson shares for Kenvue shares, but they didn't have to. So they spun it off, and it was basically trading where Johnson & Johnson owned 90% of it. They IPO'd it, and some people bought in, institutional investors bought in at the IPO, and then Johnson & Johnson had the, other 90%. And then they allowed Johnson & Johnson shareholders to trade their Johnson & Johnson, some or all of their Johnson & Johnson shares for Kenvue shares.
Gotcha.
And I'm 90% sure that was what it was. That's how they ended up doing it. And then they did it that way so that Kenvue shareholders would be shareholders that wanted Kenvue stock, right? So that helped Kenvue in that they didn't want to. If they just had spun it off and
everybody dumps the shares if they didn't want them. Yeah.
Right. Everybody's going to dump the shares, and the shares go, and then the share price goes down. So that made better sense for the overall value of Kenvue. Johnson & Johnson ended up getting more value out of Kenvue by IPOing it and spinning them off, because then also that reduced their share count, of course, which increased their earnings per share.
Yeah, that's a great idea. Yeah, people should do that, because that's a common thing, is that a company will just do a straight spinoff and they will distribute shares to everybody. And a bunch of shareholders say, you know what, I don't want that. I just want the original business. And they sell the spinoff immediately. And then the price of the spinoff goes down, which is great if you want the spinoff and you want an opportunity to buy it cheap. But it's disruptive to folks who, don't get that chance, and there's often some tax consequences involved with, do you want to sell the spun off shares or not? How do you split the basis and stuff like that? So viewers, if you own Johnson & Johnson when you had an opportunity and you could elect to keep your Johnson & Johnson or get Kenvue or a bit of both, drop us a comment. Tell us what you did, because I'm curious to see if any of you out there, like what decision you made and why. Just a short comment would be interesting to see. Let me move quickly to a question from Ed from 34 minutes ago. What is the White House looking for with tariffs? A 1-to-1 equal ratio with all trading countries? Is that the end goal, or just to slightly even out the playing field? Ed, I'm sorry, you're going to have to ask the president that. The president has not communicated that the end goal of the tariffs. In my opinion, in what I have heard, I've not been able to figure out what the end goal is. That hasn't been communicated successfully. If the president has an idea and he's tried to share that with the American public, I haven't gotten that message. It may well be that I just don't understand, or I haven't been listening to the right stuff. I mean, I don't monitor what the White House is saying all the time, but from what I have seen and from many of the news sources that I tend to rely on. Again, I can't speak to their veracity. It's personal view that I have. I've not been able to, there seems to be a lot of confusion about exactly what the end goal, what the end result is going to be. And that's what has made things difficult for, people doing business with other countries, people who are trying to invest in companies that do business in other countries, and from just ordinary people trying to figure out, okay, am I going to have a job? Is my job going to change? Am I going to get laid off? Is my industry going to go away because of different stuff? It's not there. The communication's not there. And, I could speculate that there may be bargaining advantages to not showing your hand. But from the person, but I can't answer your question. That's a question you're going to have to direct, to folks who are closer to the president, who may know the answer, may at least have a better sense of what the answer is. And then For the Bees 15 minutes ago asked, ditto with the Ed question, are there any stocks you expect to carry in your portfolio for the next 10 years, either because they have already done well or because of their potential, and why? There's a couple that I'll mention. One is the one I always mention. It's Berkshire Hathaway, ticker BRK-B, and ticker BRK-A. Those shares, I'm going to go out on a limb here for the Bees and say, within the next 10 years, I think that Warren Buffett will have passed away. I'm not going to put that on our bold predictions list because I don't think it's a bold prediction. Life expectancy chart is going to support me there. But nevertheless, I don't think that Berkshire Hathaway's success ends with the life of Warren Buffett. I think that the company has a good succession plan in place. I think that the company will have new opportunities to capitalize on when leadership does in fact change. I'll be curious to see what direction the company goes at that point, but I'm confident that it will go in a direction that will be good for shareholders. So that's one. The other that I will mention here is Alphabet, ticker GOOGL, and I specifically suggest that particular ticker. Those are the voting shares, and they are less costly. They actually trade at a lower price than the non-voting shares. Somebody needs to explain that to me one of these days, because maybe I don't know. Maybe it's a comment on the value of the vote that a voting share would have a negative value compared to a non-voting share. But
maybe they just don't want all the proxy paperwork, right?
Maybe. I think the answer is that for whatever reason, the non-voting shares have become the shares that institutions like to trade back and forth, like the the liquidity might be a little bit better. And so, like the institutions who want to trade million share blocks, they're going to do the non-voting because there's other institutions trading million share blocks the other direction there. They don't have to worry about moving the price or moving the market. Last I checked, the volumes weren't that much different. So, but I'll have to take a look. I don't know, but
I think at one point they were the other. It was the other way, right?
It was played the other way. It's just lately, So let me amend my suggestion. If at some point the non-voting shares become cheaper than the voting shares, then feel free to buy whichever one makes sense. But like, I'm a big believer. They have equivalent liquidation rights. They have equivalent shareholder rights, except for you get to vote. Or if you don't want to vote, don't vote. But get a little bit of a bargain. And to be clear, like, we're talking about $1 a share or less than $1 a share off of a stock price in the 160s or 170s. So it's not a huge amount. But if you've watched me over the years, especially the financial planning shows, you know that I'm a cheapie, and also that I'll pick up a buck off the street anytime I can. And so, but that's not the point. The point with Alphabet is just that Alphabet's kind of my value-based play on technology, because Alphabet's not the top player in artificial intelligence, but they are in there. I think that they have the ability to kind of come back, be the comeback kid in AI. And so, it's part of more as a part of my personal financial plan than anything else. I'm a big believer in diversifying, and most of my human capital is involved in my human activity. And so investing in AI for me is a diversifier, that if something happens in the workplace, in the labor market generally, that the value of my human capital goes down, then my hope is that it's because AI is somehow taking over, and that AI stocks that I invest in will go up in value as a response to that. And so that's one way that I'm trying to diversify my portfolio. And I think that at the same time, I'm comfortable that Google has a business, or that Alphabet has a business over the next 10 years, kind of regardless of what AI's trajectory is. There's some uncertainty about, is AI the real thing? Is it going to continue at this pace? Is it going to hit hit a ceiling and then bounce off the ceiling, or is it going to break through the ceiling? Like, we don't know. But that's kind of the role that Alphabet plays in my portfolio, is to kind of be that hedge against, what, especially as I get closer to retirement, if the value of my human capital is going down, hopefully the value of that position is going up.
Yeah, I have a hard time keeping companies in my portfolio for 10 years because they keep getting bought out.
Exactly.
Especially in the biotech sector. It's
not a chance. Yeah.
I mean, it's so Vertex, is probably my longest at this point. And if it doesn't get bought out, I could imagine that I would hold it for the next 10 years because it's, been a nice grower, and they've been a fantastic. They've developed their drugs pipeline quite well. I recently bought Moderna. I think that one also could potentially become a pipeline, and their platform of mRNA drugs can potentially generate so many different drugs over the next 10 years that I could see owning that one for 10 years. But there's a lot that I've owned for 5 or 6 or 7 years and end up getting bought out before I can hold them for a decade for sure. So Jeff mentioned on talking about Soleno, SLNO, Jeff points out that most people, they're not on most people's radar until they go up 40% or more. And I think that's generally true. When I started in biotech, there was probably, I don't know, maybe 100, 200 biotechs. When I started covering biotech, 17, 18 years ago, there's probably only a couple hundred. And now there's, over 1,000 different biotechs. So the ability to cover them all, even as an analyst, is pretty hard. And then, if you're a cursory observer of biotech, I think it's even harder. What's interesting here, and I don't know the full story here, but usually stocks don't go up 40% on FDA approvals, because usually by the time we get to an FDA approval, we've already seen the phase 3 data, and the phase 3 data was either promising, in which case the stock got driven up, or was poor and the stock got driven down, and the company doesn't go and get in and apply for an FDA approval. So it's sort of interesting that the value yesterday or Wednesday was for everybody knows that the FDA decision is going to come. So there must have been something that was causing investors to think that, for the fact that the fact that the valuation was 40% lower than it was on approval, it seems likely that there was something that was keeping the valuation down, that where investors weren't convinced that the FDA was going to approve this. And I don't quite understand exactly what that is, because I again just started looking at it on Thursday. But usually I think 10 to 20% is more of a more reasonable quite a more reasonable level of what you would expect for any given, the average FDA approval. You would expect more like a 10 to 20% bump. There is some risk that the FDA might make a decision, but 40% discount is usually pretty extreme. That usually means that there was something in the data that gave investors pause, because, while I can't track every biotech, somebody's looking at them, and so eventually the valuation should be about right. And then Emmerich asked 10 minutes ago, how do you create a solid dividend portfolio? So I mean, I don't know, I'm not a big dividend person, but if I was going to buy dividends, I think I would shoot for dividends that I thought could continue, right? So oftentimes the highest dividend payers are ones where the dividend is least likely to continue. So I think that's the number one. I think I would shoot for something in the 2 to 4% range, and anything higher than a 4% yield, I would start looking at whether that's sustainable. Some of them are, especially if it's like a REIT, real estate investment trust. Those are certainly options where you can get higher than 4%. I think Pfizer is at 6 point something right now, and that 6 point something is sustainable. That dividend is sustainable. It's not going to grow very fast. They've been, if you just look at this history of the last 3 or 4 years, they've raised it 1 penny per quarter each each year, and that's just because they want a history of raising their dividend, but they're they're getting to the point where they're pretty close to their free cash flow. The reason why it's so high is because investors don't think that the valuation for the underlying stock is going to go up that much, so they need that 6% dividend yield to justify owning it right now, and that they'll hopefully get another 2, 3, 4% in growth of the stock itself, and that would get them to a decent return between the dividend and the yield. And then that brings me, I guess, to my final point, which is that you shouldn't just be looking at the dividend. You should also be looking at the potential for what's going to happen with the underlying stock. And we talked about the dividend not being able to be sustainable. That's probably going to result in the stock going down if they cut the dividend, but also just what's the health of the company, and how much is the underlying stock going to go up, because that may be a bigger addition to your overall valuation increase in your portfolio than the dividend that you get for each quarter or month.
Yeah, I agree with all of that. And I think too that, Brian touched on something I think is very important, because one of the things that we'll often say is that look less at dividend yield, current dividend yield, and look more at dividend growth over time. And there are lists of stocks. There's one in particular that looks at stocks that have raised their dividends each single year for the past 25 years. And a lot of people put a lot of value on that list. There's only like four dozen stocks or so on that list. But when you look at that list, there's a decent number of stocks that do exactly what Brian was talking about Pfizer doing, which is, yeah, they raise it, but they raise it by like a penny or half. I've seen some that's like a quarter penny or a half penny. And it's just kind of like, all right, I know why you're doing this. You want to stay on the list. And it's like, okay, fine. I mean, it's good that you can maintain a dividend, but I'm not giving you any extra points just because you raised your dollar a share dividend by half a cent. Like you could have left it the same, and in my view, that would have left things differently. But you do have some stocks where that dividend, it does go up, and it goes up by a relatively strong percentage. Anywhere in like from 3 to 5% up to like 5 to 10%. I think.
Yeah, I was looking at Eli Lilly the other day, and the last 3 years in a row, they've increased their dividend 15%. Now it's only it's only a 0.6% dividend yield, but they've increased it the last 3 years in a row or 4 years in a row at like approximately 15% each year.
And I bet, without having looked, I bet that that's probably still slower than what its free cash flow has done.
Right. Yeah. Their payout ratio is like 40% right now. Because of course they have the obesity drugs, and that's generating a lot of free cash flow.
Last thing I'll say, Emmerich, about dividend stocks is that we do have here on Full 24, we have a dedicated dividend show. Say that 3 times real fast. If I recall correctly, Aunt Chavone and come on, Mike, help me out. Oh, doggone it. Oh, this is embarrassing.
Matt
Argersinger. Thank you, Brian. Do a dividend show every time on a regular basis. I think it might be every week, might be every other week. I can't recall, but check the video library. You will find all of that there. My producer, Mike, says every 2 weeks. Thank you, Mike, so much for saving my bacon there. Let me close in 1 minute. And Jeff, you're going to think this was unfair, and I apologize for that. But Jeff M asks, is quantum computing going to be as big or bigger than AI? If so, do any of the quantum stocks stand to be the next NVIDIA, ticker NVDA? Stocks mentioned are tickers QBTS, Rigetti, ticker RGTI, the ARK Invest Fund on that ARQQ, and I think it's Qubit, QUBT. Jeff, if I were going to play quantum computing, I'd probably play quantum computing with the big companies that are working on it and not with the small companies, just because I'm not good enough to pick one small company, one small disruptor from another. And what I can imagine is that if quantum computing turns out to be successful, that a handful of disruptors will do well and a much larger group will fail, or they'll get bought out, or they'll go away somehow. but they won't be big success stories. And I just, personally don't feel like I've got the, the ability to tell at this point what it's going to be. I don't know if it's going to be bigger than AI. Like, in many ways, it depends. I mean, hardware stocks generally have not fared as well as software and services style stocks. And so to the extent that quantum computing is going to be all hardware, I kind of wonder about it. But of course, NVIDIA, mostly hardware. There's still some software. There's still some services involved there. But NVIDIA is made a boatload of money on the hardware side. So there may be room for these stocks. I just don't know the answer to that. So Brian, that brings us to 7 o'clock for me, 4 o'clock for you on the West Coast. And so let me take our pause here for the Ask Us Anything segment and thank the folks behind the screens for bringing us to you. And with that in mind, let's start the Bold Predictions show that we're going to end this Saturday, March 29th, 2025 on. And again, fools, I mean, the general idea behind this show is that Brian and I try to make some predictions. And ideally, they're bold, but that's kind of up to you. One of us is going to make the prediction. The other of us is going to tell us what they think of the prediction. We're going to do a poll, and you're going to get to tell us what you think of our prediction. And we're going to try to crank through several of those before we go.
And you can also ask us questions on the
yes,
site.
Please do. Yeah. Please do ask those questions because there's time for all of that stuff, and yeah. So Brian, I'm good to go if you want me to go first, or if you want to go first.
No, go ahead.
Okay, so let me get my stuff together. My first prediction, let me pull up the right spreadsheet here, is I'm looking at 2 leveraged exchange traded funds that are tied to the NASDAQ 100 index. And my prediction is that both the ProShares Ultra QQQ ETF, which is ticker TQQQ, and the Ultra Short QQQ ETF, which is ticker SQQQ, that those will underperform the Invesco QQQ Trust over the next 5 years. Okay, that was something that, yes, that's a lot of alphabet there, and I apologize for that. So let me try to put that into, because these have to be measurable and determinable, and so that's the formal prediction I'm making. But basically what I'm saying is that these leverage ETFs, they're both going to stink compared to just buying the index fund. And that I want to show you my argument for that, and it is based on something that I looked at. So I'm going to share my screen here, and we're going to take a look at a couple of time periods to kind of explain how this worked. And so just to give you a sense of what we're talking about here, these exchange traded funds, these leveraged exchange traded funds, are designed to give you a multiple of the daily return of the underlying index. And depending on which ETF you have, you can go in the same direction as the market or the opposite direction of the market. So ideally, when these things work, if the NASDAQ 100 goes up 1% in a day, then the ultra version, the bullish version of these leverage ETF, it will go up more than 1%. In fact, if I recall correctly, these ones, they go up 3%. On the other hand, the short version of the ETF is designed not to go up 3%, but rather to go down 3% if the underlying index goes up 1%. And so the idea here is, if you think the market's going to go up, you want to make a big bet, you want to be a big winner if it goes up in a day, then you buy the ultra version, the bullish version. If you think the stock market's going to go down, you buy the ultra short version, because the ultra short version will go up if the market goes down. So what we're looking at here is 2022 to give you a sense of how these things work. 2022, a bear market year. NASDAQ did terribly. You can see, although the print is probably bad. Here, let me see if I can do the large. Large is always the right choice here. Even so, the print is still very small. Down 33%, that Invesco QQQ Trust investing straight in the NASDAQ 100. We all know it was a terrible bear market for 2022. As you would expect, the ultra bullish version did even worse. It was down 79%. And that's what you would expect because it was a leveraged bet. It would fall more than the overall market. However, if you were bearish on the market, you got a big payday because the bearish version, the ultra pro short version of this, had a return above 80%. It was 82% positive return because these were generated to the intent of these ETFs is the inverse will go in the opposite direction of the market. Now, to give you the other side of the coin, let's fast forward to 2023. I'm going to show you another chart. This is 2023. Here we had the market rebound. The NASDAQ up 55% in that year in 2023. And as you would expect, the opposite was true. And so what you had here, Pro Shares Ultra Pro Short, the bearish version, well, it did terribly. Why? Because the market was up. It was down almost 74%. Meanwhile, the Ultra Pro, the bullish version, was up almost 200%. It almost tripled. In fact, that was even more than the 3x that you would have expected. Why? Because it's a daily return. It's not you can't trust these ETFs to track over periods longer than a day. The compounding works different from that. And so you might be looking at this, you might be saying, well, okay, yeah, Dan, how is this ever going to work out? How is this ever going to be that, like, I mean, if it's bullish, if the stock market goes up, then the bullish version, the leveraged bullish is going to go up more than the regular bullish. And if it's bearish, if you have a bad market, well, the bearish version is always going to do better than the market because the market went down, the bearish one's always going to go up. But it doesn't work that way. The way I'm going to change this chart, I'm just going to combine it so that it's both years shown at the same time. And you can see here what happened. Well, you had a really bad year followed by a really good year. That resulted in a 2-year total return for the NASDAQ 100 of 4%. But as you can see, that short version of the ETF, it was up in that first year, but then it was way down the second year. By the end of the second year, its net loss was 52%. Meanwhile, the bullish one went the other direction. It lost a lot more in that first year than the NASDAQ 100 did. Yes, it tripled the next year, but it tripled from having been down 80%. And so when it tripled, it only got back up to minus 38%. And so that was a situation where that happened. And so my prediction is that that's going to happen again. You're going to see enough of this kind of up and down that it's going to end up working out that way. Brian, I'm going to stop there. What do you think?
Yeah, we don't have any questions. It doesn't look like the poll is open. I think that basically your argument, I mean, you've already said it, but just to reiterate, your argument is that I mean, if it went up and to the right for the next 5 years, that you'd be wrong, right?
Yes, that's
and
correct.
If it goes down and to the right for 5 years, you'd also be wrong.
Yes.
But if we get some volatility in the next 5 years, where we have a year or two that's up and a year or two that's down, that the end result, over those 5 years, and maybe we got a level year or something, that over those 5 years, that basically the other way of saying it is we're going to have some volatility, right? That's basically what your prediction is, and
enough volatility to make it work that way. Because I mean, just bear in mind that example that I showed you on the screen, like, I mean, that was the worst bear market that we'd seen in a while, and then we had a 50% up year for the NASDAQ. So it takes some volatility. Like, minimal levels of volatility won't necessarily be enough to undo it. But what I'm saying is that you're going to get enough of that volatility that you'd be better off sticking with the index rather than going with these leveraged ETFs. And to be fair to the leveraged ETFs, they make it very clear they are not designed for long-term investors. So the people who try to use them for long-term investors, the ETFs themselves would tell you not to do that. That's not the way that they're generated. But even so, people still some people are still doing this.
Right. Okay. So we're going to close our poll pretty soon here. So get your votes in on Slido. And if you have any questions for Dan on this one or me on the next one, get those into the Q&A. There's two different tabs on the top of the screen, one for the Q&A and one for the poll. And so I guess we'll go ahead and we're at 10 minutes in. So we'll go ahead and close. And 75% of people. Oh, I agreed with you. First of all,
Okay.
I think that if you told me, if you'd done it over 3 years, I probably would have gone with I would have gone against you. But I think over 5 years, I think there's probably enough and going to be enough volatility to figure that out. And three quarters of the people said that they agreed with you and me, and there was one person who needed more information before they could get more before they could do it.
Cool. Thanks, folks.
All right. So all three of my predictions are for medical device companies. My first one's for Intuitive Surgical, ticker is ISRG. And my bold prediction is that they're going to have an installed base of their Da Vinci systems of at least 15,059. So 15059 by the end of 2027. And so just to give you some historical information, in 2021, the installed base grew by 12%, 2022, 12%, 2023, 14%, and then last year by 15% to 9,902 systems. If you add 3 more years of 15% growth on top of what they ended 2024 with, that's how you get to 15,059. So another way of looking at this is I'm predicting that the installed base on average will grow by 15% over the next 3 years. And so I think the main growth driver here is the multi-port machine. They installed 1,430 of their multi-port and only 95 of the single port machines in 2024. The ability to go in at more than one position has allowed the surgeons to increase the number of procedures, the different types of procedures that they can do. They actually figured out at the beginning of 2024, in January of 2024, Da Vinci, Intuitive Surgical figured out that the number of potential procedures that they could do annually was 7 million. They weren't doing necessarily all 7 million, but that was the based on what had been proven that they could do with the Da Vinci system. They were at 7 million. By January of 2025, that was up to 8 million. So the doctors are the ones that are driving this and allowing them to increase the number of potential procedures. With each one of those potential procedures, the use of the Da Vinci systems get more and more used at the hospital, and then the hospitals have to buy another one of these Da Vinci systems so that the doctors that have invented these new ways of doing procedures can do the procedures. So the number of hospitals that have 7 or more Da Vinci systems is now 63%. So of the hospitals that have at least one Da Vinci system, 63% of those have 7 or more. And then acute care is also driving this. So the amount of acute care, so that would be somebody comes in and they need a surgery right now versus a scheduled surgery. Most of the procedures that Intuitive Surgical has been the doctors have been doing on the Da Vinci Intuitive Surgical systems have been scheduled surgeries, and now acute surgery is doing it. My daughter had an issue, went into the ER and ended up getting a surgery that day with a Da Vinci system, and that the acute care has grown by 33%. So I think that that will also be a big driver to allow them to grow at 15% per year.
All right, so let's see. Did we get any questions from? No questions from viewers at this point. I wonder. So 15%. Brian, what do you think about the? I would make the argument. Let me play devil's advocate here. I would make the argument that in a period where we are starting to see some macroeconomic concerns, we're starting to see consumers pull back a little bit on consumer sentiment, on consumer spending. Obviously, it doesn't necessarily translate into healthcare spending. And so, you need healthcare, you need a surgical procedure, you're going to get the surgical procedure. But I do believe that Intuitive Surgical does have some elective procedures that its units are used for. And the medical institutions that buy these, that make the capital expenditures for these, may be subject to, they get increased donations or decreased donations based on macro and stuff like that. How realistic is 15%? Do you think 15% is just kind of like what the average is that you can expect, like pretty much, as far into the future as you would go? Or do you think it's on the, like how bold do you think that is? Because my first glance, I'm looking at this and I'm sort of like, boy, recently has been a pretty good environment. Now maybe we're going into an environment not necessarily as good. Are these systems going to keep getting bought? I guess is really.
Yeah, I think it is bold because I think based on the 2024 growth basically I'm expecting 2024 growth, and if you look at the 3 years previous to that, it wasn't 15%, right? So I need the growth to continue, and I think the multi-port is going to be a lot of that. Is going to grow the number of potential procedures, and then that will spur on the leadership that makes the ultimate decisions on whether we get whether they get a new machine. That a lot of times the ability to do these procedures well will results in better profits and better customers being happier with the hospital. And so I think there's a lot of driver there. But you are correct, in a bad capital market, that could be a problem. Now, maybe the advantage is if we go into a recession, then maybe interest rates go down. And if interest rates go down, then maybe that allows these companies to buy on credit, and so the hospitals buy on credit. And actually, a lot of the hospitals now are using Intuitive Surgical as their creditor, so they're actually leasing the machines rather than purchasing the machines. So you could imagine that that's another option and way that I could still meet my goal even if we do end up in a recession.
Got it. All right, we've got comments. I'll just read For the Beast comments, not really related to this, but For the Beast saying, great finish to a full day of listening. It's April action month. I'm planting my farm, walking in wildflowers. I'm moving money. I'm buying stocks. For the Beast sounds like a good day. I tell you, I wish, it's still cold here in the Northeast, so I'm jealous of folks that are getting a taste of spring. But I signed up for this. It's not like I get Brian in San Diego. I kind of think it's probably it's.
I did have to wear. I had to wear
all the time, right?
Yeah, yeah. Well, yeah. My plum tree's already started. Has already bloomed and has plums on it. So yeah.
All right, let's get these. Let's get the poll results in. We got 1 minute left. Mike's counting down the clock here behind the scenes, and it's a close one. So if you haven't voted, get her in. Let's get this done. Let's see what happens. We want to make sure that everything comes in. Mike's going to do the countdown. I'll tell you what, Brian, I don't know. Boy, DigitalOcean, that's a tough one. I'm going to have to think about that. Newbie, I will get to your question, but I'm not going to get to it right now because I got to actually look at it before, and I got my prediction ready. And so let me just run out the clock here with the poll, and let's see, 1 minute is coming, and running the clock out here. Mike, tell me how many seconds I got to wait before we can call this. Now is good. All right, so it's a disagree. This Brian gets extra points for the disagree. I disagreed
I
with
definitely
Brian.
went bold. So I mean, I was trying to go bold. So
Good for you. It was a good bold comment because yeah, I agree with that. We got one in at the buzzer, but 50% disagreed with Brian. 33% agreed that Da Vinci Systems would go would get that go well above go above the roughly 15,000, and then one needed more information. So we'll count that, and if Brian is right and I am therefore wrong, then yeah, then there's extra bonus points for that. When everybody agrees, like, okay, fine, it usually means that we weren't bold enough. So good for you, Brian. Thank you for making the bold call. All right. Let me move on to my number 2. And my number 2 is at least a little bit less full of letters than my first one was. Mine's pretty simple. Gold will outperform Bitcoin from now until the end of 2025. And I just want to put up a chart here of just to, I don't know whether people think this is bold or not, but, I know that there's a lot of people who follow Bitcoin who are shaking their heads and thinking, Dan, yeah, you're making the same mistake everybody made. And here's the chart that says why this might be a bold call, because we're looking at the chart, and I just want to say this is my fault, folks, because I don't know Y charts well enough to change this up. Because if I knew Y charts well enough to change this up, then gold would be gold and Bitcoin would be purple. But I didn't do it right. I didn't figure that out. You know what?
it's in the annotate section of the upper left corner. If you,
I'm gonna totally fix this because it's
and
so
then click
silly.
on those.
You gotta make it gold, because gold is gold, folks. I mean, come on. And so the Bitcoin can be purple. I'm sorry, this is live TV, folks, and I'm a little bit embarrassed, but sometimes you just have to get it done. Sometimes
I feel like Bitcoin should be blue. No, isn't that their like logo? Isn't it blue?
Oh, blue?
No?
Okay.
I don't know.
Let's get her done here.
Maybe I'm wrong. I don't know.
Is that a good blue?
I thought it was more of a royal, but it's okay. It's just, we'll leave it there.
That's what you get. Yeah. I mean, actually, now that I think about it, a lot of the Bitcoin stuff is gold because they want to make it the digital gold, but let's just leave it like this. So this is a 10-year chart of gold versus Bitcoin. You can see Bitcoin has moved up, and it's gone up, and then it's gone down, and then up and way down, and then up again, up 34,000% in the past 10 years. Gold here, it looks like it's done nothing. And comparatively so, that's the case. Up 147% over that timeline. Let's bring it back to 5 years now. Bitcoin up 1,220% in the past 5 years. Gold up 87%. So we're looking at this and we're saying, Dan, what the heck are you talking about? Why would Bitcoin, you're messing with history here. History says that Bitcoin is going to do better than gold. Well, here's an interesting thing. Okay, yeah, 3 years, Bitcoin up 80%, gold up 59%. Okay. Huh. Well, that's a little bit closer at least. Well, but okay, fine, Dan. You timed this, the 3 years, unfair because you timed it right when at the beginning of 2022, Bitcoin had reached a new high. Then we had the crypto winter. We were down. You can see it was down as much as like 65% from that. And then it bounced back, as it has done historically every time, to claim its rightful place. And so you take a look at that and you say, Dan, what the heck are you thinking here? But I'll tell you what I'm thinking. I'm thinking that gold has been on the ascendancy. It's been funky, actually. Gold is, in an environment of tariffs and tariff uncertainty, there's been a lot of movement of gold. People are scared that gold is going to get tariffed and that it's going to prevent the free flow of gold bullion between countries. That has actually shown up in the futures market. There's been a big transfer of physical gold across the Atlantic in response to the possibility that if financial companies have to deliver on futures contracts, then they're not going to be able to deliver without paying a big tariff, which is going to cost them a lot of money. It's the last thing that they want to do. And so we have seen gold prices go up in the recent past. We've seen gold prices go up above the $3,000 mark for the first time in history. Meanwhile, we've seen Bitcoin kind of struggling. We were up above 100,000 for a while, but now we're back down in the 80 to 90,000 range. Still have a bunch of pro folks saying that, they keep buying. Michael Saylor over at MicroStrategy, Strategy, ticker MSTR, buying the Bitcoin. We got GameStop, ticker GME. They're starting to look at buying the Bitcoin. There's still a lot of Bitcoin interest. But I'm going to say, at the same time, a lot of folks say, well, gold doesn't produce any income, doesn't produce any, it's just a lump of metal, costs money to store it. Bitcoin, at least you have digital wallet and you're done. And so, Dan, why would you think gold is going to go up? I just think that a lot of people think gold is shiny, and I'm going to predict. I don't know if Bitcoin's going to be able to rebound, but I'm betting that gold continues along its way, that we have continued tariff uncertainty, and or that Bitcoin remains in this kind of short-term slump. Again, this is by the end of the year. We're looking at from now until year end of 2025. So this is a pretty short. This is a pretty short deal. And Brian, you said before that you like you might vote against me on these short-term deals, and so I'll stop talking. What do you think, buddy?
All right, the poll's open. We don't have any questions for you, but I do have one. Okay, so if I have a newspaper that shows the results and I'm reading it to you right now, so I got a newspaper from January 1st of 2026, and I'm reading you the results, and I'm telling you that both of them went up. Yep. Or I'm telling you both of them went down. Which one are you feeling more confident in your prediction? That if both of them went up, are you feeling more confident? Or if both of them went down, are you feeling more confident?
Oh, that's a good question. I'm gonna have to think about that for a second. My gut instinct is that if both of them go down, then I'm a little bit less comfortable with gold not being the one going down more. If they both go up, then I think gold's going to go up more.
Huh. I would have guessed the other way. That
I know you would have.
I would have figured that Bitcoin would be more volatile, and therefore, if they were both up, that Bitcoin would be up more than gold, and if they were both down, then Bitcoin would be down more than gold.
Totally understand that thought process, and I think that's part of the boldness. Is that I'm just thinking that, there's a chance that they're going to both keep going up. But I think that if Bitcoin goes up, I think it might have a tough time breaking back through. Oh boy, I hate when you're making me say this, and now it's going to be wrong next week. I'm going to continue the train wreck while I'm on the track. I think Bitcoin's going to have a trouble getting back above that 108,000. I think it's going to have trouble setting a new high. All right, I said it.
All right. The poll's still open. And then, so VK asks, what are your thoughts on ticker GOLD? I guess that'd be, basically, is that a good way to own gold?
Oh, wait a minute. Okay, let me double check this because ticker GOLD.
Maybe that isn't gold.
That is a different. Last I checked, that was Barrick Gold, if I remember right. Yeah, that's Barrick Gold. That's a mining company.
All right.
So VK, I haven't looked at Barrick for a long time. The usual argument for miners versus just owning the physical is that the miners are kind of a leveraged bet because Barrick will pay a price to produce gold. It costs money to dig that gold out of the ground. And so when the price of gold goes up, their operating margin goes up by a higher percentage than the price of gold does. And so its earnings ideally go up by a higher percentage. And so you would expect the stock price to go up by a higher percentage. Same way on the downside, though, the volatility tends to be higher. There are some company specific things that I haven't looked at. So I don't know if Barrick is having issues with any of its mining properties or anything like that. But in general, yeah, I mean, I tend to use an ETF of gold miners. It's ticker GDX. It has a bunch of different gold miners in it. And so if I were, looking to make a diversified bet on mining companies benefiting from higher gold prices, that'd probably be the way that I would suggest playing it. But there's different things. I just don't know enough about the individual company.
All right. If I was allowed to pick, I need more information. I would have picked, I may need more information because I need a like crystal ball to figure this one out, because I'm not exactly, I don't understand why Bitcoin changes at all. I don't understand why gold changes valuation at all. At least I can sort of understand gold, in that there's a, at least a somewhat of a market for it in terms of jewelry. But I voted against you, Dan, just because one, it's short term, and I figured it was, and then actually a majority of the people also voted against you and disagreed with you. So 57% of people disagreed with you and 43% agreed. So we will move on to the next bold prediction from me, and that's that Novocure, this is the ticker is NVCR, triples its revenue from 2024 to 2027. I think this is my boldest prediction I've made in all of the bold predictions that I've made. This is, I think, my fourth show, and I feel like this is my boldest prediction yet. So if you don't know, Novocure develops machines that deliver tumor treating fields. They they produce electric fields that line up the chromosomes, and then if the cell divides in a different direction than the lined up field, then the chromosomes end up going in weird directions, and the tumor cells ends up dying. So it's been given it's approved for mesothelioma, which is a very, very small market, so small that they don't even bother breaking out sales, and glioblastoma, which is essentially brain cancer. And then they've been approved most recently for lung cancer, and then in December they got an approved phase 3 clinical trial success in pancreatic cancer. That I don't believe they've, as of the last thing I've heard, they haven't filed for approval yet, but that should be coming this year, presumably. So revenue grew 19% in 2024. So you would think that it wasn't that bold that we could potentially get to a triple over 3 years, but that was mostly due to France having makeup payments. So the way France works, you get one price set, and then you continue to sell your drug or your treatment in this case, and then they eventually come to a price a couple of years down the line, and then you actually, if assuming the price is different, the end price is different than the beginning price, then you end up with you end up with getting the difference. So that's where that 19% growth is coming from. It's not actual growth in new patients. It's just growth. It's just makeup payments. So they've guided for low to mid single digit growth for glioblastoma for at least for 2025 this year. So if we just assume that's going to happen for the next 3 years, that's basically 15% growth. And then they've got lung cancer. It's a very big market, but it's a big unknown because the clinical trial was sort of it wasn't designed well, because the first line indication, what patients normally get when they're first diagnosed, changed between when they started the clinical trial and when they finished the clinical trial. At the beginning, patients were getting chemotherapy, and now they're getting checkpoint inhibitors as their first line. So when they look, chemotherapy plus tumor treating fields helped patients live longer than chemotherapy alone, but that doesn't really. And then there were some people who got checkpoint inhibitors, and that also seemed to be improved, but it was a little complicated there. And so whether doctors are going to use it in combination with checkpoint inhibitors is still a big unknown, and we'll know in a couple of quarters whether that growth is going to happen. But I'm thinking maybe we can get another 30% of the current glioblastoma sales, as lung cancer over 2025, 2026, and 2027. That seems, given the fact that lung cancer is such a much bigger market than glioblastoma, that feels like it's a reasonable guess, but certainly not a huge bold guess. But it's bold, but not insane. I'm not saying that they're going to get as much. Even though lung cancer is a much bigger market, I'm not even saying they're going to get as much as glioblastoma, as the glioblastoma sales were in 2024. And then pancreatic cancer was they had a positive clinical trial in December, so presumably they'll submit this year, get full approval in 2026, and then we'll have 2027. We'll have a full set of sales there. So if that can create another 50, and again, pancreatic cancer is bigger than glioblastoma. So if we can get 55% of sale of the glioblastoma sales in 2027, between the 15% growth in glioblastoma, the 30% of sale of glioblastoma sales as in the form of lung cancer sales, and 55% of the glioblastoma sales in the form of pancreatic cancer, that would get you to 100% increase, or a double, from 2024 sales to 2027.
Okay, so let me see if I can sum all that up. Basically, you need the trifecta, right? You need in order to get to triple, like you need all of that to work. Yes. Does the math work? Does the math work if you miss on one, but
I think the one that I'm probably, I don't know. The one that I feel most confident in is the glioblastoma. I feel like the glioblastoma could actually grow faster than that. Okay. So I think if I miss on lung or pancreatic cancer, I feel like there's a little bit of makeup that could happen for glioblastoma. I think that a 15% increase from 2024 to 2027 might be a little on the low side. It's at least cautious. The other two are a little more bold. I think lung is just a big unknown. Like, that was just a wild guess for me to guess 30%. I think it's a reasonable, they're going to launch this year. Maybe they get some traction in 2026, and then maybe in 2027 there's enough doctors who have experience with it that they're willing to use it in combination with the checkpoint inhibitors, even though the data isn't super strong. The main advantage is that it's a medical device, so it can be used in combination with any drugs and doesn't really have any extra side effects, right? So it's not like adding two different drugs can often have side effects that are worse than each one of the individual side effects. In this case, it doesn't make the side effects any worse. Maybe you get a little skin, so maybe it's a little skin irritation, but otherwise it's a fairly safe treatment compared to the average chemotherapy or targeted therapy drug. So for cancer. So I think that's the lung is probably the one where I'm most worried. And then I mean, pancreatic, the issue, I guess, is just that I'm cutting it close. Maybe I should have gone with 2028 and given them two full years to develop that market. So I don't know.
Be bold.
But I was bold and I went with 2027. I almost literally, as I was writing up my notes, I was like, oh, maybe I should change it. And then I didn't, because I decided I would just go bold. So
good for you. Good for you. Luella comments. Luella's voting agree. Luella agrees with you, Brian, because I desperately want Brian to be correct. I've discovered my desire for a good for the world company to succeed. It lures me into over-investing, Luella. I get it. I mean, David Gardner's, comment in, invest on how you want the world to be. It is a compelling argument, but it is one that, like, it doesn't always work out. And then you get the double hit, right? You get, not only did the world not become a better place the way that you wanted it to, but you also lost money on your investment. That's just, it doesn't work that way. But, Brian, I am sure, appreciates the support. Mike, how are we doing on time? It looks like it's a close one. It's another close one. Fools, thank you for participating, by the way. I love when these are close. One more minute. Okay, so let me fill just a little bit more here. I'll mention for the B's, it was talking about the past poll, but do get your answers in on the poll on Novacure, ticker NVCR. For the B's on my cryptocurrency versus gold, says, not a crypto fan. I dislike the local crypto mines. They popped up in our unregulated, beautiful mountains. They are loud. They are energy hogs, but they are popular for many investors. Just not me. For the B's, I've said it before. I'll say it again. The nice thing about investing is there's different ways, to get to where you need to be. And you can choose to rule out a certain asset class if you want. You can choose to concentrate on a different asset class if you want. Oftentimes, there's more than one way to get that done. All right, we're going to close the poll, and oh wow, it's 50-50, folks. Wow. So I disagreed. I said Brian was too bold. But if you take my vote out, the viewers agree.
Take my vote out. So.
Oh yeah, okay. All right, fine. So the view, 50-50. But yeah, no, that was a good call. That was fun. I like that. And yeah, Luella, totally agree. This is one where it's sort of like, like how could you root against it, right? Because you want there to be success. You want there to be a wider range of patients that are assisted by a groundbreaking technology. And it's an interesting, the science behind it, very interesting. I'm particularly impressed anytime that you have a company that, like, it's not just changing a molecule here or like, one little shift to something. It's like out there, but it's groundbreaking. It's innovative. They're often companies like that are controversial. You get people that are sort of like, oh, this guy's way out in left field, but then you do the scientific process and you find out. That is something that
was literally my process when Brian Feraldi first suggested this to me. I'm like, that's crazy. What the heck are you talking about? Using electric fields to stop tumors? I was like, then I looked into it more and I was like, oh, works, man. That kind of makes sense. I can see how that could work.
If it works. Yeah. So rooting for Novacure. All right. My last prediction is OpenAI, the privately held hybrid nonprofit with for-profit subsidiary. OpenAI will still have its nonprofit structure at the end of 2025. So this is one I chose not to do the slide. I thought about doing the slide. There's a slide that purports to show OpenAI's corporate structure. I thought about including the slide. Eventually, I decided not to include the slide. Why? Because it's too darn complicated. There's just no way for me. Like, it would have just confused things to show you the slide. So, Brian, if you disagree with that, if you want to go, like, it's not hard to find the slide. A simple Google search will do it. So, if you want to one up me, feel free. But let me just try to describe it in very simple terms, in as simple terms as possible. Most of the time, when you have a charitable organization, a nonprofit, it is set up. It's not a business. It generally doesn't generate business income. If there is like a little bit of a side business, then like that can be okay. But usually the side business will get taxed. So it's not a tax exempt